Yeah. So we'll now commence our session without any delay further. So what is the main purpose? Why we have gathered all here? You all are aware. So we are required to do a successful marathon in this 2 days of time available, whatever we have. Yes, the time is very limited. I know it, but we'll make a proper utilization of all the time, whatever we have. And within this limited amount of time, I will be promising you to cover all the major areas, all the key chapters, all the key concepts from the auditing paper. And this should be a participative. The whole objective of see this, I could have done it as online live also, but whenever I have an option, I always go for face to face. The only objective why I do this face to face session is because the session becomes more interactive. Okay, so let us not kill the purpose. Let us make proper utilization of this face-to-face marathon, where it should not be just one-way communication where I was continuously speaking. I get bored. If in front of me there is no one, okay, to some extent it is okay. Without the response from the other side, I can tolerate. But you guys are sitting in front of me, and you should be participating so that we can have more productive discussion going forward. Okay, is that okay with you all? Now only you're not participating here. Okay, you will participate it, right? So if you are getting lazy after a hour or so, I can understand. But just now I have started. Now itself I'm not getting the response from you. It should not be like that. So please be participative and give me all the energy required so that we can have a very good session. Okay, right. So having said that, I'm directly going into the discussion. So we have all this bunch of chapters which are required to be covered. So as you could see here, we are having the bunch of chapters. And first of all, where to get all these resources? You might have a doubt. So where to get all these resources? So just you can visit the website. So this I'm writing it here: www.fingainsacademy.com. So just visit that website. Go to the yeah. So as I was saying, whatever resources that we are going to make use of for this marathon, all these resources you'll be able to find it at this website. So just visit the website and go to the free resources section. In that free resources section, select the subject accordingly, and there you will be able to get all the resources. From there, you can get the soft copies and all. So having said that, so now without delaying any further, we'll go into the conceptual discussion. See, this marathon I usually take with a notion that you all would have done your preparation at least once. Can I go with that presumption? Definitely, right? Fine. So, if you have prepared already, if you have done one round of preparation where you are well versed with your concepts and all, this marathon is going to benefit you a lot. Even if you have not done it, also, I can't assure you, but I have heard from the students in the past also where marathon has been their starting point of preparation. It worked for few also, not for everybody, but the best use you can make out of this marathon, the best advantage you are going to get out of this marathon, if you have prepared for the entire subject at least once, at least the concepts whatever we are going to revise, if you would have prepared for that, you are going to reap the maximum benefits out of this marathon. There is no doubt in that, there is no denial of that. Fine. So before we go into this discussions and all, actually our discussion is going to start from the thing which is there in the study material, is going to be covered from the second chapter onwards, which is going to be nature, objective and scope of audit, ethics and the terms of engagement, audit reporting. From here the actual discussion is going to start. But to make that discussion all to have sense, we need to get a basic introduction. We need to get one basic introduction. So quickly we will take up this. We'll start our discussion with this chapter, Introduction to the Audit, where we will get to know about all the terms, all the basic terms familiar, so that going forward our discussion is going to flow smoothly. So I am picking up now the chapter of Introduction to the Audit. So let us start our discussion with the definition of audit. And as you could see here, this is what the definition which has been provided in the standards on audit. So as you all are well aware, the scope, the source from which our CA inter audit syllabus has been taken from, mostly 80%, 70 to 80% of the syllabus, the source has been standards on audit. The remaining that 20 to 30% which contains the general concepts, practical concepts like audit of items of the financial statements, audit of various entities, audit of banks. These are all some general concepts not from the standards on audit. Apart from that, remaining 70 to 80% of the portion, whatever we are going to cover, that's going to be completely taken from the standards on audit. So when we are actually learning this entire curriculum of the CA inter audit, we are basically trying to get familiar with the standards, nothing else. So having said that, first let us try to have a look at the definition of the term audit, how the term audit has been defined. So the definition is there here before you. So I will read it out. You please do follow it. So how it has been defined: an audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. Excellent. Very good response. I expect the same till the last minute of the session. Okay. Right. So let us try to understand this definition in a detailed manner. So this definition has been given in a paragraphical manner. But to understand this definition, we have to understand the key terms. Whatever key terms I have highlighted, if we get familiar with that, definition automatically becomes clear. So when I say I am doing audit, basically in the audit, what I am trying to do is examination I am doing. So what is the meaning of the term examination? Not the examinations which you are supposed to give. So the examination here refers to verification. So basically, by saying audit, let us say tomorrow after your qualification, after you become a chartered accountant, no excitement, you don't want to become, show at least some happy faces here. So just imagining is free of cost. No one is going to charge anything from you. Imagine first first the things happen in the brain, then the things happen in the reality. Okay, right. So just imagine that you have all become chartered accountants, and you might be heard that after you become a chartered accountant, you're going to make a tons of money. Just your qualification will be enough. People will be standing outside to get your signs and all. All that is not happening. I'm not saying that it's very difficult to make the money. No, it's easy. Not so easy also. You have to put efforts from your side, then only making money is possible. Don't be in a wrong assumption that just because you have become a chartered accountant, money will start flowing and money will start pumping in. It's not going to happen. That is a myth actually. So you have to put in the effort equally from your side. So let us say after your qualification, you have become a chartered accountant and you have opened your office. So, and someone is coming to you and asking you to do the audit for them, and you accept the assignment. That's what we have qualified for. People are going to give us the money. We are going to offer the services to the society. We are going to offer a bunch of services. In that, one of the services audit. Audit is not the only service from which we are going to make our bread and butter. Audit is one of the service. So if the client has come to you, asked you to do audit, and you are agreed to provide the audit services, what basically you are trying to do there by agreeing to do the audit? So when you go to the client's premises and start doing audit, what exactly is the thing you are doing? You are basically examining. You are basically checking. You are basically verifying. You are basically scrutinizing. And this auditing is a process of examination, is a process of checking agreed, and it is not an ordinary examination. What kind of examination it is going to be? It is going to be an independent examination. It is going to be an independent examination. Sir, what do you mean by independent, sir? So we don't have any other auspicious day to discuss about this term independence, right? So, so today is an Independence Day, right? So what do you mean by independence? Freedom for doing what? Doing whatever you want. No. So basically, what used to happen? We used to have this British era and all. People used to regulate us. They used to decide us how we live. They used to decide us. They used to tell us what things we can do, what things we cannot do. So we used to be under control. We are basically under influence of others. The others are influencing our decision. We are not at our free will for making decision. Then our respected freedom fighters, many celebrated, many uncelebrated, many unsung heroes, all have fought for this country and they made us independent. Which means what? We are no longer under the influence, we are no longer under the control or pressure from. Okay. We are no longer under the control or we are no longer under the pressure from this British Empire. We, India as a nation, we can take the decisions on our own. We can make our own choices, right? So that is what basically independence. We got free from influence. We got free from control of others. We are basically able to make our own decisions. So the same thing even happens in the audit also. When I say audit, I told that it is a process of examination, it is a process of verification, it is a process of checking, and it is an independent. So whatever examination we are doing, that should be independent, that should be free from influence. The most important term you have to remember here is free from influence. Technically, the term independence has been defined as the ability not to get your judgment on the basis of others. So you should not be compromising on your judgment depending on the interest of the others, the directions of the others. So such a kind of examination we are doing. So free from influence, without any influence, without any control, without any pressure, we should be able to do the examination. If something on the basis of our examination, if we find something as correct, we will say it as correct. If we find something as wrong, we will say it as wrong. Before saying that, we will not think, if I say something as wrong, what the other person will think. That influence should not come. So that ability, that free will to take the decision, that we call it as independence, free from influence. This point you have to remember. So when I say audit, what actually happens in the audit? Examination. How that examination is going to happen? In an independent manner, free from influence, we are doing the examination. And what exactly is the thing we are examining? You are examining, okay, what is the thing you are examining? So that is addressed by the next part of the definition, which says what? You are going to independently examine financial information. Now we have to get familiar with, sir, what the hell is this financial information? So we are all well versed with the term financial statements. Often we hear about the term financial statements, right? So what is the definition of the term financial statements? What is the definition of the term financial statements? Various sources you refer, you will always find inclusive definition of the financial statements. There is not something which is exhaustively defined. The definition of audit we have read is an exhaustive definition. They are exactly telling what is audit. But at many places where you read the financial statements, you will not be able to find exhaustive definition, but instead you will be able to find an inclusive definition. They will tell you what will be included in the financial statements. Like the most popular definition is Companies Act, which says that financial statements include balance sheet, statement of profit and loss, statement of cash flow, statement of changes in equity, and notes to accounts. All these five put together, we are going to call it as financial statements. So we are basically trying to verify by doing audit. What we are doing, what we are trying to do, we are trying to do an independent examination of what? Financial information, not financial statements. They did not say financial statements, but instead what they have mentioned? Financial information. So what is the differentiating factor between the two? What is the differentiation? So they are telling financial information, but you told us financial statements. Are both one and the same? No. To the financial statements, you have to add the source. You are preparing financial statements. Financial statements means, if I have to put it in simple way, can I call it as a reports? Those are nothing but reports only, no? Balance sheet is a report which will show financial position. Statement of P&L which will show financial profitability. Statement of cash flow is a report which will show the inflow or outflow of the cash you had. So like that, everything is a report. Now, to prepare these reports, we need source data. Report is always a summary. Whatever reports you are seeing, that is always a summary. Those reports will be actually based on the source data. Now, what is the source data for the preparation of financial statements? What is going to be the source data? Excellent. It's nothing. It's none other than books of accounts. So when I say books of accounts, your ledgers, journals, and also there's a trial balance will come. My entries will come. Your books of accounts, your supporting documents, vouchers, bills, invoices, everything put together, we call it as books of accounts. So that financial statements, to that financial statements, if you add that source for the preparation of financial statements, which is none other than books of accounts, that consolidated information, we are going to call it as financial information. So when I say as an auditor, you are going to do an independent examination. What exactly you are going to examine? Financial information of any entity. Any entity. You are going to do the independent examination. And when I say financial information, it's going to contain financial statements along with the books of accounts. Now, the next part of the definition says whether profit oriented or not. So what they are saying, whether profit oriented or not. That means whether the entity is a profit making entity or not for a profit making entity doesn't matter. Sir, regarding whose profit orientedness they are talking about? Are they talking about audit firm's profit orientedness or client's profit orientedness? Client's profit orientedness. There is no audit firm which I know which has been started only for the purpose of doing charity. If you know anybody, if you know any audit firm which is doing only, which has been incorporated only for charity, please bring it to my notice. And next time I will add it into my explanations. Okay. So, but to the extent I know, no audit firm is there which is doing the charity and all. We are all putting all this effort. No, Independence Day, thereafter Sunday, weekend, long weekend. I have a family to enjoy. You have a family or upcoming family to enjoy, right? You all have sacrificed your time, came here. This we are all not doing for charity here. No, no one will put this much effort for charity unless it is Mother Teresa, Bill Gates, something like that. Okay, we are not that great people. So we are all putting this effort to make some money, to have something in our pockets, to fill our pockets. We are doing so. Definitely, profit orientedness. They are not talking about the audit firm. They're talking about the profit orientedness of the client. So whether the entity who's a financial information you are verifying, whether that entity is a profit making entity or not for profit making entity, that doesn't have any impact on the audit. So you take the so-called biggest company of India, Reliance Industries Limited, Adani group of companies, they have been basically incorporated with the intention of making profits. Yes or no? So this profit-oriented entity, they will do the transactions, they will do the business throughout the year, they maintain books of accounts, from that they prepare financial statements. And if in case if you are getting appointed as auditor of those so-called profit-oriented companies, what you are going to do? Independently examine the financial information. There are so many non-profit oriented entities also, charitable institutions, places of religious worship, NGOs, this old age homes, orphanages, so many non-profit oriented entities also there. So many non-profit oriented entities are also having a huge amount of money and or not. Yes or no? Especially these places of religious worship. So these are the entities which have huge access to the donations and all. Many places of religious worship. You take any church, any temple, any mosque, whatever it is, for everybody, there will be auditors. So that means whether the entity is a profit making entity or it is a non-profit making entity, that doesn't matter. What we are supposed to do, that a profit oriented entity or non-profit oriented entity, they will maintain the books of accounts, they will prepare the financial statements. Our job as an auditor is to go and independently examine. And next part of the definition says, irrespective of size or legal form. What they're saying, irrespective of size or legal form. So that means size doesn't matter. Size of the client's entity doesn't matter. Your client could be so-called biggest conglomerate having 6 lakh plus crores of revenue, like Reliance. There also you will do independent examination of financial information only. There is another small company at the end of the street which is hardly making 1 crore amount of turnover. There also we will go and independently examine the financial information only. So size of the entity doesn't matter. And legal form of the entity also doesn't matter. So what is a legal form? What is a legal form? Legal form is the legal status, how you are legally identified. If I want to start a business, I can give it a legal structure of a proprietorship firm. If I have all the funds, if I can manage the business on my own, I will start a proprietorship firm. If I want to make my friends also join in my business, I will create a partnership firm. That is a legal status which I am giving to my business. If I want to go to a bigger scale, I can create a company. That is a legal status which I am giving to my entity. So even they are saying, irrespective of the legal form of your client also doesn't have any major impact on audit, on your overall objective. So everywhere, what you are doing, independently examining financial information. Clear till here? So audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal. Okay, sir, we are doing all this for what objective? For what objective? There should be one ultimate goal. Whatever we are doing, there should be one ultimate outcome for that. Without outcome, you are doing something means that means you are doing nothing. So whatever work you are doing, there should be some final ultimate outcome out of it. Sir, what is that ultimate outcome in the audit? The whole objective, the ultimate objective of doing that entire process of audit is to express an opinion on what? On whatever you have verified. So what you are verifying? Financial information. So you are ultimately going to express your opinion even on financial information only. So the ultimate objective is to express an opinion on the financial information, whatever you have verified. And that opinion, how you are going to express? Like this, call the audience, conduct a meeting, take the mic, say your opinion. That's all. Is it a proper, valid expression of opinion? No. That expression of opinion should happen in a written format, because always written format, something which is in the documentary format will only be relevant. Something which is said orally is not relevant. So you are ultimately required to express your opinion, but that opinion will be expressed in the form of a written report, and that written report we are going to call it as a audit report. And how we are required to prepare that audit report, that we are going to learn it as a part of our audit reporting chapter. Understood? And since the discussion has come regarding the opinion, let us have a quick look at the opinions. So, like any opinion in this world, any opinion, not just in audit, guys, you take any opinion regarding any object, anything, any person, any state, any place, whatever it is, opinion can be broadly falling under only two categories. Opinion can be only broadly falling under two categories: good opinion, bad opinion. That's it. Or even you can call it as positive opinion, negative opinion, whatever it is. Any opinion you take, that will have only two kinds. I ask your opinion about a person, you will say either a good person or a bad person. Or I ask your opinion about a food that I have prepared, you will say either it is good, either it is tasting good, or it is tasting bad. So like any opinion will have only two sides. A coin will have two sides. Opinion also will have only two sides. So either a good opinion or bad opinion, either a positive opinion or negative opinion. But in the audit also, we have only two kinds of opinion. But for that good and bad, or for that positive and negative, we give some technical names. What are the technical names? Number one, we have unmodified opinion. Then we have something called a modified opinion. Very simple. Try to understand it in a simple language. Like the way opinion can have two sides, either a positive opinion or negative opinion. Even the opinion which we are expressing in the audit is also going to have only two categories, either a positive opinion or negative opinion, but that we give technical names as unmodified opinion, modified opinion. Tell me between the two, which one is a positive, which one is a negative? Very good. Unmodified opinion is going to be a positive opinion, whereas modified opinion is going to be a negative opinion. So when we are giving a positive opinion, what we are trying to say is whatever financial information we have verified, that is okay, that is fine, that is giving true and fair view, that is presenting all the required information, that is not misleading. You're trying to say all this when you are happy with the financial, whatever financial information you have verified. If that is all sounding good, that is all not misleading, nothing has been hidden, nothing has been wrongly stated, if everything is perfect, then we will give a unmodified opinion. Basically, we will say financial statements are giving a true and fair view. What is a fair presentation framework? Frameworks, I will come back to that later in a short while. Whereas, on the other hand, you verified financial information, you verified the financial statements, you verified the books of accounts, but you found something wrong in the financial information, then you will give a negative opinion. That means you will give a modified opinion. You will say something is wrong with the financial statements. They're not completely giving a true and fair view. So, giving that opinion is our ultimate objective, and that report, that opinion has to be given in a written report. That written document, that written audit report, whatever you have, that is the final outcome. If you give that audit report, then only your work is done. Then only client will pay you the fees. If you have done all your audit, but you did not express opinion, you did not give the audit report, your work is not done, client will not give you the fees. We all want fees or not? Yes. If you want the fees, what we should do? We should complete our objective. We have to give our written reports. Clear? Right. So since we have spoken about the ultimate objective, which is to express an opinion, let us dig deeper into this opinion mainly. So as I've told, the ultimate objective is to express an opinion. So mainly, if I have to tell it on a broader scale, we will try to express our opinion on the financial information, but let us be specific about the objectives. There are two specified objectives. Yes, we are going to express our opinion on financial information only, but regarding two things. Number one, whether financial statements are free from material misstatements. And the second objective, whether financial statements are prepared as per applicable financial reporting framework. Come on, repeat. So the main objective is to express opinion, but that opinion is required to be expressed regarding two things. Number one, whether financial statements are free from material misstatements, and whether financial statements are prepared as per applicable financial reporting framework. So let us try to understand these two objectives in a detailed manner. Why? Because here there are so many terms associated. To go ahead, first we need to be clear about these terms. So first I will start with the second objective, which is whether financial statements are prepared as per applicable financial reporting framework. So let us try to understand what is this applicable financial reporting framework. Framework means nothing but set of rules and regulations. Set of rules and regulations for anything. If you are required to do any task, if you are required to do anything, if I give you, you have to do this activity in this manner, you have to do this task in this manner, these rules you have to follow, in this process you have to follow. That is what we call it as framework. Framework means simply a set of rules and regulations. Financial reporting. What is the financial reporting? The process of preparation and presentation of financial statements. Nothing but accounting. So at the CA inter level, we call it as accounts. But at the CA final level, you will have a paper called FR, financial reporting. None other than accounts only. The advanced level of accounts. So financial reporting is nothing but the process of preparation and the presentation of financial statements. So what could be the meaning of financial reporting framework? The rules and regulations which you are required to follow in the process of preparation and presentation of the financial statements, that we call it as financial reporting framework. Let us say you are required to prepare the financial statements. Do you think the organizations will prepare the financial statements as per their own wishes, or will they follow any rules and regulations? They have to follow rules and regulations. We have plenty. That's what the whole basis of accounting subject. If there are no set of rules and regulations, one paper will not be there for us. Accounting itself will not be there. But it's not like that. That's not how the world works. So we have to, whenever we are preparing financial statements, we will not follow our own choices here, but we have to follow some set of rules and regulations. So those rules and regulations which are applicable in the process of preparation and presentation of the financial statements, we are going to call it as a financial reporting framework. Can you give me a few examples? Schedule 3 Accounting Standards, Banking Regulation Act, IRDA Act. So like that, so many cooperative societies, they have a separate framework. So like a set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements. We are going to call it as financial reporting framework. But we are going to use a phrase something called applicable financial reporting framework. So what is this applicable financial reporting framework? Before that, let me address one question. Who is required to prepare the financial statements? Don't talk reality, we'll keep it purely from the theory perspective. Okay, what is happening in the reality, we all know it better. But technically and theoretically, who is required to prepare the financial statements? Management. Tomorrow, don't come and complain me when you go to the article ships or you told something, but in reality, something else is happening. Don't come and complain. The world works differently. Okay, some whatever we read in the books, the same thing will not happen in the reality. But whatever it is, as per theoretical knowledge, it is whose responsibility to prepare and present the financial statements? No doubt, management. So the management who is required to prepare the financial statements, depending upon the purpose of the financial statements, depending upon purpose of the financial statements, depending upon nature of the organization. The management of every organization, keeping in mind the nature of their organization, keeping in mind the purpose of their financial statements, they themselves, who management themselves, will adopt a financial reporting framework. Management themselves have to adopt, keeping in mind the nature of the entity, purpose of the financial statements. The management themselves will adopt, will choose a framework. That chosen framework by the management, that adopted framework by the management, that's what we are going to call it as applicable financial reporting framework. Who will adopt? Will auditor adopt? No, management will adopt because they are responsible for preparation of financial statements. So management will prepare financial statements. Management, while preparing financial statements, keeping what things in mind? Nature of the entity, purpose of the financial information. They will select a framework applicable. That chosen framework, that adopted framework, we are going to call it as an applicable financial reporting framework. Like the management of the Reliance, when they have sat down for preparation of the financial statements, keeping in mind the nature of the organization. The nature of the organization is a company. Keeping in mind the purpose of the financial statements, we are preparing the financial statements for the overall public. They have selected Schedule 3 and Accounting Standards. Who has selected? Management has selected Schedule 3 and Accounting Standards as their framework. They have decided we will follow Schedule 3 Accounting Standards in the process of preparation and presentation of the financial statements. Right. So this framework, we call it as applicable financial reporting framework. Clear? Able to understand? Right. So this is what regarding applicable financial reporting framework. Now, why we are reading the applicable financial reporting framework? Because we have one associated objective with that. What is that? You are required to express your opinion whether financial statements are prepared as per applicable financial reporting framework. You are required to verify whether financial statements are prepared as per applicable financial reporting framework. Are the standards asking the auditor to select the applicable financial reporting framework? No. Management will do that duty. Let them do that duty. You do your duty. What is your duty? Verify. If the Reliance has told, if the Reliance has adopted us, let us say, for example, you are conducting audit of Reliance. The management of Reliance says, sir, we are adopting Schedule 3 accounting standards as our applicable financial reporting framework, sir. They are telling it. But whether in reality, really the financial statements are prepared as per applicable financial reporting framework, whether really the financial statements of the Reliance has been prepared as per Schedule 3 and accounting standards, verification is my responsibility. Verify and express your opinion. Understood? So, second objective, what is it? Express an opinion whether financial statements are prepared as per applicable financial reporting framework. Choosing of which is whose responsibility? Management's responsibility. So, since the discussion has come regarding framework, we will try to understand different types of frameworks. Different types of frameworks we'll try to understand. Quickly, I will try to summarize the discussion. So, on the basis of purpose, on the basis of what? Purpose. Financial statements are broadly divided into two categories. One is general purpose financial statements and the other one is special purpose financial statements. On the basis of what? Purpose. Purpose which they are fulfilling, the financial statements are broadly divided into two categories. What are they? General purpose financial statements and the special purpose financial statements. Sir, what is general purpose financial statements? Those financial statements which are prepared as per general purpose framework. So then what will be the special purpose financial statements? Very good. Excellent. Those which are prepared as per special purpose framework. That's all. That's how they have defined it. But to make this definition clear, first we need to understand what is a general purpose framework and what is a special purpose framework. So first let us try to understand the meanings of this framework. First we will start with what is the meaning of the term general purpose framework. So they say that the framework which fulfills financial information needs of various users of the financial statements. What they are saying? Various users. The framework which will fulfill financial information needs of various users of the financial statements. That framework we call it as general purpose framework. That means if you are following a certain framework, and by following that framework you prepare financial statements, and that financial statements will fulfill information needs of various users. First of all, who are various users of the financial statements? Management. Why they will use it? Decision making. For their own decision making they will use the financial statements. Next, shareholders, be it already existing shareholder or be it a prospective shareholder. If it is an existing shareholder, they want to know about whether they have to stay invested or not. If it is a prospective shareholder, they want to decide whether to invest it or not. So shareholders could be a user. Who else? Bankers, for deciding whether to give you the funding or not. Apart from that, creditors, suppliers, government, to know whether you are making proper use of the taxes or not, proper payment of the taxes or not. So there are n number of users. So there are n number of users of the financial statements. Now, if the management of the company, if they follow one particular framework, which will fulfill information needs of all the users. There are different users, but we are not preparing separate set of financial statement for shareholders, separate set of financial statement for management, separate set of financial statement for banker, nothing like that. We are following one particular framework, and that particular framework is going to fulfill financial information needs of various users or all the users also, you can say. We are following one single framework which is going to fulfill financial information needs of various users. That framework I'm going to call it as a general purpose framework. One best example, if I have to give, you go to any listed company's official website and you try to download their financial statements. You try to download their annual report and you try to download the financial statements. Yes, free only. So for all the listed companies, it is mandatory. They have to maintain one website. In that, there should be investor section. In that investor section, they have to communicate all that financial information related data. So you go to any listed company, you download the financial statements for their website. The same financial statements will be used by everybody. Reliance will not prepare different set of financial statements. They prepare one single set of financial statements following Schedule 3 accounting standards, which will fulfill information needs of management also. They will use that for decision making. That will be used by shareholders also to determine their investment positions. That will be used by bankers also in some cases. That will be used by government also. So the management of the Reliance is following one single framework, which is Schedule 3 and accounting standards, which is going to fulfill financial information needs of various users simultaneously. So that framework I call it as what? General purpose framework. So Schedule 3 and accounting standards is the best example for general purpose framework. Sir, why general purpose framework will be accepted by everybody? Why general purpose framework? So you are saying that general purpose framework will fulfill financial information needs of various users. Why, sir? Why everybody will accept the general purpose financial statements? Because it will have some characteristics. Will have some characteristics. Sir, what are they? They follow fundamental accounting assumptions, going concern accrual consistency. They follow generally accepted accounting principles, and they also follow accounting standards, and they will be prepared periodically. For a fixed duration, they will be prepared like once in a year, annually, that will be prepared. So they have four characteristics. They follow fundamental accounting assumptions, they follow generally accepted accounting principles, they follow accounting standards, and they are prepared periodically. So that's why they will be accepted by everybody. Then what is a special purpose framework? If general purpose framework is a framework which is going to fulfill information needs of various users, then what could be the meaning of special purpose framework? Which fulfills financial information needs of specific users. The management is trying to prepare a financial statements by following certain rules and regulations, and by following that framework, if you prepare financial statements, it will not fulfill information needs of everybody. There are few special financial information requirements of specific users. For those specific users only, they are preparing financial statements that will fulfill only their purpose, not for everybody else. That kind of frameworks we are going to call it as special purpose framework. I will give you one example. Let us say we are a startup company. We need funding. These days, startup ecosystem is all everybody wants to be an entrepreneur. So there used to be one saying that This is regarding Bangalore location. There used to be one saying when I used to work in the bank. If you throw a stone, if you go in the open air and throw a stone in the open air in Bangalore, that will hit one software engineer. They used to say it in a funny way. Those many software engineers used to be there. If you go in the open air and throw a stone, definitely it will go and hit a software engineer. Now I will say the same thing will become applicable for entrepreneurs. Today everybody want to become an entrepreneur. What you want to do? Everybody entrepreneur. So from the student and also those people who are working, non-working, idle people, unemployed people, everybody wants to become an entrepreneur. So today I can say, if you go to the open air, not just in Bangalore, anywhere in the world, anywhere in India especially, if you go into the open air and throw a stone, it will definitely go and hit an entrepreneur. So that's what the world has become. So let us say we are a startup company. I have some innovative idea. We have started our operations. We want funding. So now funding, we'll go to venture capital firm. VC firms we have. We went to venture capital firm. So we made a pitch. Shark Tank, you see, no? So that is what basically a pitch. So they are going for not that pitchy. That is a pitch actually, sales pitch. Okay, that is an investment pitch. So I went to a VC capital firm and I told, sir, I need this much funding. I'm ready to give this much equity. Now what that VC firm will say is, okay, boss, we'll give you funding. We want your financial statements. Now you will say, sir, we have an auditor also, sir, local auditor. See the last 3 years financial statements and all. Please give us the funding. Now that VC firm will say, no, this financial statements we will not accept. We'll give you special rules. We'll give you special rules. A set of rules we'll give, which are different from the general accounting standards and all. Prepare the financial statements as per this rule and present that financial statements to us. Depending on that, we will give you funding. So now you will follow that special requirements and prepare the financial statements. For whose purpose? Only for the purpose of that specific user. Who is that specific user? Venture capital firm, right? Now if you prepare that financial statements, you gave it to that VC firm, they liked it, they gave you funding. If you take the same copy of the financial statements and give it to your usual shareholder, what they will say? Get lost. We will not accept. If you go to the government and say, depending on this financial statements only, we'll pay the taxes. Government also will say what? Get lost. So we are preparing the financial statements, but not to meet the financial information needs of all the users, to fulfill the information needs of only specific user. Here in our example, the specific user is none other than VC. So those kind of frameworks, we call it as what? Special purpose framework. Sir, do we do audit of special purpose financial statements also? Do we do? Sir, we chartered accountants, we will do audit of general purpose financial statements. There is no doubt about it. Do we as auditors also do audit of the special purpose financial statements? Yes. We have a dedicated series of the standards for that. SA 800 series. Don't worry, not there in your CA inter syllabus. Not there in your CA inter syllabus. You will learn it at the CFN level. SA 800 series, specialized areas, where we will get to know how to do audit of the special purpose framework. One more point of differentiation here. One more point of differentiation here. In case if you are doing audit as per general purpose framework, there we will comment on true and fair view. But in case if you are conducting audit as per special purpose framework, we will not be commenting on true and fair view. We will be commenting whether the requirements of that special purpose framework are fulfilled or not. That's all. I hope you are able to understand this difference. In case if you are conducting audit of general purpose financial statements, we will comment on true and fair view. Whereas in case if you are conducting audit of special purpose financial statements, we might not comment on true and fair view. Just we will comment whether the requirements are complied with or not. Whether the requirements of the special purpose framework are complied with or not. Understood? Till here everybody comfortable? So these are the two kinds of frameworks on the basis of purpose. This is not the end of the story, but we have one more categorization. The financial reporting frameworks are divided into two more categories now on the basis of presentation. Now on the basis of presentation, the financial reporting framework can be broadly divided into how many categories? Into two categories. Sir, what are they? So two categories of frameworks on the basis of presentation are going to be fair presentation framework and compliance framework. What are they? Fair presentation framework and compliance framework. Sir, what is that fair presentation framework? What is that compliance framework? First, we'll try to understand the compliance. First of all, general meaning of the term compliance. What is it? Compliance means what? To fulfill, to follow, to strictly comply with. Let us say if I say you have to comply with the law and regulation. That is what you have to follow. That's all. So compliance framework means the framework in which financial statements are prepared as per the requirements of such framework. We are going to prepare the financial statements strictly as per the requirements. Whatever has been told in the framework, we have to strictly follow without any deviation. Deviation is not at all permitted. You can't deviate. whatever has been told in the requirement, you have to strictly follow. By following it, whether you will get a true and fair view, you will not get a true and fair view, let it go to hell, we are least worried. Whatever has been told in the framework, that we are required to strictly follow, that frameworks we are going to call it as compliance framework, where a deviation will not be permitted. You have to follow strictly, whether you like it or don't like it, whether it is giving a true and fair view, not giving a true and fair view, doesn't matter. Strictly you have to comply with that. Those kind of frameworks we are going to call them as what? Compliance framework. Sir, can there be true and fair view guaranteed always in the compliance framework? No. There might be true and fair view. There might not be a true and fair. Next. Sir, what about fair presentation framework? See the name itself, see the title itself. Here the emphasis is on fair presentation. Here the emphasis is on what? Fair presentation. In the previous case, they told compliance, you have to comply. But here they are saying fair presentation. So first I will tell you textually what is this. Fair presentation frameworks refers to such a frameworks where we will here also we will try to prepare the financial statements as per the requirements of framework. Here also we'll try to prepare the financial statements as per the requirements of framework only. Whatever has been told in the framework, here also we'll try to follow. But here there will be freedom. Here there will be given some choice. You are free to do two things. Either you can deviate from the requirements of the framework. What you can do? Either you can deviate. What do you mean by deviating? Don't follow whatever is mentioned in the framework. Try to follow something else. Like let us say, for example, Schedule 3 accounting standards is asking you to follow depreciation in one of the two methods, WDV, SLM. But you want to follow something else. You want to follow production units method. You want to follow some other method. That freedom is there. You can deviate from the requirements of the framework. Or you are also given an option. You comply with the requirements, but give additional disclosures. What do you give? Additional disclosures you give beyond the requirements of the framework. Whatever is not there in the framework, try to give extra disclosures. So follow SLM method only, WDV method only, but add extra notes. As per the framework, I have followed them, but there is some more other method is available. If I follow that, this would have been my impact. Like that, give a disclosure in the notes to accounts. So two permissions will be given in the fair presentation framework. What are they? Here also, to the extent we try to comply with the requirements of the framework only. But here we have a freedom. We have an option to do two things. Either we can deviate from the requirements of the framework. Don't follow whatever has been mentioned in the framework, do something else. Or provide additional disclosures beyond the requirements of the framework. For what purpose? For what purpose? You have been given permission to do two things. For what purpose? To achieve the fair presentation. To achieve what? Fair presentation, your ultimate objective. You have been given that freedom. You have been given that choice to either deviate from the requirements or to provide additional disclosure. The whole objective of giving you that freedom is to achieve a fair presentation. The whole objective is to achieve fair presentation. So that's what they say here. To achieve fair presentation, to either you can provide additional disclosure or you can deviate from the requirements of the framework. For what purpose? To achieve the fair presentation. Here whole emphasis has been on fair presentation. Will there be always true and fair view in the case of fair presentation framework? Absolutely. Absolutely. Yes. Always there will be a true and fair view. And one more point to add it here. Most of the general purpose financial statements will be prepared as per fair presentation framework. So general purpose financial statements are those which are accepted by everybody. Everybody will accept only when there is a true and fair. That true and fair view is possible only in the case of fair presentation framework. Whereas most of the special purpose financial statements will be prepared as per compliance framework. Why? Because when you are meeting the specific needs of a specific user, he will be least bothered whether it is giving a true and fair view or not. So that's why most of the special purpose financial statements will be prepared as per compliance framework. Now, a question for you. Whatever financial statements you are seeing, I told you just now, listed companies will have their official website. Go to their investor section, you will be able to download their financial statements. What are those financial statements prepared as per? Are they prepared as per fair presentation framework? Are they prepared as per compliance framework? Fair presentation framework. That means, do you think that has given the permission for them to deviate from the Schedule 3 and accounting standards? Then how come you told financial reporting fair presentation framework? You only told fair presentation framework. No. Fair presentation framework means what? There should be permission to deviate. Do you think Companies Act is giving the permission to the companies to deviate from the Schedule 3 and accounting standards? No. Then it should be compliance. No. Why you told fair presentation? Yes, section 129 is giving the permission to deviate. Yes, section 129 of the Companies Act, which is dealing about the preparation of the financial statements, has given the permission for the companies to deviate from the requirements of the framework. From the Schedule 3 and accounting standards, you can deviate. You will not trust me? Open section 129 and read subsection 5. In the subsection 1, they will say the company shall prepare the financial statements which shall give a true and fair view. It will start with, the sentence will start with the financial statements shall give a true and fair view. And in compliance with Schedule 3 and accounting standards, they will say, sir, they are saying true and fair view, no sir. But ultimately they are asking you to follow Schedule 3 and accounting standards, no sir. That means it should be compliance, no sir. No. The main emphasis has been on true and fair view. And go to subsection 5. There in the subsection 5, they will say, in case if you are not following the requirements of any accounting standard, give a proper disclosure. They will have one subsection. They will say that in case if you are not complying with any accounting standard or in days because of any reason, explain about that you have deviated from the requirements of accounting standard in the notes to accounts. By adding that subsection, they are impliedly giving the permission for the companies to deviate from the requirements of accounting standards. Yes, Companies Act has given that permission to deviate from the requirements, and the Companies Act has given the permission for the companies to achieve the true and fair view. That's why that general purpose financial statements, whatever you are seeing in the companies and all, they are all prepared as per fair presentation framework. Understood? Clear and comfortable, everybody? So these are the another two types of frameworks on the basis of presentation. Totally, how many frameworks we have covered? Four frameworks we have covered. Two on the basis of purpose. What are they? General purpose framework, special purpose framework. Two on the basis of presentation. What are they? Fair presentation framework, compliance framework. Comfortable till here? So now we are done with the second objective. So have the context of the discussion. We are till now covering the second objective only. One of the second objective of the auditor to express an opinion whether financial statements are prepared as per applicable financial reporting framework. As a part of that discussion, we have understood what is applicable financial reporting framework. We have also understood what are the various kinds of frameworks. Now let us come to the first objective. What's the first objective? To express an opinion whether the financial statements are free from material misstatements. Sir, what do you mean by this term material misstatement? What do you mean by this term material misstatement? First, let us break it down. We'll try to understand what is the meaning of the term misstatement. Tell me, what is the meaning of the term misstatement? Misstatement. Statement means what? Statement means saying something. Misstatement means what? Wrongly saying something. Simply, if I have to put it, a misstatement in the financial statements is nothing but a mistake. A mistake in the financial statements. Who will commit that mistake in the financial statements? Right? Auditor will not commit any mistake. Auditor has to identify the misstatement. But who will commit the misstatements? Management. So misstatements means simply a mistake in the financial statements. But that's what the simple meaning. Simple things don't work. They have given a complex definition. What they have done? They have given one complex definition. Sir, what is the meaning of the term misstatement? See it here. The difference between amount, classification, presentation, disclosure in the reported financial statements and the amount, classification, presentation, disclosure required as per bullshit, no. Crap, no. Simply they could have told mistake, no. But what they are trying to say, no, no. If someone is asking you to show the notes, we will not show it like this. We will show it like this. Okay. So what they have told, there is a misstatement. Misstatement means what? A difference in amount, classification, presentation, disclosure, which is there in what? Reported financial statements, which are already prepared by whom? Management. The financial statements which are already prepared by the management. In that there is an amount, there is a classification, there is a presentation, there is a disclosure, which is a different from the amount, classification, presentation, disclosure required as per applicable financial reporting framework. That we call it as misstatement. Sir, what is it? As per the applicable financial reporting framework, let us say you are required to show a revenue at a figure of 1 CR. But in the financial statements prepared by the in the applicable financial reporting framework, it is 1 CR. But in the financial statements prepared by the management, they are showing it as 1.2 CR. Difference in the amount required as per applicable financial reporting framework and reported financial statements. Misstatement. Similarly, classification. As per the applicable financial reporting framework, you are required to classify certain expenditure as a capital expenditure. But in the financial statements, they have shown it as a revenue expenditure. Or some asset has to be shown as a current asset, but it has been shown as a non-current asset. Whatever it is, if there is a difference in the classification, that also could be called as a misstatement. Or there could be difference in presentation as per the applicable financial reporting framework. Whenever you are preparing the financial statements of a company, you have to present it in the vertical format. But company still follow the T format of the financial statements. Difference in the presentation. This is also a misstatement. Or even there could be a misstatement in disclosure. Disclosure. Sir, what is disclosure? What is a disclosure? So one common terminology which we all have to become familiar: ABCD of the financial statements. What is it? ABCD of the financial statements. What is ABCD? AB, account balances. Account balances means what? Balance sheet items, assets and liabilities, that closing balances, whatever we have, they will be called as account balances. C for class of transactions. What do you mean by class of transactions? Mainly they are referring to the P&L items. D of financial statements, disclosures. Disclosures means all that explanation you will be able to find it in the notes to accounts. In the notes to accounts, there's a hell a lot of information which you can read. Your entire 1 month or 2 months will be enough for you if you could read the entire financial statements to get a complete understanding. Those many disclosures will be there. So all that explanation given in the notes to accounts, we call it as what? Disclosure. So ABCD of the financial statements: account balances, class of transactions, disclosures. Don't never ever forget it, but don't write this in the exam. ABCD of financial statements, examiner will not understand. Okay, right. So there could be a difference in the disclosure also. See, one common misconception which we have, which we all have. Let us say I'm giving you a copy of the financial statements and I'm telling that in the financial statements there is a misstatement. What you will immediately start looking for? You will check the balance sheet total is matching or not. P&L figure calculation is correct or not. Arithmetical accuracy is correct or not. Cash flow statement is correct or not. You will only concentrate on the figures only. When I say misstatement, you will always imagine that misstatement will happen in quantitative figures, but never your thought will go to the notes to accounts. So going forward, you have to change that perception. So misstatement need not only happen in quantitative terms. Misstatement can even happen in qualitative aspects also. In the disclosures also, there could be a misstatement, and there could be such a bigger misstatement where you can give a disclaimer or adverse opinion. Anyhow, we'll come back to the opinions later, where you can go and give extremely severe negative opinion just because of a misstatement in the disclosure. Yes, it is possible. So change your perception going forward. When I say there is a misstatement in the financial statements, don't just imagine that misstatement will happen only in the financial statements in the quantitative figures. Misstatements could even happen in notes to accounts also. Not just ordinary misstatements, pervasive misstatements could happen in the notes to accounts. Clear? Clear about it? So like that, whenever there is a difference between amount classification, presentation, disclosure in the reported financial statements and the amount classification, presentation, disclosure required as per applicable financial reporting framework, that difference we are going to call it as a misstatement. Nothing but, in our simple language, that's what I have told, a mistake in the financial statements. That's what. And they don't just say misstatement here, they say something called material misstatement. Now, materiality, material, this term is very much significant in the audit. From now onwards until the end of the discussion, we are going to continuously make use of this term material. So, what is the meaning of the term material? Something which is significant, something which is important, something which is major, not something which you can ignore. That we call it as material misstatement. And technically, they have defined this term misstatement, material misstatement, a misstatement that could influence the decision of users of the financial statements. If because of a misstatement, if the user of the financial statements decision is getting influenced, let us say you are looking at the financial statements of Reliance, it is having 6 lakh plus crores of revenue. In that, you got to know 1 crore rupees of fraud is there. Will you change your decision? Let us say you want to invest your money in the company. So you are looking at the financial statements. You got to know that in the financial statements, 1 crore worth of misstatement is there. Just by getting to know about it, will you stop yourself from investing your money in the company? No. That is chiller. For a Reliance company, it is like a very small amount. So it will be going in the rounding of error. Financial statements itself will be rounded off to crores. So no. So there is a misstatement. I'm not saying there is no misstatement. There is a misstatement, but it is not big enough to influence your decision. So I will not consider it as a material. On the other hand, if you felt that there is 100 crores worth of misstatement before you are going to invest in the company, you will definitely stop yourself from investing in the company. So here the misstatement is big enough to influence the decision of users of the financial statements. So a misstatement which is significant enough, which could have an influence on the decision of users of the financial statements, that misstatements we are going to call it as material. Understood? Clear? And materiality is something a subjective term. It is a relative term. In physics, the concepts of relativity is having a lot of significance. Relativity, you know it. So I often use this example here. Excellent example. Albert Einstein. He explained the concept of relativity in an excellent manner. So in physics, relativity is having a very much key role. So Albert Einstein says that, let us say there is one beautiful girl or a beautiful boy. If for that boy or girl, if you give 1 hour of time and give a book to read, that 1 hour will feel like 1 year. The same 1 hour of time, if you give him and ask him to go on a date, the time will just like flow. You will feel as if even 5 minutes have not passed, but 1 hour of time is over. So no, but at both the places you have given equal 1 hour of time only. The clock will not lie. No, I kept a timer in front of you. So in both the cases, the time which you have spent is 1 hour only. But in one case, it felt like 1 year. In another case, it felt like 5 minutes. This is what relativity. It changes from person to person, situation to situation, instance to instance, case to case, it will change. The same thing will even happen in the audit also. Why? Because materiality is a relative term. You felt that 1 crore is not material in Reliance. Let us say the same 1 crore misstatement, same circumstances, same scenario happens in the company which is hardly having 10 crores of turnover. Then you will call it as a, in at another place you call it as not material, no. But here circumstance has changed, situation has changed, case has changed. So that's what the materiality also. Materiality is a highly relative term, highly subjective term. Understood? Clear everybody? So why we are discussing this material misstatement? Because we have one objective. What is that one objective? We have to express an opinion whether financial statements are free from material misstatements. What do you mean by free from material misstatements? Should they contain or should they not contain? They should not contain any material misstatements. Whether financial statements are containing a material misstatement or not containing a material misstatement, that also you have to express your opinion. And as we all are aware, a misstatement in the financial statements can happen because of two reasons. Or you take in common life also, a mistake can happen because of two reasons here. One, you know that you are doing a mistake, fraud, cheater, scammer. One, by mistake it happens. Error. You don't have any fraudulent intention, just it happened. That is an error. You know you are doing mistake, but still you are doing it. That is a fraud. Same thing, bring this analogy into audit. So a misstatement in the financial statements is happening because of management reason. That could happen either because of fraud, that could happen because of error. Differentiating factor between the two, underlying intention. If something is done intentionally, knowingly, willfully, if the intention to cause the harm to other person, then it is a fraud. If something happens by mistake, without your intention, without any fraud, out of your usual activities, because of some what we say negligence or something, it has happened. That is a what? Error. Which one is difficult to detect? Fraud is difficult to detect. Which one can cause a potential misstatement? Both can cause a material misstatement. Errors also can cause misstatement. Yes, one simple error has costed the Citibank some millions of dollars. It's not the time for us to explain in that in a detailed manner. But one simple mistake, one simple error has costed Citibank, the foreign bank, some millions of dollars it has costed. So error and fraud both have equal potential to create a big misstatement in the financial statements, but the ability to detect the fraud is more difficult than the ability to detect an error. Why? Intention, simple logic intention. When a person knows, knowingly he commits something wrong, definitely he will, in the way, he will try to destroy all the evidences, he will try to create the fake documents and he will try to hide it. No fool will conduct a fraud in such a way that he will get easily caught. If he has committed that, then he is a fool only. Right? So, since a fraud is done intentionally, at one side you are putting an effort to detect it, at the other side, the equal effort is being put to hide it. So that's why it is difficult to detect. But error is not like that. You are putting an effort to detect it, but no one from the other side is putting an effort to hide it. So somehow it will come to your notice. But fraud is very much difficult to detect. Clear? But both will have equal potential to cause a misstatement in the financial statements. Clear till here, everybody? So with this, we have successfully completed the another part of introduction, which is two objectives. Number one, to express an opinion whether financial statements are free from material misstatements. Number two, whether financial statements are prepared as per applicable financial reporting framework. Perfect. Understood? Right. So mostly we are done with this introduction part. Few more basic terms we have to learn before we go ahead. Auditor. One term which we have to learn is auditor. Sir, who is auditor, sir? Audit is a process of independent examination. Then who is auditor? Whoever is doing that independent examination, that we call it as auditor. But generally, if you have so anyhow you are going to experience it, there will be audit firms, right? Audit firm is not a one-man army. There are so many people associated with that audit firm. There will be partners who are qualified chartered accountants who will start their practice and all. There will be article assistants, cheap labor. So no, so article assistants are none other than cheap labor only. Yeah? You work like a dog and you get stipend by the end of the month, right? So article assistants we have, senior article assistants, junior article assistants also we have. Nothing but in the first year of articleship junior, 1 year promotion with increase in 2,000 rupees of stipend, and you will be senior article assistant. So senior article assistant, junior article assistant will be there. Apart from that, you are temporary staff, cheap labor, but temporary cheap labor. You will not stay long with the audit firm. Once your articleship gets over, you will leave and find your place. But we need some regular staff. We can't rely on article assistant, gone only. If you completely rely on article assistants, gone. Audit firm will not survive. So they need some regular staff also. So they will recruit some BCom people, MCom people, MBA people who will be doing the accounting functions and all in the audit firm. So them we call them as paid assistants. Paid assistants. In that something called something self-designated semi-qualified chartered accountants also will come. We are sitting in this place. Go and ask anybody. Does in the Chartered Accountants Act is there anywhere the term used semi-qualified chartered accountants? No, no. There is no profession. There is no identification called semi-qualified chartered accountant. That is something which we are celebrating who are unable to clear. Okay, so there is no legal recognition of something called semi-qualified chartered accountant. So that nothing but you have cleared your CA inter, but you are unable to clear CA final. You are giving so many attempts. Not you, not you. You will all clear. Okay, so some people. So they will also go and get some jobs in the audit firms and all. So they all will be called as paid assistants. Thereafter, some qualified people. When the firms grow bigger and bigger, they will recruit qualified people, qualified chartered accountants, cost accountants, company secretaries into their offices. Them generally we call them as audit managers. We call them. These are designations given to different people. So when I say audit firm, it is a team. It is a very good number of people will be there in the audit firm. So now what will happen is these audit firms will get n number of works. An audit firm will not do only one audit here. First of all, audit firm will not do only audit. Just it is a common usual parlance. We use the term audit firm. That doesn't mean audit firm means only it will do audit. No, they will do all kinds of works. So in this audit firm, let us say some 50 people are there. Considering that partners or article assistants, paid assistants, audit managers, or any other designation, whatever put together, so 50 people are there. Now, one fine day, this audit firm got the audit of the company X Limited. Now, they have to go and complete the audit of the client X Limited. When they have to go and complete the audit of the client X Limited, not one person will go, a team will go, no, right? So, first of all, among the partners of the audit firm, at least one partner will come forward and take the responsibility because someone has to sign the audit report, no? So one partner will come forward and take the responsibility. I'm going, so let us say for example, there is a partner A, he's coming and saying, I will come and take the responsibility for audit engagement of the client X Limited. So he will be called as engagement partner. Sir, why engagement has come? Why we are going to personals now? No, yeah. So when I say engagement, I'm not going into anyone's personal life. Engagement is a common term. So engagement is a kind of a contract or agreement where two persons agree to do something in return. Understood what I'm trying to say? If two people enter into one contract where one agrees to do something for the other, that is what we call it as engagement. But we only know one engagement, something which happens before marriage. No, that is one of the kind of engagement. There are n number of every contract where there are mutual promises. We all call it as engagement only. Audit is also engagement. Why? Auditor will agree to audit the client. Client will agree to pay the fees. There is an engagement between auditor and client. That doesn't mean both will marry. Okay, it is a kind of engagement. That's all. So like that, like any other kind of engagement, audit is also a kind of engagement. So since this partner came forward and took the responsibility for completing and signing the audit report of that particular audit engagement, he will be called as what? Engagement partner. Now you will have n number of article assistants. Let us say for this engagement, I have taken some 5 article assistants along with me. So 3 are junior article assistants, 2 are senior article assistants. I have taken some 2 audit managers with me and also some 3 paid assistants with me. So all put together, out of this 50 members in my audit firm, we created a team of some 10 people and we are going and collectively doing the audit of the client X Limited. We will be called as engagement team. Engagement team for conducting the audit of the X Limited. For that audit engagement, you are the engagement team. So why I am telling you all this story is, whenever I say auditor, auditor doesn't mean one single person. Auditor means entire engagement team. Wherever you are referring to the term auditor, I'm not just referring to one person, I'm referring to entire engagement team, except in 2 cases. In 2 cases, when I'm referring to auditor, I'm not referring to entire engagement team, I'm referring to only engagement partner. In all other cases, auditor means entire engagement team. But in two cases, when I'm saying auditor doesn't mean engagement part. Auditor doesn't mean entire engagement team. It refers to only engagement partner. Sir, what are the two cases? Number one, when it comes to acceptance of responsibility, when somewhere in the act it was mentioned that auditor should take the responsibility by signing the financial statements. You cannot say you are an article assistant. You cannot say I'm also auditor. My auditing faculty has told, let me sign the audit report. Not possible, because it is a matter related to acceptance of responsibility. So when it is a matter related to acceptance of responsibility, auditor means only engagement partner. When it comes to accountability before regulatory authorities, what is it? Accountability. So if auditor has done something wrong, so police have come to arrest him. Yes, these days they are doing. They are arresting the chartered accountants also, like thieves and all they are doing in some cases. So there was a lot of issues going on around this. So let us say, for example, you have committed something wrong. You are accountable now. Police has come to arrest you. Your engagement partner was not there. You are the article assistant there. You are sitting on that office today. Can they pick you by the collar, keep you in the van and take them along with you? No. Why? Because it is a matter related to accountability. Accountability means the auditor means who? Only engagement partner. Understood? That's all. So this is what regarding engagement team, auditor, and in what circumstances auditor will refer to only engagement partner. Done? Then dusted. We are done with the chapter introduction. So that a lot of basic terms, a lot of familiarity. We have basically become very much familiar with the terms throughout the audit, whatever we are going to use. Okay, understood? Right. So with this basic understanding, now what we are going to do is we are going to proceed further with the next chapter, which is going to be nature, objective, and scope of audit. Okay. So on the basis of foundation, whatever we have laid up till now, in the introduction chapter, we have basically laid the foundation. We have got to know what is what. Now we have to start building the concept on that. On that foundation, we have to start creating the structure. For that, first we have to establish the pillars. No, so those pillars will be explained in this concept of nature, objective, and scope of audit. So there is so much of information here. I will come to the most relevant part here. First, they say about origin of auditing, history. Who is worried about the history? Who is worried about history? They will say from Kautilya's Ardhasastra itself there was a reference. Audit means audir. Audir means to hear. Traditionally, people used to read and auditor used to listen. Gone are all those days. Now, auditing means nothing but doing the audit, where everything you will do the verification, paper verification and so on. System verification has come now. Okay, when we have advanced this further, there is no purpose in reading the history. If your time is so bad, an MCQ can come for here. You are so bad, your destiny is so bad, and I believe that if this has to happen, your entire destiny should be very bad. Not just one person. If the entire people who are giving the exam, if all their destiny is bad, then they will ask this kind of questions. Okay, so but just they say a few references here, just ignore it and all. Now, coming to the main part, meaning and nature of auditing. So this part we have just now completed. So meaning, I think we need not refer to it once again. I have already explained you what is the meaning of the audit. So for one last time, I will not ask you again and again. For one last time, we will repeat what is the definition of audit. So tell me, what is the meaning of audit? Independent examination of financial information, whether profit oriented or not, irrespective of the size or the legal form, when such an examination is conducted with a view to express an opinion thereon. Very good. So now this point we have already told. Audit is a what kind of examination? Independent examination. So what is the meaning of the term independence? Now if you read the technical meaning here, judgment of a person should not be subordinate. Subordinate means what? Should not be influenced according to the wishes and directions of another. So independence means judgment of a person should not be subordinate. See, one more common problem the students are having with regard to auditors, they don't write the proper words. Terminology you will miss. You will understand the concepts. You will understand the concept. But what is the problem, you know? When someone is teaching you, most of the people will teach you in a very plain language. That's not the correct approach. At the time of teaching itself, you have to get accustomed to the language. Someone should teach you in the language of the audit. It is not something like I'm explaining in simple term. Later, I'm asking you to learn the technology from, learn the terminology from the book. No, explanation part should come from teaching. At the teaching point itself, you should get adopted to the terminology. Okay. So if you are doing self-study and all, no one will dare to do it. I know it. If at all, someone is doing the self-study and all, at the time of first learning itself, you have to learn with the terminology. That's what the key ingredient for success in the audit paper. So don't never ever try to learn first in a simple language, then later try to remember the terminology. That's not going to happen. That's not going to happen. So when you change your roots, when you are learning for the first time only, you get accustomed to the terminology, then the path becomes easier. Okay, right. So what is the meaning of the term independence? The judgment of a person should not be subordinate to the wishes or directions of another person. Next one. So this all we have covered. So what is the meaning of independence and all? Then coming to this part, this also we have covered. It is not necessary the profit orientation of entity. Whether your client is profit oriented, not for profit oriented, all of this is not going to matter at all. Next one. The purpose of audit is to express an opinion. This point also I have told, as an auditor, you are required to express an opinion. But here comes in some extra points. Before you express your opinion, what are the bare minimum points you have to check? Like this, I will ask a question. What are the points which you have to check before expressing an opinion so that financial statements will not mislead anybody? This terminology you remember. So what points you will verify to see that financial statements will not mislead anybody? So you are giving opinion. So you should be very responsible. So you should make sure that financial statements are not misleading before expressing opinion. So what things you will check to make sure that financial statements are not misleading anybody? What are the minimum points you will check? There are 6 points are there. How many? 6 points. There are 6 points which auditor should check to make sure that financial statements will not mislead anybody. What are they? Number 1, financial statements should be prepared according to books of accounts. Financial statements are not something just coming from the air. There is some source. What is that? Books of accounts. So whether financial statements are drawn up with reference to books of accounts, which means financial statements are matching with the books of accounts. But you should not write this term financial statements are matching. You have to write financial statements are drawn with reference to the books of accounts. Simply, if I have to put it, financial statements are matching with the books of accounts or not. Number 2, those entries in the books of accounts also are not coming from here. Though there should be sufficient and appropriate evidence for entries in the books of accounts. Clear? First 2 points, financial statements are drawn in reference to books of accounts. Entries in the books of accounts should have a sufficient evidence. In the form of what? Evidence is what? Supporting documents. So if you find a purchase transaction in the books of accounts, supporting document is purchase invoice. If you find any purchase of immovable property, supporting document is that sale deed and all. So like that, whether the entries in the books of accounts are adequately supported by sufficient evidence. Next, none of the entries in the books of accounts has been omitted, which means what? No omissions. Whatever entries which are there in the books of accounts, every such entry should be compiled in the financial statements. So none of the entry should be omitted. Simply, if I have to put it, no omissions. Number 4, the information should be clear and unambiguous. Don't portray all your communication skills in the financial statements. Keep it simple. If someone reads the financial statements, it should be clear, it should be unambiguous. It should not create any kind of confusion. By reading, someone should get a clarity. It should not be creating confusion. So financial statements, information conveyed by the financial statements is clear and unambiguous. Next, the financial statements are properly classified, described and disclosed in accordance with accounting standards. Simply, if I have to put it, compliance with the accounting standards. Next, finally, the financial statements present a true and fair view. If they are giving a true and fair view or not, we have to check. But this we will check only in the case of fair presentation framework. We will check true and fair view only in the case of fair presentation framework. 6 simple points here. Before you express opinion, what are the points you will check so that financial statements would not mislead anybody? Number 1, financial statements are drawn in reference to books of accounts. Entries in the books of accounts are supported by evidence. The information, there should not be any omissions. It should be clear and unambiguous. Compliance with the accounting standards. True and fair. Clear? Understood? And what is the whole purpose of having this audit? Why audit as a function has evolved? Why function of audit has evolved? Ultimately, users need information. No, management is preparing. They can directly give it to the users. Why we need audit? Why we need audit? Because management, shareholder just will invest their money. They will not run day-to-day business. Just because you are purchasing one share of Reliance, you can say yourself as owner. I'm owner of Reliance. But that doesn't mean every day Ambani will call you every morning what I should do today. No, it is not going to happen. So entire business will be run by management. Decisions will be taken by management. Financial statements are also prepared by management. If you don't know what really is happening inside the company. So when business is run by the management, financial statements are also prepared by the management. How can that shareholder have a confidence that whatever information conveyed is correct or not? You will not have that confidence. So there is a need for enhancing the confidence of users of financial statements. That's why the function of audit has come. That's why the function of audit has come. What is the whole purpose? To enhance, to increase the confidence of, come on, tell me, to increase the confidence of users of financial statements. Okay. Why, sir? Why audit only will increase the confidence? Independent examination. Society is trusting you. Society is trusting you. They are saying that you are an independent qualified person. For us only, they are using all these terms. Independent qualified person is verifying and expressing his opinion. So they are giving respect to our qualification. They are believing us. So since we are an independent qualified person and we are verifying, that's why that will increase the confidence. So if the management presented something in the financial statements, auditor gave an unmodified opinion, that will immediately boost up the confidence of the shareholders so that they can take the decisions on the basis of the financial statements. That's what the whole purpose, to enhance the confidence of users of the financial statements. Clear till here? Next. Then one more beauty of the subject of the audit is connectivity here. Connectivity. Audit is not a standalone subject. Audit is not at all a standalone subject. Audit is going to have a linkages with various disciplines. With various disciplines, it will have a linkage. First of all, as an auditor, you are required to verify financial information. If you are required to verify financial information, first you have to learn about accounting. We have to learn about accounting. So definitely auditing is 100% linked with accounting. Why? Because as an auditor, we are required to verify financial statements only. In order to verify the financial statements, first you should know what are the accounting principles, what are the accounting standards, what are the generally accepted accounting principles, what are the fundamental accounting assumptions, you should know. So undeniably, auditing is linked with accounting. There's no doubt about it. Not just that, auditing and law. Even as an audit as a subject is linked with the discipline of law also. Why, sir? You are conducting audit of company. You are required to give certain points regarding the compliance of the Companies Act. First, you should know what are the provisions of the Companies Act. Then only you can then only you can comment on its compliance. So definitely, auditing as a subject is linked with law. Next, auditing and economics. Sir, what economics, sir? Micro, macro too, we have long ago when we are kids, we learned. So what auditor should be more concerned with? Micro or macro? Microeconomics. Macro means overall industry and all. Okay, to some extent as an auditor, we get involved with macroeconomics, but mainly we'll be concerned with microeconomics within the entity, what is working, what is not working and all. Then auditing and behavioral science. Sir, what is this? Psychology. Behavioral science means what? Human psychology. As an audit as a subject is also undeniably linked with human psychology also. But thankfully, we don't have that subject as a part of our curriculum. So, but we have to be well versed with the human psychology, because being an auditor, we have to deal with people. Being an auditor, we have to deal with people. You have to go and get the information from the people. You have to ask the information. Sometimes you have to make them fall in your trap and extract the information. So for that, you need to know how to deal with the people. So that's why auditing as a discipline is also linked with behavioral science. Not just that, auditing is linked with statistics and mathematics. Statistics here, as a part of your CA foundation, variance, covariance, standard deviation, so much of trouble. So you might have got it out. Why the hell I'm reading all this? Regression analysis, so many things. No. So what the hell I'm going to do with all this? That's what you might have felt. But the world runs on statistics. World runs on statistics. And particularly talking from the auditing perspective, how the statistics will be linked is sampling. We are not going to do 100% verification, but we are going to verify the transactions on sampling basis. That sampling principles, concepts, probability theories, everything is derived from statistics. And not just that, mathematics. Auditing is linked with mathematics also. Most advanced mathematics we do. What we do, addition, deletion, subtraction, and most advanced is division. That is only we use here. Derivatives and all, we are not going to use it. You don't worry about it. So in that manner, it is going to link with mathematics as well. And auditing and data processing. Auditing and data processing. Nothing but what? Information technology. Today in this digital world, we have to do the auditing with the system only. If you go to the client and say, sir, you please give me a printout of all the books of accounts, then I will do the audit. Next day, he will give you a letter for removal. He will appoint somebody else. So we have to get well versed with data processing, information technology. So auditing as a domain is linked with data processing. And even auditing is linked with financial management. So how this financial management will get linked here is, in the financial management, you will learn a chapter called ratio analysis, where you calculate n number of ratios. So no, all that ratio analysis, whatever you have learned, that is one chapter, that is one method as analytical procedure. Whatever you have learned as a part of that What is that? Financial management, ratio analysis. That is none other than a technique which we use in audit, which we call it as analytical procedures. So in this way, you are required, that is linked with financial management and even auditing and production. What do they mean by production is costing here. What do they mean by production? Costing here. Auditing as a subject is linked with the costing also. Simply, if I have to put it, auditing is such a subject which is having a lot of connection with various other disciplines. It is not a subject on its own. It is having linkages with all other disciplines. Auditing is linked with accounting. It is linked with law. It is linked with economics. It is linked with behavioral science. It is linked with data processing. It is linked with financial management, statistics and mathematics, and finally production also. Clear? Next. So then we have this thing called, this I will come back to that later, objectives of the audit and all. First I will talk about scope of audit. Sir, if I am getting appointed as auditor of a company, there should be some defined scope no, in which I have to work, what I have to cover, what I need not cover, what will fall in my scope of work, what will not fall in my scope of work. We have to look, we have to know. So let us try to understand what will be included in the scope of the audit. Number one, first thing they will say, there is nothing like a limited scope. You have to cover all aspects of the entity which are having a linkage with the financial statements. Every aspect of the organization which is having a connection with the audit that will form part of your scope. So when I say audit, it is not just that you will restrict only to accounts department. You will not just go and get the financial statements, books of accounts and spend that 10-15 days of time with only financial statements and books of accounts. No. So let us say, for example, to know whether the inventory is correct or not, you might be required to go to the warehouse where the stock is kept and you are required to verify that also. You are required to do the warehouse stock counting also. Sir, it is not linked with financial statements, no. Who told not linked with financial statements? If you go and do the physical verification, then only you will know what is the quantity of the stock as on the balance sheet date. That quantity only you will use it for valuation of the stock. So like that, every aspect of the organization which is related to the financial statements, which is relevant to the financial statements, should be covered in the scope of the audit. Next, one of the most important area is you have one of the primary activity which is included in your scope is checking the reliability and sufficiency of financial information. What is it? Checking the reliability and the sufficiency of financial information. You have to check, see, main objective is financial information. So one of the main area which is included in your scope is whatever financial information which the management has provided to you, is it reliable? Reliability means trustability, whether you can trust that financial information or not, and is that information sufficient? Is that information sufficient? So the auditor should be reasonably satisfied. You have to satisfy that information contained in underlying records and source data is sufficient. It is reliable and sufficient. But how, sir? How? How will I get to know whether the financial information is reliable, whether the financial information is sufficient or not? How will I get to know about it? The standard says by making a study and assessment of accounting systems and internal control system. So one of the things which is included in your scope is to check the reliability and sufficiency of financial information. But how you can get to know whether the financial information is reliable and sufficient? By making a study of their accounting system and internal control system. Sir, what is accounting system? What is an accounting system? In the today's environment, it is simply an accounting software. It is simply an accounting software because today everybody is maintaining the accounts in a computerized environment. This manual accounts has become a history. Manual accounts has become a history. So everybody is doing a automated accounting. So in the today's environment, accounting system means simply an accounting software. But if you go a decade back and all, where manual accounting used to happen, every process which we follow, by which we are maintaining the books of accounts, that entire system used to call as accounting system. Like writing of the vouchers, physically signing the signature, physically putting the signatures, recording that in the books of accounts. So that we used to call it as accounting system. Traditionally, all these manual activities. But today, entire things are done in the system. So simply, if I have to put it, whatever accounting software the client is using, that will be called as accounting system. So if you want to know whether the financial information is reliable and sufficient or not, first thing is we have to do a deeper study of the accounting system, what they are using. Then we have to make a study of internal control. So now what is the internal control? What is internal control? Any procedure, any policy which is getting followed by management, which is getting followed in the organization to prevent or to achieve their objectives. To achieve their objectives. Or this is technical meaning. Technical meaning will come back to that later. But if you put it in very simple terms, any policy, any procedure which is getting implemented in the organization to prevent something from going wrong. This is simple meaning. So to prevent something from going wrong, or if I have to put it in very specific terms, either to prevent something from going wrong, or to detect it if something has happened, or after detection to correct it. To prevent, detect, or correct something wrong in the organization, whatever policy and procedure we have implemented, that all we are going to call it as internal control. You look up any organization, you will be able to find n number of internal controls. But just we don't know that it is an internal control. If I have to give you one simple example, if you go to one local kirana store and all, local kirana store you go, very small kirana stores and all will be there near your houses and all. So they will have a piece of paper. They will have a notepad. To that they will attach one piece of paper. Every transaction, whatever they have done, they will record the amount. Every transaction, they will record the amount. These days, you are going and doing the phone pay also. These days, some people will give the cash also. The shopkeeper will maintain that stamp pad. On that piece of paper, he will keep. So if you are making phone pay and cash, 2 columns he will maintain. All the cash sale amount only he will record. Nothing else. Amount only he will record. And this phone pay amounts only he will record. By the end of the day, he will tally. So he will count all that amount of the cash and he will match it with the balance in the counter. He will match the entire amount of the phone pay and he will check, cross verify with the phone pay. This is also internal control. Simple example, if I have to put it, this is an internal control, a policy followed in the business to prevent something from going wrong, or to detect something has already gone wrong, or correct from happening this again. This we call it as simple internal control. That shopkeeper doesn't know that he is following internal control, but he is following an internal control. Or you take this big organizations, like when you go to the supermarkets and all, you'll be able to find a CCTV surveillance. You are getting continuously monitored, internal control, and security checks will happen. Security checks will happen. So whenever you try to enter inside the shop, inside that DMart and all, that security guard will be scanning. What he will be scanning for? He will be scanning for something which he will never be able to find it in his life. Explosives. Explosives. Whether you are carrying any explosives, no one will carry, but he will check each and every customer. Yes or no? That is also one internal control. So like that, and also billing, if you see, so there will be barcode scanner. Only by scanning the barcode, price and discount will get captured. The price cannot be entered manually. And also cash box, you see, cash box always will get locked. When the employee enters the amount, then only cash box will open. Then only he will give you the change. Once again, he has to close the cash box for next entry. And before you leave that supermarket, security guard will be standing at the exit gate and he will check whatever items you are carrying in your trolley, whether they are all billed or not. These are all nothing but internal controls. Every organization you see is from smaller to larger. Every organization will have internal control. Simply any policy or procedure which is getting followed by the organization to prevent, detect, or correct something from going wrong in the organization. So one of the main objective, one of the main thing which will be included in our scope is we have to check whether the financial information is reliable and sufficient or not. And to do that, what we have to do, we have to make a study of accounting system, internal control system. Next. Third most important area which will be covered in your scope is you have to check proper disclosure of financial information. Whatever financial information is there that has been properly presented and disclosed or not, you have to check. Sir, how will I fulfill this scope? So auditors to decide whether relevant information is properly disclosed, keeping in mind the statutory requirements. First thing is you have to understand the statutory requirements. Why? Because what things you have to disclose, what things you need not disclose, that will be governed by the laws and regulations. So first you have to understand the statutory considerations. Thereafter, we have to ensure that financial statements are properly summarizing transactions and events by considering the judgments made by the management. Management will make n number of judgments in the preparation of financial statements. We have to evaluate their judgments. And so the next point is also that only the management will make various judgments. You have to make a in this process. You have to, the management is responsible for preparation in the process of preparation and presentation of financial statements, makes many judgments. And one more thing which you have to check is you have to check whether the management has applied correct accounting policies and whether they are consistently applied or not. Two things. They should select such accounting policy which is appropriate for them. Selecting alone is not enough. They have to do a consistent application. Year after year, same accounting policies are followed or not. That also you need to check. And also you have to realize the fact that only historical financial information is covered in your scope. Audit is a term given to the engagement which involves only historical financial information. By doing audit, we are not going to check at any future financial information. Our scope is mainly concerned with historical financial information. Future financial information or prospective financial information also we call it. That will never get included in the scope. Sometimes we might be doing only prospective financial information, but for that we can't use the term audit. That doesn't mean auditor will never work with prospective financial information. No, Auditor will also work with prospective financial information, but that engagement we can't call it as audit. That engagement we should not call it as audit. Whenever I say audit, in the audit only which kind of information is covered? Historical, something which has already happened in the past. Something which has already happened in the past. Only historical financial information will get covered in your scope. Understood? So these are the three areas which will be covered in the scope. Number one, you should cover all aspects of the entity which are related to financial statements. Number two, you have to study, you have to check the sufficiency and reliability of financial information. How? By making a study of accounting system, internal control system. Number three, you have proper disclosure of financial information. This you have to do it from the statutory point of view, and also you have to evaluate various judgments. You have to select the consistent application of accounting policies, and always keep in mind it is only historical financial information. Sir, we understood what is included. What is not included, sir? We should know what we should not do. First, before doing anything, if any client has asked you to do any engagement for them, don't just get a list of what is included. You should focus on what is not included. So what is not included in the audit? Number one, the auditor is not expected to perform any duty which is falling outside his scope. Let us say you are working as auditor of one company. In that company, one machinery broke down. The management is calling you, please go and fix the machinery. Is it falling in your scope? No, don't do it. You are not a mechanic there. You are an auditor there. So, or let us say, for example, company is going through one legal case. They are calling you and saying, we have appointed you as an auditor. Please go and fight the case case for us in the court of law. Are you supposed to do it? No. So, as an auditor, you are not supposed to do anything which is requested by the client outside of your competence. You are not supposed to do it politely or even in a strong manner. Say it on the face of the client only. This is not my scope. I will not do it. Next, he is not an expert in authentication of documents. If the client is expecting you to verify the authenticity of the documents, don't do it. Authenticity means what? Genuinity. Genuinity. So let us say, for example, the client is giving you a check and asking you to verify whether this signature is a genuine signature or forged signature. Please find out. Will you be able to do it? No. You are not a forensic expert there. You are not an expert in authentication of documents. If someone is asking you to do that kind of activities, you are not supposed to do it because you are not an expert in authentication of documents. And also, audit is something which is different from official investigation. As an auditor, you are not required to do investigation. So what is the difference between audit and investigation? Audit is a general purpose arrangement, general purpose engagement, where we will try to verify the overall areas with the objective of finding out whether there is any material misstatement or not. But investigation is a special purpose engagement which will be required only in special cases. So like, let us say, for example, an organization is suspecting in the purchases fraud is happening. They will ask you to come and investigate only the area of purchases. So like that, it's a special purpose engagement. Whether there is a suspicion or not, every year audit will happen. Whether there is a suspicion or not, every year audit will happen. But investigation is not a every year engagement. Only when something exceptional happens, then only investigation will happen. And also, in audit, you can only get satisfactory evidence. But in investigation, you are required to get conclusive evidence. What is that? Conclusive evidence. So as an auditor, you can't even get the conclusive evidences also. Understood? So don't mistake your audit for investigation. You are not required to do that kind of procedures which are generally required to be done in investigation. So that's what they say. He will not have any legal powers like search or recording statement of witnesses or examining on oath. Investigators will do this. Investigators. So you might have watched in the movies and all income tax raids. So what is that income tax raid? A group of professional people coming and doing all the unprofessional things. Yes or no? You are entering somebody's home. You are stopping the communication of them. You are breaking their walls. You are breaking their ceilings. You are cutting the communication and all. You are taking all the money and going away. Okay, ultimately that person has committed tax evasion and all. But entering into someone's personal space and doing all these things is unprofessional things only. No. So they have supreme powers. So those people who are coming for investigation, they have specific legal powers to do all this. They can cut the communication and all. They can't slap and all. In movies, they show that they will slap, they will beat, all that also they will do. But that is not permitted. So, but whatever it is, that investigation, they have specific powers. They can even examine the person on oath also. Now, if you try to do all this kind of things in the audit, no, client will hold you by the collar and throw you outside of his office. So we don't have all that legal powers like examining on oath and all. And also, audit is distinct from investigation. Investigation is a critical examination of the accounts with a special purpose, but audit is a general purpose engagement. The objective of the audit, on the other hand, has already been discussed, is to obtain reasonable assurance. We'll come to the reasonable assurance point in a short while. Then, scope of audit is general. We cover entire organization. But scope of investigation is specific. We cover only specific areas for which we are asked upon to do the investigation. Now, we come to the next part, objectives only. We'll try to understand the objectives in a little detailed manner. So we have SA 200, the first and foremost standard on audit. Like the way AS1 is the first and foremost accounting standard, we have SA 200. Sir, what about 1 to 199? Not there. No. SA 200 is the first and foremost standard on auditing. So whose title is Overall Objectives of an Independent Auditor and Conduct of Audit in Accordance with the Standards on Audit. Yes, this is the title. Overall Objectives of an Independent Auditor and Conducting an Audit in Accordance with the Standards on Audit. Sir, are we required to remember the standard names also? Remember SA 200 here at least. SA 200 and a few things anyhow you can remember. Like SA 570 going concern, 560 subsequent events, 580 written representation. So like that, wherever it is possible, you remember it. But remember SA 200, okay? For God's sake, you remember it. So overall objectives of an independent auditor and conducting an audit in accordance with the standards on audit. So this standard says two objectives. Actually, whatever objectives we have learned, those are also some summarized versions of SA 200 only. But if you read the text as it is, if you read SA 200, literally this reads out like this. The objective of an auditor as per SA 200 is to obtain reasonable assurance about whether financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to express an opinion whether financial statements are prepared in all material respects in accordance with applicable financial reporting framework. On a broader manner, whatever we have learned, that only they are saying whether financial statements are free from material misstatements, whether due to fraud or error, and expressing an opinion whether financial statements are prepared as per applicable financial reporting framework. But they use one more phrase. What is it? Reasonable assurance. Sir, what is this reasonable assurance? Now, first let me tell you one more thing here. There are three kinds of assurance here. One is something called reasonable assurance. Not three, many we have. And we have something called absolute assurance. We have something called limited assurance. We have something called moderate assurance also. Different assurance we have. So one is reasonable assurance, absolute assurance, limited assurance, moderate assurance. In audit, we give which assurance? Reasonable assurance. Sir, what is the reasonable assurance? They say that reasonable assurance is a high level of assurance. Assurance means what, first of all? Confidence. In audit, we try to give assurance. First, we should obtain reasonable assurance. We should be confident enough. And what kind of assurance we have to obtain? Reasonable assurance. Reasonable assurance means what? High level of assurance, but not absolute assurance. But not absolute assurance. What do you mean by absolute assurance? Absolute means what? 100%. Pakka. So, absolute assurance we can never get in audit. Even standards are not expecting also. Don't even try to do it. Standard itself is not expecting. So in audit, we try to get an assurance which is a reasonable assurance, which is a very high level of assurance, but not an absolute assurance. Absolute assurance is something similar to giving guarantee. From the beginning, I was continuously saying as an auditor, you will express opinion. Nowhere I told auditor will give guarantee. Nowhere any standard has told it. So standard is also asking you to obtain only reasonable assurance. Get a high level of assurance, it is enough. We are not expecting from you absolute assurance. Absolute assurance means something giving a 100% guarantee. So why not absolute assurance? Why we can't get absolute assurance? Because the process of auditing is suffering from some limitations, some drawbacks. And these limitations are of such a nature that no matter whatever you do, it can't be avoided. The process of auditing is suffering from some limitations, and those limitations are of such a nature that no matter how much effort you put it, these limitations are unavoidable. You cannot eliminate them. Whether you like it or not, you have to accept the fact. The process of auditing will always suffer from some limitations which are unavoidable. And we call those limitations as what? Inherent limitations. That means no matter how effectively you do the audit, there is always a chance of your opinion going wrong. Chance probability. I'm not saying always your opinion go wrong, but you have to realize the fact that no matter how sincerely, how effectively, how much effort you are putting for the audit, but still there is a chance of your opinion going wrong. Why, sir? Inherent limitations. Inherent limitations. So whatever it is, why auditor cannot obtain reasonable assurance, and why auditor can obtain only why auditor cannot obtain absolute assurance, why he can obtain only reasonable assurances. Number one, the process of auditing is suffering from inherent limitations. Or why auditor cannot give guarantee, for that also same reason, inherent limitations. There is always a chance of auditor's opinion going wrong. The reason being inherent limitations. By doing audit, there is a risk involved. There's a risk involved. What is that risk? Don't say audit risk. Tell me what is that risk actually. Scenario you tell me. There is a risk of your opinion going wrong. There is a chance of your opinion going wrong. If tomorrow you have given a positive opinion, you have given a modified opinion, but later if fraud was found out, regulatory authorities will question you. Boss, you have done the audit, but you are unable to find out the fraud. See how much big fraud has happened. Relying on your financial statement, someone has taken a decision. Now who will be held responsible? You face the consequences. That risk will always be there or not. That risk we call it as audit risk. The chance of auditor's opinion going wrong. Can you eliminate that risk? Can you completely eliminate that risk? Can you reduce that risk to zero? What do you mean by completely eliminating the risk or reducing the risk to zero? That means you are saying that I have done the audit, my opinion will never go wrong. Just now I told it is not possible. So audit risk can never be eliminated. Audit risk can never be reduced to zero. Once again, the reason for that is once again inherent limitations. So inherent limitation is going to have multiple consequences. So inherent limitations are the reason why auditor cannot obtain absolute assurance. Inherent limitations are the reasons why auditor can't give you guarantee. Inherent limitations are the reason why there is a chance of auditor's opinion going wrong. Inherent limitations are the reasons why auditors can never be eliminated or can never be reduced to zero. Understood? So what are that inherent limitations? We'll see it in a short while. But whatever it is, as an auditor, even SA 200 is also expecting you to obtain only reasonable assurance, high level of assurance, but not absolute assurance. Then we have something called limited assurance. Limited assurance, we try to get in an engagement called review engagement. We try to get in an engagement called review engagement. Sometimes as an auditor, we might be called upon to do review. Sir, what is the review? One best example if I have to give you, quarterly financial statements. Listed entities will prepare interim financial statements. Those interim financial statements also will be published. Like often if you watch the business news channels and all, you will find that Q1 results are declared, Q2 results are declared and all like that. Listed companies will declare. Sir, will that interim financial statements also will be audited? Will also be verified by the auditor or just like that management will publish? They will also be verified, but we don't call it as audit. There a very limited verification will happen. Very, very limited verification. Like in audit, we do procedures, we will not do that in review engagements. So that interim financial statements is one example of that review engagement. In the review engagement, we give a assurance which is a limited assurance, which is far below the reasonable assurance. Reasonable assurance itself is not an absolute assurance. Even below that, we give one more assurance called limited assurance. In review engagements, we are going to give it. Then we have something called moderate assurance. Moderate assurance will be given in case of other than historical financial information. Exactly. So when you are dealing something with other than historical financial information, when I say other than historical financial information, it could mean two things once again. It could be either prospective financial information or it could be a non-financial information also. Other than historical financial information, I told. When I say other than historical financial information, it could be either a prospective financial information or even it could be a non-financial information also. So in case if you are doing any engagement where the subject matter is other than historical financial information, there we give moderate assurance. Understood? So these are different kinds of assurance. Since we are dealing with audit, we are only concerned with reasonable assurance, not even absolute assurance. So that is what the meaning here. So one of the objective they have told you have to obtain reasonable assurance whether financial statements as a whole are free from material misstatements and express an opinion whether financial statements are prepared as per applicable financial reporting framework. Then second objective, then finally you have to report on the financial statements. Whatever opinion you are expressing, as I have told, don't just say it expressly, you have to include it in the form of a written report and communicate as required by the standards in accordance with your findings. Now, after completing your audit and all, you will have various findings to all that findings you are required to report it. How you are required to report that findings? Once again, for every finding, there is a specific standard. Like if you have an issue regarding going concern, you have to report it. How? As per SA 570. You have subsequent event, you want to report it. How? As per SA 560. So like that on whatever issues you have identified, you have to report it, and that reporting also you have to do it as per the standards. Understood? Right. So this is what detailed analysis of the objective. So as an auditor, your objective is to obtain reasonable assurance whether financial statements as a whole are free from material misstatements. And they are telling reasonable assurance is distinguished from absolute assurance. Absolute assurance is a what? Guarantee. However, reasonable assurance is not a complete guarantee. It is a what? High level of assurance. And audit of the financial statements should be carried out by the auditor with professional competence. Competence means capabilities, and also you have to do the audit not as per your choice. You have to do it as per standards on audit. Audit procedures, whatever you are applying, that should be as per standards on audit. You have to obtain the evidence, and from that evidence, you have to draw the conclusions, and that point you are required to report it. So now I will take this opportunity to explain one more point. Sir, what is the entire process of the audit? What happens in the entire audit process? So it all starts with auditor's appointment. Auditor will get appointed. So a client will approach you. Generally, we will only approach the client. Don't write in the exams. We should not do it. It is a violation of the professional ethics and all. So just the client will approach the auditor asking you to do the engagement. That is the starting point. Thereafter, we accept the engagement. We accept. We'll say yes, okay, I will do the engagement. But before accepting and all, whenever the client has approached, before appointment and all, there will happen a few things called preliminary engagement activities. What will happen? Preliminary engagement activities. Just like that, just a client has come, don't jump in excitement and accept. Before accepting the audit engagement itself, there are some formalities which you are required to fulfill. So, like even we have to draft our engagement letter, like that, various formalities will be there. Client will approach us, we will perform all the preliminary engagement activities, then we accept. Then we accept. So just because you have accepted the audit, it doesn't mean some magic will happen and all the evidence you will get in your dream and you will give the report. No. So ultimate objective is to give the report. There is no doubt about it. Ultimate objective is to express the opinion and give the report. That is the last stage. But in between, various things will happen. So whenever you are giving your opinion, that opinion should be supported by evidence. So no, if you give opinion regarding anything, if tomorrow someone is coming and asking you, you gave so and so opinion, no, what is the basis for your opinion? People will ask. When someone is coming and asking you what is the basis for opinion, you should have some supporting information to prove your opinion. The evidence for opinion should be there. Similarly, when you have given audit opinion, be it unmodified opinion, be it modified opinion, if tomorrow someone is coming and asking you what is the basis for opinion, you should be able to show some evidence. So that evidence will be called as audit evidence. What is it? Audit evidence. So simply if I have to put it, audit evidence is the information used by the auditor in forming an opinion. So to form that opinion, you will use some information, no. On the basis of some information you will give that opinion, no. So that information used by the auditor or which forms the opinion, which forms the basis for auditor's opinion, that we are going to call it as audit evidence. And this audit evidence will not come automatically. You have to put some efforts from your side. Definitely put some efforts from your side. So whatever efforts you are putting or whatever procedures you are performing to obtain that audit evidence, that we are going to call it as audit procedures. Audit procedures. So whatever procedures you are performing to obtain all that audit evidences, that we call it as audit procedures. Audit procedures is a very broad term. It includes everything you do in the audit from the beginning till the ending. Whatever you do in the audit, everything can be collectively called as audit procedures. So client will approach you, you will perform preliminary engagement activities, then you will accept the engagement, then you will start doing the audit procedures you will perform, and even audit evidence you will obtain, and finally you will give the report. In between, one more step is also that before you perform audit procedures, first you have to do the planning. Planning, very important. So we do planning for small activities only, which you will never implement. Like even for this exam also, you might have a master plan. You might have had it long ago, you would have drafted it. You might have written it somewhere also. But I know you would not have followed it. So like that, for everything, we have a plan. So we spend a lot of time on planning, but we fail in execution. So that is what the ground reality which we all have to accept. Even I plan at multiple levels. Today I have planned I will start my session at 9. Right. That didn't happen anyhow. So it happens. We do a lot of planning, but that will not turn out to be reality. So, but whatever it is, even in audit also, before you are doing audit and all, don't directly jump into performing the procedures and steps. You have to plan. Planning also, you have to spend some time. So this is what happens in the audit, and whatever chapters we are going to cover going forward, it will fall in this cycle somewhere. It will fall in the cycle somewhere. So like when we are discussing audit evidence and all, we'll be mainly discussing with audit procedures and audit evidence stage. Audit documentation is also from audit evidence stage only. Then we have risk assessment procedures. It will form part of that audit procedure stage only. Audit reporting chapter forms at the reporting stage. Planning forms at that planning stage and all. So like that, each and every chapter, whatever we are discussing, that will somehow fall in this cycle. So this is what entirely happens in the audit. So just remember this discussion at the back of your mind. So then coming to the few more objectives. These objectives are elaborating as per SA 200. Misstatement in the financial statements can occur either due to fraud or error. Don't we know this? We already know this. Misstatements can happen because of either fraud or it could happen because of error. So obtaining reasonable assurance that financial statements as a whole are free from material misstatements. It will enable the auditor to express an opinion whether financial statements are prepared in accordance with applicable financial reporting framework. So by obtaining reasonable assurance, you can get that comfort zone whether the financial statements are prepared as per applicable financial reporting framework or not. And finally, whatever opinion is there, that will be reported and it will be communicated in accordance with all your findings through a written report. And how to prepare that audit report, that we are going to learn it as a part of our audit reporting chapter. SA 700 series will deal about how to prepare that audit report. So this is what breakdown of the objectives as per SA 200. Next, scope we have already covered. So next major topic we have inherent limitations, but before that let us see some easy things which we can complete. Engagement, this we have already clarified. So engagement means arrangement to do something. So even audit is also an engagement where there is an agreement between auditor and the client. And there is something called external audit engagements. Audit engagements also can be broadly divided into two categories: external audit engagements, internal audit engagements, or other engagements you can broadly say. External audit engagement means where a person who is external to the entity will come into the audit. Stat audit under Companies Act is an external audit. Tax audit under Income Tax Act, that is also an external audit. If GST audit is happening under the GST Act, that is also an external audit. Apart from this external audit, various internal audits also will happen. Like in the case of banks, there will be something called concurrent audit, or in corporate companies only there will be something called internal audit, where a person internal to the organization only will do the audit and give the reports. So, but from auditing's perspective, we are mainly going to talk about external audit. Even majority of the discussion we are having towards this external audit engagements only. Next one. So basically, those engagements to enhance the confidence of the intended users, all that engagements we call them as external audit engagements. Then we have something called benefits of audit. Sir, why audit is needed? Or if you get the accounts audited, what will be advantages? Many we already know. Number one, it will enhance the confidence. Nothing but quality of the information will get increased. So if the management is preparing the financial statements, directly giving it to the shareholder, people will not be able to rely on its quality. But some independent person verifies it, the quality of that information will get increased. That will enhance the confidence of the users. Next, it will protect the interest of the people. See here. So it will interest is safeguarded. Whose interest? Those people who are not involved in the management. So as I've told, mainly shareholders. Shareholders are the people. Even you can take the example of bankers also. Bankers will give the loan, but they don't participate in the management of the business. So for these people, will rely on the financial statements. So if the audit happens, the management will not try to misuse them. The management will not try to damage their interest. Why? Because even if they commit something wrong, tomorrow auditor will verify and report it. So it will stop the management from committing wrong acts. So in this manner, it is protecting the interest of those people who are not involved in the management. Next, it will act as a moral check on the employees. Even employees of your client organization will have a fear. If I commit something wrong, tomorrow auditor will come and catch me. He will report to the management. Management will fire me. This moral fear will stop the employees from committing fraudulent acts. And audited financial statements are also helpful for government authorities for determining your tax liabilities, whether you have made the correct payment of the tax or not. Government authorities also will determine on the basis of your audited financial statements. And it can be relied upon by lenders, bankers for giving you financing activities. That will help you to determine your repaying capabilities. Next, it will also help you to detect the frauds and errors. So by detecting frauds and errors, you are doing a favor to the management also, so that they will also get to know what frauds and errors are happening in the organization, so that they can make sure that the same things will not happen again and again in the future. And also, it reviews existence and operation of various controls also. As I've told, every organization will have internal controls. By doing audit, auditor will find out the weaknesses in the internal control and report to the management so that they can improve them. So these are all the advantages of audit. Then comes audit mandatory or voluntary. Audit mandatory or voluntary? Depends actually. Mainly, it depends on the legal structure. So in case of companies and all, it is mandatory under Companies Act, but in other forms of organization, it is not mandatory. So we can say that audit is not mandatory for every organization. It all depends on the legal structure and applicability of the laws and regulations. So this is what nothing significant discussion here. So only one point which you have to remember: audit is not always mandatory. It depends on the entity. So for corporate like companies and all, it is mandatory. For others, it is voluntary. They voluntarily get it done. Next, who appoints an auditor? Who appoints an auditor? Mainly owners here. Owners. We have to call it as owners. If it is a sole proprietor, the owner sole proprietor himself will appoint. If it is a partnership firm, the partners themselves will appoint. If it is a company, shareholders will make an appointment, except that first auditor and all. First auditor will be appointed by board of directors. There also, if they fail, shareholders will. But usually, from subsequent auditor onwards, the power is with the shareholders, except in case of a government company. In the government company, who will come into picture? C and AG will come into picture. Similarly, in case of cooperative societies, registrar of cooperative societies also will make an appointment. Majority of the cases, shareholders. In few exceptional circumstances, C and AG, and in few exceptional circumstances, these regulating authorities like registrar of the cooperative societies also will make an appointment. So that's what they say. Mainly, an auditor will be appointed by owners, and in some cases by constitutional or government authorities like C and AG. In case of government companies, C and AG will make an appointment of auditor. In the case of the firm, the auditor is appointed by partners. There may be a situation in which auditor may be appointed by government authority, like this registrar of cooperative societies. They also can appoint an auditor. To whom the report will be submitted? Whoever appointed you, to them only you will submit the report. If shareholders appointed you, to them you will submit the report. If the CNDG has appointed you, to them also one copy you will send. You might have read it in the company audit under law and all. So in case of government companies audit report will be sent to the management also. One copy will be given to the CNDG also. So simply if you have to put it, whoever made an appointment, to those people only you will submit your reports. Understood? Now, next concept. Now we will come to the inherent limitations. So as I've already told you, the process of auditing always suffers from some inherent limitations. No matter whatever you do, these limitations are of such a nature that they are unavoidable. You can't avoid them. No matter whatever you do, these limitations are of such a nature that you can't avoid them. That's why we call them as what? Inherent limitations. Now, coming to these inherent limitations, let us try to understand what are the various categories of inherent limitations. Number one is what? Nature of financial reporting. So here what they are saying is accounting process itself is saying it's not you, it's me. Is right? It's not you, it's me. Who is saying it? Accounting is saying it. You don't have a problem. The problem is with me only. In the accounting process itself only there is a problem. What is the problem? Judgments. Management, while preparing the financial statements, they make use of judgments. They make use of various subjective decisions, which involves so many uncertainties. These terms are all important. Whatever I'm saying, judgments, assumptions, uncertainties. The moment the examiner finds these terms in your answer sheet, then only he will award you the marks. So the management prepares the financial statements, but that preparation of the financial statements is not on the basis of 100% available data. In the process of financial statements, there is no chance in some cases where management has to compulsorily make a judgment. Example: provision for bad and doubtful debts. You don't know how much debtor will repay, so their management is helpless. They have to make an assumption to create a provision for bad and doubtful debts. Calculating depreciation, useful life. We don't say useful life. Estimated useful life we will say. So that is also an assumption. We don't know, right? Today, if we purchased a machinery, whether the machinery will work for 1 year, 5 years, or within 6 months only short circuit will happen and entire machinery will get burnt, I don't know. But I will make one reliable estimate: 5 years. Or net realizable value, inventory valuation, NRV is also an estimate. Is it so? What is NRV? Don't say net realizable value. Tell me. What is net realizable value? So they say estimated selling price minus cost of making that sale. That means as on the balance sheet date, if you go and sell the stock in the market, what is the price which you will realize? To know that you don't go and actually sell the stock. You sell the stock, where is the stock? Right. So you determine, depending on the current market conditions, what will be your estimated selling price. If you go and sell that stock in the market today, how much you will be able to realize it? You estimate it. That is also once again a judgment. So like that, there will be n number of items of financial statements where management will become helpless and they have to make the use of estimate. And when I say assumption, assumption is inherently uncertain. That assumption can turn into reality, can assumption might change also. I estimated useful life of machinery to be 5 years. But in the next year only fire accident happened, entire machinery got burnt. That means actual useful life turned out to be 1 year. But I estimated 5 years. That means last year financial statements have gone wrong. If they have gone wrong, my opinion has also gone wrong. Last year, 5 years of useful life felt reasonable for me. I gave opinion. But now, assumption has gone wrong. If the assumption has gone wrong, financial statements also will go wrong. If the financial statements has gone wrong, audit opinion also will go wrong. Understood? And also they say one more point here. The audit, we do it with the perception that internal controls will work effectively. We test the internal controls and we go with the notion that controls are working effectively. But those controls itself will be suffering from some limitations, which we will see. Internal controls itself will have some limitations. Then they might not be working as we expected, but we don't know. Because of which we felt financial statements as reliable, but in reality, financial statements are not reliable. So because of this, also auditor's opinion can go. So that is the first inherent limitation, nature of financial reporting, in which they say that preparation of financial statements involves making judgment by management. And management may involve subjective decisions, which carry a lot of uncertainty. That's why you cannot obtain absolute assurance. And one more thing is, you do the audit assuming that management will prepare financial statements in accordance with applicable financial reporting framework, and they will also have internal controls. But however, the controls may not work effectively as you expected. Next one. So that is first point. Now you are saying it's me only. Sorry, it's you only. It's not me. First point says it's not you, it's me. The problem is with accounting only. Second point, they are saying the problem is with you also. It's you only. So what is that? Nature of audit procedures. Nature of audit procedures. The process, the procedures, whatever we are performing, they themselves have some limitations. Sir, what are that limitations? So as an auditor, as I have told, for expressing opinion, we need evidence. That evidence we are going to obtain by performing audit procedures. We all know it. But however, there are practical and legal limitations. Sometimes we have to perform audit procedures with limitations, practical limitations. Let us say, for example, I want to go and verify the stock. That stock is kept at some place. Let us say the stock is kept at Kashmir. Now, currently, what is happening is some social unrest is there. You have to go and verify the stock at the warehouse at the Kashmir. You have to go and verify whether really that much quantity of stock is there or not. But you can't go. Social unrest is there. If you go, you will not come back. So I have not seen any such auditor who is so serious, who will give more importance to the audit than his life. So there are practical limitations. You are not able to go to the warehouse and verify the stock. Legal limitations. You want to verify the stock in the godown, but that godown was sealed by the GST department, or some legal authority came and sealed it. You can't say, no, I am an auditor, I will break the seal, go inside and verify the stock. No. There also you will go to jail if you break the seal of the government. So like that, sometimes we have to do the audit with practical and legal limitations, because of which we are not able to obtain evidence. We believe whatever has been told. Because of that reason also opinion can go wrong. Next. And if you have to obtain evidence, who has to provide you information? Management. Sometimes management themselves will not provide you requested information. Either intentionally or unintentionally, management themselves may not provide you information. Then also you will express your opinion on half-baked information. Next. And fraud. See, sometimes the fraud will be carried out in a very sophisticated manner. And the person, whoever is committing a fraud, if he is a very intelligent fellow, he will create fake evidences. He will destroy existing evidences. He will take care every attention to make sure that everything is looking normal. He will put all the efforts to conceal it. Once again, terminology. Concealing means what? Hiding it. So sometimes fraud will be carried out in a sophisticated manner, unscrupulous manner, where all the measures are taken to conceal it. If such fraud has been carried out by such an intelligent person, no matter how much effectively you do the audit, there is always a chance of not detecting that fraud. PNB scam, 14,000 crores worth of scam. Now it has not happened in a day or two. Over a span of 7 to 8 years, it happened. Sir, for 7 to 8 years, were auditors sleeping? No, auditors are doing audit. But why they are not able to identify the initial 7 years, sir? Only in the last year, when the amount has grown to 14,000 crores, then only why they are able to identify. Why? Because in the initial 7 years, the fraud was carried out in such a manner that they have carefully organized the schemes, so that they created every such thing to believe that nothing is wrong. But fraud can be managed only up to some volume. At certain point of time, it becomes very big, which goes beyond your control. Then ultimately, it will get busted. So here, can I blame the auditors for the initial 7 years for not detecting fraud? No, that is inherent limitation. The fraud has been carefully organized and carried out in a sophisticated and unscrupulous manner, where they have used all the ways to conceal it. So because of this also your opinion can go wrong. And also this point we have already covered. As an auditor, you are not an expert in authentication of documents. You verify, check, signature is there, but actually that signature is forged. You are not able to find it out. Is it because of your mistake? No, because you are not a person who is an expert in authentication of documents. And then finally, sometimes entity may have entered into transactions with related parties. Major problem. When the transaction has been entered with unrelated person, you will not be able to influence that other person. So somehow that information can be found out. But in case if you have done the transaction with related party, sometimes you will not be able to understand the actual objective. Since the other party is also related party, they can influence the other party. Outside evidences also can be manipulated. So there also it becomes very difficult to detect the frauds and all, especially in case of transactions with related parties. So 5 points regarding nature of audit procedures as an inherent limitation. Number 1, general point. You perform audit procedures to obtain audit evidence. Number 2, sometimes you have to operate under practical and legal limitations. Number 3, management may not provide you the requested information. Number 4, fraud can be carried out in a sophisticated and unscrupulous manner designed by ways to conceal it. Last one, sometimes it may be transactions with the related parties. That's all, no? Sorry, he is also not an expert in authentication of the documents. 6 points. And this is the frequently tested area. Frequently tested area, only 6 points you have to remember. Once again, I am repeating, audit procedures you have to perform to obtain audit evidence. Number 2, there are some practical and legal limitations. Number 3, so what is the third point? Management may not provide the requested information. Number 4, fraud can be carried out in a sophisticated manner. Number 5, auditor is not an expert in authentication of documents. And the last one, this transactions might be entered with the related parties. Two categories of inherent limitations we have covered. Number 1, nature of financial reporting. Number 2, nature of audit procedures. Third point, anyhow, we know, not in the nature of investigation. As we have already covered previously, audit is not like investigation. In investigation, you have superior powers. Like you can take an examination on both, and you have some various powers connecting, cutting communication and all. But all that powers are not available. You give us that powers, then you expect absolute assurance from us. You are not giving us all the powers, but still if you expect absolute assurance, it's not going to happen. Next, timeliness of financial reporting decreases in relevance of information over time. So now what does this point is? Many students often get confused here. See, for doing audit, we don't get ample of time. Within a limited time, we are required to do the audit. So standards also will permit you, in case if you have done audit of the last year, you can use that information for conducting the audit of the current year also. For the same entity, if you have done the audit for the last year, that information you can use it for doing the audit of the current year. Standards are permitting. But since there is a time gap between obtaining that information and using it, its relevance will get reduced. Its relevance will get reduced. Simple logic here. If you get the information now itself you are using it, that information will be more relevant, more reliable. If you got the information a month ago, that you are using it now, its relevance will get reduced or not, because there has been a timeliness, there has been a time gap between the time you obtain information and you are using it. The same problem happens in the audit also. So because of the passage of the time, sometimes you might use the evidence of the last year for current year engagements. Standards on auditing will permit you also. But since there is a time gap between obtaining of the information and using it, its relevance will get reduced. And also because of that, your opinion can go. So this is what regarding timeliness of financial reporting and decrease in the relevance of information over time. And then finally, future events. Sometimes we have to deal with future events. Historical financial information only, but that historical financial information is influenced by future events. Going concern. Going concern. As on the balance sheet date, the company looked all good. It is its revenues are increasing. It is having new contracts. Everything was good, but all of a sudden, some calamity has happened, which has wiped the industry out of the business. Sometimes it happens. So, like telecom sector, we have a very good example. So everybody's fortune looked very great, but the moment Reliance has entered, all their going concerns has become vanished. But at that point of time, in hindsight, everything looks good only. So as of 31st of March, when I checked, going concern is valid. Management is also told going concern is valid. I gave unmodified opinion, but within 6 months, because of some unexpected calamity, unexpected events, company got closed down. Your opinion has gone wrong. But is it because of your mistake? No, because it is a future event which is beyond my control. Understood? That's all. These are the 5 inherent limitations. Number 1, nature of financial information. Number 2, nature of audit procedures. Number 3, not in the nature of investigation. Number 4, relevance of the information will get reduced over a period of time. Number 5, future edits. Clear? Next. So one more last concept we have from this particular chapter. Not last, two we have, but one thing is very easier. Qualities of an audit. This is very easy. Sir, what qualities you should have here? What qualities are expected from you? If you want to become a good auditor, two qualities should go hand in hand: professional qualities, personal qualities. So, since we are doing a responsible job, whatever qualities which are possessed by a good human being, all that qualities we have to possess. Like what? Coming to the personal qualities, you should have tact, caution, firmness, good temper, not shout at the clients and all. Integrity, you should be a person of integrity. People should be able to trust you. Discretion, that means decision making once again. Industry knowledge you should have. You should be very judgmental, and you should have patience. A lot of patience you require. Clear headedness you require. What is clear headedness? Not baldness here, even though we are getting it. But clear headedness doesn't mean baldness, it is a clarity of thought. Right. And then finally, reliability. You should be a reliable person. So simply, if I have to put it, he's not just like any other person. He's like ordinary businessman only. So whatever qualities that make a good businessman, all that qualities you should have, like tact, caution, firmness, good temper, integrity, discretion. All these things you should have. And he must have the shine of culture for attaining a greater height. Should have that zeal to become a person of a greater height. So you have to reach at the higher levels and all. That zeal you should have, and thereafter should have all those basic human qualities apart from technical requirements of professional training and education. And since he's required to verify the financial statements, he should have an exhaustive knowledge of accounting. A good knowledge of the accounting in all branches is mandatory in order to become a good auditor. Next. Now let us come to the assurance engagement. Important. I'll try to explain it in a simple manner. Many students often get confused here. Sir, what is the meaning of the term assurance engagement? This is a very common term, we use it here. There is something called assurance engagement. Sir, what is an assurance engagement? To call an engagement as assurance engagement, it should have some elements. To call an engagement as an assurance engagement, it should have some elements. What is that? There should be three-party relationship. There should be three-party relationship. Sir, who are the three parties? Practitioner, responsible party, and then we should have intended users. And there should be some subject matter. There should be some subject matter. And there should be some criteria, established criteria. So that only know that term they use. Yes. Elements of assurance engagement and suitable criteria. Sorry, not established criteria. There should be a subject matter. There should be a suitable criteria. So first we will try to understand till here. So there should be three parties where responsible party will be preparing some information. Responsible party is the party which is responsible for preparing some information. Now a person called practitioner, a person called practitioner will verify. They will prepare some subject matter. That information, whatever responsible party is preparing, that we call it as what? Subject matter. So responsible party will prepare subject matter. And that subject matter will be prepared as per some criteria. Responsible party is preparing some subject matter. Subject matter means some report, some information, some data. And they will prepare that subject matter as per some criteria, not out of their own choice. They will prepare that as per certain criteria. Then what practitioner will do is the practitioner will evaluate whether really the subject matter has been prepared in accordance with suitable criteria. So responsible party prepared subject matter. As a practitioner, you are evaluating whether that subject matter is prepared as per suitable criteria, and you will express a conclusion. And you are going to express one conclusion which will increase the confidence of the intended users. Which will increase the confidence of the intended users. And that conclusion he will express on the basis of sufficient and appropriate evidence. Not just in the air. That conclusion to increase the confidence of the enhanced users, he is going to do it as per after obtaining sufficient and appropriate evidence. Got all the elements? So there should be three-party relationship. Responsible party who is responsible for preparing the subject matter. Intended user, those who will use that subject matter. Practitioner who is evaluating whether that subject matter has been prepared as per suitable criteria. Now, after doing that, practitioner will express a conclusion to increase the confidence of intended users. That conclusion he will express it on the basis of sufficient and appropriate audit evidence. Wherever all these elements are present, the engagement we call it as assurance engagement. Wherever these all elements are present, that engagement we call it as assurance engagement. So now if you read it here, so there should be a three-party relationship, there should be a appropriate subject matter, there should be a suitable criteria, and there should be a sufficient and appropriate evidence, and finally a written assurance report. Nothing but you are giving a conclusion in the form of a written assurance report. So wherever all these elements are there, that we call it as assurance engagement. Now link it with the audit. Link it with the audit. There is management, which is preparing financial statements as per applicable financial reporting framework. There is an auditor who is evaluating whether the financial statements are as per applicable financial reporting framework. He is obtaining a sufficient and appropriate audit evidence. Finally, he will give a report through which he is giving a assurance to increase the confidence of intended users, nothing but shareholders. Can I call audit engagement as an assurance engagement? Can I call audit engagement as an assurance engagement? Yes, you can call it. Now, let me tell you one more scenario. There is a management. They have prepared projections. They have prepared some projections. What do you mean by projections? Next few years, for the next 5 years, how their statement of P&L will look like. They have prepared projections. And that projection, they have prepared it as per criteria. There is a bank. The bank has asked them to, the bank is ready to give them a loan. Bank gave them criteria and asked the management to prepare the projections as per that criteria. And bank has asked the management, we want assurance from one chartered accountant. We want one assurance from chartered accountant. So they came to you, management came to you. You are a chartered accountant, that means you are a practitioner. You are evaluating subject matter. Here subject matter is projection. Again is the suitable criteria. Here also you will try to obtain sufficient and appropriate audit evidence. Finally, you will give a written report providing assurance to intended user. Who is that intended user here? Is it an assurance engagement? Is it an assurance engagement? Yes. Is it an audit engagement? No. No. Why? Because I told audit is a term associated only with historical financial information, not with prospective financial information. So this is an assurance engagement, but not an audit engagement. The point which I want to make here is assurance is a very bigger term. Assurance is a very bigger term. Assurance engagement is a very broader term. Every engagement where there is a three-party relationship, subject matter, suitable criteria, written report, sufficient and appropriate evidence, all that we call it as assurance engagement. So assurance engagement is a very broader area. In that, one of the kind of assurance engagement is audit engagement. That's what I want to say. That's what I wanted to say. So assurance engagement is a very broader engagement. In that, one of the component, one of the type of assurance engagement is audit engagement. Understood? Apart from audit, there will be n number of other assurance engagements. So that much bigger is assurance engagement. In that, one of the element, one of the type of assurance engagement is audit engagement. In that, review engagement also will come. Review engagement also can come. Prospective financial information can come. Non-financial information related assurances can come. So assurance is a very broader term. In that, one of the subset is audit engagement. Clear? That's it. So here what you have to learn is definition of the assurance engagement. You have to learn. Anyhow, elements I have explained. This you have to learn in this manner only. Assurance engagement means an engagement in which a practitioner expresses a conclusion, which is designed to enhance the degree of confidence of intended users who are other than responsible party about the outcome of evaluation or measurement of a subject matter against the criteria. 3 elements, very simple. If you understand the concept, remembering is very easy. Assurance engagement is an engagement when the practitioner expresses a conclusion designed to enhance the confidence of intended users who are other than responsible party about the outcome of a evaluation. You are evaluating the subject matter against a suitable criteria. From that, whatever outcome you had, that only you are expressing it as a conclusion. Will you be able to remember this definition? Yes. So this definition along with this elements, important concept, assurance engagement. Clear? So with this we have successfully completed nature, objective and scope of audit also we have covered. Understood everybody? Now I think it's time for lunch break already. Fine, we'll take a break now. Perfect. So before the break, we have completed two chapters. One is introduction to audit, and the other one is nature of objective and scope of audit. Now, the next chapter which we'll be picking up for revision is going to be ethics and terms of the engagement. So once again, a very small chapter, but equally important from the examination point of view. So we'll try to quickly do it. So what exactly we are going to learn here? In this chapter, in this particular chapter, we are mainly going to cover the contents of essay 210, agreeing to the terms of the engagement. Along with that, some ethical principles and all we are going to discuss. So first of all, what exactly are these ethics? Do we need to have any ethics? Yes, we should have. So they say that ethics means basically moral principles which constitute the acceptable behavior. So we are all a part of the society. So when we are being a part and parcel of the society, we cannot behave, we cannot live the manner in which we want. If we have to be acceptable, our behavior has to be in certain manner. So that's what we call it as moral principles. So at a personal level itself, we should have so many moral principles and all. But even at a professional point of view, also we are required to follow a lot of moral principles. So that's what basically ethics is all about. And to govern chartered accountants, we chartered accountants, they say in this first part of the answer and all, why do we need the professional ethics? Why do we need professional ethics? They say that every profession has their ethics, like medical field has their ethics, and lawyers also will have ethics. They say that when compared with all other fields in audit, the importance of ethics is very high. Just they say it, but every profession, they for every profession equally ethics are going to be important, but they have to give some boost up, right? So they say that when compared with all other professions, in auditing profession, the role of ethics is very important. Why? Because we are enjoying the public trust. So as I've told, we do our work, we give the reports. That opinion will be used by many stakeholders. They will use it for the purpose of decision making, and we are expected to be independent. And public, if we expect the public to continue to trust us, we should definitely comply with the ethical principles. So all that ethical principles for the chartered accountants has been given in a document called Code of Ethics. We have something called Code of Ethics. So in that Code of Ethics, all that ethical principles have been given. That Code of Ethics we are going to learn at a CFN level. So we have a dedicated chapter called Professional Ethics and all. So there significant amount of time we will spend at the CFN level learning about the professional ethics in a detailed manner. But here they will give you a few things like what are the fundamental principles. There are five fundamental principles which you are required to comply with. What are the different kinds of threats to independence? How to safeguard the threats? What are the different kinds of threats? And how that threats can be overcome? How you have to evaluate independence? So like that on mainly fundamental principles and threats to independence, on those aspects they will speak about. So first, let us try to complete that discussion. So as I've told, this first paragraph is once again not that important, but they will explain you about what is the meaning of the term ethics. As I've told, ethics means moral principles which govern a person's behavior, and it is a branch of knowledge that deals with the moral principles. And ethics is something which comes from an individual intrinsically. Ethics are something which will not be taught to you. They are something which have to come from within. The way we are brought up, the way we live. So from that, ethics will come intrinsically. And here it has to be inculcated in habit. These ethics are required to be inbuilt in our habit, and which are so strong enough that to withstand any selfish motive and temptation. So we should have ethics in such a strong manner that we should be able to withstand. We should be not easily giving up for our selfish motives and temptation. We should be able to withstand the temptations and motives. And it's a science of human conduct, blah blah blah, all that they will say. The need for professional ethics, I have told you. The main logic is we are enjoying the public trust, and if we expect the public to have that trust on us, we are definitely required to comply with the ethical principles. Then, coming to the main point of discussion here, there is something called rule based approach versus principle based approach. When it comes to ethics compliance, so as a chartered accountant, you have told that we are all required to comply with the ethics. In making sure that we chartered accountants have to comply with ethics, there are two approaches, not just we chartered accountants, for everybody. If I want to, if I let's say this classroom, if I want to make sure that you all have to comply with some ethics, I have two approaches for that. Number one is rule-based approach and the other one is principle-based approach. So what is a rule-based approach? Let us say, for example, if it is a rule-based approach, means if you are coming to the class, I want to follow you some rules. I will give you a list of 10 rules. So like let's say, for example, I told you that you should come to the class on time. You should not leave in between, and your mobile phone should be turned off. You should be attentive to the class. So like that, some 10 rules I have given. That 10 rules you have to strictly follow. That is a what? Rule-based approach. But there is a problem with the rule-based approach. Everything we can't keep it in the format of rules. Let us say, for example, I told you to listen to the class attentively, one of the rule, but I never mentioned in the 10 points that you should not sleep in the class, but someone is sleeping in the class. When I pointed them out and when I asked them why are you sleeping in the class, they are telling me that in the 10 rules did you mention not to sleep, that's why I'm sleeping. So that is a problem with the rule-based approach. Even when you apply the same principle to the ethics also. If I say chart accountants are required to follow this ethics, some 10 rules I'm giving. Those 10 rules only they will follow. But complying with ethics and all is a very principle-oriented approach. So instead of that, if I say if I'm not giving you any rules and all, I want complete attention in the class. I'm not giving you rules. I'm generally saying I want complete attention in the class. If I find someone who is not paying attention in the class, I will send you out of the class. It is a principle. So now by saying this principle, what and all will come? You should not sleep, you should not use mobile phones, and you should not be talking with others, you should not be chatting with others. All this will come. So this is a principle-based approach. Now, which approach I say will follow? Which approach I say will follow? They are following both. Combination of both. So we have rule-based approach also. There are so many rules they have given. Something we call it as schedules to Chartered Accountants Act. Once again at the CFN level, most important concept is going to be they have given various schedules. Schedule 1, Schedule 2. In that each part they have given where they have told what CA in practice should not do, what CA in service should not do, what members should not do. If they do it, if they do these kind of activities, what kind of punishment will be imposed. Like the rule-based approach is there. But in addition to that rule-based approach, principle-based approach is also there. So under that principle-based approach, we have that 5 fundamental principles. Instead of telling you exact rules, they're telling you 5 principles. We want you to comply with 5 principles. So now anything which affects that principle, you will be held responsible. So I say it's following a combination of both. It is following a rule-based approach as well as principle-based approach. So let us try to understand what are that fundamental principles of the professional ethics. So we have 5 fundamental principles. How many we have? 5 fundamental principles we have. What are they? Integrity, objectivity, professional competence and due care, professional confidentiality, and professional behavior. So like that 5 fundamental principles we have. Repeat everybody. Integrity, objectivity, professional competence and due care, confidentiality, professional behavior. These 5 fundamental principles we have. Let us try to understand what is the meaning of each of this. First of all, integrity. So what do you mean by integrity? So like previously also we have covered, you should be a person of highest integrity. That means what? You should be a straightforward person, you should be an honest person, you should be a sincere person, you should be doing a fair dealing, and also you should be truthful. People should be able to trust you. So such a kind of character you have to exhibit. And what else they say is, what do you mean by integrity is, knowingly you should not get associated with such information which is either false or which is misleading or it omits some important information. Knowingly you should not get associated. If some client is coming to you asking you to work out some information, before you accept only, you know that that information is false. So if you read it here, so you should not be knowingly associated with either reports, returns, communications or other information where he believes that the information contains a materially false or misleading statement, or information has been provided negligently or obscures some information or omits some information. So which kind of information should not get associated with? Which contains false and misleading statements, or which provides information which is negligently provided, or which obscures or omits some information. Knowingly you should not get associated. Okay, if after accepting you got to know it, that we can't avoid it. But in case before accepting only, if you got to know that that information is going to be this kind, then you should not accept that engagement only. If you are doing it, then you are not a person of integrity. Next, objectivity. Sir, what do you mean by objectivity? Not to compromise your professional judgment, either because of bias, conflict of interest, or undue influence of others. Please keep your mobiles in the silent mode. So whatever decision, whatever judgment you are making, that decision, that judgment should not be compromised because of bias. You should not show any kind of bias to any client. I will do favor to this client, I will not do favor to that client. Like that, you should not have any bias. There should be no conflict of interest. There should be no undue influence of others. More or less independence only. Objectivity and independence, more or less, both try to convey the same thing. And also, you should not undertake a professional activity if a circumstance or relationship unduly influences your judgment. Say, in the previous case, they say if you know some information is false, don't accept. Objectivity says if I accept this engagement because of this relationship, I will not be able to take the decision properly. I will come under others' influence. Stay away from that kind of professional relationships also. So that is what objectivity. Third one comes professional competence and due care. Two things they say: competence, due care. Competent means what? Capability, very good. So what do I mean by competent is, as a chartered accountant, you must acquire the skill. That's what we are doing actually as a part of our education and all. We are acquiring. But acquiring and leaving is not the correct way. Acquiring and maintaining the skill. This term you have to write. You have to acquire the skills and you have to maintain that skills. Why? Because direct reality of our profession, we are dealing with such subjects which are not going to remain constant, which are not at all going to remain constant. Every year budget meeting will happen, income tax amendments will come. Every time GST council will meet, some some amendments will come. And especially when it comes to GST, circulars will come, notifications will come, case laws will come. It is your responsibility to maintain that knowledge. So you have to acquire the knowledge and you have to maintain the knowledge to provide competent services to the client so that your client gets the best service. Right? So whether you are doing it by way of formal education or you are attending the seminar or out of your own practice you are doing, doesn't matter. You have to acquire the skills and you have to maintain the skills. Second aspect, due care. This we also call it as diligence. Diligence also we call it. So what is the meaning of the term diligence? Since you are doing the responsible work, since depending on your decision, depending on your work, many people are taking the decisions, you should do the work with utmost care. In any case, you should not be negligent. So doing that work with the utmost care, with a lot of carefulness, that is what we call it as diligence. So those two qualities you have to maintain. You have to be professionally competent, whereby you have to acquire and maintain the skills, and you have to do that with due care. Diligence is required. Then comes confidentiality. Sir, what is confidentiality? What is confidentiality? Maintaining the secrecy of the client's information. See, client will trust you. One more advantage which we enjoy is being a chartered accountant, client will share with you any information, not personal, business oriented. And client is going to trust you and you can ask any information regarding the business. The client will never say, why do you need this information for audit? If it provided, if it is related to once again a business only. So when the client is trusting you and giving you all that information, whatever is required for the purpose of your audit, there is a moral responsibility, minimum expected from you. That information you should not disclose it to anybody else, and you should not even use that information for your personal advantage also. Confidentiality means two things. You should not disclose the information to others without the client's permission. You should also not use the information for your own advantages. Insider trading, heard about it? So that is also breach of confidentiality only. So when you are doing the audit of the company, especially listed company, before the results are out, you actually know how the results of the company are going to be. So you should not actually. So you should not buy the shares. Let us say, for example, the company has made a bumper profit for this quarter. Before the news comes in the public domain, you will already become aware of it. Sir, I will do one thing. I will buy the shares and make the gain out of it. Insider trading, breach of confidentiality. You should not do it. So don't disclose the information about the client with others, and even don't use that information for your own personal advantages, except when required under laws and regulation. If some law or regulation is asking the information, then you should not do overacting. No, confidentiality. I will not share the information there. The things are not going to work out. So if there is a requirement of law or regulation, you have to disclose that information. Except that in other cases, you have to get the client permission. Next one, professional behavior. Sir, what is this professional behavior? Last fundamental principle. Many chartered accountants in the past have worked very hard to bring enough of bad image for our profession. Okay, so some people have done hard work in both the ways. See, we see in every area there will be few culprits. So like that, some chartered accountants are there. So because of their misbehavior, because of their personal gains and all, they have compromised on their independence and they have done some wrong acts. So the profession enjoys already enough of bad name. We should not be adding the fuel to the fire. So we should be able to do all that acts we have to do when we are doing the work. We have to do the work after complying with all the laws and regulations, and we should stay away from anything which brings a bad reputation for the profession. So that is what we call it as professional behavior. So which is you have to do the work complying with all the laws and regulations and don't engage in anything which brings a disrepute to the profession. So that's what we call it as professional behavior. So these are the 5 fundamental principle based approach. What are the 5 fundamental principles? Integrity, objectivity, professional competence and rigor, confidentiality, and professional behavior. Then we have independence requirements. As I've already told you, one of the most important quality which every chartered accountant must possess is what? Independence. And especially from the audit perspective, the independence is even more important. And what is the meaning of the independence we have read? The judgment of a person should not be subordinate to wishes and directions of others. And even not getting influenced for your personal benefit also. Even while taking decision, you should not pay attention to your personal benefit also. That is also independence. Now they say that independence will be of two types. How many types? Two types. Independence of mind, independence of appearance. I know high time, post lunch, theory revision. Okay, things are slowly revealing on your face that you are feeling sleepy and all. Please do participate. That's one way by which we can avoid feeling sleepy. So kindly do participate. We'll complete this ethics part, then we'll go to the audit reporting. Most important part we are going to do. So please bear with me for a few minutes. We'll complete the ethics part, then we'll go to the audit reporting. So just you have to keep that momentum going in the initial few minutes. So independence will be of how many types? Two types. What are they? Independence of mind and independence of appearance. Sir, what is independence of mind? Independence of mind is something which is a state of mind. You are in such a state of mind that will permit you to act with independence. So if you read it, it is a state of mind that permits provision of an opinion without being affected by influences that compromise professional judgment. That means you are in such a state of mind which will allow the person to act in an independent manner. But independence of mind is something which we can't see. You can't break someone's head and see whether he's independent or not. So it's a kind of feeling. So agreement of the mind. Let us say, for example, I'm conducting audit of some company where my brother is a promoter. So now I might have agreement of mind. I agreed in my mind. I will do the audit in an independent manner. Okay, your state of mind is there. But you should also have one more thing called independence of appearance. So what do you mean by independence of appearance? Simply, if I have to put it, you should be free from every such kind of relationship or association with the client, which makes a third party believe that independence has been compromised. Appear, you have to look independent also. That means what? Let us say the same example. I'm conducting audit of a company where my brother is a promoter. I agreed in my mind, have independence of mind. The state of mind is there that will allow me to act independently. But I'm having one association with a client, which makes a third party believe that independence has been compromised. Independence of appearance is not there. So independence is of two types: independence of mind and independence of appearance. So you should not just be independent in mind, you should appear to be independent also. So if you read that independence in appearance, so if you read that independence in appearance, the avoidance of facts and circumstances. You should avoid all that facts and circumstances that are so significant that a reasonably informed third party, having knowledge of all relevant information, including any safeguards, would reasonably conclude that a firm or member of team's integrity, objectivity, or professional skepticism has been compromised. That means you should avoid all such kinds of facts and circumstances. That means you should be free from all such kind of relationships and associations where a reasonably informed third party concludes that firm is not independent, member is not independent, he is not having professional skepticism. Such a feeling you should not get. So you should avoid all such facts and circumstances. Then you will be considered as independent of appearance. So now the next important part is this thing, threats to independence. As I have told, there are a few instances which have been considered as threats to independence. So when I consider a instance a threat as a threat to independence, what do I mean by that? Because of that circumstances, will independence get increased or decreased? Decreased. There's a danger. There's a threat. I'm not telling independence will has actually compromised. I'm saying that there is a possibility, there is a danger, there is a threat to your independence. So there are some events or conditions which indicate that the independence of the auditor could be in danger. And they have identified those threats into five categories. How many? Five categories they have identified. What are they? Number one, self-interest threat. Then we have something called self-review threat, advocacy threat, familiarity threat, and intimidation threat. So let us try to understand each of these threat in a detailed manner. Here I am telling you examples are going to be very, very important. So I suggest you to refer to the examples, just especially just before you go for the examination. It is very important to look at these examples. From these examples, case scenario, MCQs could get tested. They will give you example and they will ask you to identify what kind of threat is involved here. So first of all, self-interest threat. When does self-interest threat occur? when the auditor is having some kind of financial interest in the company, in the client. So that financial interest could be in the form of acquiring the shares, or giving or accepting the loan, or having a significant business relationship. Business relationship. If it is a personal relationship, it will be a familiarity. Right? If you are having a business relationship, or contingent fees, even there's a few more things here. A few examples, if I have to say, like this direct financial interest, and also loan or guarantee to or from the client. Undue dependence on the client's fees. You are largely dependent on this client only. 90% of revenue is coming from this client only. That is also a self-interest threat. Close business relationship with an audit client. Potential employment. The company is offering you potential employment. Sir, you do the audit, next year we'll make you CFO of the company. So they are trying to lure you with benefits. And also contingent fees for the audit engagement. You are accepting the engagement where they are saying fees we will decide depending on the report. You give the report, then I will report you, then I will tell you, then I will fix your fees. That also indicates a self-interest threat. That means client is indirectly giving you a hint. What hint? You give me a favorable opinion, I will give you financial benefit. You give me unfavorable opinion, I will cut your fees. So here it is also a self-interest threat. So this is what mainly self-interest threat. Then we have something called self-review threat. Sir, what is self-review threat? Whatever, as a part, you are doing some audit engagement where you are reviewing the work which you have performed it as a part of some previous engagement or a previous position. Like recently you have been a director or a senior most employee in that company. Later you started the practice, and immediately that same company where you are a director has appointed you as an auditor. So it will be about self-review thread. Why? Because being a director, you are involved in the preparation of the financial statements. You are involved in implementation of controls. Now, exactly the same person is getting appointed as an auditor. Basically, you are reviewing your own work. Simply, it is like evaluating your own answer sheet. Will it be independent? For you, it could be independent, but it is not actually independent, right? So, like that, self-review thread. If you are reviewing the work which you have done as a part of your previous engagement, or it could be some non-assurance service. For the client, you provided non-assurance service, like you maintained their books of accounts, you implemented the financial software for them. So if the same person has been appointed as an auditor, once again you will be reviewing the work which you have done it. So these all will lead to self-review threat. So examples, if you see it here, when auditor having been recently a director or senior officer of the company, or when the auditor performs services that are themselves subject matter of audit, like maintenance of books of accounts, preparation of the financial statements, implementation of internal control, designing of the accounting software, all of this will come into picture here. Next, advocacy threats. Sir, what is advocacy threat? They say that advocacy threat occurs when the auditor promotes, or he is looking like promoting, perceived to promote a client's opinion to a point where people may believe that objectivity is getting compromised. You are supporting a client's opinion to such an extent that where people are believing that your independence has been compromised. Sir, what are the examples for this? When you are acting as a client's advocate in income tax cases and all, or you are acting as an arbitrator. So, advocate, like let us say, for example, if the client has got a GST notice, they have appointed you as a representational officer, representation person. So, as a representation in that capacity, what you will do? You will try to support the client. You know that your client has committed a GST scam or fraud, but still you will try to support the client. Now, if the same person has been appointed as an auditor, what will happen? At one place, you are supporting the client's mistake to such an extreme, and in the auditor's position, you are exactly in the opposite side. Somewhere you have to get compromised. No. So this is an advocacy threat. Or even they say one more point here. When the auditor deals with the shares or securities of the audited company, here many students will get confused. Sir, when the auditor is dealing with the shares and securities of the client company, it is a self-interest threat, no sir. But here they have given an example of an advocacy threat. I will tell you, there is a difference. If you are acquiring, if you are holding the shares, it's a self-interest threat. Dealing with the shares means you are promoting the shares of the company. Underwriters. Underwriters heard about it. So what is the role of underwriters? So in case if there is under subscription and all, they will subscribe for the shares, no? Sometimes chart accountants will also act as underwriters. Where their objective will be to promote the people to buy the shares, to subscribe for the shares. Why? Because if the shareholders fail to do it, they have to underwrite. So that means even though you know that client's financial statements have a mistake, or client is not going to make viable fund, not a viable option, but still you will try to persuade others to buy that shares or not. That is what they are saying it here. Dealing in shares means not holding the shares, like acting as an underwriter, like acting as a promoter of the shares. If you are holding such a position, you will support the client to such a level that where other people will feel that objectivity has been compromised. Okay, holding shares or financial interest is a self-interest threat. Dealing in the shares is a advocacy threat. Difference is there. I hope you are able to understand the difference. Then comes familiarity threats. Sir, what is a familiarity threat? So the name itself says you are becoming too familiar with the client. When we become too familiar with the client, when we have some personal relationship with them. So like our relatives are working in a top level position, or there is one more reason, you are having a long relationship with the client. You are being acting as an auditor for a very long period of time where you become too sympathetic for the client. So that is also one intimidation threat. Or accepting hospitality. Accepting hospitality. The client has appointed you as an auditor. Thereafter, they are saying they are arranging one international trip for you and your family. If you accept the hospitality and all, then also they are trying to become familiar with you. So that will be a familiarity. So examples, if you see it here for the familiarity threat, close relative of the audit team working in a senior position in the client company, former partner of the audit firm being director or senior employee of the client. There is an audit firm. Till last year, one senior partner used to be there. Now he resigned as a partner and joined as director of company. Now the same company is appointing this audit firm. You have some close bonding with that, no? So then also it will be a familiarity threat. Long association between specific auditors and their specific client counterparts. That means relationship. You are continuing as an auditor for the same client for a longer period of time. Acceptance of significant gifts and hospitality from the client company, its directors or employees. Significant here, not small gifts also. On Diwali, client is distributing a sweet box. Then also you should not say no. Accepting gift is a familiarity threat and all. So significant gifts and hospitality, if you have accepted, that will have an impact on the familiarity threat. Even the concept of rotation of auditors has also been introduced under Companies Act to prevent this familiarity threat only. Like every once in 5 years or once in 10 years, you're required to change your auditors depending on whether the auditor is an individual or audit firm. The whole concept, the whole logic behind bringing the concept of rotation is to avoid that familiarity threat only. And then finally, intimidation threat. Sir, what is intimidation threat? You want to act independently. You want to act independently, but you are prevented from acting independently. People are not letting you to act independently. How, sir? Threatening, blackmailing. If you give a negative opinion, if you give a modified opinion, your wife will not return from office today, your kid will not return from school today, you will not go to home today. So like that, they are threatening. So this is what actually intimidation will happen. But here you can't write all this in the exam, no. So they gave some easy examples, some simple examples. They will say this could happen because of threat of replacement. The client is threatening you, replace. I will replace you. What I will say, replace. I will find another client. This is not intimidation. What I told you, no, that is intimidation. Or pressure to disproportionately reduce the work in response to reduced audit fee. So they're telling I will reduce your audit fees and all, or threatening with litigation. I will file a wrong case against you. So such threats attempt to intimidate auditors to deter from acting objectively or in an independent manner. So these examples are going to be very important, especially in these threats to independence. Please do refer to the example once before you go for the exam. So high chance of getting tested as a MCQ, especially case scenario based MCQ, 2 marks. Now, safeguards to independence. So, what do you mean by safeguard to independence? How can you protect your independence? See, sometimes when you are doing engagement, if you come across any threat to independence, like you are doing audit engagement, or when a client has approached you asking you to do the audit, now first you have to evaluate. If I accept this engagement or if I do this engagement, will there be any threat to my independence? First, you have to check all these factors. Will there be self-interest threat, self-review threat, intimacy threat, advocacy threat, intimidation threat, and all? You have to check. So, in case if you come across any threat, then what you should do? What you should do? They say either eliminate that threat. What you should do? Eliminate that threat. If completely eliminate that threat. If complete elimination is not possible, implement the safeguards to reduce the threat to an acceptably low level. Terminology once again. First, you try to reduce the threat. Completely eliminate the threat. If elimination is not possible, try to reduce the threat to an acceptably low level by applying some safeguards. Safeguard means preventive measures. If that is also not possible, you are not able to reduce the threat to an acceptably low level, then what you should do? Don't accept the engagement. Don't accept the engagement only. Sir, what if after accepting the engagement I am facing the threat? Then what I should do? Then also say reduce the threat, eliminate the threat, or reduce it to an acceptably low level, or if not possible, withdraw from the engagement. Withdraw. Wherever possibility is there you have to withdraw from the engagement. So that's what they say it here. So threats to safeguards to threats. So for the public to have confidence in the quality, it is always important that the auditor should be independent. Before taking any work, before accepting any work, the auditor must consciously consider whether it involves any threat to his independence. When such threat exists, yes, there is some threat, then what I should do? Either desist, this is at the last option. First option should be eliminate the threat, or at the very least, put in place safeguards which reduce the threat to an acceptably low level. If you can't do it, either desist, that means don't take up the task. All such safeguard measures need to be recorded in a form that serve as a evidence. What safeguards you have implemented to reduce the threat to an acceptably low level, that you have to document it, because tomorrow some allegation has come in against you. Let us say ICA itself is asking, boss, your independence is in danger, but still you accepted. Why? You are telling, sir, I have implemented the safeguards, sir, by which I can reduce them to an acceptable low level. Then they will counter question you, what are the safeguards you have implemented? So that's why maintain proper documentation, what kind of safeguards you have implemented to reduce the threats to an acceptably low level. And if the auditor is unable to fully implement credible and adequate safeguards, he must not accept the work. Next, coming to the next concept. So there is something called professional skepticism. Sir, what is this? Skepticism, professional skepticism. Skepticism means what? Skeptic means what? Questioning mind. So sometimes we meet people who are very skeptic. It is very difficult to convince them. You say something, they ask a counter question. So that quality, that attitude of questioning mind, those people who don't accept anything easily, they keep on asking the questions, those people will be called as skeptical. Skepticism, is it a good quality or a bad quality? Personal level, personal level. To the extent, asking questions to the extent is good quality. But in personal relationship, no, skepticism is always bad quality. You can't bear it. Okay, right? So skepticism at a personal level, we feel it as a bad quality. But standards says professional skepticism is a very much good quality. So professionally, you have to be skeptical. So what do you mean by professionally? You have to be skeptical whenever you are doing audit. But sometimes what will happen? No, this will get messed up with our personal life also. So you should avoid it. See, some things, no, good or bad, some things will become part of our life. CA will make us. The CA qualification will build some qualities in us. So one is, no, everything we start looking commercially only. Everything. Because that's what we do. No, see, when the clients appoint us, various engagements we do, we always think from the client in what manner, how we can reduce the expenses, how we increase the profits, how you can save the taxes, whether this decision is financially viable or not. This is fine. But that becomes our second nature. Without our involvement also, without even actively thinking also, when we start dealing in our personal matters also, sometimes commercial considerations will come into picture. So that is one thing which we can't avoid. The skepticism is also like that only. This skepticism also, since when we are doing audits and all, since we keep on thinking from the skeptical mind, even in our personal matters also, we start thinking skeptically, which is actually very bad. Okay. So whatever it is, some things can't be avoided. Profession makes us like this. So whatever it is, professional skepticism is one of the important quality, which standards are also recognizing. As a chartered accountant, one of the most important quality you should have is you have to be professionally skeptical. And what do you mean by professional skepticism? Means they say three things. They say what? Three things, which I call it as A, B, C of professional skepticism. A, attitude of questioning mind. What is it? Attitude of questioning mind. Don't accept anything from the client at face value. So you have to continuously question. If the client has given me that information, what could be a wrong in that? Why I have to believe this information is genuine? Why can't the wrong information be provided? So is there any counter argument which can prove this information wrong? So like that, you have to always maintain an attitude of questioning mind. That stands for A for professionals, A of professional skepticism. B, being alert to unusual circumstances. Or if I have to put it, being alert to conditions which indicate a possible misstatement. Whenever you come across any circumstances which is indicating a misstatement, you have to immediately become alert to it. You should not ignore it. You have to remain alert to conditions which indicate a potential for material misstatement. Then C stands for critical assessment of audit evidence. Whatever audit evidence you have gathered, like I have told you, you will perform audit procedures. After performing audit procedures, you will gather audit evidence. That audit evidence you have to critically analyze from multiple perspectives. You have to analyze that audit evidence. So whether evidence I have obtained is sufficient, is there any requirement to obtain additional evidence, is the evidence appropriate, do I need any extra evidences, like that continuously, critically you have to make an assessment of audit evidence. So these are three qualities put together, we call it as professional skepticism. Number one, attitude of questioning mind, being alert to unusual circumstances. Number three, critical assessment of audit evidences. So now, if you see it here, they elaborate it further. Sir, you are telling us we have to remain alert to conditions which indicate a possible misstatement. No? Can you give us few examples? Can you give us few examples? A few examples which indicate that there could be a possible misstatement for which we have to remain alert. Yes, we have some examples. So, what are the examples for which you have to remain alert? Professional skepticism includes being alert to like the following. So, you have to remain alert to conditions which indicate possible misstatement. Are there any examples for that? Yes. Number one, audit evidences that contradicts with other audit evidences you have obtained. See, for a single item, you can get the evidence from multiple sources. If you want to know debtor's balance is correct or not, you can do two things. Either you can do the reconciliation of the debtor's account or even you can get the balance confirmation. If both are matching with each other, then everything is okay. But from the ledger verification, I'm getting something, but for balance confirmation is saying something else. Audit evidence is contradicting with each other. What does that indicate? That indicate a possible misstatement. To that, you will remain alert or you will simply ignore it. You have to remain alert. And also, information that brings into question reliability of documents and responses to inquiries. You got evidences, but sometimes you come across some information which brings into question the reliability of the information. Like, for example, you found some supporting document, but in the supporting document, the handwriting is different. Let us say, for example, so there is an entry for 10,000 rupees here. There is a purchase invoice for 10,000 rupees. I want to inflate this. I want to inflate this figure. Sometimes we do that manipulations. No, I want to inflate this. What I can do to inflate? What I can do to inflate? Okay. Have some criminal mind. If I want to increase this, what I have to do? Add zero is a very blunder mistake. You should not add before. Add before, no. After they will keep like this, no. That's not the whole purpose. Chart accountant, think like a chart accountant. Right? So I will add one before. So by that I can inflate. So sometimes, no, some people will get caught. So this all font looks little different, but this one looks little different or in a different ink and all. So this is also one circumstance which indicates a possibility of misstatement. To this also you should remain alert or not? Yes. Next one. Conditions that may indicate possible fraud. Sometimes you might come across some circumstances which indicate a possible fraud. To that also you have to remain alert. Circumstances that suggest a need for additional audit procedures. Sometimes you will come across some circumstances which will suggest you that you need to perform more audit procedures. So these are the examples of the instances to which you have to remain alert. Once again, some examples they are saying. For the P of professional skepticism, being alert to conditions indicating possible misstatement. For that, they are giving you examples. 4 examples they are given here. What are they? If the evidences are contradicting with each other, or if there is something which brings into question the reliability of the documents, or circumstances indicating possibility of fraud, circumstances which indicate that there is a need for additional audit procedures. Clear? Sir. Now, what is the whole objective of by maintaining professional skepticism? How, as an auditor, I will get benefited? By maintaining professional skepticism, how, as an auditor, I will get benefited? They will say that by maintaining professional skepticism in the audit, I can reduce 3 kinds of risk. I can reduce 3 kinds of risk. Reduction of the risk is advantage only, no? So by maintaining professional skepticism, I can reduce 3 risks. What are they? Number 1, overlooking unusual transactions. Overlooking means what? Ignoring, simply, if I have to put it. If you don't maintain professional skepticism, even if you come across unusual circumstances also, you will ignore. But by maintaining professional skepticism, since you have a questioning mind, if you come across unusual circumstances, you will not overlook it. You will compulsorily pay attention. So you are reducing the risk of overlooking unusual transactions. Yes. Number 2, you will also reduce the risk of overgeneralizing when drawing conclusions from audit observations. What is one more risk you are going to reduce? You are going to reduce the risk of overgeneralizing. I use often very simple example to make you understand what is the meaning of overgeneralizing. A dog is having how many legs? You got the right only answer. A dog is having how many legs? 4 legs. Dog will have 4 legs, right? 4 legs, right? Now, if I say any animal which is having 4 legs is a dog, that is overgeneralizing. Dog having 4 legs is a general fact. But if I do overgeneralizing, what I am saying, all the animals which have 4 legs are dogs. It is overgeneralizing. Is overgeneralizing good or bad? Bad. In audit, how overgeneralizing will happen? Let us say I started with fixed assets. In the fixed assets, I did not find out any material misstatement. Now I am doing overgeneralizing. Since in the fixed assets there are no material misstatements, in all other areas also there will not be any misstatement. This is overgeneralizing. Is it good or bad? Bad. If you don't have professional skepticism, you will do these kind of things only. But if you have professional skepticism, you will feel that if in the fixed assets if there is no misstatement, why can't be in other areas there could be a misstatement? So that means you are reducing the risk of overgeneralizing. Yes. Next one. You can also reduce the risk of using inappropriate assumptions in determining nature, timing, and extent of audit procedures in evaluating the results thereof. That means you will reduce the risk of making wrong assumptions while determining nature, timing, and extent of audit procedures. That means you will determine better nature, timing, and extent of audit procedures by maintaining professional skepticism. If you are performing better audit procedures, overall what will be benefited? Entire audit will be benefited. Understood? Three risk you can reduce it. So this is not a this point here. This is altogether a separate point. So by maintaining professional skepticism, you can reduce three kinds of risk. Let us say what are they? Overlooking unusual circumstances, overgeneralizing while taking decisions, and using inappropriate assumptions regarding nature, timing, and extent of the audit procedures. Can someone turn on the AC? Next. Coming to the next part. Now, so since we are done with the ethics part and all, system is getting heated up. That's why. So since we are done with the fundamental principles part, now what we will try to do is we'll come to essay 210. Ethics related discussion mostly we are done. So now we are going to discuss essay 210, agreeing to the terms of the engagement. So what is this? So there is something called, will come from here. From here. We'll start with something very simple, which is engagement letter, or there is something called letter of engagement. In any commercial transaction, not just in audit, you take any commercial transaction, there is always a chance for misunderstanding. So no. So in what ways misunderstanding can happen? Misunderstandings can happen in the areas of rights and obligations. Misunderstanding can happen with regard to deliverables. And most common misunderstanding which will happen is in terms of payment. So in any commercial contract, you take any commercial contract between two parties, there is always a chance of misunderstanding. Let us say you are going to construct a house. You call some builder. You both will have some terms like these many floors, or this quality of the raw materials, this will be the payment terms, like that. You agree on multiple things. And you start the construction. Let us say you have orally all these terms and conditions. Now when the actual construction starts, there are so many misunderstandings which would come. It could come regarding quality of the material, it could come regarding payment terms. So, like any commercial consideration, these misunderstandings are quite common. What we can do, what one simple thing we can do to eliminate most of these misunderstandings? If you're doing any commercial consideration, to avoid these misunderstandings in the future, what is one simple thing you can do? Instead of agreeing the terms and conditions orally, put them on a piece of paper. Right? All the terms and conditions on the piece of the paper, you sign it, let the other party also sign it. You both keep one copy so that if tomorrow, if any misunderstanding comes, you can simply refer to that agreement and sort out that misunderstanding. That's what we'll simply do. Even audit is not an exception. Even audit is not an exception. Like any other commercial engagement, even audit is also a commercial engagement where we agree to provide the commercial services like audit services. In return, client will agree to pay us the fees. Here also misunderstandings will be possible or not. Let us say you have accepted the engagement, you went for doing the audit. Client, you asked the client, sir, please give me the financial statements. I will do audit. Client is saying, what financial statements? I told her, you are required to prepare the financial statements and I will do the audit. Client is saying, that's why I appointed you. You prepare the financial statements. So like that, many misunderstandings can happen even in the audit also. Like the way we are reducing the misunderstandings in other commercial contracts, here also we can do the same thing to reduce the misunderstandings even in the case of audit also. What we can do that simple thing? By writing all the terms and conditions in the form of a written agreement. So whatever terms and conditions are there, write it down on a piece of paper and get it. You sign it. Let the client also sign it. Both of you keep one copy. That document which contains all the terms and conditions of the audit only. We are going to call it as letter of engagement or engagement letter. We are going to understood. Clear everybody? So that's what the whole concept of this meaning of engagement letter. It is a simple written document which contains all the terms and conditions related to audit. It is whose responsibility to prepare engagement letter? Auditor only has to prepare the engagement letter. So auditor shall prepare the engagement letter and get it signed by the. So auditor shall agree to the terms of the engagement. So it is a responsibility of the auditor. And then yeah. So this audit engagement letter, it has to be, must be sent by the auditor to the client. Not that client will prepare and give it to you. Auditor must prepare the engagement letter and give it to the client. sir, what should be the contents of the engagement letter? In that engagement letter, what and all contents should be there? Number one, objective and the scope of audit. So what is the objective of audit? What is the scope of the audit? That you have to include one paragraph. Then you have to explain about responsibilities of the audit. Include one paragraph where you are talk about all your responsibilities. Then include one paragraph where you are going to talk about all the responsibilities of management. And also you have to identify the applicable financial reporting framework. Just give a reference. So it's applicable financial reporting framework is that. And also reference to expected form. Reference to expected form. What could be the expected form of your audit report? So what could be the expected form and content of any report to be issued by auditor? Let them know, sir, this is what the expected form and this will be the expected contents in my audit report. Also give a warning. What warning? A statement that there may be circumstances in which the report may differ from its expected form. Sir, if everything is okay, I will give the report like this. This will be the format. This will be the contents. But also let them aware. Also add a statement that there could be some circumstances in which my report could differ from whatever expected format and content I have told you. Like I will say that, sir, these will be the usual contents. But give them a warning. Sir, if circumstances are necessary, I will even include an emphasis of matter paragraph. So like that, give them a hint. Tell them expected form and content of the audit report and also make them aware that there could be circumstances where you might be required to make changes to your expected form and content of the auditor's report. Clear? And then comes the most important point. These sentences are something which is very interesting where examiner can play with you. So how they are asking the questions. See, these days, no, we are required to answer MCQ question, but answering that MCQs is like answering to 4 true or false statements. MCQs these days, how they are asking you is identify which of the below option is correct or incorrect. By asking that kind of question, they are indirectly making you solve 4 true or false statements. Yes or no? So you have to be very careful about it, especially when you are answering the MCQs. And this is one such sentences which could be twisted in multiple ways. So they say that if law or regulation prescribes in sufficient detail, if law or regulation, if it's already mentioned in sufficient detail, the terms of the audit engagement. See, audits can be of two types: statutory, non-statutory. Statutory audits are those audits which are mandatorily required under law. In the statutory audits, we have an advantage. What is that advantage? You know, what and all are the terms and conditions, what are responsibilities of auditor, what are responsibilities of the management, they will be explained in a specified manner in the law itself. Law itself will tell you what will be your responsibility, what will be your auditor's responsibility and all. So if law or regulation has prescribed in sufficient detail terms of audit engagement, the auditor need not record them in a written agreement. You need not once again include them in the written agreement. When if the law or regulation has already prescribed in a detailed manner the terms of the engagement, there is an exception given to the auditor. You need not include them in that written engagement letter. Except one fact you have to mention. What is that fact? Except for the fact that such law or regulation applies. Instead of writing everything once again, just you mention a fact that so and so section of the so and so act will become applicable and management acknowledges, management accepts and understands its responsibility. That statement only you have to add. Got it? If law or regulation prescribes in sufficient detail the terms of the engagement, the auditor need not record them in writing, except a fact that so and so act will become applicable and management understands it and accepts it. Now, how they will play with you in the examination is they will make small changes. So they will say that if law or regulation prescribes in sufficient detail the terms of the engagement, the auditor need to, they will say, identify which of the following option is correct. In one option, they will remove this not. They will say that auditor need to record this in the written agreement, which is actually false. And sometimes they will say if law or regulation does not prescribe, instead of prescribe, here they will add does not. If the law or regulation does not prescribe in sufficient detail the terms of the engagement, the auditor need not record them in the written format. Once again, that is also a incorrect statement. So be very careful. Like this, many sentences will be there. I will identify all that sentences. You have to understand the concept behind it. If you muck it up, you will not be able to answer these kind of MCQs. You have to understand the underlying concept behind it. So then only you can write the correct answer for these kind of MCQs. Clear? Next. So then comes the next point. Preconditions. There is something called preconditions for an audit. There is something called preconditions for an audit. There is other name for this preconditions. We are also going to call it as management responsibilities. Sir, what do you mean by precondition? Precondition, other name for that is prerequisite. That means before we doing something, before we have to do certain thing, some things must be present. Prerequisites we call it. Like for example, for completing writing CA final examination, you have to clear CA intern. It's the prerequisite, no? So like that, some things which must be present before we can do certain things, that we call it as prerequisites or preconditions. Even for audit also there are preconditions. Even for audit also there are preconditions. That means before you can start doing the audit, there must be some conditions, there must be some requirements which must be fulfilled. And these preconditions are none other than management responsibilities. These preconditions are none other than management responsibilities. So if I rephrase my sentence, if I have to start doing the audit, I can start doing the audit only if the management has fulfilled some responsibilities. Only if the management has fulfilled some responsibilities. So what are that preconditions without which I cannot do the audit? So if you see it, so in order to establish, so see this, as per SA 210, preconditions for an audit as defined as the use by management of an acceptable applicable financial reporting framework in the preparation of the financial statements. There are two preconditions here. Number one, the management, whatever applicable financial reporting framework they are using, that should be acceptable. First precondition, whatever framework which the management is using for preparation of financial statements, that should be acceptable. Let us say you are conducting audit of a bank, yes bank. Management is saying we'll prepare the financial statements as per Schedule 3 and accounting standards. Management has only adopted, but is it acceptable? No. Since it is a bank, they are required to comply with banking regulation. So first precondition is whatever applicable financial reporting framework which is getting used by the management in the preparation of the financial statements should be acceptable. And along with that, one more thing is an agreement of the management and where appropriate those charged with governance on the premise. And one more prerequisite is you have to get the agreement of the management that they are responsible for certain activities. Nothing but that only we call it as management responsibilities. You should also get an agreement from the management. Management should have accepted that they are ready to fulfill their responsibilities. So two preconditions. Number one, applicable financial reporting framework should be acceptable. Number two, get the agreement of the management that they are responsible and they will fulfill the responsibilities relating to premise of audit. And how they will get that acknowledgement? See, I'm asking you to get the agreement of the management that they will fulfill their responsibilities. How we will get that agreement? Through the engagement letter only. Through the engagement letter only. By getting the engagement letter signed by the management, no, we are getting the agreement that they are ready to fulfill their responsibilities. Sir, what are the responsibilities? What are the responsibilities? Once again, they are elaborating here. Number one, you have to determine whether financial reporting framework is acceptable, and you have to obtain agreement of the management regarding the following. Management should agree on the following responsibilities. Number one, what is number one? Management should prepare the financial statements. Management should have agreed that they are responsible for preparation of financial statements, that too in accordance with applicable financial reporting framework. Number two, just preparing financial statements alone will not be enough. They are even responsible for implementing internal controls to make sure that financial statements are free from material misstatements. To provide auditor, it is a responsibility of the management to provide the auditor with three things. First, all the information, all the books, accounts, and documents you have to provide. Just providing the information alone will not be enough. From that, books, documents, and records, if the auditor needs any additional information, extra explanation, it is whose responsibility to provide it? Once again, management. Not just that, if the auditor wants to go to the people in the organization and ask the questions, who should provide him unrestricted access to the people in the organization? Management. That's all. So checking whether applicable financial reporting framework is acceptable and get that agreement from the management that they will acknowledge their responsibilities. Three responsibilities. Number one, preparation of financial statements, the implementation of internal controls, to provide auditor with access to the books, documents, and records, provide additional information, explanation, and provide unrestricted access to the people within the organization from whom auditor can obtain the information. Clear? So these are the preconditions. And before that, they say that, and one more point, they say that SA 210 says one more thing. In case, see this paragraph. The objective of the auditor is to accept or continue audit engagement only when it is performed, only when the basis upon which it is performed has been agreed. You should say yes to the client relationship only when the client has agreed to the responsibilities. Not just that, establishing whether the preconditions are present. What are the preconditions? Just now we have told. So whether applicable financial reporting framework is acceptable and management is ready to fulfill the responsibility. If this is not happening, don't accept the audit. If there are no preconditions, don't accept the audit. And also confirming that there is a common understanding between the auditor and the management. How that common understanding can be obtained? Through the engagement letter. So how a common understanding has been obtained between the auditor and the management, and where appropriate, those charged with garnishments. So these two things only when they are possible, then only accept the engagement. If one of the things is missing, like either preconditions are not there or there is no common understanding, there is no engagement letter, then don't accept such engagements. Understood? Clear, everyone? Next. So thereafter, what if preconditions for an audit are not present? Same point here, just now we have covered. If the preconditions of audit are not present, that means if the applicable financial reporting framework is not acceptable or management is not ready to agree to their responsibilities, don't accept the engagement only. So that's what they say. If the preconditions for an audit are not present, first the auditor shall discuss the matter with management. Unless required by law or regulation. Unless there is a strict requirement from law or regulation, the auditor shall not accept the proposed engagement. If there is some pressure on you from law or regulation where you are required to compulsorily accept that engagement, then only accept it. Unless there is requirement from law or regulation, if the preconditions are not present, don't accept that engagement. Clear? Understood? Right. So that's what they say it here. Then we have one more small paragraph. Limitation on scope prior to engagement acceptance. So let us create a typical scenario. You are a chartered accountant into practice. You are sitting in your office. One day, the client, along with the client's board of directors, have come to your office. They told, "Sir, we got to know that you are a reputed chartered accountant. We want you to do the audit for us." Which audit? Statutory audit. We want you to do the company audit under Companies Act for us. But I did not say yes. Even before I say yes, you are required to do the audit for us. We are asking you to get appointed as a statutory auditor of our company. But don't ask us sales information. We will not give you sales data. Don't ask first of all. Even if you ask also, we will not give you. So even before you accept the engagement, the client is putting a restriction. The client is putting a limitation on your scope. Just imagine you are sitting in that auditor's chair. If the client is coming with you with such requirement, what you will do? Show them the exit gate and ask them to get lost. That means what? You should not accept the engagement. That's what they say. That's it. Purely common sense. So if you read it, if the management or those charged with governance imposes a limitation on the scope of auditor's work in terms of the audit engagement, such that auditor believes limitation will result in disclaimer of opinion. We'll come to the disclaimer of opinion part later. So before accepting the engagement only, you got to know that management is putting a limitation on your work. And that limitation is so significant that you will not be able to obtain evidence. And ultimately you will give disclaimer. So what is disclaimer of opinion? Basically, you are saying that you are not able to express an opinion. When you know that well in advance, before accepting the audit only, you know that because of the limitation, you are going to say you will be unable to express the opinion. When you know that well in advance, why you have to accept? You will say for fees. That's what ICA is prohibiting. That's what the standard is prohibiting. Don't do it. Don't show your commercial nature. So when it is well in advance, you know that there is a limitation because of which you are going to give disclaimer of opinion. Don't accept that engagement. Stay away from that engagement. Unless here also, unless required by law or regulation. Unless if there is a strict requirement from law or regulation, don't do it. Next. This is the next point. Sir, if the client is keeping a limitation on the scope, prior to the audit engagement only, you are saying don't accept. But some clients will be useless fellows. At the time when I am accepting the engagement, they will not put any restriction for everything. They will not direct, okay, sir, okay, sir, okay, sir. But when I actually go and start doing the audit, no, then they will approach me, sir, we agreed for this terms. No, let us change the terms of the engagement. Let us change the terms of the engagement. At the time of accepting the engagement, no restriction, nothing. We drafted the engagement letter, client said okay, I told okay, we are all fine. But actually, when I started doing the audit, after accepting the audit, the client is now approaching you and asking you for the changes in the terms of the engagement. Then what you should do? This is particularly addressed by SA 210. First of all, Why client will come to you? Why the need might arise for the client to come to you asking you for the changes in the terms of engagement? Why the need will come? Number one, there could be changes in the circumstances. Whatever circumstances that are there at the time of accepting the engagement, those circumstances might not be there now. So, because of the change in circumstances, the client might approach you asking you for the changes in the terms of the engagement. Or there could be a possible misunderstanding. When we agreed the terms of the engagement, there could be a possible misunderstanding. Client misunderstood one of his responsibility and he gave the acceptance. Now he realizes misunderstanding. Now he might be approaching you, asking you for the changes in the terms. These two are genuine cases. These two are genuine cases. Change in the terms, change in the circumstances, or misunderstanding, genuine reasons. But sometimes clients intentionally come to you asking you for the changes in the terms of the engagement in order to put a limitation on your scope. In order to put a limitation on your scope. Like let us say, for example, I'm conducting audit, I'm required to verify the inventory. I told to my client, sir, I want to go to your warehouse and physically verify the stock. Now the client is coming to me and saying, sir, do one thing. We will revise the terms of the engagement. Let us take out the inventory verification from your scope only. So here client is asking me to change the terms of the engagement in order to put a limitation on scope. So this is not a genuine reason. So whatever it is, there could be three reasons why the client might approach you asking you for the changes in the terms of the engagement. What are the three reasons? Number one, change in the circumstances. Number two, misunderstanding regarding the nature of an audit, and also restriction on the scope of the engagement. Whatever may be the reason, if the client is coming to you and asking you for change in the terms of the engagement, what you are supposed to do. So the standard says if the client is asking you for the changes in the terms of the engagement, first you should ask the reasons. You should ask them reasons. And you have to check, is there a reasonable justification? Is there a reasonable justification? If there is a reasonable justification, you can agree to the changes. If there is a reasonable justification, what you can do? You can agree to the changes. And when you have agreed to the changes, also determine, is it necessary for you to change the engagement to such an engagement which will reduce your assurance. Agree to the changes, but evaluate after you have agreed to the changes, will it be possible for you to continue the audit engagement? Are you still in a position to obtain the reasonable assurance? But by agreeing the changes, if you feel that no, if there is a valid reason, but by agreeing to the changes, I will not be able to obtain reasonable assurance, then you should ask the client to change the engagement to one which will provide the lower level of assurance. Like you can go ahead to the client and say, sir, we will do one thing, we will not do the audit, we will convert this to review engagement, where I will be giving you limited assurance. Sir, agreed. There is a valid reason why you are coming to me and asking me for the change in the terms of engagement. Agreed. Valid reason is there. Accept the changes, but determine with the changes in the terms of the engagement, will you be able to continue audit? Will you be able to obtain reasonable assurance? In case after agreeing to the changes, if you feel that there is a limitation where you will not be able to obtain reasonable assurance, then what you do? Ask the client to change the engagement to one which will provide lower level of assurance, like converting it into review engagement or converting it to related services. And whatever it is, since you have agreed to the changes, old engagement letter will become invalid. Old engagement letter will become invalid. So what you should do? You should draft a new engagement letter and continue the engagement. And finally, in the audit report, whatever you give, in the audit report or review report, whatever you give, don't give any reference to the old engagement letter. Don't refer to any procedure performed as per the terms under the original engagement letter. Understood what I'm trying to say it here? So you change the engagement letter. After changing the engagement letter, also finally, let us say for example, audit was not suitable, you converted it to review engagement. For that review report, you will give no. In that review report, you should not refer to old engagement letter. You should not refer to any audit performed under any audit procedure performed under old engagement letter. Understood? Clear and comfortable? So once again, repeat. So what if there is a reasonable justification? What you will do? You will agree to the changes. Determine will it be suitable for you to continue audit only, or you have to change it to the engagement to a one which provides lower level of assurance. Draft a new engagement letter. In the report, whatever you are finally giving, don't include any reference to original engagement letter or don't give any reference to procedures performed under the original engagement letter. Perfect. Clear? Shall I proceed further? Right. So this is one case. But we have other case, no? What is it? What if there is no reasonable justification? The client is coming to me, he's asking me to agree for the changes, and he's not giving me any reasonable justification. Then what I should do? Don't agree to the changes. Client is coming to me and asking me, sir, please take out the inventory verification from your scope. I asked him reasons. He told me all the bullshit reasons. What you will say? No, no, sir, all your reasons are not acceptable. I have to compulsorily do the inventory verification. So do not agree to the changes. Now, when you don't agree to the changes, two things can happen. The client will permit you to carry out the audit as per original terms. This is what mainly will happen. Because generally, clients will not mess with us because they know we'll make their life a mess if they mess with us. So I told, no, sir, you don't. I will not agree to the changes whatever you have suggested. I will do the audit as per original terms only. Now, most of the clients, what they will say is to let this person do whatever he want. Let him. They will give you the verification, stores related verification and all. They will let you. So, in case if you are permitted to carry out the audit as per original terms, happily continue the audit, complete your audit. But some exceptional cases will be there where clients will say you are not agreeing to the changes, but the client is not permitting you to carry out the audit as per original terms. You told, no, sir, I have to do inventory verification. Please let me do it. Now the client is saying, I will see how you will go and verify. There are 10 people standing outside of the gate of the inventory. I will not give you the key and all. So, like that, somehow he's not letting me carry out the work as per original terms. Then what you should do? Withdraw from the engagement. Withdraw from the engagement. Wherever suitable, you have to withdraw from the engagement. And also, when you are if you have decided to withdraw from the engagement, take proper actions. Like if you are withdrawing just like that, you should not keep a WhatsApp message saying that useless fellow from tomorrow I'm not coming to office. Like that, you should not behave. There should be some professional manner. There will be some professional responsibilities. Communication requirements will be there. Reporting under ADT 3 and all will be there. Fulfill all your responsibilities. So that's what this paragraph is all about. So this last part is very important. Whatever I have told you. So in case if you are unable to agree to the changes in the terms of the engagement and it is not permitted by the management to continue the audit as per original audit engagement, then the auditor shall withdraw from the engagement wherever possible and determine whether there is any obligation, either contractual or otherwise, to report the circumstances to other parties. In case if you are withdrawing, sometimes there will be a professional responsibility on you to communicate about your withdrawal to other parties, like filing of 883 and all will be there. Fulfill that responsibilities. Clear about it? Right. So this is very important part. Changes in the terms of the engagement after you have accepted the audit. Coming to the next part. Requirement of engagement letter in the case of recurring. So what is a recurring audit? Audit happening again and again. Simply if I have to put it, if the last year auditor is the same person who is a current year auditor, then it will be a recurring audit. Is it mandatory for the auditor to send the engagement letter every year in the case of recurring audit? Let us say, for example, financial year 23-24, I have data audit of the company. The same company has appointed me as an auditor for the next year also. Same company, same auditor, same scope of work. Am I mandatorily required to give the engagement letter? No. Standard did not make it mandatory. They have left it to the choice of the auditor. They have left it to the choice of the auditor. You auditor, you yourself will decide whether in the case of recurring audit you want to give an engagement letter or not. We don't want to make any obligation. It's your choice. You use your professional judgment and decide whether it is necessary to give the engagement letter. Even if you don't give it also, it is fine for us. However, they have identified some circumstances, they have identified a few factors where even though it is a recurring audit engagement, it will be appropriate to issue the engagement letter. They have identified a few circumstances, few factors they have identified. If these factors are present, even though it is a recurring audit, it is always advisable for you to give a new engagement letter. Sir, what are that circumstances? Any revised or special terms. If the terms of engagement have been changed with compared with the last year, give a new engagement letter. Or there is a change of senior management. Your client's top level management have changed. Give a new engagement letter. Or if there is a change in ownership, your client company has become subsidiary of another company. Give a new engagement letter. A significant change in nature or size of the entity's business. The client has diversified or size has expanded. Change in legal or regulatory requirements. Some laws and regulations like Companies Act and all have changed. Then also given new engagement letter. Change in financial reporting framework, like change in Schedule 3, change in accounting standards, given engagement letter. Or change in other reporting requirements, like change in standards on auditing, change in Companies Act reporting requirements, then also give a fresh engagement letter. Clear? So complete it is at the option of the auditor. But when these kind of factors are present, it is always advisable to give a new engagement letter, even though it is a recurring audit. Understood? Shall we proceed further? Right. So with this, we are successfully done with the ethics and the terms of engagement. I hope you are able to get through it. Right. So we'll continue now with the next chapter, which is audit reporting. So we'll start now discussing about the audit reporting chapter. One of the most important chapter from the examination point of view. There's going to be a huge weightage from here. So we'll try to comprehensively cover the standards of audit related to audit reporting. So first of all, let us become clear about what is the scope of this chapter. What and all we are required to revise as a part of this chapter. Four standards we are required to cover. Say 700, 701, 705, and 706. Thereafter, a few sections of the Companies Act, 143 subsection 1, 143 subsection 3, 143 subsection 11, nothing but CARO, 143 subsection 12. So these are the bunch of concepts which we are required to revise it as a part of this audit reporting chapter. So without any delay further, we will start with standards first. SA 700 we'll try to cover it. Sir, what does SA 700 speak about? What does SA 700 talk about? Just give me a minute. Yeah. So first we'll try to start our discussion with SA 700. So what does SA 700 title? You are able to see it here. Forming an opinion and reporting on the financial statements. So as I've told you, just as a part of our previous chapters, that your ultimate objective is to express an opinion. And that opinion you are required to express in a written format. So that how to prepare that audit report is the main thing which this standard is going to talk. So if you look at the title of the standard is going to talk about two aspects. Number one, forming an opinion. Number two, reporting. So first, you form an opinion. Expressing is later. First, you have to form your opinion now. On what basis you have to form the opinion? On the basis of the evidence, whatever you have gathered, you have to first to form your opinion. First, you arrive at the opinion. So thereafter, once you have arrived at the opinion, keeping that opinion to yourself doesn't have any use at all. So that opinion is required to be expressed. So two things. First, to form the opinion, two objectives. These are actually two objectives. First one, to form an opinion on the basis of audit evidence, whatever you have gathered. Number two, whatever opinion you have formed, don't keep it to yourself. You have to report it. Report it in the form of a written audit report. In the written format, in the written audit report, you have to prepare it. So, how to prepare that audit report? First, we will come to that main point. So, how to prepare that audit report and what and all should be the contents of the audit report? That will be our starting point of the discussion. So, this is going to be the contents of the audit report. First and foremost content of the audit report is going to be title. And generally, the title is always going to be Independent Auditor's Report. That will be the title. Then comes the next part, addressing. Basically, auditor's report is a letter through which you are expressing an opinion. So for every letter, there should be some addressee. Now, who should be the addressee? This addressee, like I have told you previously, to whom you will report, whoever made an appoint. So to whom you are going to address, it depends on the legal form. If it is a sole proprietorship form, you will address sole proprietor. If it is a partnership form, you will address to partners. If it is a company, you will address it to shareholders. So that depends. Who is going to be your addressee? That depends. Then after that, first come to the point. To come to the point, we know you have n number of things to say. We know you have n number of things to say. Say all that shit later. First, come to the point. So, why we are giving the auditor's report? Opinion. So, first to say that. So, first and foremost paragraph. First two are not paragraphs. Title is the heading. Address is to whom you are giving the report. So, since the main objective of this audit report is to express an opinion, first come to the point. The first and foremost paragraph should be opinion paragraph. Okay. So now we will talk about different kinds of opinion in a much more elaborated manner. Let us try to understand it. So opinions can be broadly divided into how many categories, guys? Two categories. What are they? Number one is unmodified opinion and the other one is what? Modified opinion. So the other one is modified opinion. So when unmodified opinion will be given? Simply if the two objectives you are convinced. If two objectives you have convinced, you are convinced with the two objectives, then you will give a unmodified opinion. So what are the two objectives? Financial statements are, you have concluded, you should have concluded, you should have obtained sufficient and appropriate audit evidence, and you should have concluded that financial statements are free from material misstatements and they are also prepared as per applicable financial reporting framework. Then you will give a unmodified opinion. Okay, other names for unmodified opinion. It is also called as a clean opinion, or it is also called as a unqualified opinion. Clean opinion, unqualified opinion also we call it. Now, how to identify? What kind of phrases you have to use? If you say unmodified opinion, no one will understand. If you say in the opinion paragraph, I am giving an unmodified opinion, no one will understand. Even we are going through all this formal education, that's why we are learning what is unmodified and all. You can't expect everybody to understand it. So that's why what they have told is they have given one terminology that only you have to use. We are giving you one terminology. If you want to give unmodified opinion, use that phrase only. Don't use anything else. Use only that phrase. Sir, what is that phrase which I have to use, sir? What is that phrase which I have to use? In case if you are reporting on the financial statements which are prepared as per fair presentation framework. In case if you are preparing, if you are giving the report on the financial statements which are prepared as per fair presentation framework, I told you, you should always comment on true and fair. So since you are giving unmodified opinion, completely positive opinion, so what you should say is, in our opinion, and according to the Western explanation given to us, I will read that paragraph for you. So I will show that because these days they are asking you that questions and all from this aspect. Just give me 1 minute. We'll get comfortable with the terminology also because these days very highly they are asking on drafting related points. So we'll become well versed with that. See here. So in the opinion paragraph, actually two subparagraphs will be there. First subparagraph, I will come back to that later. In the second subparagraph, main audit report will be there. So see here, in case if you are giving unmodified opinion, no, the standard has, if it is a fair presentation framework, one of the two phrases. Say that financial statements are giving a true and fair. Or alternatively say that financial statements present fairly in all material respects. This sentence should come. How to exactly draft the paragraph, I will tell you that. But one of the phrases you have to use. Either use financial statements give true and fair view, or you use the phrase financial statements present fairly in all material respects. This when I am reporting it as per fair presentation framework. What if it is a compliance framework? Financial statements are prepared in all material respects in accordance with the framework. That's all. No true and fair view. We should not comment on true and fair view. In case of what? In case of fair compliance framework, you should not use that true and fair view. See here. So while expressing an opinion, not present fairly. So here we have. So at some other place I would have given it. Even in SS 705 also you will come across the terminology. But as I have told, practically speaking, in case if you are preparing the compliance framework, if you are reporting on the financial statements as per compliance framework, you should have told financial statements are prepared in all material respects in accordance with the framework. That's all. There is no comment on true and fair. But whatever it is, that line you should use. But that one single line we will not use. No, we will draft it in the form of paragraph. This paragraph you have to learn it. This paragraph you have to learn it. Sir, how I have to write that paragraph? In our opinion, same as it is you have to write. In our opinion, why? Because drafting cannot be your own. ICA has taken that freedom from you. You cannot use your own language. Drafting has to be exactly done like this only. In our opinion, and to the best of our information, and according to the explanation given to us. So, what is the starting point? In our opinion, in our opinion, and to the best of our information, and according to the explanation given to us, the aforesaid financial statements, ignore that standalone and all. The aforesaid financial statements give the information required by Companies Act in the manner so required, and they give a true and fair view. This one paragraph you can use, or you can also say here they give all the information required by the Companies Act in the manner so required, and they present fairly. Also, you can say here there is an option. So the financial statements give a true and fair view in conformity with Ind AS prescribed under Section 133 of the Companies Act, as amended, and other accounting principles generally accepted in India. Now, once again, from the beginning, in our opinion, and to the best of our information, and according to the explanation given to us, the aforesaid financial statements give the information required by Companies Act in the manner so required, and they give a true and fair view. Then they give a true and fair view in conformity with Ind AS as prescribed under Section 133 of the Companies Act as amended, and also as per generally accepted accounting principles, other accepted accounting principles in India. Of what? Okay, they're giving true and fair view. Of what? Of state of affairs of the company. Nothing but what? Balance sheet. State of affairs is financial position. So it is giving a true and fair view of state of affairs of the company as at 31st of March. It is also giving a true and fair view of profit. It is also giving a true and fair view of total comprehensive income. It is also giving true and fair view of cash flows. It is also giving a true and fair view of changes in equity. All the elements of the financial statements they are covering. So if they ask you to draft the paragraph, exactly this is what you have to write it here. Understood? So this is what in the case of unmodified opinion. Clear? Able to understand? Right. So, okay, unmodified opinion we have understood. Then, when we will give modified opinion. When we will give modified opinion, when we are not satisfied with the true and fair view. Can I say that in the case of fair presentation framework, if I am not satisfied with true and fair view of the financial statements, when I don't want to say that financial statements are giving a true and fair view. See, unmodified opinion is a completely positive opinion, no negative remark attached. Completely positive. I'm saying financial statements are completely giving a true and fair view, no remark at all. But when I will give modified, when I don't want to say it, when I don't want to say financial statements are giving a true and fair, I have some negative remark to give, then I will give modified opinion. Now we have different kinds of modified opinion. So how many we have? Three kinds of modified opinion we have. All the three are negative comments only, but severity is changing. Some is less severely negative, something is more severely negative. But all the three are modified opinions only. All the three carry a negative remark. So what are the three? Number one is a qualified opinion. Then we have adverse opinion. Then we have disclaimer of opinion. So let us try to understand when what will be given. First of all, coming to qualified opinion. Qualified opinion can be given in how many circumstances? Two circumstances. What are they? Number one, you have obtained sufficient and appropriate audit evidence. You should have performed audit procedures and you have obtained sufficient and appropriate audit evidence. On the basis of that, you concluded, because you have evidence, that's why you have concluded. You have concluded that financial statements contain misstatement. Financial statements contain a misstatement whose effect, financial statements contain a misstatement whose effect is material. It is material, but not pervasive. But not pervasive. Then we will give a what? Qualified opinion. So one case, you have obtained sufficient and appropriate audit evidence. On that basis, we have concluded that financial statements contain a misstatement whose effect is material but not pervasive. Misstatement is there, material, but it is not pervasive. Simply, if I have to put it, pervasive means very big misstatement. I will tell you technical meaning in a short while. Pervasive misstatement means the misstatement so big enough to say financial statements are completely wrong. If the misstatements are so big enough to say completely wrong, that misstatements we call it as pervasive misstatements. But technical definition I will tell to you later. Okay? Other instance, when qualified opinion will be given. Terminology here it is very important. Auditor unable to obtain sufficient and appropriate audit evidence and possible effect. Very important terminology. Possible effect. Possible effect of undetected, possible effect of undetected misstatement. So why we have to use this phrase possible effect? In the previous case, you have obtained sufficient and appropriate audit evidence and you are able to conclude. In this case, I am unable to obtain sufficient and appropriate audit evidence. Let us say there is inventory. Regarding that inventory, I am unable to obtain sufficient and appropriate audit evidence. When you don't have sufficient and appropriate audit evidence, you can't conclude only. But I am estimating, I am imagining if the inventory item regarding which I am unable to obtain audit evidence, if it could go wrong, if it had gone wrong, what could be the possible effect? Don't conclude, don't arrive at a conclusion. We are all talking in terms of possibilities. If the item regarding which I am unable to obtain sufficient and appropriate audit evidence, what will be the possible effect of undetected? You did not detect it, no, because you don't have evidence only. So whatever misstatements I would not have detected, what could be the possible effect of it? For this only you will get the marks. For writing these phrases, you will get the marks. So you are unable to obtain sufficient and appropriate audit evidence, and the possible effect of undetected misstatements is what? Material. Possible effect is material, but not pervasive. Then I will give what? Qualified opinion. Understood? So, qualified opinion can be given in two instances, whether you have evidence or you don't have evidence, but the effect or possible effect should be only material but not pervasive. So, since misstatement is only material but not pervasive, I will give a negative remark, but less severe negative I will give. So, how to give that less severe negative opinion is the standard has told, say that except or subject to the matters. Except or subject to the matters as described in the basis for opinion paragraph. I will come to that later. Except or subject to certain items, financial statements give a true and fair view or present fairly in all material respects. So entire paragraph will remain the same, but before that, at the beginning, we add in our opinion and according in our opinion and to the best of our information and according to the explanation given to us. Except for the matters, there one sentence will come. Except for the matters, the remaining items of the financial statements give a true and fair, give all the required information as required by the Companies Act, and they give a true and fair view in conformity with the Ind AS, blah blah blah. Everything will remain the same in that paragraph. Understood? But we use the phrase except or subject to certain matters. Financial statements give a true and fair. It is not a completely positive opinion. It is not even a completely negative opinion. Somewhere it stands in between. It is a kind of positive opinion with a negative remark. But whatever is negative remark is attached or not. So that's why I say this is a less severe negative opinion. Understood? Qualified opinion, two instances. Next. So when adverse opinion will be given. Adverse opinion will be given in one case. Sir, what is that one case? You are able to perform audit procedures and you have a sufficient and appropriate audit evidence. You performed audit procedures, you obtained sufficient and appropriate audit evidence. On the basis of that, you concluded, because you have evidence, you can conclude it here. You concluded that financial statements contain a misstatement whose effect is material and also pervasive. Whose effect is material also pervasive. So you have performed audit procedures, you obtained audit evidence. From that audit evidence, you concluded that financial statements contain a misstatement. It is not just a material. The misstatement is so big enough to say financial statements are completely wrong. Such a big misstatement, you have found it out. So what opinion you will give? Sir, which phrase I have to use? Straight away say the phrase financial statements do not give it went fair. Straight away, completely negative. Straight away say that financial statements do not give a true and view. Financial statements do not give a true and fair view. You can say that. Understood? Next, coming to the last case. What is the last case? Disclaimer. So disclaimer will be given in which case? Disclaimer will be given when you don't have sufficient and appropriate audit evidence. You are unable to perform audit procedures and you are unable to obtain sufficient and appropriate audit evidence. Next. Very good. Possible effect of undetected misstatement is material and also pervasive. Then we give a what? Disclaimer of sufficient and appropriate audit evidence not available. The possible. Why once again we are using the term possible? Because we don't have evidence. We are unable to conclude. We are just thinking in terms of possibilities. The possible effect of undetected misstatement is material and also pervasive. Then we give a disclaimer. And what kind of phrase we use? Disclaimer means what? You're stopping yourself. Disclaimer of opinion means what? You're stopping yourself from giving an opinion. So you will say that we do not express an opinion on the aforesaid financial statements because of so and so reasons. In your opinion paragraph, you will directly say we do not express an opinion on the financial statements. On the aforesaid financial statements, we are unable to express an opinion. So when you find that phrase, that is a what kind of opinion? Disclaimer. It is also an extremely severely negative opinion. Understood? Clear and comfortable, everybody? So these are all different kinds of modified opinion. So all the three are negative remarks only, but severity is changing. Qualified will be given in two, adverse will be given in one case, disclaimer will be given in one case. Understood? See, we have defined what is qualified, what is adverse, what is disclaimer, what is modified, we have to define. And we have to define the term modified opinion in such a manner that in that definition, all the three are getting covered. You understand what I'm trying to say? We have defined qualified opinion. We have defined adverse opinion. We have defined disclaimer. But these three are nothing but different types of modified opinion. Now we have to define the term modified opinion also. No? And we have to define the modified opinion in such a manner that it is taking into its perspective all the three kinds of modifications. Got it? So how that modified opinion has been defined. So if you read it, the modified opinion, how it has been defined. So actually, when we are discussing this modified opinion and all, we are discussing SA 705. So if you go to this thing, circumstances when modified opinion is necessary, or what are the objectives of the auditor as per 705, or even if they ask you the question, define modified opinion, you have to write this definition. So let us see the definition and whether it is taking into its perspective all three kinds of modified opinion or not, we will check. So auditor will express a modified opinion if the auditor concludes that based on audit evidence obtained, the financial statements as a whole are not free from material misstatements. Then you will give modified opinion. Insufficient and appropriate audit evidence, and on the basis of that, we have concluded that financial statements are not free from material misstatements. Then you will give modified. Which kind of modified? Which kind of modification here? Here I can give either qualified or adverse, depending on pervasiveness. If the financial statements are not free from material misstatements, and if that misstatement is only material but not pervasive, then I will give qualified. If it is material and also pervasive, then I will give adverse. Or I will also modify my opinion if the auditor is unable to obtain sufficient and appropriate audit evidence to conclude that or I will also modify the opinion if the auditor is unable to obtain sufficient and appropriate audit evidence to conclude the financial statements as a whole are free from material misstatements. Here, what kind of opinion? Very good. Either a qualified or disclaimer. Not just disclaimer, either a qualified or disclaimer. If the possible effect is only material but not pervasive, qualified. If the possible effect is material and also pervasive, disclaimer. Disclaimer. Okay? Clear? So this is how the term modified opinion has been defined, where it is taking into its perspective qualified, adverse, disclaimer. All the three it has been covered. Coming to the next point, pervasive. Sir, you are saying pervasive misstatement, pervasive and all. What is the exact meaning of the term pervasive? They say that pervasive is a term used in relation to the misstatements or possible misstatements. Pervasive is a term used in relation to misstatements identified or possible misstatements to explain their effect or possible effect. Pervasive is a term is used in relation to misstatement, or it could be a possible misstatement to explain its effect or its possible effect. And when we can consider that misstatement, when we can consider the effect or possible effect of a misstatement to be pervasive, they say 3 points. A misstatement can be considered to be pervasive in 3 cases. Number 1, if it is not confined to specific elements, accounts, or items of the financial statements. There is a misstatement which is not confined, which is not just restricted to 1 or 2 items of the financial statements. It is spread across so many items of the financial statements. It is spread across multiple items of the financial statements. Then we can call it as pervasive. When it is not confined to specific elements of assets, liabilities, etc. Or sometimes if it is confined, but it is representing or it could represent a substantial portion of the financial statements. Let us take a typical balance sheet here. So in the typical balance sheet, let us say in the balance sheet there are so many items. So assets are there, liabilities are there, multiple items are there. If there is a misstatement in multiple items, then I call it as pervasive. Sometimes a misstatement will be there in only one item. Let us say in the assets only there is a misstatement. The assets are, the amount of the misstatement is 80 crore rupees, whereas the total balance sheet itself is 150. The misstatement is confined to only one single item. but that misstatement is representing a substantial portion of the financial statements, a bigger portion of the financial statements, then also we can call it as pervasive. So either it is not confined to single element, spread across multiple items, pervasive. If it is confined to a single item, but it is representing a substantial portion, then also it is pervasive. Or in relation to disclosures which are fundamental to users' understanding of the financial statements, or if the management has made a mistake in those disclosures means what? Notes to accounts. If the management has made a misstatement in those kind of notes to accounts which are very much fundamental to users' understanding of the financial statements, like management might have given one wrong disclosure regarding going concern, which is very much fundamental to users' understanding, then also we can call it as a pervasive misstatement. That's what I told you at the beginning. Not just ordinary misstatements, even pervasive misstatements could happen in notes to accounts. Clear? So when we can call a misstatement to be pervasive, number one, not confined to specific elements or items of the financial statements. Number two, even though confined, it's representing substantial portion. Number three, in relation to those disclosures which are fundamental to users' understanding of the financial statements. This is what the meaning of the term pervasive. Understood? Then, sir, why we are discussing all this? Where our discussion started? Our discussion started at the contents of the auditor's report. We have discussed what should be title, what should be addressed. Then we are discussing opinion paragraph. As a part of that opinion paragraph, we have understood different kinds of opinion. But the discussion regarding opinion paragraph is not yet done. Not yet done. Because I have shown you practically opinion paragraph contains two parts. We have addressed only second part. First is a paragraph is that. So in the opinion paragraph, along with the opinion, whatever you are expressing, some compulsory information should be presented. 5 such items are required to be presented in the opinion paragraph. Number one, identify the entity whose financial statements you are verifying. That means mention the name of the organization whose financial statements you are verifying. Number two, state that financial statements have been audited. You have to mention a fact that you have audited the financial statements. Number three, identify the title of each statement comprising financial statements. So we have to say that financial statements contain balance sheet, P&L, statement of changes in equity, etc., etc., and also give a reference to notes, including the summary of significant accounting policies. And finally, specify the date and period covered by each financial statement comprising the financial statements. So date and period covered by the financial statement should be given. So these are 5 items only. You will be able to find it in the first subparagraph. So as you could see here, we have audited the accompanying standalone financial statements of Reliance Industries Limited. First 2 points are covered. Identify the entity, state that you have audited the financial statements, which includes joint operations, which comprises the balance sheet, statement of P&L, statement of cash flow, statement of changes in equity. Identify the elements of the items of the financial statements. Give a reference to the notes and significant accounting policies and notes to standalone financial statements, including summary of significant accounting policies. Even period covered by the financial statements, 31st of March 2025. Covered all the 5 contents, right? So this is what the opinion paragraph. So we are done with the opinion paragraph now. Now we have to go to the next content. So in the contents of the auditor's report, since we are done with the opinion paragraph, now coming to the next part, basis for opinion paragraph. So now what is this basis for opinion paragraph? Okay, you are giving opinion. Why anybody should believe your opinion? Why anybody should believe your opinion? You have to tell them the basis, no, on what basis you have done the audit. If you let them know, then they will be comfortable in relying your opinion. So what I have to exactly mention in my basis for opinion paragraph, sir? 4 simple things. You have to give basically basis for opinion are justification points why anybody should believe your opinion. So 4 points you have to mention in the basis for opinion paragraph. What are they? Number 1, state that audit was conducted in accordance with standards on audit. Say that you are not doing the audit as per your wishes, you are doing the audit as per standards on audit. Refer to the section of the auditor's report that describes the auditor's responsibilities. In the contents of the audit report, you will be able to find one paragraph called auditor's responsibilities. So give a reference to that paragraph in the basis for opinion paragraph. We are not just expressing opinion, we are having a bunch of responsibilities. All that responsibilities we have explained in the auditor's responsibility paragraph. Like that, give a reference. Thereafter, third point, you say that you are doing the audit independent of the entity and also in accordance with the relevant ethical requirements relating to audit, and you have fulfilled all other ethical responsibilities. You say that you are doing the audit in compliance with the ethical requirements, you have complied with independence, you have all complied with all other ethical requirements, you have done it, mentioned that. And state whether the auditor believes that audit evidence the auditor has obtained is sufficient and appropriate. And even mention that whether they have obtained, whatever evidence you have obtained is sufficient and appropriate or not. These are 4 things you have to compulsorily mention in your basis for opinion paragraph. These four things only will be summarized in the form of this paragraph. If you practically look at the audit report and all, this is what they will be able to find it. We conducted our audit in accordance with the standards on audit, first point. And they say that we have our responsibilities are further described in auditor's responsibility, reference to auditor's responsibility paragraph. We complied with code of ethics, ethical requirements, we are independent, etc. That is also covered. And then finally, we believe that audit evidence obtained by us is sufficient and appropriate. These are 4 points must come in your opinion, basis for opinion paragraph. There are some changes which you are required to make to the opinion paragraph and basis for opinion paragraph. Important discussion, listen. There are few changes you are required to make to the opinion paragraph and the basis for opinion paragraph in case if you are giving a modified opinion. Change number one, you have to amend the headings. If you are giving unmodified opinion paragraph will remain opinion only. If you are giving a qualified adverse disclaimer, you have to change the heading of the opinion paragraph. If you are giving qualified opinion, mention qualified opinion as heading. If you are giving disclaimer, give it as a disclaimer. If you are giving adverse, give it as adverse. And title for basis for opinion paragraph also should change. If you are giving unmodified, just a basis for opinion. If you are giving qualified opinion, basis for qualified opinion. If you are giving adverse, basis for adverse, same thing for disclaimer. In addition to that, in case if you are giving a modified opinion, if you give unmodified opinion, your basis for opinion paragraph will be very limited, which will contain only 4 points. But in case if you are giving a modified opinion, first you have to explain the reason why you are giving a modified opinion. What you should do? You are required to explain the reason why you are giving a modified opinion, where you have to do it in the basis for opinion paragraph. You have to do it. This you have to do it only in case of modified opinion. That means either you are giving qualified, adverse, disclaimer, whatever it is, that reason you have to explain it in the basis for opinion paragraph. Sir, what and all exactly I have to explain? So this is very important part of the standard. Come to SA 705. There you will be able to find it. See here. So what are the changes which you are required to make in case if you are giving a basis for a modified opinion? First, heading anyhow you have to change. Then, if there is a material misstatement that relates to specific amount, if the misstatement has happened in quantitative details, management has made some mistake in the figures, then you have to explain in the basis for opinion section a description what misstatement they have done, and even you have to quantify. Even what you have to do, quantify what is the amount of the misstatement they have done, that also you have to mention. If the misstatement relates to a quantitative thing, if the misstatement is relating to an amount, explain about that misstatement, what misstatement they have done, and even do the quantification. Sir, what if quantification is not possible? Mention the fact. If the quantification is not possible, you have to mention the fact that quantification is not possible. So that you have to mention. If it is not practicable to quantify, the auditor shall so state. Mention the same fact in your opinion section. However, as I have told you, misstatement need not always happen in figures only. Misstatements can also happen in notes to accounts, in the narrative disclosures. That's what we call it as narrative disclosure. In case if you are giving a modified opinion because there was a misstatement in the narrative disclosure, not in the amount, in the narrative disclosure, in the notes to accounts, in the explanation, there is a misstatement. That's why you are giving a modified opinion. Then what you should do? So if there is a material misstatement that relates to narrative disclosures, auditor shall include in the basis for opinion section an explanation of how that disclosure was misstated. How management wrongly gave that disclosure, you have to clearly explain it. And you can also give modified opinion due to non-disclosure also. Wrong disclosure we have covered. Non-disclosure. Non-disclosure means what? Management is required to give some disclosure in the financial statements, but they are not giving it. Previous case is what? They have given it, but they have given it in a wrong manner. See, modification can happen because of a number of reasons. One is because of amount. Second one is because of wrong disclosure. Third one is because of non-disclosure. So management is not giving a disclosure. That's why also you can give modified opinion. In that case, what you should do? See, if there is a material misstatement of the financial statements that relates to non-disclosure of the information required to be disclosed, then the auditor should discuss the non-disclosure. First point, discuss that non-disclosure with those statutory guidelines. Then describe in the basis for opinion section nature of the omitted information. What kind of information was omitted that you have to explain. Unless prohibited by law or regulation, include omitted disclosure. Unless prohibited by law or regulation, whatever disclosure management has omitted, that you give it in the basis for opinion section. So include omitted disclosure provided it is practicable to do so and the auditor has obtained sufficient and appropriate evidence. So if it is related to non-disclosure, very important. First you have to go and discuss that with the those charged with governance. Nature of information, whatever has been omitted that you have to explain, unless prohibited by law or regulation, whatever disclosure management has missed, explain it in the give that same disclosure in the basis for opinion paragraph. Next. In case if you are unable to obtain evidence, see we can give modified opinion even because of non-availability of audit evidence also. In case if you are giving a modified opinion due to non-availability of audit evidence, then you have to explain the reasons why you are unable to obtain sufficient and appropriate audit evidence. Because of what reasons? Are the documents destroyed? Are the supporting documents are burned? Or management put a restriction? Why you are unable to obtain sufficient and appropriate audit evidence? And tell that reasons also. Next. Where the auditor expresses qualified or adverse opinion, the auditor shall amend the statement whether audit evidence obtained is sufficient and appropriate for giving that opinion. Okay, this is not the case. Most important. This is the most important. See, I told you 4 points should come always in the basis for opinion paragraph. What are the 4 points? You have done the audit as per standards and audit. Explain them. Explain the auditor's responsibilities, and thereafter, what is it? That you are independent of the entity and also you have obtained that sufficient and appropriate audit evidence. In case if you are giving a disclaimer of opinion, some points should not come from this four. What are they? Sufficient and appropriate audit evidence. That point you should not mention. That is there. No? In addition to that, second point also don't mention. Don't give reference to auditor's responsibilities. Why you know? Going forward, we will see when you are giving disclaimer of opinion, then also your auditor's responsibility paragraph will be very short because you are not fulfilling the responsibilities. No, generally auditor's responsibility paragraph will be very lengthy. We are going to see it in a short while. But when you are giving a disclaimer of opinion, your auditor's responsibility paragraph should be very much limited because you are not able to fulfill the responsibilities. That's why auditor's responsibility paragraph will be very limited. An auditor's responsibility paragraph itself is very limited. Why there is a need for giving reference once again in the basis for opinion paragraph? Able to understand? So especially when you are giving a disclaimer of opinion, what specific changes you have to make it to basis for opinion paragraph. So if you see that when auditor is giving a disclaimer of opinion on the financial statements, the auditor's report shall not include the following. What are they? Number one, a reference to the auditor's report where auditor's responsibilities are described. Because when you are giving a disclaimer of opinion, the responsibility paragraph will be very shrinked. So that's why don't give reference to auditor's responsibilities. And even you should not give any statement that you have obtained sufficient and appropriate audit evidence. Last one is self-explanatory. The second point you have to exclude it that have specifically mentioned it. Next. Even if auditor has expressed an adverse or disclaimer of opinion, the auditor should describe in the basis for opinion section the reasons for any other matters of which the auditor is aware that would have required a modification to the opinion and the effects thereof. So nothing but even though you are giving adverse opinion, overall you are saying that financial statements are not giving true and fair. Or even though you are giving a disclaimer, you are saying that you are unable to express opinion. But still, if you want to stress and explain on specific misstatements, you can do it. You can do specific explanation. If you want to add extra things in your basis for opinion section, then you can do it. Understood? Clear? So this is what regarding changes which are required to make to basis for opinion paragraph. Very important paragraph. What and all changes you have to make for basis for opinion in case of modified. Very, very important. So that also we have covered. So basis for opinion paragraph also covered. Clear? Now we will come to the next content. So title over, addressee over, and opinion paragraph over, basis for opinion is also over. Then we have few more things here. There is something called going concern paragraph. So management regarding going concern also there is some disclosure which is required to be given. But this going concern paragraph will have an elaborated discussion when we take up the standard SA 570. Ignore this for the time being now. Then we have something called key audit matter paragraph. Along with that, there will also be some other paragraphs called emphasis of matter paragraph and other matter paragraph. Like that, three special contents will be there. Regarding this, we'll have a separate discussion. So, key audit matter paragraph we will cover in SA 701, emphasis of matter and other matter paragraph that we'll try to do it in SA 706. So, that will have a separate discussion. Then we have something called other information. This is governed by SA 720, not a part of your syllabus. That you can ignore it. So after all this, responsibilities for the financial statements, simply responsibilities of the management for the preparation of the financial statements. So management responsibilities. Sir, what are the management responsibilities here? Simple. So if you look at the management responsibilities, same more or less. So as an auditor, you have to say that the management is responsible for preparing financial statements. That too in accordance with applicable financial reporting framework. And also you have to say that they are responsible for making an entities assessment regarding ability to continue as a going concern. You have to say that management is responsible for making an assessment regarding entity's ability to continue as a going concern. And also you have to identify those who are having oversight of the financial reporting process. Who is monitoring that financial reporting process? Who is supervising that financial reporting process? Generally, those charged with governance will be there. You have to identify the people, those who are having oversight of the financial reporting process. So three things: management is responsible for preparation of financial statements. They are even responsible for making an assessment regarding entity's ability to continue as a going concern. Even those who are having the oversight of the financial reporting process. Then immediately after management responsibilities, you will have another paragraph which is none other than auditor's responsibilities. Now, all your headaches you have to say it here. So you have n number of responsibilities, no, n number of obligations, right? One by one, all the responsibilities you have to start explaining. Then you have to say that as an auditor, your objective is to obtain reasonable assurance, and you have to issue a auditor's report. Reasonable assurance is a high level of assurance, but it is not a guarantee. And you have to mention that misstatement can arise from either fraud or error. But you will not be worried about each and every misstatement. Only that could influence the decision of users of financial statements. Only material misstatements you will get worried. Then, in addition to that, you should say that as an auditor, you have to apply professional judgment, you have to maintain professional skepticism, and it is your responsibility to identify and assess the risk of material misstatement. Depending on that, you are going to plan your further audit procedures. And also, you have to obtain an understanding of internal control. You have to evaluate the appropriateness of accounting policies, and you have to evaluate the appropriateness of management's use of going concern basis of accounting. In the audit management responsibility paragraph, we have told that management is responsible for making an assessment regarding entity's ability to continue as a going concern. But as an auditor, your responsibility is to evaluate whatever assessment management has done, whether that is appropriate or not. You need to obtain sufficient and appropriate evidence. And you have to check whether, in case if the financial statements are prepared as per fair presentation framework, you have to check their fair presentation, whether they are giving a true and fair view or not. You have to check it. And in case if SA600 becomes applicable, when SA600 will become applicable, when you are using the work of other auditors, like you are using the work of the branch auditor. If you are conducting audit of consolidated financial statements, you might be using the work of component auditors, like subsidiary financial statements auditors work and all you are using. So in that case, if SA600 becomes applicable, division of responsibility. You have to say that in case if you are using the work of the branch auditor, you can say that I will be responsible only for the work which I have done. Branch related work was carried out by a separate branch auditor. That division of responsibility also you can say. Not just that, you have some reporting requirements. You have some communication requirements with those charged with governance as per SA 260 and 265. As per SA 260 and as per SA 265, there are some matters which you are required to communicate with those charged with governance. Even you have to tell that you are having that responsibility to fulfill all that communication requirements as per SA 260. So this communication requirements and all, we will get to know about it in SA 260. Simply, if I have to put it, these all matters you are required to explain. That you have some reporting communication requirements with those charged with governance. Now, so these are all auditor's responsibility paragraph. Now I told that in case if you are giving a disclaimer of opinion, you should not explain all this. You should not explain all this in your auditor's responsibility because you are not able to fulfill now. What is the whole purpose of giving disclaimer? You are saying that you are unable to obtain audit. You are unable to obtain audit evidence. That means you are unable to do the audit only. If you are unable to do the audit, you are not able to fulfill all these responsibilities only. Then what is the purpose of mentioning all these responsibilities? So that's why they have told that in case if you are giving a disclaimer of opinion, keep your auditor's responsibility paragraph very restricted. Just a few points we will tell, that itself if you mention it will be enough. Sir, what are that few points which I have to mention? In case if I am giving a disclaimer of opinion, so once again come to SA 705. See here. Description of auditor's responsibilities for audit of the financial statements when the auditor is giving a disclaimer of opinion. So they say that when the auditor is giving a disclaimer of opinion on the financial statements due to inability to obtain sufficient and appropriate audit evidence, the auditor shall amend description of auditor's responsibilities to include only the following. So in case if you are giving a disclaimer of opinion, you amend your auditor's responsibility paragraph. What they are saying, you amend your auditor's responsibility paragraph to include only following. We'll mention you some points, only that much you mention in auditor's responsibility paragraph. When you are giving a disclaimer. So if you are giving disclaimer, your auditor's responsibility shall include only the below mentioned things. What are they? a simple statement that auditor's responsibility is to conduct an audit of financial statements in accordance with standards. Mention this point. A statement that, however, because of the reasons which I have explained in the basis for disclaimer of opinion, we are unable to obtain sufficient and appropriate audit evidence. And statement that auditor's independence and other ethical responsibilities are complied with. That's all. Three simple points you have to mention. In which paragraph? Auditor's responsibility. When you are giving a disclaimer. Three things. Number one, as an auditor, you are responsible for conducting audit in accordance with standards on audit. But because of the matters which I have already explained in basis for disclaimer, we are unable to obtain that evidence and we complied with independence and ethical requirements. We are responsible for complying with the independence and ethical requirements. These 3 points you have to mention. Not that lengthy auditor's responsibility paragraph. That's why, since we are shrinking the auditor's responsibility paragraph in the case of disclaimer of opinion, we told the previous point, when you are giving the basis for opinion paragraph in the case of disclaimer of opinion, don't include any reference to auditor's responsibility paragraph. Why? Because there is nothing there. There is nothing there mentioned. So what is the purpose of giving the reference? Understood? Clear? So this is what regarding auditor's responsibility paragraph. Okay, thereafter, one more important point. So what is the location of the description of auditor's responsibilities? Where you have to mention this responsibility paragraph. See, I told you responsibility paragraph is very lengthy, right? So how you can present it, where you can locate it. If you want, include it in the auditor's report only. In the auditor's report only, under the auditor's responsibilities heading, write all the responsibilities, whatever we have told you till now. But they are giving you one more option. If you are feeling that this audit responsibility is becoming very lengthy, they are interrupting the other content. So what you do is keep the heading auditor's responsibilities, add an annexure. Add an annexure. Refer to, keep the heading auditor's responsibilities, add annexure. Refer to annexure so and so. At the end, you attach that annexure where you are containing the auditor's responsibilities. When you feel that it is because so much of content has to go in there, if you feel that people will get lost in reading and don't refer to the remaining part of the audit report, then you do this thing. So either you can include it within the body of auditor's report, or you can include it as appendix, like an annexure. So give the heading auditor's responsibility paragraph and write there refer to so and so annexure. After the completion of the audit report, you give that, you add that annexure. That is also one more thing. However, they have told one more point, by a specific reference with the auditor's report to the location of such a description on a website of an appropriate authority where law, regulation, or national auditing standards expressly permit the auditor to do so. So what is it? Let us say whatever your responsibilities are there, if they are already mentioned in some government website. Let us say ICA website is there. In the ICA website, what and all are our responsibilities, that is already explained. If I am permitted by law or regulation and also ICA, instead of writing all that responsibilities, what I can do, I can mention the paragraph auditor's responsibilities and give the link there. Give the link there. So that if the person goes and visits the link, there he can read all the responsibilities. But that permission is not there in India. You have to either write it within the body of the auditor's report or give it as a annexure. If permitted by law, regulation, or the standard setting body, like I say, if they have given the permission, if your responsibilities are mentioned in some website, you can even give a link of that website also. Clear? So 3 ways of location of description of auditor's responsibilities, either within the body or as an appendix, or even by giving a specific reference to the website of the government or any authority, unless prohibited by law or regulation. Clear? Right. So with this, we have completed fully auditor's responsibility paragraph. Thereafter, then we have this location also we have done other reporting responsibilities. So till now, whatever contents we have included in the auditor's report, under all that paragraphs, we are fulfilling our reporting requirements as per standards. But apart from that, depending upon the governing act of your client, you might have some additional reporting responsibilities also. Like I told you at the beginning of this chapter, you have some reporting requirements under Companies Act, section 143, 143.3, 143, 12. So these matters also auditors required to report, no sir. In which paragraph you will do it? For that you have to use this dedicated paragraph, other reporting responsibilities. So apart from the standards on audit, if you have any additional matters which are required to be reported, use this paragraph and fulfill all the reporting requirements. So that's what the purpose of other reporting responsibilities. Now, after including all this content, you have to sign it. Sign the auditor's report. You have to mention the signature. And if it's an individual auditor, he will sign in his name. He will mention his membership number. That's all. If he's signing on behalf of the firm, He has to mention in his personal name. He has to mention his membership number. He has to mention the name of the firm, and firm registration number is also required to be mentioned. And then finally, place of signature. No need to write the full address and all. Just mention the city wherever you are signing. And thereafter, date of the auditor's report. And you have to be very careful. Date of the auditor's report should not be earlier than date of obtaining the evidences. Date of obtaining evidences. Why? Because the process is first evidence, then report. So it should not be in any case when the date of auditor's report is earlier than the date of obtaining of the audit evidences. You have to be pretty careful about it. And then finally, UDIN. So as we all are aware, today auditor signature will not have, chartered accountant signature will not have any validity unless and until there is an UDIN below it. So UDIN also you have to generate, and you have to affix that UDIN as well. So these are all the contents of the auditor's report. Understood? Clear? So mostly we are done with 700 and 705, but some left out content is there. That also we'll try to finish it off. Then we'll go to 701 and 706. So first we'll try to complete the left out content from SA 705, just talking about this modifications and all. So this all we have covered. What is the definition of modified opinion? What are the definitions of different types of modified opinion? All this we have covered. Meaning of the pervasive is also covered. This is one simple point. See, if you have decided to give modified opinion, but which kind of modified opinion you have to give, that depends on only two factors. You have decided to give modified, but whether you will give qualified, adverse, or disclaimer, that is going to depend on only two factors. What are they? Availability and non-availability of sufficient and appropriate audit evidence, pervasiveness of the misstatement. That's all. Only two factors. These two factors will be enough for us to decide which kind of modified opinion will be appropriate. Number one, availability and non-availability of audit evidence, and pervasiveness of the misstatement. That's all. Then this one. This is a extended version of what we have already discussed. Consequences of inability to obtain sufficient and appropriate audit evidence due to management imposed limitation. So what is this? So as an auditor, you are unable to obtain sufficient and appropriate audit evidence. And why you are unable to obtain sufficient and appropriate audit evidences? Because management is imposing a limitation on you, not because of circumstances. Management is imposing a limitation because of which you are unable to obtain sufficient and appropriate audit evidence. Then what you should do? Then what you should do? So here they say one process here. So first they say that first be a gentleman. First be a gentleman. Go and ask the management to remove the limitation. Sir, because of your limitation, I am unable to obtain sufficient and appropriate audit evidence. Please remove the limitation. Please go and ask the management. Request the management to remove the limitation. When you go and request, two things can happen. What are they? Management removes the limitation. Well and good. If the management has removed the limitation, they are letting you carry out the work. Do it. Complete the audit. If the management is not removing the limitation, then what you should do? Then what you should do? Then first thing they will say, they will ask you to go and inquire, complain to the those charged with garnets. Sir, I'm asking, management is putting a restriction because of which I'm unable to obtain evidence. You are those charged with garnets. No, at least you tell them. So go and communicate with the those charged with garnets. If after communicating with those charged with garnets, if they have removed the limitation, well and good. No, sir. Even after communicating with those charged with garnets, also limitation does not get removed. Then you try to perform alternative audit procedures. Think anything alternatively you can do without the involvement of the management. Can you do anything alternatively to obtain sufficient and appropriate audit evidence? No, sir. Even if I am unable to perform the alternative audit procedures also, then what you should do? Then they say, determine what is the possible effect. You are unable to obtain audit evidence, management imposed a limitation, you complain to those charged with guidance, you try to perform alternative audit procedures, but still you are unable to obtain audit evidence. Determine what is the possible effect. Possible effect of undetected misstatement. If it is only material but not pervasive, if it is only material but not pervasive, do one thing, continue the audit, don't take extreme step, continue the audit, give a qualified opinion, close the audit, get your fees, be happy. So, in case if the possible effect is material and also pervasive, then what you should do? First option they told withdraw here. You give disclaimer usually, but here they are saying since you are unable to obtain evidence because of management imposed limitation, no. If the possible effect is material and also pervasive, first take the extreme step, withdraw from the engagement. In case withdrawal is not permissible, if you are unable to do the withdrawal, in some cases we will not be able to do it. Like in case of listed companies, we have an obligation. For 3 continuous quarters, if you have given the review reports, you can't withdraw unless and until you give the audit report. So like that, in some cases there will be restrictions. In case if you are unable to withdraw, then you have to give a disclaimer of okay, continue and give a disclaimer. But wherever there is a possibility, you have to withdraw. That's all. So this is what regarding consequences of inability to obtain sufficient and appropriate audit evidence due to management imposed limitations. Let me see if I have anything any. And one more thing. So one more thing here, in case if you have decided to give a modified opinion, first you have to go and communicate with those charged with governments. So SS 705 we have completed. In SS 700 we have some left out content that we will try to do it. There will be one useless concept called evaluations here, so that we'll try to quickly cover it. Even though it is a useless concept, the questions will get tested from there. So let us see what are they. See, before as an auditor, as per SS 700, as I have told you, first you have to form the opinion and then you have to express it. So now when you are forming the opinion, you will consider all your audit evidence, and equally you are also required to do some evaluations. You're also required to do some evaluations. Some things you have to check, some things you have to analyze. And whatever evaluations you are required to do before expression of opinion, those evaluations are divided into two categories. One is qualitative aspects evaluation, and the other one is specific evaluations. One is qualitative aspects evaluation, and the other one is specific evaluations. So specific evaluations will be more or less similar to points which are required to be verified to make sure that financial statements will not mislead anybody. Nature, objective, and scope of audit, we have read one small paragraph. No, what points you will verify to make sure that financial statements would not mislead anybody? It will look similar to that. Not exactly same, changes are there, but mostly it will look like that. Now, what are qualitative aspects evaluation? So, qualitative means other than quantitative. That means apart from figures, apart from amounts, apart from balances, what are the significant qualitative aspects you have to check? So, what they say here is they will not say anything meaningful here, but we have to report on it. So, you can experience it here. They will say nothing meaningful here. Some useless shit and all they will say. So, what are the qualitative aspects you have to evaluate? They say that if I read the points for you, management will make a number of judgments. As I have already told you, from inherent limitation onwards, we are seeing. So, management will make so many judgments in the process of preparation of financial statements regarding the amounts and disclosures. Essay 216 discusses the qualitative aspects of accounting practices. So when I say qualitative aspects, you are going beyond numbers. You are checking at accounting policies, accounting principles, and all. So more guidance has been given in Essay 216. In considering qualitative aspects of entities' accounting practices, auditor may become aware of possible bias. So especially when you are evaluating the judgments and all, you can sometimes find out the bias. See, judgment means management taking a decision. Let us say, one example, management is required to decide on method of depreciation. They have two options, WDV, SLM. So after SLM method, you can use SLM method when the expected pattern of consumption of that asset is going to be uniform throughout its useful life. Now, management, what they are doing is, even though the machinery is expected to be used uniformly, but instead of charging depreciation under SLM, they are charging depreciation under WDV method, diminishing value method. So, this is bias or not? If the management is unbiased, what they should have done? Since the consumption pattern is uniform, they should have charged the depreciation on SLM basis. But the management, what they are doing, they are charging some other method. So they are biased here. They did not make a fair decision. So sometimes when you are evaluating the accounting practices, you might get to know about bias in the management judgment. The auditor may conclude that cumulative effect of lack of neutrality together with the effect of uncorrected misstatements may cause the financial statements to be materially misstated. So when you come across a bias, don't ignore it. Consider whether from that bias is there any chance for you to identify whether financial statements are containing a misstatement. Next, indicators of lack of neutrality. Sir, when you will get is there any indicator? Are there any hint points which will make us aware that here management might be lacking neutrality, management might be under bias? Will there be any indicators, sir? Yes. Number one, selective correction of misstatements. You identify 20 misstatements. You ask the management to correct it. But they are correcting only those misstatements which will increase the profit. They are not correcting those misstatements which are decreasing the profit. That is clearly indicating their bias or not? Yes. And also possible management bias in making of accounting estimates. Like management is creating under provisioning for bad and doubtful debts. Management is estimating more useful life. So when in accounting estimates also you are seeing the bias, then they're definitely in other qualitative aspects also there will be bias. Simple. As I told you, no meaningful conclusion. Just they will leave some points randomly in the air. So what they are trying to say it here in the qualitative aspects, number one, management will make number of judgments. SA 260 talks about qualitative aspects. When you are verifying the qualitative aspects, you might get to know about bias. So when you come across that bias, you evaluate whether financial statements are free from material misstatements or not. Are there any indicators of bias? Yes, two they have told. Selective correction of misstatements and also possible bias while making the accounting estimates. Understood? And when it comes to accounting estimates, we have SA 540, anyhow not in CA inter syllabus, we will learn them at the CA final syllabus. Then, sir, what are the specific matters which are required to be evaluated? You told qualitative aspects evaluation, specific evaluations. Sir, what are that specific evaluations? So if you see it here, whether you have to specifically check whether financial statements adequately disclose accounting policies. Nothing but in the notes to accounts, what accounting policies they have followed has been clearly explained or not. Accounting policies selected and applied are consistent. They are consistently getting applied or not. Accounting estimates are reasonable. Whatever estimates made by the management are reasonable or not. Information presented in the financial statements is relevant, reliable, comparable, understandable, clear and unambiguous. And financial statements provide adequate disclosure to enable the users to understand the effect of material transactions and events, whether they are disclosing all the important information or not. Terminology used in the financial statements should be appropriate. Further, financial statements which are prepared in accordance with the fair presentation framework, the evaluation must also include auditor's evaluation of whether financial statements achieve a fair presentation. In case if you are checking for a fair presentation framework, we have to check whether they are really giving a true and fair view or not. So whether they are giving true and fair view of overall presentation structure and content, and even in the notes to accounts also they are giving all the disclosures which will help them to achieve the fair presentation. And then finally, whether financial statements adequately describe applicable financial reporting framework. In the financial statements, whether they have clearly explained the applicable financial reporting framework or not. So some random points, specifically these points you have to check, and apart from that, qualitative aspects also you have to evaluate. Clear? So this is one left out area regarding this thing. So all this is all repeated things and all. So we are done with 700 and 705. So what we will try to do now is SA 701 we will try to discuss. You guys need a break? After SA 701 we will take a break. One more standard. 701 we will do, thereafter we will try to take. I should be asking for a break here. You are asking for a break. You will say, sir, you are talking, sir. You will not get sleep. We are listening, sir. We will get sleep. So SA 701 we will try to discuss. Small standard, quick one, compulsory question. SA 701, which is going to talk about communicating the key audit matter. Sir, what exactly is this key audit matter? They say that key audit matters are those matters that in the auditor's professional judgment are most significant while conducting the audit of the current period financial statements. See, traditionally there used to be no uniformity in the audit reports here. Everybody used to prepare the audit report in whatever manner they want. So now industry cried and they thought that uniformity is required. So today we brought the uniformity. How we brought the uniformity is, to what level we have brought the uniformity is, you take the two companies audit report where it contains modified unmodified opinion, it will contain exactly ditto copy pasted information. Name of the company, name of the auditor, date will change. Apart from it, everything will remain constant. How come, sir? Because we are all copying from the same source. ICA doesn't want to have the chance. They told, no, no, we have a lot of confidence in your communication skills and all. Wherever drafting comes, we will tell you that you copy it and paste it. So today we have achieved that level of uniformity where if you look at two audit reports which are having same opinion, they will look exactly copy pasted. And or is, comma, full stop, nothing will change. So that level of uniformity we have achieved. Now when we have got that level of uniformity, industry is once again crying, sir, your audit reports are all looking similar. By reading audit reports, nothing we are getting. Yes, true. You only cried for uniformity. We brought it. Now once again you are crying. Whatever you do, we have a problem. So that's what even it is visible today. So industry doesn't like chartered accountants. Why, we don't know. So that's why they are fighting. They are removing the statutory audit also for the companies and all. They are for private companies and all the statutory audit and all. They are going to remove it. I think it should be a good sign only, because in developing countries itself they have that norm here. Otherwise, no company from the business perspective. If you think company management is becoming very difficult. MCA compliances, mandatory audit compliances for small companies and all, compliances are adding up. Good sign for the industry for removing statutory audit and all. So soon they will this will come into a proper structure and all. But anyhow, whatever it is, industry always will have a problem with the chartered accountants. One problem number one: if you have to get an appointed, you have to share the secrets with him. If you are a company, if you want to get an audit done, you have to share the business secrets with him. Nobody wants to like to share their secrets and all. And sometimes some auditors are harassing also. Statutory audit, they are not finding any value addition. Why? Just because law requirement is that, that's why they are getting it audited and all. So whatever we do, industry will have a problem. So one problem they caught up and they started crying is audit reports are all looking similar. We are not getting any value addition. So now ICA has to do something in order to bring that value addition. No one should get a feeling that by reading audit report I got nothing new to know. So that's why what they have told us, let us do one thing. You are doing the audit of the current year, no? From doing the audit of the current period financial statements, as an auditor, you use your professional judgment. You use your professional judgment, and from the current period audit, you select a few matters which you feel it as most significant. From the current period audit, you select a few matters which you feel it as most significant and explain how you have dealt with them in your auditor's report. So three things you have to explain. Which matter you have selected as a key audit matter. Second point, why you have selected this as a key audit matter. Because of what reasons you are selecting it as a key audit matter. Number three, how you have addressed that key audit matter. How you dealt with that. So three things you have to explain regarding key audit matter. What is the matter? You are choosing it as key audit matter. Why you have chosen this as a key audit matter. How you have dealt with that matter. The three matters you have to explain. And which matter will be a key audit matter? That who has to choose? Auditor himself has to choose. How he has to choose? On the basis of his professional judgment, he has to choose it. Clear? So that's what the whole object. Sir, now key audit matters also can be copy pasted. No, sir. No. If you do that, you are a fool. Now. If you do that, you are a fool. Why? Because company to company, industry to industry, business to business, not all matters will remain significant for everybody. Or even if they remain, even if the matter remains same also, the way you are going to address is going to be different. So today, if you compare two audit reports, if you are finding the same key audit matter copy pasted, one of the auditors is a fool there. So key audit matter, it's personally your things you are sharing. So what difficulties you have faced, what difficulties you have faced, how you have dealt with that. So to increase that value addition, to increase the communicative value of the auditor's report, they have introduced that audit or key audit matters. So that there will be transparency and there will be better communicative value from the auditor's report. That's what has been the whole purpose of bringing this content called key audit matters. Understood? So now, sir, will this key audit matter paragraph be applicable for each and every audit? Currently, no. They are doing it in a phased manner. Very soon, they will make it applicable for every company. But currently, key audit matters is not applicable for every company. So they say that key audit matter paragraph will become applicable in case if you are conducting audit of a listed company. In case if you are conducting audit of a listed company, your audit report must compulsorily contain a key audit matter paragraph. Number two, if there is any requirement of law or regulation, it is not a listed company, but some law or regulation is expecting you to include a key audit matter paragraph, then also you have to include it. In remaining all circumstances, let the auditor himself decide. If you feel that this company is so significant, it will be better if I could give a key audit matter, then you include it. If you don't feel any necessity, don't do it. But currently, it is going to be mandatory only for listed companies or wherever there is a requirement from law or regulation. Sir, they say that the purpose of the key audit matter is to enhance or increase the communicative value of the auditor's report, but they have specifically clarified a few things. Key audit matter is not a substitute for three things. Key audit matter is not a substitute for three things. What is that? Number one, key audit matter paragraph is not a substitute for a disclosure which is required in the financial statements to be made by the management as per applicable financial reporting framework. So key audit matter paragraph, I was saying, it is not a substitute for disclosure that is required in the financial statements to be made by the management as per applicable financial reporting framework. Point number one. Sir, what does that mean? It is a responsibility of the management to prepare financial statements. It is a responsibility of the management to give the disclosures. Now, let us say management forgot to give one disclosure. They are coming to the auditor and saying, sir, we forgot to give one disclosure. We don't want to amend the financial statements. Anyhow, you are giving the audit report now. Whatever disclosure we forgot, you include it in the key audit matter paragraph. Do you think it is the purpose of the key audit matter? So key audit matter paragraph is not a substitute for disclosures which are required in the financial statements. Number two, key audit matter paragraph is not a substitute for material uncertainty relating to going concern paragraph. Key audit matter is not a substitute for material uncertainty relating to going concern paragraph required as per SA 570. So as per SA 570 in your going concern paragraphs, so let me show you that. So as per SA 570, you are required to include a material uncertainty relating to going concern. some information should go to that paragraph only. You cannot say instead of explaining that in the material uncertainty paragraph, I will explain it in the key audit matter paragraph. You cannot say that. It is not a substitute for material uncertainty relating to going concern paragraph. Number 3, it is also not a substitute for giving a modified opinion. What is it? It is also not a substitute for giving a modified opinion. Let us say you are conducting audit of the financial statements, you found a material misstatement in one area. You are saying that instead of giving a modified opinion, I will explain about it in the key audit matter paragraph. Is it accepted? No. So 3 things it is not a substitute for. Number 1, it is not a substitute for disclosures recorded in the financial statements as per applicable financial reporting framework. It is not a substitute for giving a modified opinion. It is not a substitute for a material uncertainty related to going concern paragraph. So it is not a separate opinion on any of the matter. By explaining the matters in the key audit matter paragraph, like if you see the practicality here in the Reliance Industries Limited audit report, they have included some key audit matters. By including that key audit matters, like auditor here is saying litigation as a key audit matter. Does that mean he is giving a separate opinion on this litigation? No, he's just letting you know why he has chosen this as a key audit matter, how he has tackled that area. That's all. He is not giving any separate opinion on this litigations. Understood? So it is also not a separate opinion on any of the matter. Clear, everyone? Able to understand? Right. And few more things here. Before you are explaining the key audit matter paragraph, give some introductory information. Give some introductory information. So let the readers be aware. What is this key audit matter? Why you are doing it? Let the reader be aware. Sir, how you can make them aware? By introducing them. What is the key audit matter? So what paragraph we have to use? We have to say that this is where it is. No, not this one. So from the report itself, I will try to explain it here. So these introductory lines use. What are they? Key audit matters are those matters that in our professional judgment were of most significance in our audit of the standalone financial statements of the current period. These matters were addressed in the context of audit of standalone financial statements. We have addressed these matters and in forming our opinion. And we do not provide a separate opinion on any of these matters. Clearly mention that so that reader will not get confused. Why? Even though with a very good intention we include some information, but users always take it in a wrong way. So if I explain something like this, if I explain about this litigation matter, if I don't give this introductory paragraph, the user will always think that company has committed some lafda in this litigation matters. So that's why give a disclaimer. What is a key audit matter? So why we are explaining it? We do not give a separate opinion. So that's why you have to include this a introductory paragraph. Apart from that, sir, you are telling that key audit matters have to be chosen by the auditor completely on the basis of professional judgment. But is there any hint? Is there any example given by the standard from which areas I can go and search for key audit matters? Or what factors will help me in identifying a key audit matter? Yes, they have given a few factors which will help the auditor in identifying a key audit matter. Or if I put it in another way around, the standard has given you hints of few areas where you can go and search for the key audit matters. 3 areas they have suggested. Go to those areas where there is a high risk of material misstatement. In those areas wherever there is a higher risk of material misstatement, go and search for key audit matters there. Or go and search for key audit matters where significant auditors' judgments are involved. In those areas wherever significant judgments are involved, like revenue recognition and also provision for bad and doubtful debts, depreciation, useful life. So wherever significant judgments are involved, from there also you can go and search for key audit matters. Or any significant events or transactions that have occurred during the year, like your company has acquired another company, some amalgamation happened. Those areas you have faced a lot of difficulty in obtaining evidence. From those areas also you can go and start looking for key audit matters. So whether they ask you the question, what are the factors that will help the auditor in identifying key audit matters, or from which areas auditor can go and start looking for key audit matters, you can write these 3 areas. Areas with higher assessed risk of material misstatement, areas where significant auditors' judgments are involved, and various significant events or transactions that have taken place. And apart from that, in case if you want to include a key audit matter, you have to communicate with those charged with governance. You have to they use one phrase. You have to select the key audit matters from those matters which are communicated with those charged with governance. Like that, they use one phrase. That means if you want to communicate something as a key audit matter, then you have to first communicate with those charged with governance. And one more point here. The standard has specifically prohibited, in case if you are giving a disclaimer of opinion, you cannot explain the key audit matter. If you are giving a disclaimer of opinion, you should not include a key audit matter paragraph. Why, sir? You are unable to do the audit only. When you are unable to do the audit, it will not be fair enough to ask you to once again identify the key matters. When you have done the audit, when you have given your opinions and all, then if someone is expecting you to identify the key matters and explain them, there is a purpose. But when you are giving disclaimer of opinion, you yourself are saying, no, no, I'm unable to obtain sufficient and appropriate audit evidence. I'm unable to do the audit. I'm unable to perform audit procedures. There is no purpose in asking him to once again identify the key matters from that and explain it. So that's why when you are giving a disclaimer of opinion, you should not include a key audit matter paragraph in your auditor's report. That's all. This is what the key content from key audit matter. There's one more thing. Sir, what if there is no key audit matter? What if there is no key audit matter? There is nothing significant, sir. Then you did not do the audit only properly. First thing. So there should be something significant, right? So, but let us say a typical scenario where you have done the audit, but there is nothing significant, sir. There is no key audit matter. What you should do? So use a paragraph key audit matter. Say in that there is no key audit matter. Then also use the key audit matter paragraph and say that apart from the matters explained in basis for opinion paragraph and all, I don't have any other key audit matter. Say that. But use the key audit matter paragraph and say that there is no key audit matter. So that's what the illustration I have given it here. So except for the matter described in basis for qualified option or material uncertainty, we have determined that there are no other key audit matters like that. You can express one like. Understood? That's all. So this we have completed 701. So now Mhm. uh, so since we have completed SS 701, one more last standard which we are left with in the audit reporting chapter is SS 706. I just try to do it. So SS 706 is going to talk about two contents in the auditor's report. How many? Two contents in the auditor's report. So what are the two contents? One is emphasis of matter paragraph and the other one is other matter paragraph. So let us try to understand what is the purpose of these paragraphs, when it will be used, how it will be presented, all that we'll try to get familiar with. So first we'll try to start with emphasis of matter paragraph. So what is this emphasis of matter paragraph? They say that emphasis of matter paragraph is a paragraph which is used to refer to the matter which is already presented or disclosed in the financial statements. By whom? Management. Management, without their fault, they have already presented or disclosed in the financial statements, that too in a correct manner only, no misstatement, nothing. So the management has properly presented and disclosed some information in the financial statements. But that matter is very fundamental to users understand. Even though management has presented that information in the financial statements itself, we cannot expect each and every reader to refer to entire section of the financial statements. So many people often they will read only that balance sheet, P&L, that too also figures only they will check and they will proceed. But there is one important information which is already presented or disclosed in the financial statements by the management, but it is very fundamental for a reader. It is very fundamental to his understanding of the financial statements. As an auditor, I felt that urge to highlight it somewhere in my auditor's report. I want to highlight it. Somewhere in my auditor's report, I want to highlight it. What I can do? How can I highlight it? Sir, can I highlight it by giving a modified opinion? No. Client will give me a tight slap. So when he has already presented everything in a proper manner, that too without any material misstatement, how can I give a modified opinion? So I can't give a modified. Then how can I highlight? The standard in these circumstances, they have given one permission. They told, okay, you do one thing, you use a paragraph with a heading called emphasis of matter paragraph. The meaning of the term emphasize is to highlight. So there is some information which is already presented or disclosed in the financial statements, but it is very fundamental to users' understanding of the financial statements, and you want to highlight it somewhere in your auditor's report. You use the emphasis of matter paragraph for that. But prerequisite for using emphasis of matter paragraph is something should have been already presented or disclosed in the financial statements. Like for example, management is the company is going through a court case. They have shown it as a contingent liability. Management, without their fault, they have shown it as a contingent liability, but you want to highlight it. So do one thing, use a title emphasis of matter paragraph, say that we draw your attention to so and so note number where some information has been presented, go and refer to it. Or let us say there was one extraordinary event during the financial year, a fire accident has happened, and that fire accident you want to highlight it because of that extraordinary item. There was some hit on the P&L, so that you want to explain. Let us say the company was maintaining a streak, year on year revenue was growing by 10%. This year, if you look at the profit and all, it has fallen by 10%. Why? Why? Because one extraordinary event happened, fire accident happened, loss has happened, that has been absorbed, extraordinary item. That's why there is a dip in the profit. This you want to make the reader aware. The management explained. They have explained some notes. So it's a note number 52. In that they have clearly explained during the year this much fire accident happened, this loss, this compensation, this is the net loss. They have clearly explained. But you felt it is very much fundamental to users' understanding of the financial statements. You do one thing, highlight it in your emphasis of matter paragraph. Clear? So that's what has been the whole purpose of the financials, whole purpose of this emphasis of matter paragraph. So if you see it here, emphasis of matter paragraph is a paragraph which is included in auditor's report that refers to a matter which is appropriately presented. It is appropriately already presented or disclosed in the financial statement, but in the auditor's judgment, it is of such importance that it is fundamental to users' understanding of the financial statements. Then, so examples, sir. Sir, what are the examples of the instances which can be highlighted in the emphasis of matter paragraph? As you could see, uncertainty relating to future outcome of an expected litigation or regulatory requirement. Nothing but, as I was saying, contingent liabilities that you can highlight it. Or significant subsequent events that occur between the date of the financial statements. If any subsequent event has been adjusted, management has already presented it, that you can highlight it. Or early application of a new accounting standard. Your client has made an early adoption of a new accounting standard. Prior to that effective date only, they have implemented it. So because of that, some financial impact has had. So that you want to explain it. That also could be one example. Or even a major catastrophe that has or continues to have a significant effect on the financial statements, like fire accident or some calamity. That also you can highlight it. These are only examples of the matters which can be explained in the emphasis of matter paragraph. Now, how you are required to present it? How you are, and one few more things here. They say that you can use emphasis of matter paragraph to draw user attention to some matter only when certain things are present. If you want to use emphasis of matter paragraph, and in that emphasis of matter paragraph, if you want to refer to some matter, that you can do it only when the auditor would not be required to modify the opinion as a result of that matter. Let us say management prepared financial statements. Let us take this contingent liability only. They have shown it as a contingent liability, but they have given wrong disclosure. But they have given what? Wrong disclosure. Since that contingent liability contains a wrong disclosure, I should give a modified opinion. Can I simply highlight it in the emphasis of matter paragraph? No. I can highlight only those matters in the emphasis of matter paragraph which are already presented or disclosed, and they do not contain material misstatement, which requires me to modify the opinion. So highlight only those matters regarding which you are not required to give a modified opinion. And also those matter which has not already been communicated as a key audit matter. If some matter is already determined as a key audit matter, don't explain it once again in the emphasis of matter paragraph. Next, sir, how I have to present it? If I have decided to make use of emphasis of matter paragraph, how I have to present it? Number one, start it in a separate section of the auditor's report. Don't mix it with the opinion paragraph, basis of our opinion paragraph and all. Try to start it in a not try to start. You have to start. You have to allocate one dedicated paragraph, emphasis of matter. There you can highlight it and include the paragraph in a clear reference the matter being emphasized. You have to give a reference. We draw your attention to so and so note number. You have to give a reference where the user can go and get that information. So include in the paragraph a clear reference to the matter being emphasized and to where relevant disclosures that fully describe the matter can be found. Where you can go and find this matter in a detailed manner in the financial statements, refer to that note number. And also indicate that auditor's opinion is not modified. Very, very important. As I have told you, auditor with a very good intention, he will highlight it. But some people might misunderstand it. So even if you try to highlight it also, they will think that you are saying something wrong about it. So that's why clearly mention that we are not modifying our opinion. We are just bringing it to your attention. Next one. Then similarly, key audit matter paragraph is not a substitute for three things I have told you. No? Even emphasis of matter paragraph is also not a substitute for the same three things. What are the three things? It is not a substitute for disclosure required in the financial statements to be given by the management. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph. So this is what regarding other matter. This is what regarding emphasis of matter. Whereas, what is other matter paragraph? If emphasis of matter paragraph is used to refer to the matter which is already presented or disclosed in the financial statements, then other matter paragraph will be used to refer to something which is not already presented or disclosed in the financial statements. This is what simply they have to. If the other matter paragraph will be used to refer to some matters which is not presented or disclosed in the financial statements, which will have an impact on understanding. So read this phrase here. Where is it? So here it is. So, other matter paragraph is a paragraph included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statements, but that in the auditor's judgment is relevant for understanding of audit or for understanding auditor's responsibilities or for understanding auditor's report. If the auditor feels that there is some matter other than those presented or disclosed in the financial statements which will be relevant. That means if I give this information, that will help in better understanding of the audit. That will help the readers in better understanding of the auditor's responsibilities. That matters, you can highlight it in the other matter paragraph. But mainly speaking, other matter paragraph will be used for explaining responsibility related matters. Other matter paragraph will be mainly used for explaining responsibility related matters. Like there was a separate branch auditor, or last year audit was not done by you. You are an auditor of consolidated financial statements, but you did not do the audit of you did not do the audit of subsidiary companies. So these kind of responsibility related matters you can explain generally in the other matter paragraph. And finally, they say that in case if you want to make use of other matter paragraph, you can use that other matter paragraph only if there is no prohibition from law or regulation. So if you want to use other matter paragraph, there should not be any restriction from law or regulation, or even the matter has not already been determined to be a key audit matter. Why? Because if the matter is already determined to be a key audit matter, you should not explain it once again, either in the emphasis or in the other matter paragraph. And even there should be a separate section like emphasis of matter paragraph. Don't mix it with other paragraphs. Try to include it in a separate section of your auditor's report. And then if you want to make use of other matter paragraph or emphasis of matter paragraph, these matters are also required to be communicated with those charged with guidance. So whether if you want to give modified opinion, or you want to include a key audit matter paragraph, or you want to include emphasis or other matter paragraph, for all of this you are required to communicate with those charged with guidance. Next one. So thereafter, we'll come to the next part. 600 to 299, we'll come back to that later and all. So we'll try to understand the reporting requirements under the Companies Act. Under the Companies Act, what and all reporting requirements we have. So under Companies Act, we have reporting requirements under Section 143 mainly. So there also four matters are there, four subsections are there: 143 subsection 1, 143 subsection 3, 143 subsection 11, and 143 subsection 12. So one by one we'll try to cover. So first we'll start with reporting requirements under 143 subsection 1. There are 6 matters which are required to be reported here. How many? 6 matters. Come on, we will repeat. Number 1, you need to comment whether the loans and advances which are made by the company. Made by the company means given by the company. So loans and advances made by the company on the basis of the security are properly secured, and whether they are the terms on which they have been made, they are not prejudicial, they are not harmful to the interest of the company. So basically, you are required to comment on the loans and advances given by the company. Are they properly secured, and whether the terms and conditions on which they are made, they are not harmful, they are not prejudicial. Second one, the transactions represented merely by book entries are they prejudicial? Those are transactions which are merely book entries. What are the transactions which are merely book entries? Examples: depreciation, provisions, provision for bad and doubtful debts. These are just book entries. Actual substance will not be there. So those are transactions which are represented merely by book entries. They should not be prejudicial. They should not be harmful. That means they should not be over provisioning, under provisioning. Nothing of that sort should have happened. Number three, in case if the company is having the investments in the form of shares, have they sold the shares at a price less than the purchase price? Simply, if I have to put it, did the company sell the shares at a loss? Have they sold the shares at a price less than the purchase price? If yes, you have to comment it here. However, this point is not applicable for a investment company and a banking company. For investment company and banking company, even though they are selling the shares at less than their purchase price, you are not required to report it. Why? Because it is an ordinary course of business. Fourth point, whether loans and advances have been shown as deposits. Whether your client company has shown loans and advances in the form of deposits. Fifth point, whether the personal expenses have been charged to revenue. Whose personal expenses? Company will not have any personal expenses. Company will not go for a vacation. Company will not have a family and all. So when they say personal expenses of management, employees, whatever it is, whether the personal expenses of the company, that is, whether the personal expenses of the employees or the staff, they have been shown as a business expenses, that you have to comment. Then last one, whether the company has allotted the shares for cash. In case if it was stated that the company has allotted the shares for cash, whether cash has actually been collected or not. If cash is not collected, the position stated in the financial statement should be not misleading. That means correct financial position should be stated in the financial statements. In case if the cash is not collected, like calls in arrears, etc., you have to show a proper accounting treatment. That's simple 6 points under 140 subsection 1. First point is regarding loans and advances made by the company. Second point is regarding merely book entries. Third point is regarding sale of shares at less than purchase price. Fourth one, loans and advances shown as deposits. Fifth one, personal expenses charged into revenue. Sixth one, shares issued for cash. If yes, cash is received, and if not received, position should be not misleading. And these matters under 140 subsection 1 are required to be reported only when there is a negative comment. Only when there is an adverse remark. If there is a positive comment, you are not required to report on the requirements under 143 subsection 1. Clear? Then we have reporting requirements under 143 subsection 3. There are various matters which are required to be reported under 143 subsection 3. 9 plus 6, 15 matters we have. How many? 15 matters. 9 plus 6, 15 matters we have. Sir, what are all them? See, clause A to clause I, not that important. Clause J is very important. Under clause J, we have 6 extra matters, but we'll try to cover one by one. Don't worry, they will not ask a question to write about all the reporting requirements under 143 subsection 3, but they might ask you to write the reporting requirements exclusively under 143 subsection 3 clause J. 143 subsection 3 clause J, there are 6 extra points we have, that alone they can ask. But they will not ask you to write all the reporting requirements under 143 subsection 3 clause I. They will not ask. Clause 143 subsection 3 they will not ask. But anyhow, we'll try to quickly revise. Number 1. First point required to be reported under 143 subsection 3. Whether the auditor, so as an auditor, did you have you sought and obtained all the information and explanation necessary for the purpose of your audit? Did you get all the information necessary? Next one. Whether in your opinion, proper books of accounts have been maintained or not. Whether your client company has maintained proper books of accounts or not, and whether from the branches returns you have received or not. Third one. In case if the branch accounts are audited by a different branch auditor, did that branch auditor send you his report to you, and how you have dealt with that branch audit report while forming an opinion on the entire company. Number 4, whether the company's balance sheet and P&L are matching with the books of accounts. The balance sheet, P&L, whether they are in agreement with the books of accounts or not. Clause E, whether the financial statements are complying with accounting standards. Clause F, the observations or comments of the auditors on the financial transactions that have any adverse effect on the functioning of the company. Like company has taken a loan at a very high interest rate, or the company has got some funding at unfavorable terms. So whether the company has entered into any financial transaction that is having an adverse effect on the functioning of the company, that you have to comment. Then clause G, whether any of the director is disqualified under 164 subsection 2. So when the director will get disqualified, If the company did not file annual return or financial statements for 3 consecutive years, then all the directors of that company will be disqualified for a period of 5 years. So we have to even commit whether any director of our company is disqualified. That means you should not just check whether your client company has filed the annual return or financial statements with ROC. You should check all other companies in which your directors are acting as board of directors, whether all of them have filed their annual returns or financial statements for 3 consecutive years or not. You have to check it. So whatever it is, clause G, whether any of the director is disqualified. Clause H, if you have any qualification adverse remark relating to the maintenance of the books of accounts, comment on it. And then finally, clause I. Clause I is important. You have to comment on internal financial controls. Shortcut 140 subsection 3 clause I for internal financial controls. Remember it. So internal financial controls. So whether your client is having a proper system of internal financial controls, they have implemented the internal financial controls, and whether they are operating effectively or not. Two things: whether controls are implemented, in case if they are implemented, whether they are operating effectively or not. However, these internal financial controls will not become applicable for some companies. Some private companies are not required to implement internal financial controls only. Sir, for which companies internal financial controls are exempted? So it should not be applicable to a private company, which is a one-person company, or just 1 minute here. So it is a one-person company, small company, or a company having an aggregate turnover less than 50 crores as per latest audited financial statements, and having an aggregate borrowings from banks and financial institutions or any body corporate at any point of time less than 25 crores. So one-person company, small company, or a private company having a turnover less than 50 crores and also borrowings less than 25 crores. For these private companies, IFC itself is not applicable. Internal financial controls is not applicable. If you are conducting audit of such company where IFC is exempted, you are not required to comment on this point. You can simply say that the client is not required to implement internal financial controls. Next, clause J. Initially, only 9 clauses we used to have. A to I we have. J used to be a residuary clause. What do you mean by residuary clause? In future, if the government want to add extra reporting requirements, they could add it under clause J. But over a period of time, the following reporting requirements are added under clause J. Some extra matters are required to be reported under 143 subsection 3 clause J. So in total, we have some 6 extra points which are added. How many? 6 we have. This question they can ask here. So they can ask a question, what are the matters which are required to be reported under 140 subsection 3 clause J, or alternatively they can ask what are the matters which are required to be reported under rule 11 of the company's audit and accounts rules 2014. In both the cases, we'll report this, we'll write the 6 points. Let us try to understand one by one. First one, whether the company has a disclosed the impact of pending litigations, if any, on their financial position in the financial statements. So what they're asking the auditor to do? They're asking the auditor to disclose the impact of pending litigations in the auditor's report? No, no. They're asking the auditor to check whether management made a disclosure of pending litigations in their financial statements or not. They're not asking auditor to give any disclosure in the auditor's report. They're asking auditor to check whether management has disclosed the impact of pending litigations in their financial statements or not. See, if there is a pending litigation, two outcomes here. Either show it as a contingent liability or show it as a provision. If the liability is certain, show it as a provision. If the liability is uncertain, show it as a contingent liability. Somehow it should be shown. So whether the company has shown that, has properly disclosed that litigation in their financial statements or not, that we have to comment on it. Next, second one, whether the company has made provision for material foreseeable losses, including the long-term derivative contracts. We have a concept of conservatism or prudence now. What is that conservatism or prudence says? Recognize anticipated losses, don't recognize anticipated gains. That is the logic behind this point. If the company has a long-term contract, let us say the contract is going to run for 5 years, 10 years. But in the year one only, you got to know that you are going to make a loss on that contract. Should you wait till the completion of that 5 years to recognize the loss, or you have to recognize immediately? You have to recognize it immediately. Same thing will happen for long-term derivative contracts also. Sometimes companies will enter into long-term futures and options. On that, if they're going to make a loss, they should have created a provision now only. So whether they have created a provision for material foreseeable losses on the long-term contracts, including derivative contracts or not, that also have to give a comment. Third point, whether there has been any delay in transferring the funds which are required to be transferred to IAPF, Investor Education Protection Fund. Is the company required to transfer some funds to IAPF? You have to check. If yes, for transferring the amounts to IAPF also, there will be due dates. Whether that money has been transferred to IAPF within the due dates or beyond the due dates. That also you have to check it and comment it. D point, I will come to that later. Let us complete the last two. E and F. So E point, whether dividend declared or paid during the year is in compliance with the provisions of Section 123 of the Companies Act. In case if the company has declared dividend, they cannot declare the dividend in whatever manner they want. There are competitions, especially if the price, if the dividend is declared out of reserves. There are specific calculations. So we need to check if the company has declared a dividend, whether it has done it in compliance with the provisions of Section 123 of the Companies Act. And then finally, last point, whether your client company is using such an accounting software which is having a feature of recording audit trail facility, and whether that audit trail facility has been operated throughout the year and it should not have been tampered with and it should be preserved. Three things: whether your client is maintaining accounting software which is having a feature of recording audit trail, and also I have to comment that that audit trail feature has not been tampered with and it has been preserved by the company and it has been operating throughout the year. See, 3 points: it should be operated throughout the year, and that audit trail facility should not be tampered with, and also it should be preserved by the company as per the statutory timelines. Clear? So under clause J, 5 points only I have covered. Total six are there. What are the 5 points? Whether the company discloses the impact of pending litigation, and second one, whether the material foreseeable losses provision has been created or not. Third one, what is the third one? Whether there has been any delay in transferring the funds required to be transferred to IEPF, and whether dividend declared is in compliance with provisions of section 123, and whether the accounting software is having an audit trail facility. Now the most important point comes clause D. It will come clause D. So these are some additional points. Let me try to explain it in a simple manner. Listen carefully. Listen carefully. So clause D says that you should ask, as an auditor, you should ask representation, the confirmation from the management regarding two things. Regarding two matters, your client company did not engage in two kinds of transactions. Ask a confirmation from the management. So first kind of transaction which your client company should not have engaged is, let us say there is a company A Limited, which is your client company. Okay, A Limited has given some loan advance or they have invested in another company. Let us say B Limited, whom we call them as intermediary. Whom we call them as intermediary. Listen carefully. Stop everything, whatever you are doing, and just focus what I'm trying to say. Don't even write. Also listen carefully. So there is your client company. You are conducting audit of the client A Limited. So you should make sure that your client is not doing some kind of transactions. What kind of transactions? That too without disclosing in the notes to accounts. Without disclosing in the notes to accounts, your client should not do some transactions. What kind of transaction? Your client should not have given any loan or advance or invested in the shares of any other entity with an understanding. There is an understanding between your company and that another company to whom you have given the funds. There is an understanding. And this understanding could be either in written format or it could be just a oral understanding. And what is that understanding is, this intermediary should either go and give that funds as either loan and advance to some another company, which we call it as ultimate beneficiary. Which we call it as ultimate beneficiary because they are the entity who is getting ultimately benefited. So what is that understanding between A Limited, B Limited? That B Limited should go and either give a loan or advance to the ultimate beneficiary who will be identified by your client company. Or at least, if not giving direct loan or advance, at least they should give a guarantee on behalf of the ultimate beneficiary. They did not engage in this kind of transaction without disclosing it in the notes to accounts. Ask the management to give a written confirmation. Why? Because what is the whole thing happening here? A Limited wants to do some favor to C Limited. Either they are prohibited from doing it, or if they have done it, they are answerable to so many people. To avoid that, what they are doing, they are creating one intermediary where they are giving the funds, loans, advances, or investments to another entity. When you are entering into an understanding where this intermediary should go and do that favor ultimately to the ultimate beneficiary, either giving in the form of loan or advance or giving a guarantee on behalf of that ultimate beneficiary. So your client company should not have engaged in this kind of transaction. Ask the management to give a written confirmation. Now read that D first point. You slowly understand it. I will show it here. Read that first point. Done? Understood? Able to link it? So with the example, are you able to understand the text there? Right. So this is one confirmation you have to get from the management. Not just that, one more confirmation you have to get. What is that one more confirmation? So let us say, for example, you are having a client company, X Limited. This is your client company. There, without disclosing in the notes to accounts, your client company should not do transactions. What are they? Let us say, for example, there is a company Y Limited, whom we call them as funding party. Whom we call them as funding party. So your client company should not have received funds either in the form of loans, advance, or investment, whatever it is, and you both are having an understanding. Who the funding party, whoever has given the money to your client company and your client company, you both are having understanding. What is that understanding? Whatever money that your client has received, they have to either go and give it as a loan or advance to ultimate beneficiary. Let us say some Z Limited, who is ultimately getting benefited. So to them, they have to go either go and give a loan or advance or provide a guarantee on their behalf. Even they should not engage in this transaction also. So what is the difference between first and second case? Simply, if I have to put it, in the first case, your client created an intermediary to do some favor to ultimate beneficiary. In the second case, your client is acting as an intermediary where funding party wants to do some favor to the ultimate beneficiary. Both are wrong, no? You should not get engaged in this kind of transactions. So ask the management to give a written representation regarding this. Ask the management to give a written representation regarding this only, written confirmation that without disclosing it in the notes to accounts, these kind of transactions you have not entered. Ask the management to give a written confirmation. Understood? That will be your second point. Now, if you ask the management to give a written confirmation, they will give, but you should not blindly believe no. By performing some procedures as you feel it as appropriate, have anything come to your notice which makes you believe that these confirmations are misleading? Three things you have to comment. First, have you got this first confirmation or not? Have you got the second confirmation or not? Third one, depending on some procedures, whatever you have performed, has anything come to your notice which makes you believe that these confirmations are misleading? That means management might have given a wrong confirmation. That means even after engaging in this kind of transactions, also they're saying it as no. Has anything come to your notice like that? That three things you are required to comment. Understood? So this alone, each point I can explain for 15-20 minutes, but we can't afford that much amount of time. So simply I have given you the context. What exactly are those matters telling you about? Understood? So these are the reporting requirements under 143 subsection 3 clause J. And with this we have completed 143 subsection 3 altogether. Fine. So now let us try to proceed further. We will try to understand now 143 subsection 12 reporting requirements. What we'll try to do? We'll try to understand the reporting requirements under 143 subsection 12. Fraud reporting we'll try to understand. Right. So fraud reporting quickly we'll try to understand. So what are the reporting requirements regarding fraud under 143 subsection 12? See, in case if you have come across a fraud, you anyhow will consider its impact and consider its opinion or consider its impact on the opinion. But in addition to that, there are some special reporting requirements in case if you are conducting audit of a company and if you got to know about a fraud, if you have a reason to believe that the fraud has taken place, you will be required to communicate. You will be required to fulfill some reporting requirements. And what reporting requirements will become applicable? That depends on what is the amount involved in the fraud. The reporting requirements under 143 subsection 12, to whom you have to report, what you have to report and all. So that those are indirectly linked with the amount involved in the fraud. So if the amount involved in the fraud is 1 crore or more, there are different reporting requirements. If the amount involved in the fraud is less than 1 crore, then there are different reporting requirements. So let us try to understand what are the reporting requirements in each case. First case, sir, what if the amount involved in the fraud is 1 crore or more? Then what will happen is central government reporting will become applicable. What will become applicable? Central government reporting will become applicable. You have to report the central government. Sir, what is the manner of reporting? First thing, the moment you got to know about the fraud, the moment you have got to know about the fraud, first you have to report the matter to audit committee if it is there. If audit committee is not there, then to the board of directors. Many people mistook this also. They read it as you have to report the matter to either audit committee or board of directors. No, it's not a choice given. If audit committee is there, to the audit committee. If audit committee is not there, then to the board of directors. So whatever it is, within 2 days, today I got to know. By tomorrow and day after tomorrow, you have to report the matter to audit committee if it is there. If audit committee is not there, to the board of directors. Within 2 days of the knowledge of the fraud, you are required to report it. And you have to give them 45 days of time. How many days of time? 45 days of time. For what purpose? For getting their replies. You communicated the fraud. Give them 45 days of time for reply. And within 45 days, two things can happen. You received a reply or you don't receive a reply. If you received a reply, then what you should do? Within 15 days of receiving the reply, then how many days? Within 15 days of receiving the reply, you are required to report the matter to the central bank. Sir, what and all you will report? You will report the report which you have sent it to audit committee or board of directors. What reply you have received? On that reply, what are your remarks? All these three put together, you have to report it to central government. And this reporting should happen in a form ADT4. And this reporting should be done on the letterhead of the auditor. And it should contain all the details like name of the auditor, address, postal address, fax number, email address, everything. It should be contained on the letterhead. Even it should contain a signature and common seal of the auditor also. Understood? And it has to be sent to Secretary, Ministry of Corporate Affairs. It is an online filing actually. When you file the ADT4, it will go through there only automatically. Understood? So what is the reporting requirement? First, you have to communicate with the audit committee if it is available. If not, board of directors within 2 days. Give them 45 days of time. If reply is received within 45 days, within 15 days of receiving reply, you have to report the matter to the central government in form number 884, where you are required to submit the report which you have sent to audit committee or board of directors. What replies you have got on that reply? What are your remarks? All these three you are required to send it. Then, in case if reply is not received, you communicated with audit committee or board of directors, you gave them 45 days of time, but even within 45 days also you need to receive any reply. Then what will happen? Then also you have to report the matter to the central government. Then also you have to report to the central government. But the rules are silent on the time limit. They did not say any specific time limit, but you can derive the implied time limit from other case. So if reply is received, they are giving maximum 45 days for reply, 15 days for you sending. That means from the date of communication with audit committee or board of directors, maximum you are getting 60 days. So within expiry of that 60 days from the date of communication with audit committee or board of directors, you have to communicate the matter here also to the central government. Here also form number 884. But only one thing is you are required to send only the report which you have sent to audit committee or board of directors along with the fact that no reply has been received. Along with the fact that no reply has been received. So this will be your reporting requirements in case if the amount involved in the fraud is 1 crore or more. So what if the amount involved in the fraud is less than a crore? What if the amount involved in the fraud is less than a crore? Then central government reporting will not become applicable. Simply, you will report the matter to audit committee if it exists. If audit committee is not there, then to the board of directors within 2 days here also. What and all you will communicate? 3 things. Nature of the fraud along with the description. Then, what is the approximate amount involved in the fraud? Who are the parties involved? Who are the parties involved? And with this, your responsibility will come to an end. You are not required to report to anybody else. But all these kinds of frauds which are not reported to central government, these frauds are required to be reported by the board of directors in their board's report. Board of directors will give something called board's report. Those frauds which are not communicated to central government, basically those frauds which are less than a crore, they are required to be included in the board's report. So what board has to disclose in the board's report? Nature of the fraud along with the description, approximate amount involved, parties involved, and remedial actions taken. Parties involved will be indicated only when no remedial actions are taken. If remedial actions are taken, parties involved need not be commented. So if remedial actions are not taken, then parties involved also should be included. So this should be given in which report? Board report, which is not auditor's responsibility, which is actually board of directors' responsibility. Your responsibility will come to end the moment you communicate with audit committee or board of directors. Thereafter, board of directors' responsibility will start, where they will give board's report. In that board's report, they have to give all this disclosures. Understood? So this is what the reporting requirements under 143 subsection 12. Now we will come to the reporting requirements under 143 subsection 11. So the other name for that is what? CARO. So CARO 2020. There are total 21 matters which are required to be reported. Let us try to get familiar with that CARO reporting requirements. So first of all, before we talk about that 21 matters which are required to be reported, we'll first try to become clear about its applicability. Is CARO reporting applicable for each and every auditor of a company? The answer is yes, subject to some exceptions. Subject to some exceptions. Sir, what are that exceptions? CARO will not be applicable for whom? First one, banking company. If you are a banking company, CARO will not become applicable for you. The logic being, the bank auditors are already overloaded with a number of reporting requirements from the RBI and all. So they don't want to add additional burden. So for banking companies, CARO will not become applicable. What about NBFCs? Applicable. For NBFCs, it is applicable. Only for banking companies, it is not applicable. Then it is also not applicable for a insurance company, and it is also not applicable for a Section 8 company, and also it is not applicable for one person company, and also a small company. For one person company, small company also, this will not become applicable. And these are specified companies. Apart from that, a private limited company. A private limited company, if it fulfills four conditions, all four cumulatively. If a private limited company fulfills all four conditions, then what will happen? CARO will be exempted. CARO is not required to be reported. So when CARO matters are not required to be reported, who will be happy? Both auditor and client will be happy. Auditor's responsibilities will get reduced. When auditor's responsibility are reduced, he will not go and irritate the client also. So both will be happy. So that's why if a private limited company, when it fulfills all four conditions cumulatively, then CARO will not become applicable. Sir, who are that lucky fellows? Number one, not being a holding or subsidiary of a public company. If you are a private limited company, neither your holding company nor your subsidiary company should be a public company. If you are either your holding or subsidiary company is a public company, gone. CARO will become applicable for you. Next, second condition. Paid up capital along with reserves and surpluses. What is it? Paid up capital along with reserves and surpluses shall not exceed how much? 1 crore as on the balance sheet date. As on the balance sheet date. So what they are saying, paid up capital along with reserves and surpluses shall not exceed 1 crore as on the balance sheet date. So when I say paid up capital, consider only paid up capital, not subscribed, authorized and all. Paid up capital you have to consider. Every kind of capital you consider, equity share capital, paid up share capital you have to consider. If there are any calls in arrears and calls in advance, adjustments you have to do it. Then, when it comes to reserves and surpluses, consider every kind of reserve, general reserve, free reserve, all kinds of reserves you have to cover. So, when you are calculating the reserves and surpluses, let us say debit balance in the P&L, we have 15 lakh rupees. Credit balance in the revenue. Let us say we have a general reserve, 30 lakh rupees we have. So, what should be the, let us say paid up capital we have? Paid up capital we have 70. So, what should be the amount of paid up capital in reserves and surpluses here? What should be the amount of paid up capital and reserves and surpluses here? Should it be 100 or should it be 85? 85. The point which I want to make it here is if there is any debit balance in the P&L, that could be adjusted against credit balance of the reserves for the purpose of calculating paid up capital and reserves and surpluses. Comfortable everybody till here? So here it will be net 15 and 70, 85 lakhs. Let me tell you another scenario. Paid up capital we have 120 crore rupees, 120 lakhs, sorry, 120 lakhs. Under reserves and surpluses, I have a debit balance in the P&L 40. I have a general reserve 10. General reserve 10. So now what will be my balance of paid up capital along with reserves and surpluses? Will it be 90 or will it be 120? So the point here is, the point which is creating a confusion here is, sir, if I have a debit balance in the P&L, I can adjust it against credit balance of reserves. But there also excess debit balance in the P&L is there. There also excess debit balance in the P&L is there. Can I go and adjust it against the paid up capital for the purpose of calculation? Yes, you can adjust it. So here the paid up capital and reserves and surpluses balances will be only 90 lakh rupees. But remember, when I say you can adjust, don't go and do the adjustment in the balance sheet. For calculation, we are adjusting. In the balance sheet, they will remain under respective heads only. For the purpose of calculation, we are going to do this adjustment. Clear? So this is what? Paid up capital along with the reserves and surpluses shall not exceed 1 crore on which date? Balance sheet date. Next. So first condition, not being a holding or subsidiary of a public company. Next, second one, paid up capital along with the reserves and surpluses shall not exceed 1 crore as on the balance sheet date. Third condition, outstanding borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. What is the third condition? The outstanding borrowings from the banks and financial institutions shall not exceed 1 crore, not just on the balance sheet date. At any point of time during the financial year, it should not exceed 1 crore. Now, few things we have to consider here. Sir, which kind of borrowings? Not all borrowings, only borrowings from banks and financial institutions. Then, sir, what kind of borrowings you have to consider? Short term, long term, every kind of borrowing you have to consider. Short term, long term, even credit card outstanding balance also you have to consider. And sir, should I consider secured or unsecured? Every kind of borrowing once again. Sir, you are telling borrowings are up to limit of 1 crore. Borrowing should not exceed 1 crore. No. There is one intelligent fellow who got a thought that he is taking loans from 4 banks. From each bank, 50 lakhs loan he has taken. And he is saying that since the borrowings from each bank does not exceed 1 crore rupees, he can enjoy the CARO exemption. Is it applicable? No. That 1 crore limit is applicable for all the banks and financial institutions put together. Cumulatively, the outstanding borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Then, coming to the last point, last condition, the total revenue, including revenue from outstanding operations. Not outstanding. What is it here? Discontinued operations. So, total revenue, including revenue from discontinuing operations, should not exceed 10 crores. As on the balance sheet date or during the financial year? It's a cumulative figure. Neither. Revenue is a cumulative figure. For the entire financial year, we will calculate. So there is nothing like as on the date or for so and so period. So revenue for the entire financial year should not exceed 10 crores during the financial year, including the revenue from discontinued operations. So when all these 4 conditions are fulfilled, then private limited company will be exempted from CARO. Even if one condition gets violated, for that private limited company, CARO will become applicable and you have to report on that 21 clauses. Understood? Few more points. So, in case if there is a company having branches, for a branch separate auditor appointed. To determine CARO applicability, will we check the limits for company as a whole or head office branch offices separately? For the company as a whole, including all the branches, we will check the limits. And if for the company CARO becomes applicable, each and every branch auditor must compulsorily report on CARO. He cannot argue saying that for my branch, within the limits, I will not report on CARO. He can't say. Then, coming to holding companies, they will prepare 2 sets of financial statements: standalone financial statements, consolidated financial statements. To determine CARO applicability, should I calculate the limits as per consolidated financial statements or standalone financial statements? Standalone financial. We'll check the limits for standalone financial statements only. Audit will happen for consolidated financial statements or standalone financial statements. Both audit will happen. And they say that audit report of the standalone financial statements, CARO will become applicable. In the audit report of consolidated financial statements, CARO will not become applicable except the clause number 21. What they have done? For audit report of consolidated financial statements, CARO will not become applicable except one clause. What is that? Except the clause number 21, no other clauses will become applicable for audit of the consolidated financial statements. So this is what regarding applicability. Since we are done with the applicability, now we will go and pick up each matter and we'll try to understand the matters required to be reported. So first matter, clause number 1, which is required to be reported, is regarding property, plant and equipment. So all kinds of property, plant and equipment will come here, including the intangible assets also. So regarding the PPE, 5 things are there which we are required to check. Number 1, whether company is maintaining proper records showing full particulars, including quantitative details of PPE and intangible assets and situation of PPE. So what they are saying, are they asking the auditor to maintain the records? No. They are asking the auditor to check whether the company has maintained proper records for PPE, and from that records one should be able to find out the quantity of fixed assets and intangible assets, and also they should be able to understand situation. What is the situation? Location, where they are located, whether they are located at head office, branch office, they will have one fixed asset register. So whether they are maintaining that PPE register or not, you have to comment. Number 2, whether these fixed assets have been verified by the management at reasonable intervals. Are they asking the auditor to do physical verification? No. They are asking the auditor to check whether management has done the physical verification of fixed assets at reasonable intervals. What is reasonable interval? Once in every 3 years. What is it? For fixed assets, periodical verification, reasonable interval will be once in every 3 years. It is not required for once in every year. Once in every 3 years, if they do the physical verification of their fixed assets, it will be enough. And on doing that physical verification, whether any material discrepancy has been found out, whether any differences has been found out. If yes, whether it has been properly dealt with in the books of accounts. Who has to deal with it in the books of accounts? Management only has to deal with in the books of accounts. Understood? So first point, whether management has maintained proper records. Second point, whether management has done the physical verification at reasonable intervals. If any material discrepancy has been found out, if yes, whether it has been properly dealt with or not. Third one is regarding immobile properties. Whether title of the immobile properties is held in the name of the company. What do you mean by title? Ownership. So when it comes to immobile properties, especially landed buildings, whether title of that immobile properties are held in the name of the company. So how they will be held in the name of the company? How you will get to know? By checking the sale deeds and all. They will be held in the name of the company. So you have to check whether the title of the immobile properties are held in the name of the company. If not, in case if you find there is an immobile property other than leased asset will not be in the name of the company. That you have to remember. Other than leased asset, if any other assets are there which are held in the name of the company, so if not held in the name of the company, then you have to report some details. What details you have to report? Description of the property. Describe that immobile property. What is its gross carrying value, not the net carrying value. In the MCQs they will play. So regarding that property is not held in the name of the company, which of the information need not be included? At one place they will give net carrying value. That will be the correct option. So gross carrying value you have to include it, but not net carrying value. So description of the property, gross carrying value held in whose name? If not in the name of the company, in whose name it is held? Is he a promoter or director? In whose name you are holding that property? How long that property has been held by the company? Why it has not yet been transferred in the name of the company? Reasons why it has not been transferred in the name of the company. These 6 details are required to be reported in respect of those immobile properties which are not held in the name of the company. Next, so 3 points we have covered. Next point, revaluation. So whether your client company has done the revaluation of their fixed assets, including intangible assets. When I say revaluation, revaluation could increase the value also or decrease the value also. So whether your client has done revaluation of the assets. If yes, you need to check whether that revaluation has been done on the basis of valuation certificate given by a registered value. Not whatever value comes to their mind, they have to do the revaluation. That revaluation should be done on the basis of valuation done by a registered valuer. And also specify the amount of change due to revaluation. What is the amount of the change you are required to report? But that amount you are required to report only when the change is 10% or more in the aggregate of the net carrying value of each class of PPE or the intangible assets. Before and after revaluation, the difference will be there. No, if that difference is more than 10% of the net carrying value of each class of PPE, then only you are required to report the amount. So let me give you one scenario here. There is a buildings class of plant and buildings class is there. 3 buildings are there. Building 1, building 2, building 3. Before revaluation, the values are 100, 50, 100. After revaluation, the value is something like 85, 48, and 106. So not 106, 116. So the amount change in each asset is, here it is 50 net, positive plus or minus you ignore. Here the net change is 2. Here the net change is 60. So tell me, for which assets I am required to report the amount? For which asset I am required to report the amount? Wherever change is 10% or more. So I am required to report the change for building 1 and building 3. No, they are asking you to check the change before and after revaluation for the entire class of PP. For the entire building category before revaluation, the amount is 250. For the entire building category after revaluation, what is the amount here? How much? 240, 249. So somehow I worked it out, but it will not come. So what you have to do is before revaluation, after revaluation, you have to check the value for the entire class of PPE. So for the entire class of PPE before revaluation, after revaluation, the change is less than 10%. You are not required to report the amount here. Okay, not individual asset. For class of property, you have to check what is the percentage of change. Understood this point? Then finally, last point, Binami transaction. Whether any proceedings have been initiated or pending against the company for holding any Binami property under the Binami Transactions Prohibition Act and rules made thereunder. If so, whether the company has disclosed it or. So you need to check whether the company, any new case has been filed or the case is undergoing for holding Binami properties under Binami Transactions Prohibition Act. If yes, the company has disclosed that pending cases in their financial statements or not, that's what you need to check and give a comment here. That's all. These are the 5 matters which are required to be reported regarding PPE. Comfortable? Shall I go to the next clause? Right. Next clause is talking about inventory. Sir, what points I am required to check regarding inventory? Number 1, physical verification. Are they asking the auditor to do physical verification? No. They are asking the auditor to check whether management has done the physical verification of their inventory at reasonable intervals. What is reasonable interval? Once in every year. For PPE, once in 3 years. For this thing, for inventory, it is going to be every year. So whether management has done the physical verification of inventory at reasonable intervals, and whether the coverage and procedure of such verification by the management is appropriate. Whatever coverage of physical verification they have done, whatever procedure they have followed for verification, is it appropriate? You have to comment on the physical verification procedure of the management. Did they do that physical verification properly or not? And also, on doing that physical verification, whether any discrepancy has been found out. Discrepancy means discrepancy between what here? Stock as per books, stock as per physical verification. If there is a discrepancy, and if the discrepancy is a 10% or more for each class of inventory, you have to mention the amount and whether they have been properly dealt with in the books of accounts or not. Okay, when the discrepancy is 10% or more. So here also you should not check the discrepancy for each individual inventory, for entire class, for entire raw material, for entire work in progress, for entire finished goods, for entire stores and spares. In raw material, 5 raw materials could be there. Discrepancy you should not check for each raw material item. For the entire raw material clause, what is the discrepancy you have to check? If it is 10% or more, then you are required to report the amount and whether it has been dealt with properly or not. Then one more point regarding the inventory. In case if your client company has taken a working capital loan, has been sanctioned a working capital loan in excess of 5 crores at any point of time during the financial year. Your client has taken a working capital loan, giving the security as current assets. For working capital loan, you have to give the loan security, no? Generally current assets, stock. So whether in case if your client company has been sanctioned a working capital loan in excess of 5 crores against the security of current assets, in that case, you will be required to submit the periodical stock statements. Generally, your client will submit the quarterly stock statements. You need to check whether that quarterly stock statements are matching with books of accounts or not. That means, are they submitting genuine stock statements or they are submitting the fake stock statements? You have to verify and give a comment. Understood? But this point will become applicable only when your client has been sanctioned a working capital limit, that too in excess of 5 crores, that too against the security of current assets. Your client has taken working capital loan but less than 5 crores, not applicable. Your client has taken an unsecured working capital loan, not applicable. Your client should have taken a working capital loan secured against current assets, that too in excess of 5 crores at any point of time during the financial year. Then you are required to comment on the quarterly stock statement submitted by the company. Clear? Next. So this is the two clauses. Two clauses we have done. PPE clause we have done and inventory clause we have done. Coming to the third clause. Loans, investments, guarantee, security or advances given by the company. So once again, loans given by the company only. Regarding the loans, advances, investments given by the company, there are 6 matters which are required to be reported. Number 1, you need to check whether the company has provided loans or provided advances or provided any guarantee during the year. If yes, bifurcate what is the amount of loan given and balance outstanding for subsidiary associate joint venture for other than subsidiary associate joint venture. Very simple. You need to check whether your client company has given any loans, advances, or provided any security to any parties. Let us say my client company has given loans, advances, or guarantees to 10 people, 10 companies. Out of them, 2 subsidiaries, 1 associate, 1 joint venture is there. Remaining are not subsidiary associate joint venture. Now, what you should do is you have to bifurcate. What is the amount outstanding from subsidiary associate joint venture and from others? And what is the amount of loan given and what is the balance outstanding as on 31st of March for subsidiary associate joint venture for other than subsidiary associate joint venture? Just to bifurcate the amount and show it. First point. Second one, the terms and conditions in which that loans are given, are they not prejudicial to the interest of the company? Repeated point. This we have seen in 143 subsection 1 also. So once again they are saying whatever terms and conditions under which such loans are given by your client company to others, are they prejudicial? Are they harmful to the interest of the company? Like giving interest-free loan, giving unsecured loan and all, these are all harmful. These are all prejudicial. So you need to comment on the terms and conditions under which such loans are given. Are they prejudicial to the interest of the company? Next, repayment. It will not be enough just if the company has given a loan, whether the repayment schedule has been prepared and whether the whether this principal and interest has been received regularly on or before the due dates they are receiving it or not. So two things, repayment schedule should have been prepared and they should have collected the principal and interest regularly on or before the due dates. Next, if any amount is overdue for more than 90 days, If any amount is overdue for more than 90 days, what reasonable steps have been taken by the management, not the company, not the auditor? What reasonable steps have been taken by the company for recovering that amount that you are required to comment? Next one, rescheduling or extension of overdue loans. So the company in the past, they have given the loan. That loan has fallen due in the current year. Fallen due means what? Due date is coming in the current year. When the due date has come in the current year, what company should do? They should recover it. But the company, instead of recovering the money, they are extending the due date or they are granting the fresh loan to the same person. So if such kind of things are happening, when the loan which has been given in the past fallen due in the current year, but instead of recovering it, they are either renewing it, renewing extension both convey the same meaning, or they are giving the fresh loan to the same person. If yes, you are required to report what is the total amount of such dues which are either renewed, extended, or fresh loan given to the same party, and also calculate the percentage with the total loans and advances. Let us say during the year, total 100 crores worth of loans are given. In that, some 20 crores are in the form of renewal, extension, or fresh loans given to same person. So this 20 crore rupees amount also you have to indicate that percentage of 20% also you have to indicate. Understood? Last one, last point under clause 3, whether your client has given any demand loans or without mentioning any repayment period. Your client has given any loans without mentioning any repayment period. If that is the case, you have to comment what is the total amount of such loans given, demand loans, and what is the percentage with the total loans, and how much of the demand loans are given to promoters and related parties. All these points you are required to report it. Understood? Clear and comfortable, everybody? Right. However, out of all these points, the first point and fifth point is not applicable for companies whose principal business is to give the loans. What is it? The first point and fifth point, loans and advances, that bifurcation and that renewal, extension, or loans given to same person, those 2 points are not required to be reported if the company's business is primarily into giving loans. Sir, who will be primarily into business of giving loans? For banks, CARO itself is exempted. NBFCs we have no. So for NBFCs, CARO will become applicable. But within the CARO, under this clause 3, first and fifth point will not become applicable. They are not required to comment on that first and fifth. Then we have fourth clause. Fourth clause is also talking about loans, investments, guarantees only. Very simple. In case if the company has given any loan, for especially public companies and all, they cannot give the loans in whatever manner they want. There are some conditions and restrictions given under section 185 and 186 of the Companies Act. So I need to check whether the company has given any loan, guarantee, investment, etc. by complying with the provisions of section 185 and 186, or have they violated any of the provisions of 185 and 186. I have to check and give a comment. This is the fourth clause. Fifth clause, whether your client company has accepted the deposits from the public. If yes, you need to check the compliance with the provisions of section 73 to 76 of the Companies Act. If any order of the court or if any directives are issued by the RBI, whether they have been complied with or not. If any order of the court or CLB or tribunal is there, whether that compliance with that court order has also been done or not. If you find any of the non-compliances, either provisions of the Companies Act or the RBI directives or the order of court or tribunal, what kind of non-compliance happened, that you are required to report. Next, we have cost records, clause 6, whether your client company is required to maintain cost records as per section 148 of the Companies Act. If yes, whether they have maintained the cost records. Then clause 7, important clause, statutory dues. Statutory dues. Sir, what do you mean by statutory dues? Those amounts which you are required to pay because of requirement of law. Examples: income tax, GST, PF, gratuity, bonus, all these are examples of the statutory dues. So regarding the statutory dues also, you have some reporting requirements. And for the reporting requirements, we are dividing the statutory dues into two categories. Number one, undisputed, disputed. What is undisputed? Those statutory dues which you agree to it, no litigation, nothing is going on. Okay, so that we call it as undisputed statutory dues. So regarding the undisputed statutory dues, two things you are required to comment: whether the company is regular in depositing all the undisputed statutory dues or not. That means on or before the due dates, are they depositing all the undisputed statutory dues? If not, the extent of the outstanding amount, which is outstanding for a period of more than 6 months, as on the balance sheet date. As on the balance sheet date, if any undisputed statutory dues is outstanding for a period of more than 6 months, that amount you are required to report. So as on the balance sheet date, if it is not outstanding for more than 6 months, it is outstanding. But if it is not outstanding for more than 6 months, you are not required to report. It must be outstanding for a period of more than 6 months as on the balance sheet date. That only you are required to report. Then disputed statutory dues. So regarding the disputed statutory dues, what are the reporting requirements? What is the amount involved in the dispute and the forum where the dispute is pending. The court, tribunal or commissioner where the dispute is pending, that forum also you are required to indicate. So two things here, specify the aggregate amount, specify the amount involved in the dispute and forum where the dispute is pending. Next, clause 8, disclosure of undisclosed income. Sir, what is it? Whether during the year, whether any income tax assessment happened. Income tax assessment could be in the form of scrutiny, raid, whatever it is. As a part of income tax assessment, whether your client has offered, whether your client has surrendered any undisclosed income. Income tax assessment is happening, your client has hidden some income, now he is disclosing it. Just disclosing it before tax authorities alone will not be enough. If you have not disclosed it to tax authorities, that would not have been recorded in the books of accounts also. Now, as a part of income tax assessment, if you found that your client has disclosed some undisclosed income to the tax authorities, whether the same has also been brought in the books of accounts or not, I have to check and give a comment. Clear? So that is what clause 8 is about, whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in the tax assessment. The same previously unrecorded income has been recorded in the books of accounts or not. Now coming to the clause 9, repayment of the loans. So till now you spoke about many matters which are required to be reported regarding loans given by the company. But what about the loans which are accepted by the company? What about the loans which are accepted by the company? So regarding the loans accepted by the company also, do you have any reporting requirements? Yes, we have some reporting requirements regarding the loans accepted by the company also. So what are they? Number one, whether your client company has made any default in either repayment of principal or payment of interest. So what do you mean by making a default? Not paying. It could be not paying or even paying beyond the due date also. If you pay beyond the due date also, it is also a default. So whether your client company has made any default in repayment of principal or payment of interest. If yes, you have to report amount of default and period of default, that to lender wise. For each lender, how much amount has been defaulted, for each lender, for how much period default has occurred. So that you are required to report. Next, willful defaulter. Whether your client company has been classified as a willful defaulter by any institution. So there is a RBI circular actually. In that they will tell which people are required to be classified as willful defaulter. You need to check whether your client company has been declared as willful defaulter by any financial institution. Then purpose of term loan. If your client company has got a term loan, they will tell some convincing purpose to the bank and get the term loan. Now, whether your client company has used that term loan only for the intended purposes or they have misused it. They have used it for other purposes. You are required to comment. To protect the interest of the bankers, they have included this point. Next one. In case whether your client has got any short-term loans, but instead of using it for short-term purposes, they are using it for long-term purposes. This will create something called a liquidity crunch for the companies. So that's why they have asked you to report on this matter. And then whether your client company has taken loan, not for meeting your client company's requirements, but for meeting the obligations of subsidiaries, associates, joint ventures. If yes, you are required to report that amount. And loans along with the nature of transactions and the amount in each case you have to report. The last point, your client has taken the loan for your client's purposes only, but for loan they have to give security. No, what they have offered as security is whatever investments they are holding it in the subsidiary, associate, joint venture. So those investments they have pledged it and they have got the loan. If yes, that also you are required to report the details, and have they made any default in these loans, you have to report it. Clear? So these are the 6 points which are required to be reported regarding the loans which are accepted by the company. Then clause 10, which is talking about IPO, FPO. So whether your client has raised any money, including equity, debentures, whatever it is, have they made IPO or FPO? Have they raised the money? If yes, for whatever purpose the money has been raised, whether it has been utilized for the set purposes only. How you will get to know for what purpose money has been raised? Prospectus, very good. If you refer to the prospectus, you will get to know for what purpose the money has been raised. So whether money has really been used for that set purposes only or not, you have to comment. If not, if any delays, rectifications or misuses have happened, those are required to be reported, including subsequent rectifications. Similarly, there will be private placement of the shares also or preferential allotment. That is also a way of raising the money. But the difference between IPO, FPO and preferential allotment is it will be issued only for a few people, not for everybody. Even for that also prospectus will be there. For that also, whether you have used it for the intended purposes or not, you have to check it. So that's what they say. If it is a preferential allotment, first you have to check the provisions of the compliance of the Companies Act, Section 42 and 62 of the Act. And in addition to that, whatever money that has been raised by way of IPO or FPO, whether that has been used for the intended purpose. If not, the details you are required to report. Reporting of the frauds. So regarding fraud, we have already reporting requirements under 143 subsection 12. In addition to that, you are required to report it under clause 11 of the CARO also. Sir, here what I have to report, if you read it, whether any fraud by the company or on the company has been noticed or reported during the year, then you are required to report the nature and amount involved. If there is any fraud which is noticed or reported during the year, you are required to report the amount involved in the fraud, nature of the fraud and amount involved in the fraud. So we have just now covered the reporting requirements under 143 subsection 12. Now they are also asking you to report it under CARO. Are there any differences between the two? So there are few differences here. Few points need attention here. The reporting requirements under 143 subsection 12 will become applicable even if you have reason to believe. If you read 143 subsection 12, no, they will say if you have a reason to believe, it need not be a proven fraud. If you have a reason to believe, you have to fulfill your reporting requirements. But under clause number 11 of the CARO, they will say noticed or reported frauds. That means a suspicion alone will not be enough. Suspicion alone will be enough to report it under 143 subsection 12. But suspicion alone will not be enough to report it under CARO. Able to understand? So their reason to believe is enough. But here they are saying noticed or reported frauds are only required to be included. And one more thing here, one more point you have to note here. The reporting requirements under 143 subsection 12, their materiality doesn't matter. If the amount of fraud involved is 1 crore or more, that's all. Whether it is material, not material, doesn't matter. You have to report the matter to the central government. So let us say for Reliance company, 1 crore worth of fraud happened. It is not material, but still Reliance auditors are required to report to the central government. But while reporting the frauds under CARO, you can consider materiality. Only material frauds you report, it will be enough. Immaterial frauds, you need not report it under CARO. So these are the two differences. So under 140 subsection 12, reason to believe is enough. But under CARO, it should be noticed or reported fraud. Under 140 subsection 12, there is no scope for materiality. Every fraud which exceeds 1 crore is required to be reported to central government. But under CARO, you can consider the aspects of materiality. Only material frauds, if you report, that will be enough. Next. Similarly, next point. Whether any report under 143 subsection 12 of the Companies Act has been filed with the auditors in form number 884. So whether any of the auditors, see these reporting requirements under 143 subsection 12, they will not just become applicable for statutory auditor, they will also become applicable for cost auditor, secretarial auditor also. Whether any of the auditors have submitted form number 884, that you have to check and give a comment. And also whether the auditor has considered whistleblower complaints, if any, received during the year by the company. Did the company receive any whistleblower complaints? If yes, has the auditor considered them or not? So these are the three matters you are required to report it under clause 11 of the CARO. Yeah. Next one. Coming to the next clause, clause number 12. This is applicable in case of Nidhi company. In case if your client company is a Nidhi company, there are a few things which are required to report. What if the client company is not a Nidhi company? You will simply say the same fact that my client is not a Nidhi company. But in case if your client company is a Nidhi company, what matters you are required to report? Number one, Nidhi companies are required to maintain net own funds to deposits in the ratio of 1:20. For every 1 rupee of own money, they can accept only maximum 20 rupees of deposits. So whether the client Nidhi company has complied with the requirement of net own funds to deposits in the ratio of 1:20 or not. Similarly, Nidhi companies are required to maintain 10% of their deposits in unencumbered term deposits. Out of the total deposits, whatever they have collected, 10% they have to keep it in a fixed deposit, that too unencumbered. Unencumbered means what? Without any charge. They should not give it as security for any loan. So without any charge, 10% of the deposits they have to keep it in a fixed deposits of the bank, unencumbered term deposits. And also whether there has been any default in payment of interest on deposits or repayment thereof for any period. Has an Nidhi company made any default in the repayment of principal or payment of interest? That also you have to consider. That also you have to report. Next, related party transactions, clause number 13. In case if your client company has entered into related party transaction, you have to comment whether they have complied with the provisions of section 177 and 188 of the Companies Act. Section 177, 188 will talk about the provisions relating to related parties, like 171, 177 will say audit committee approval and all. So whether your client company has complied with the provisions of 177 and 188 in respect of related party transactions. And also, when it comes to related party transactions, there are so many disclosure requirements. Under Companies Act also we have, under accounting standards also we have. So whether the company has fulfilled all the disclosures requirements in the financial statements or not, these are the 2 points you are required to comment. Next, internal audit system. In case if your client is having an internal audit system, is it commensurate with the size and nature of the entity? What do you mean by commensurate? Matching. Is it sufficient enough? In case if your client is having an internal audit system, that internal audit system is such big enough, which is matching with the nature and size of the business. Like the size of the company of Reliance, but internal audit team contain 2-3 people, not commensurate. So you have to comment whether the size of the internal audit team is commensurate with the nature and size of the business. And have you, and whether the reports of the internal auditor were considered. Did you look at the internal auditor's report? Did you consider the internal auditor's report? SA 610 will come into picture here. So did you refer to the internal auditor's report? Did you consider that internal auditor's reports for your external audit purposes? So these are the 2 points regarding internal audit system. Then 15th one, non-cash transaction. Whether your client company has entered into any non-cash transactions with the directors. What do you mean by non-cash transaction? Barter. Like you are doing some service to the director, in return director is also providing some goods or service. So in case if there is any non-cash transaction between the directors and the company, they cannot do in whatever manner they want. The provisions are contained in section 192 of the Companies Act. We need to check whether the provisions of section 192 has been complied with regard to non-cash transactions. Then 16th point we have regarding NBFC. In case if your client is conducting any into NBFC business, then you are required to report on these matters. What are they? Number one, whether your client is required to get registered under 45IA of the Reserve Bank of India Act. So all NBFCs are required to get registered. So when NBFC will be required to be registered and all, once again that we will learn it at the CFN level. They say that if your financial assets are more than 50%, if your income from financial assets are more than 50% of total income, then you have to register yourself as NBFC. So like that, whether your client is required to get registered under 45IA of the Reserve Bank of India Act, check and give a comment. If yes, whether they have obtained that required registration or not. Second one, whether your client company is carrying out a non-banking financial or housing finance activity without obtaining valid certificate of registration. If you want to carry out non-banking financial activity or housing finance activity, you cannot do it unless and until you get a registration from RBI. So whether your client is carrying out any non-banking financial or housing finance activity without obtaining certificate of registration. Then third, core investment company. In the NBFCs also, there will be a category called core investment company. That means if the NBFC fulfills some conditions, they will get that CIC status, core investment company. If you get the CIC status, you will enjoy some exemptions. So in case if your client NBFC is a CIC, whether it is fulfilling the required conditions or not. After you become CIC, if you fulfill some extra conditions, you will become exempted CIC. CIC only will give you some benefits. Even after becoming, let us say if you fulfill 10 conditions, you will become CIC. If you are a normal CIC, your auditor should check whether that 10 conditions are fulfilled or not. Now, after becoming CIC, if you fulfill 5 more extra conditions, you will become exempted CIC. In case if your client is that exempted CIC also, you should check the compliance with 10 plus 5, 15 sections, 15 conditions. So that also you need to check. In case if your client company is a very big group company, holding companies are there, subsidiaries are there, associates are there. Now, as a part of that entire group, is there only one CIC or more than one CIC? Let us say holding is also a CIC status, subsidiary is also a CIC status, associate is also a CIC status. In that case, you have to mention how many number of total CICs are there as a part of the group. Understood? That's all. This is what regarding NBFCs. So what are they? Whether your client is required to obtain registration under 45A of the Reserve Bank of India Act. If yes, whether they have obtained it or not. Second one, is your client carrying out a non-banking financial or housing finance activities without obtaining a valid certificate of registration. Third point, whether your client company is a CIC. If yes, whether they have fulfilled the criteria. If it is an exempted CIC, whether they fulfill that additional criteria. As a part of the group, is there one CIC or more than one CIC? If there is more than one CIC, you are required to mention the number of CICs as a part of the group. Next one, cash losses. Whether your client company has made the cash losses in the current year and also in the immediately preceding financial year. Both, not in one. In the current year and also in the preceding financial year, whether your client company has made cash losses. If yes, report the amount of cash losses. Don't look at the loss as per statement of P&L. Don't look at loss as per statement of P&L. You have to calculate the cash losses separately. So take the profit or loss as per the statement of P&L, add back non-cash expenses, reduce non-cash incomes. By that you will arrive at the cash loss. So check whether your client company has made the cash loss in the current year and also in the preceding financial year. In both the years, if it has made the cash losses, then you are required to report those cash losses. And then resignation of the auditors. Whether any of the auditor has resigned, any of the statutory auditors has resigned. If yes, because of whatever reasons he has resigned, you have to get to know about it and you have to consider those reasons. You have to consider those reasons. This is what regarding resignation of statutory auditors. Then we have 19th point. So what is this 19th point is, generally, as I've told, as an auditor, whenever we are conducting the audit, we are mainly concerned with historical financial information. But by bringing this new clause, this is a new clause in CARO 2020, not there in CARO 2016. By bringing this clause number 19, they are making us even look into the future of the company also. They are even asking us to comment on the future of the company also. So what they are trying to say here is, you have to express your opinion. I will read the second point. Whether the auditor is of the opinion that no material uncertainty exists as of the date of auditor's report. At the time when you are signing the audit report, in your opinion, is there any material uncertainty regarding what? That company is capable of meeting its liabilities at the date of the balance sheet, as and when they fall due within 1 year from the balance sheet. As on the date of signing the audit report, you have to tell your opinion. Is the company having the capability to pay its liabilities which fall due within 1 year from the balance sheet date? That means whatever current liabilities which are going to come within 1 year, is the company capable of paying their liabilities, or is there any material uncertainty existing, or there is any doubtfulness? That opinion you have to comment. You have to talk about the future. In the next 1 year, whatever current liabilities are there, will the company will be able to pay it? As on the date of auditor's report, you have to do this assessment. Sir, on what basis he has to comment on this? Not by tossing a coin. So he has to do it on the basis of financial ratios. On what basis, I will tell you in the first point. By calculating some ratios, by doing some aging and expected dates of realization of financial assets and payment of financial liabilities. What is the expected date of collection from debtors? What is the expected date of payment of liabilities? So this you have to do aging and expected dates, and also other information accompanying the financial statements. Even use all other information supporting the financial statements, and even you have to sit with the board of directors and understand their plans. By doing all this, you have to comment your opinion. Is there any material uncertainty regarding the company's ability to pay its liabilities which fall due within 1 year from the balance sheet date? So basically, you are required to comment on the future of the company. But even though you are required to comment it here, it is not a guarantee. It's not a guarantee. Even it might feel that the company will be able to pay all its current liabilities on due date, but in reality that might not happen. In reality that might not happen. No one will come and blame you. Don't worry. So just it is a matter of opinion. And then finally, clause number 20, we have CSR expenditure. Now, so what is the CSR expenditure is? Two things here. Whether in respect of other than ongoing projects, the company has transferred the unspent amount to a fund specified in Schedule 7 within a period of 6 months from the expiry of the financial year, as per the provisions of 135 subsection 5. Sir, what is that? Sir, we all know CSR expenditure, right? Some companies which fulfill the criteria under section 135, they are required to spend 2% of their average net profits on the corporate social responsibility. So let us say there is one company, it is getting covered under section 135. And last 3 years average profits they have calculated is coming to 100 crores. 2% they are required to spend on corporate social responsibility. 2 crores they are required to spend it. Now, company should decide. They should plan. They should decide projects, how they are going to spend. So out of this 2 crore rupees, they have various projects. So 50 lakh rupees, they are going to give it as a donation for old age home. They have a project for that. Another 20 lakh rupees, they are going to donate it for orphanage. Remaining 1 crore rupees, they are going to use it for the construction of one hospital. In a backward area, they want to construct one hospital. For medical facilities, they want to construct. They have this project ready. So financial year 25-26, 31st of March 2026 financial year is over. From this, within 6 months, by 30th of September 2026, this is what the projects they have. How much money they are required to spend? 2 crores they are required to spend. How much projects they have? 1.7 crores only they have. 50 lakh rupees they want to give the donation. I am not saying they have done it. I'm saying they have a project ready. So 50 lakh rupees they want to give it as a donation for old age home, 20 lakh rupees they want to give it as a donation for orphanage, 1 lakh rupees they want to construct a hospital. They have a project ready. I'm not telling they have spent it. They have a project ready. Financial year over, from that within 6 months over, but you have a project ready only for 1.7 crores. You're required to spend how much? 2 crore rupees. That means balance is 0.3 crores. Balance 0.3 crores. That is for 30 lakh rupees, you don't have a project ready. Financial year over, 6 months from the end of the balance sheet also over, but still you don't have a project ready for the 30 lakh rupees. That means you are unable to decide how to spend. Then you have to transfer it to the fund. Fund is specified under Schedule 7. PM Cares Fund. There are various funds which are specified under Schedule 7. PM Cares Fund, PM National Relief Fund, like that various funds are specified under Schedule 7. So you have to transfer that money to the fund. Cells. Yeah. So as I was saying, how much total amount they are required to spend? 2 crore rupees. They have the projects for 1.7. Balance sheet is dated is over. 3 months, 6 months from the end of the financial year is also over. But you still don't have a project ready for 30 lakh rupees. This 30 lakh rupees, as per the provisions of the Companies Act, you are required to transfer it to a fund specified under Schedule 7. Some government funds are there, you have to transfer to it. Government will take care of it. Government will take care of it. Once it has gone to the fund, there is no coming back. It will not come back. So government will take care of it. So that provision you have met it or not, you have to check. So if you read this provision carefully, so they say that whether in respect of other than ongoing project, so you don't have a project ready, other than ongoing project, whatever amount is there, that should be transferred to a fund specified under Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year. We have one more point here. Sir, for 1.7 crores, I have a project ready. 50 lakh rupees the company has to give a donation. They wrote a check, gave it, amount got debited. They gave a check of 20 lakh rupees to the orphanage. That amount also got debited. 1 crore rupees they want to spend it for hospital. But this hospital construction is going to take a time. It will not happen in a day or two. It will take some time. You have a project ready. This 1 crore rupees of money is there. This is relating to a project only. But you will spend it slowly. Unspent amount, you have a project ready, but you are only going to spend it. Now, what they are asking you to do is the amount relating to ongoing project, which is remaining unspent, keep it in a separate bank account. Where they're asking you to keep it in a separate bank account. Just open one CSR account with the bank and keep it there. So if the money has been transferred in a separate bank account, who will have control over it? Company only will have control over it. Who will spend it? Company only will spend it. For what purpose they will spend it? For CSR only they will spend it. Able to understand? Just they are asking you to bifurcate, differentiate the funds between normal funds and CSR funds. They are asking you to differentiate, keep it in a separate bank account. That's all. So whether they have kept it in a separate bank account or not, that also you are required to comment. That's what they say here. Whether any amount remaining unspent under 135 subsection 5 pursuant to ongoing project, relating to ongoing project, has been transferred to a special account in compliance with the provisions of 135 subsection 6. Understood? So the amount relating to other than ongoing project should be transferred to a fund within 6 months. The amount relating to ongoing project which is not yet spent should be transferred to a separate bank account. Clear? Next. Then last clause we have clause number 21, qualification or adverse remark. This clause number 21 only will come in the audit report of consolidated financial statements. And what this clause number 21 says is, see, in the consolidated financial statements, it is a collective information of holding company, subsidiary company, associate company, joint venture, everything will be clubbed together. Consolidated financial statements will be prepared. Now, if you are an auditor conducting audit of consolidated financial statements, they are asking this auditor to check the individual audit reports on the standalone financial statements. Holding company will have standalone financial statements, but that audit report will be there. Subsidiary companies also will have standalone financial statements, their audit report will be there. In their audit reports, CARO reports will be there. The respective auditors would have commented on CARO. So they are asking auditor of the consolidated financial statements to go through the individual audit reports of these components which are forming part of the consolidated financial statements. Go through their individual CARO reports. find out whether any of the clause contains a negative remark. In these companies auditors report, find out whether any of the companies contain negative remarks in any of the CARO clauses. If yes, mention that company which is containing a negative comment and mention that paragraph which contains a negative comment. So let us say in the in the subsidiary company audit report, clause number 12 contains a negative remark. Now you have to say it in the consolidated financial statements. So and so company X Limited, which is a subsidiary company, in their CARO report, para number 12 contains a negative remark. That's it. So that's what they try to say it here. So whether there have been any qualifications or adverse remark by the respective auditors in the company's report of the companies included in consolidated financial statements. If yes, indicate the details of the companies and paragraph numbers of the CARO report containing the qualification or adverse remarks. Understood? Clear? So these are the 21 clauses. And then finally, whether you have a positive for both 143 subsection 3 and 143 subsection 11, whether you have a positive comment or you have a negative comment, compulsorily you are required to report on those matters. Even you have a positive point also, you have to comment it. When you have a negative point also, you are required to comment on it. But 143 subsection 1 is not like that. You are required to comment it only when you have a negative comment. Clear? One more standard. Essay 299. Audit report will be over. Okay, we'll do essay 299. Tomorrow, a fresh will start. Audit documentation, audit evidence will start with that. So we'll try to the 299 here, hardly 10 minutes, nothing much. So just bear with me for 10 more minutes. We'll complete essay 299 and wind up the chapter. So essay 299, which is going to talk about what? Joint audit. Sir, what is joint audit, sir? What is joint audit? What is the meaning of the term joint audit? When more than one auditor has been appointed for the same entity for the same financial year and also having the same scope of work, those engagements we are going to call it as joint. Sir, does that mean if the principal auditor, branch auditor separately appointed, can we call it as a joint audit engagement? No. Principal audit, branch audit, that is not a joint audit. Why? Because there the scope of work is different. So what is basically joint audit is for the whole company, two or more than two auditors will be appointed. Like Reliance Industries Limited, two audit firms have been appointed for conducting audit of entire company. Even if you look at the audit report also, both the auditors from two audit firms would have signed the audit report. So more than one auditor for the same financial year, for the same entity, having the same scope of work. So they will be considered as what? That engagements will be called as joint audit. Now, why joint audit, sir? Why joint audit? Because industry is finding some advantages. Sir, what are the advantages? As you could see here, sharing of expertise. When more than one auditor gets appointed, they can share their expertise with each other. My recording is getting stuck. So, why they are undergoing for joint audit? Because they are finding some advantages in the joint audit. So what are the advantages? Sharing of expertise. When more than one auditor has been appointed, more than one firm has been appointed, they are sharing their expertise with each other. And advantages of mutual consultation. They both can consult with each other. Lower workload on the auditors also, workload will get reduced. Better quality of the performance. When the same work is done by two professionals, quality of the work will get improved. And improved service to the client. Ultimately, client will be happy because he is getting a better service. And in case of multinational companies, if they are going for joint audit from different countries, auditors they can appoint. So that possibility is also there. Slower staff development cost. When you have joint auditors working, you need not train your staff for audit purposes. And low cost to carry out the work. And finally, a sense of healthy competition. But it will ultimately lead to unhealthy competition between auditors. But as they are saying it, it will lead to healthy competition. Then, see, not just advantages, the process of this joint audit also brings some disadvantages. So, what are the disadvantages? Fees will get reduced. So, traditionally, you used to do single audit, you used to eat the entire fees. Now, since you are sharing the work, you have to share the fees also. From the client's perspective, if you think it will be a costly affair. See, last year, once a single auditor you have appointed, paid them 10 lakhs. This year, you are going for joint audit, you cannot say, I will pay you 10 lakhs, both share 50-50%. It is not going to happen. So they might say, okay, we will do it for 7 lakhs, 14 lakhs, 4 lakhs extra cost is incurring. So like that, it will be increased cost and coordination problems will be there. So we naturally tend to have these ego issues and all. So when you have to work with another professional who is equally qualified like us, so definitely those ego issues are going to come up. So lack of coordination, superiority complexes, ego complexes. Sometimes because of others' mistakes, you have to face the consequences. So like that, so many disadvantages are also there. But slowly companies are adopting for joint audit. It is not any mandatory requirement. There is some self-regulatory measure of ICI, but it is only self-regulatory, recommendatory measure, not a mandatory measure. Now, okay, sir, we have understood advantages, disadvantages. Now, how the work will happen? If the joint auditors are appointed, how the work is going to happen? Will each joint auditor do the work separately? For SBI, 14 joint auditors are there. So, if joint auditors are appointed, does that mean each auditor will do audit separately and 14 times audit will happen? So, when the joint auditors are appointed, mainly they will divide the work among themselves. On what basis? There are different bases on the basis of which work can be divided. It could be divided on the basis of items of financial statements. It could be divided on the basis of geographical locations. It could be divided on the basis of identified units or businesses. It could be even divided on the basis of period of the financial statements. On multiple bases, they can divide the work. Okay, sir. They are dividing the work and doing it. Now, what about responsibility? What about responsibility? Each joint auditor will be held responsible only for the work which was allocated to him. What they have told, each joint auditor will be held responsible only for the work which was allocated to him. So if the work was not allocated to him, that on that he will not be responsible. Let us say, for example, Reliance two joint auditors have divided the work on the basis of period of the financial statements. So April to September joint auditor A, October to March joint auditor B. So both have done the audit, both are unable to find out any material misstatement, gave an unmodified opinion. Later, fraud was found out relating to February month. Who will be held responsible? Only joint auditor B will be held responsible. So that's what the meaning of each joint auditor being responsible only for the work which was allocated to him. Then thereafter, so but however, there are certain areas where there will be joint and several responsibility. What do you mean by that? There are certain areas where each and every joint auditor he will be held responsible. You cannot say I did not do the work, blame the other person. You can't shift the blame. So there will be certain areas where there will be joint and several responsibility, which means each and every joint auditor will be held responsible in some circumstances. So what are that circumstances? Number one, when there is some undivided work. When some work was not divided, either by mistake you forgot or intentionally you did not allocate, least bother. So if the work is not allocated, if there is some undivided work, that work will be, if something goes wrong in that undivided work, everybody will be held responsible. Similarly, decisions taken by all joint auditors. If some decision has been taken by all joint auditors collectively, then also everybody will be held responsible. And matters which are brought to the notice of the joint auditors. Work was allocated. 14 joint auditors of SBA. They have divided the work on the basis of geographical location. There is a joint auditor A who is handling the AP related work. He found some misstatement in his work. He did not keep it to himself. These 14 useless fellows are having a WhatsApp group. In that group, he has posted. Everybody has seen it. Everyone has done their respective work. Finally, when the opinion they have to take, this fellow did not say anything. Whoever has done the AP related audit, he told, okay, everything is fine. I will give unmodified opinion. Remaining all people also, okay, since he is not worried, why we need to worry? Everybody have told unmodified opinion. Later, the fraud has came into public domain. Who will be held responsible? Everybody. Why, sir? Because that useless fellow did not keep that information to himself. No, he informed it to everybody. Since he informed it to everybody, if he is not taking action, other person should have taken an action. Since you have not taken the action, everybody have to held responsible. So three instances: undivided work, decisions taken by all, matters brought to the notice of all joint auditors, and also checking that financial statements comply with the relevant statute. Whatever financial statements are there, whether they are prepared as per applicable statute, Schedule 3 accounting standards or not, checking that is also everybody's responsibility. And also presentation and disclosure of financial statements as per applicable financial reporting framework, that is also everybody's responsibility. And ensuring that whatever audit report you are giving, that is complying with the requirements of relevant statutes like standards on auditing, companies act, etc. You are giving the audit report in compliance with the standards on auditing and relevant statute, that is also everybody's responsibility. So these are the 6 areas where there will be joint and several responsibility, which means each and every joint auditor will be held responsible if in these areas something goes wrong. Understood? Next. Now, sir, what about reporting requirements? What about reporting requirements? So what about the reporting requirements means, sir, generally what will happen is when joint audit has been completed, when everybody has done their respective portion, all of them will sit together, they will discuss all their findings and they arrive at one common opinion. and that common opinion will be expressed through a single audit report, and that single audit report will be signed by all the joint auditors. But everything life will not be smooth every time. Sometimes there will be disturbances. So let us say the SBI audit, 13 joint auditors are saying we'll give an unmodified opinion. One joint auditor is there, he wants to give a modified opinion because he was a newly qualified chartered accountant like you. He want to display all his skills in the first audit only. So he found out a misstatement. Remaining 13 people are telling, okay, boss, you found a misstatement, but that is not material. We will give unmodified. But this fellow is saying, no, no, this is material. I have to give modified opinion only. Now, what should happen? Should he go with the majority? No, no. So they can give a separate audit report. Let those 13 joint auditors give an audit report. Let those 13 people sign it containing an unmodified opinion. This one single person will give an audit report containing a modified opinion. So, in case if there are multiple audit reports, each audit report must contain a reference to the other auditor's report. So these 13 people's auditors report, it has to clearly mention that this is the audit report of us, the 13 people. One joint auditor is there who has given a different audit report. Similarly, that one joint auditor also should mention in his audit report, this is my audit report. Remaining 13 joint auditors have given a different audit report. So like that, there will be two audit reports. Now these joint auditors will submit these two reports to the management. Now management has to circulate now. Which report they have to circulate? Both they have to circulate. Okay, now multiple reports have gone to the shareholder. Which one he has to rely? His headache. His headache. Leave it. We have passed on the information. He will read the reports. He will read the basis for opinion. If he felt unmodified opinion is appropriate, he will rely on it. After reading the modified opinion and basis for opinion, if he feels modified opinion is appropriate, he will act accordingly. We have passed on the information. Let the shareholder have his own headache. Clear? Next, one more thing. Sir, can the joint auditor rely on the work of other joint auditor? Can a joint auditor rely on the work of another joint auditor? With review, without review? Without any review. Without any review. Standard has told a joint auditor will be entitled to rely on the work of another joint auditor even without performing any review. We need not check it. The other person is equally qualified like you. A joint auditor will be entitled to rely on the work performed by another auditor. And there are some special considerations while doing joint audit. So what are that is? So this I will explain you later. Special considerations. This I will try to link it with audit planning, audit strategy planning and program. There I will try to link this G point. Okay. So that's all. This is what regarding SA 299. With this we have successfully completed this part also. Audit reporting and all we have. Okay. So that's all for today. So what and all things we have covered in the previous session. So we have covered the introduction part, nature, objective, and scope of audit we are done, ethics and the terms of engagement we are done, and thereafter we have also completed the audit reporting part where we have covered the bunch of standards and also reporting requirements under Companies Act, all that things we have covered it. So now what we are trying to do is we are going to pick up a chapter called audit documentation and audit evidence, which is going to contain two standards. Audit evidence part, which has been taken from SA 500, whereas audit documentation part, which has been taken from SA 230. So both the standards we'll try to quickly revise. So first we'll start with the SA 500 audit evidence. So SA 500 series of the standards, the entire 500 series of the standards is going to talk about audit evidence in general. So like I told you in the previous session, the entire process of audit, like the client will approach us asking us for to do the engagement, then we'll perform preliminary engagement activities. Thereafter, we are going to accept the engagement, and we'll draft engagement letter, formalities and all will get completed. Then we start performing audit procedures. By performing audit procedures, we are going to get something called audit evidence, and on the basis of that audit evidence, we are going to express an opinion, give the report. With that, our process of audit is going to end. So we are required to elaborate on this thing called audit procedures. We are required to understand before we talk about audit evidence in a detailed manner. First, let us become clear what exactly is the meaning of the term audit procedures. We'll try to understand what are the different types of audit procedures we perform in an audit, that we'll try to understand in a detailed manner. So first thing, the meaning of the term audit procedures, as I've told, the term audit procedures is a very broad term which includes everything you do in the audit. So whatever procedures you are simply performing to obtain audit evidence, all that we are going to call it as audit procedures. And this audit procedures can be broadly divided into two categories. How many categories? Two categories. Number one is risk assessment procedures. Then we have something called further audit procedures. And in the further audit procedures, further they are divided into two categories. One is compliance procedures which we also call it as test of controls, and other one is there which is called as substantive audit procedures. So like that, these are the various categories of the audit procedures. Risk assessment, if I go into specifically risk assessment procedures, compliance procedures, and substantive audit procedures. These are the different, whatever audit procedures we perform, that will fall under these three categories. So first we'll start with risk assessment procedures. Sir, if we have got audit, if we have been appointed as an auditor, so definitely our main objective is to verify the financial statements, books of accounts, etc. There is no doubt about it. But it is not like the moment you have gone for the client's premises, directly you will rush to the accounts department and start verifying the books of accounts. That's not what we do. So before we actually jump into that accounts and before we start verifying the books of accounts and etc., first we need to perform some procedures to obtain an understanding of entity, environment, and its internal control. What we have to understand, we have to perform some procedures to obtain an understanding of entity, environment, and its internal controls. So to understand about the entity, environment, and its internal controls, we need to perform some procedures. And why we need to understand the entity, environment, and its internal control? Basically to identify and assess something called risk of material misstatement. To identify and assess risk of material misstatement. Sir, what is risk of material misstatement? The chance, the possibility of happening of misstatement in the financial statements. So what are the areas where there is a chance of happening misstatement, where there is a probability of happening misstatement, where there is something wrong? We are not exactly finding out the misstatement here, guys. So as a part of risk assessment procedures, we perform the procedures to obtain understanding of entity, environment, and its internal control. We are only understanding. Like we do something called plant visit, we walk around the premises, we go to various departments, we try to understand what kind of entity it is, what business it is operating, what kind of environment it is operating, what laws and regulations will become applicable, what kind of internal controls they are having. We try to obtain an understanding. From that basic understanding, we are going to identify risk of material misstatement. We are going to identify and also assess. We are going to find out and we are going to analyze something called risk of material misstatement. So that procedures we are going to call it as risk assessment procedures. That is the first and foremost procedures we do in the audit. We don't directly jump into the accounts department and start verifying the books of accounts. So first we understand this. We identify and assess the risk of material misstatement. Sir, okay, sir, for 1-2 days, we have done the risk assessment procedures whereby we have understood the entity, environment, and its internal control. We identified in each area, in this area, what is risk of material misstatement in purchases, what is risk of material misstatement in sales, what is risk of material misstatement, we have identified. Then what is the next step? Next step, now will you go to the accounts department and start verifying books of accounts? No. So we have to do one more thing. As a part of risk assessment procedures, you understood about internal controls. We understood. We did not test. We understood what kind of controls are there. Just understanding doesn't mean they are operating effectively. So we understood internal controls, but whatever controls we have understood, whether those controls are operating effectively or not, whether those internal controls are operating effectively or not. So we perform audit procedures to obtain the audit evidence regarding the operating effectiveness of internal controls. So those procedures we are going to call them as compliance procedures, or even alternative name for this is test of controls. The name itself says test of controls. You are testing the internal controls. So this will perform. Okay, we tested the internal controls. Depending on that, we will determine whether internal controls are working effectively or not working effectively. Okay, risk assessment done, compliance done. Now at least will you go to the accounts department and start verifying books of accounts? Yes. Now you have to go to the accounts department, get the access to the books of accounts, check the reliability of the data, whether financial information is reliable or not. All that procedures you are going to perform. That actual checking stage happens at substantive audit procedures. Actual testing will happen where? At the substantive audit procedure stage, we actually verify the reliability and appropriateness of this financial data. And these substantive audit procedures also can be performed in various ways. If you want to test, if you want to know whether the financial information is reliable or not, whether books of accounts are reliable or not. So if you wanted to even verify the books of accounts also, if you want, if when you're checking financial information also, you can do it in two ways. One is test of details and the other one is analytical procedures. Nothing but let us all keep the concept aside. If you wanted to know whether financial information is correct or not, what simple thing you will do? You will verify the supporting documents, whatever entries in the books of accounts are there, whatever financial statement related data is there, that we will verify whether it is with supporting documents. You will verify that checking of the supporting documents only we are going to call it as test of details. Test of details is none other than checking of supporting documents. And this test of details will be further divided into two categories. One is a test of transactions and the other one is test of balances. If you are checking the supporting documents of incomes and expenses, that is P&L items, it is test of transactions. On the other hand, you are checking the supporting documents of assets and liabilities, that is going to be test of balances. This is one way. There is another way. There is one more way by which we can check whether financial information is reliable or not. So what is that other way is we don't do the routine checking of supporting documents, but instead what we do is we try to study the relationship among financial and non-financial data. We are going to study the relationship among financial and non-financial data. Thereby, we are going to evaluate whether financial information is correct or not. So we are going to think analytically here. So this is where actual analysis will come into picture. You are not working like a robot where you check the supporting documents, but you are applying your skills. You are studying the relationship between financial and non-financial data. Thereby, you are evaluating whether financial information is correct or not. So that is also one way of performing substantive audit procedures. So whatever it is, these are the various kinds of audit procedures: risk assessment, compliance, substantive. Now, see, compliance procedures and substantive audit procedures, they both should complement each other. One is not a substitute for the other. Compliance, this terminology is once again important. The compliance procedures and substantive audit procedures, both are complementary to each other. So, what do you mean by complementary to each other? We perform compliance audit procedures to determine nature, timing, and extent of substantive audit procedures. We are performing compliance procedures. So why we are performing compliance procedures, why we are going to test the operating effectiveness of internal controls is depending on results of operating, depending on outcome of the compliance procedures, we are going to determine our nature, timing, and extent of substantive audit procedures. So that's why we call them as both are complementary with each other. Then one more general question I would like to ask you here. Do you think by performing risk assessment procedures alone, will I be able to get all the evidence required for expression of opinion? Absolutely no. We are only identifying risk of vital misstatement. Do you think by performing a combination of risk assessment and compliance procedures, will I be able to obtain all the evidence required for expression of opinion? Still the answer is no. The evidence which is required for expression of opinion, we are going to get it only and only by performing substantive audit procedures. That's all. The complete evidence which is required for expression of opinion, we are going to get it only from the performance of substantive audit procedures. Then why do we have risk assessment and compliance? They are complementary. They will make your substantive audit procedures easier. So we perform risk assessment procedures. We identify risk of material misstatement. We find out the areas where risk is higher, where risk is lower. So that wherever risk is higher, there we perform more substantive audit procedures. Wherever risk is lower, there we perform less substantive audit procedures. Similarly, we are performing compliance procedures to test the operating effectiveness of internal controls. If the controls are effective, in those areas where controls are effective, we perform less substantive audit procedures. On the other hand, those areas where controls are not effective, we perform more substantive audit procedures. The whole purpose of performing risk assessment and compliance is not to obtain evidence, but to help us make our substantive audit procedures better. Clear? Able to understand? Right. So this is what regarding the audit procedures. So different types of audit procedures we have understood. Now we will talk about audit evidence. Sir, what is audit evidence? This I have already told you. Audit evidence is information which will be used by the auditor in arriving at the conclusions on which auditor's opinion is based. So whatever information auditor is using to arrive at the conclusion on the basis of which he is forming an opinion, all that information we are going to call it as audit evidence. Sir, from where we are going to get this audit evidence from? So they say that the primary source, the main source for obtaining audit evidence is accounting records. What is the primary source for obtaining audit evidence? Accounting records. Sir, what do you mean by accounting records? The journals, ledgers, supporting documents, trial balances, everything will come under accounting records. The primary source, the major source for getting the audit evidence is for accounting records. But do you think it is the only source for obtaining audit evidence? There is no denial in saying that, sir, one of the major source of evidence is accounting records. But do you think accounting records is the only source from which you are going to get the evidence from? Definitely not. So we are going to get a bunch of audit evidence, not just from accounting records, we can also get it from other sources, other information also we can get. Sir, what is other information? Like companies' legal documents, like MOA, AOA, it could be external confirmations. So like that, apart from accounting records, there is so much of other information from which I can obtain the audit evidence. Then, talking about audit evidence, there are different types of audit evidence. On the basis of nature, evidence can be divided into three categories, which is oral, documentary, visual. So oral evidence, which is by way of word spoken; documentary evidence, which is by way of written information, either in paper form or electronic form; visual evidence is something looking at it, observation, inventory counting and all. That will come under physical observation, visual evidence. Then on the basis of the source, evidence can be broadly divided into two categories. Number one, internal evidence, and number two, external evidence. So what is internal evidence? The evidence which is originated within the organization. Within whose organization? Very good. Client's organization, not auditor's organization. The evidence which is originated, which is generated within the client's organization, we are going to call it as internal evidence. On the other hand, the evidence which is originated outside of client's organization, that we are going to call it as external evidence. Now, talking about reliability, which one will be more reliable? External evidence is going to be more reliable than the internal evidence. The logic, clients, staff, and management will not have control over it. Since they don't have control over it, they will have less scope for manipulation. So, comparatively, when compared with internal evidence, external evidence is more reliable. Does that mean did I ask you to throw away all the internal evidences? No, I did not say it. Internal evidences are also reliable when internal controls are strong. But comparatively, when I do a comparison between internal versus external evidence will be more reliable. Then, whenever we use the term audit evidence, the standards will never refer to audit evidence alone. It will always be preceded by two terms. Exactly. Sufficient and appropriate audit evidence. Even in the yesterday session also, when we are discussing that audit reporting, there also everywhere we have written sufficient and appropriate audit evidence. So sufficient and appropriate, these two attributes will always be used in combination with the term audit evidence. So let us try to understand what is the meaning of the term sufficient, what is the meaning of appropriateness. Sufficiency is a measure of quantity. What is it? Sufficiency is a measure of quantity, whereas appropriateness is a measure of quality of the audit evidence. So sufficiency is a measure of quantity, appropriateness is a measure of quality of audit evidence. So the standards will always ask you to obtain sufficient evidence. Enough of quantity of evidence you have to get. Obtain qualitative evidence, that is appropriate evidence. The standards will always tell you, every standard will tell you obtain sufficient and appropriate audit evidence, but the standard did not exactly tell us how much quantity will be considered as sufficient, what quality will be considered as appropriate. It has not been mentioned anywhere. So how much quantity will be sufficient? Will 100 quantity will be sufficient? Will 200 quantity will be sufficient? Will 500 quantity will be sufficient? Or what quality can be considered as appropriate? That was not exhaustively defined. So what amounts to sufficient and appropriate audit evidence? That is something auditor himself has to decide using his professional judgment. Who has to decide it? Auditor himself has to decide it using his professional judgment. He himself has to decide whether the evidence is sufficient and appropriate or not. But there are various factors. The auditor will consider various factors in deciding whether evidence is sufficient or not. So there are various factors which auditor will consider. So what are the factors which auditor will consider in determining sufficiency and appropriateness of audit evidence? So first, talking about sufficiency. So whether evidence will be sufficient or not, how much quantity of evidence will be sufficient, that is going to depend on various factors like materiality. If the item of the financial statement which you are verifying is very, very material, very significant item, for those significant items you require more quantity. If you are verifying some immaterial items, less important items, less significant items in the financial statements, for that you can get satisfied with lesser quantity. So that's what the first point. Materiality is one of the factors which will determine the sufficiency of audit evidence. Then we have risk of material misstatement. What is it? Risk of material misstatement. When the risk of material misstatement is very high, when the risk of material misstatement is high, the auditor will always be looking for more evidences. When the risk of material misstatement is low, then the auditor will be obtaining less quantity will be considered as sufficient here. However, there are various components of risk of material misstatement like inherent risk we have, control risk we have. That is a part of the risk assessment chapter. We will not mess with that discussion here. Then it also depends on size and characteristics of the population. Sufficiency is also going to depend on one more factor, which is size and characteristics of the population. Size of the population is the number of items, the number of entries, or the cumulative data, accounting data, that we call it as size of the population. So if the size of the population is higher, then it could be there the quantity of evidence required could be higher. It also depends on characteristics of the population. Characteristics means whether it is a homogeneous population or heterogeneous population. If it is homogeneous population, all the items are having similar characteristics. We might get convinced with lesser quantity. In case if there are heterogeneous populations where they are having different characteristics, then we might be asking for more quantity. So these are the three factors they have simply told: materiality, risk of material misstatement, and size and characteristics of the population. Thereafter, appropriateness. I told appropriateness means quality. So appropriateness means quality. Appropriateness is going to further depend on two factors. One is relevance and the other one is reliability. What is it? Relevance and reliability. So appropriateness means quality, and this appropriateness is going to be determined by relevance and reliability. Sir, what is relevance? What is reliability? I've already told you. Reliability means trustability. Reliability means trustability. If the evidence is more reliable, then it will be more qualitative. Like for example, when I say internal versus external you told more reliable. So I will consider external as more qualitative. Between oral, documentary, visual, documentary evidences will be more reliable. So I will consider that as more qualitative. So appropriateness, one factor which will decide the appropriateness is reliability. And the other one is relevance. And the other one is what? Relevance. How logically that evidence is connected with the given item of the financial statement. How logically the evidence is connected with given item of the financial statement. More logically it is connected, the more relevant it is going to be. More the relevance, more appropriate it is going to be. Understood? So these are the two factors which will determine the appropriateness. And we have one point here. We have one point here. So this is specifically important. Fourth point, if you read it, while recognizing that exceptions may exist, the following generalizations about the reliability of audit evidence may be useful. So what they're saying, you have to have reliable evidence. When the evidence is more reliable, it will be more qualitative, right? So there are some generalizations regarding reliability. What do you mean by generalizations? Some general instances where we feel evidence as more reliable. So what are that generalizations, or even you can call them as general principles, which will determine the reliability? But this sentence starts with one point, while recognizing that exceptions may exist. So we are going to tell you a few general principles where evidence will be considered as more reliable. But it is not always the case. There could be sometimes exceptions also. There could be, we are going to discuss now some general principles. Usually when these general principles are present, we consider evidence as more reliable. But the statement is starting with exception. There could be even exceptions also. Always this might not be the case. So what are that generalizations regarding reliability of evidence? Number one, when you get the evidence from an independent source outside of the entity, that means external evidences. Generally, it will be more reliable. But for this, there could be an exception. See, you are getting a evidence from outside of the entity, but that outsider is also your related party. But outsider is also a client's related party. So then, even though you are getting from an outside source, it might not be reliable in that case. So that is what the beginning sentence is. Realizing that there will be exceptions. So we are accepting the fact there will be exceptions, but some general principles we are letting you know. So first one, evidence you are obtaining from independent sources outside of the entity is more reliable. Then the reliability of audit evidence that is generated internally is increased when the internal controls are effective. That means internal evidences will be more reliable when the internal controls are effective. Third one, evidence obtained directly by the auditor will be more reliable than the information obtained through the other party. If you are getting the information directly from the third party, that is more reliable. If you are getting information from the third party, but in between one mediator is there, like client, you are getting the information through the client, that will not be that much reliable. Evidence obtained directly by the auditor will be more reliable. And audit evidence in documentary form, whether in paper or electronic medium, is going to be more reliable than oral evidence. This point also general point only. And audit evidence obtained as original documents is more reliable than the photocopies or Xerox copies. Agreed or not? Simple point, original documents are more reliable than the photocopies. So like that, five general principles they have told, or five generalizations they have told. So what are the five generalizations? Evidence obtained from independent outside or independent source outside of the entity is more reliable. Internal evidence will be more reliable when the internal controls are effective. Evidence obtained by the auditor directly is more reliable than the evidence obtained through the other parties. And evidence in the documentary form is going to be more reliable than the oral evidence. And evidence obtained from the original documents is going to be more reliable than the photocopies. Understood? Next. Now comes the most important part. What are the various methods for obtaining that audit evidence? So they can call it as the audit procedures to obtain audit evidence or audit methods to obtain audit evidence. So we have some 7 universal methods. How many we have? 7 universal methods we have across the world. Wherever audit is happening, the auditors are always using one of these 7 methods to obtain the audit evidence. So what are that 7 usual methods which will be used by the auditor for obtaining the audit evidence? Inspection, inquiry, observation, external confirmation, recalculation, reperformance, and finally analytical procedures. So 7 we have. What are they? Inquiry, inspection, observation, analytical procedure, observation, external confirmation, recalculation, reperformance, analytical procedures. We'll try to understand one by one. Inspection. Inspection involves two things: documentary examination and even physical examination of an asset. When I say inspection, I'm referring to two things. It could be either documentary examination, like for example, to know whether the transactions are genuine or not, you might be checking the supporting documents. So checking of the supporting documents will fall under inspection. Not just that, even when you are doing physical examination of an asset, going and doing the physical verification of fixed asset, physical verification of inventory, that also will form part of inspection. So inspection contains two aspects. Number one, it is documentary examination. It also includes physical examination of an asset. So different when you are doing the inspection, different kinds of documents will give different levels of assurance. See, if you, when you are verifying the purchase related supporting documents, you will have purchase invoice also, GRN also, purchase order also. But not all documents will give equal level of confidence. Like purchase invoice will give you highest level of assurance than when compared with the other supporting documents. So inspection will give you different levels of assurance depending on the document which you are verifying. Then we have second point, if you see it here, observation we have. Sir, what is observation? Looking at the process being performed by others. If you are looking at the process being performed by others, then we are going to call it as observation. So very simple. Management is doing inventory verification, you are sitting and observing it. So in the organization, the internal controls are getting implemented by the people, you are sitting and observing it. So if you are looking at a process being performed by others, that we call it as observation. Do you think observation will give you reliable evidence? Yes, observation evidence will be reliable, but the problem is the reliability is restricted only till the point of time when such observation takes place. See, when you know that someone is monitoring you, you will definitely do the task with a lot of care. What is the guarantee when I'm not seeing you, when no one is seeing you, you will do the same activity in the same manner? No guarantee. So that's why observation, by doing observation, whatever evidence you are getting is reliable. But the problem is that reliability is restricted only till the point of time when such observation takes place. Then we have external confirmation. Sir, what is external confirmation? Obtaining a direct written response by the auditor from a third party, that we are going to call it as external confirmation. And you have to realize one fact here, getting oral communication is not considered as external confirmation. So it must be in the written form. When I say written format, it need not be handwritten. It could be either in paper form or electronic form. So if you are getting a direct written response from a third party, then it will be called as external confirmation. So anyhow, regarding external confirmation, we are going to discuss a dedicated standard SA505. There we will talk about it in a more detailed manner. Then we have this recalculation. Sir, what is this recalculation? Checking of the arithmetical accuracy. What is it? Checking of arithmetical accuracy. So nothing but this additions, deletions, subtractions and all calculation part has been done properly or not. You will do the recalculation. But this method has become redundant. Why? Because today no human being is doing and sitting that calculation and all. Everything is done with the help of accounting software. Then thereafter we have reperformance. Sir, what is reperformance? You are extra itching there. So management or client's internal control, you have already done some work, but still you want to do it independently. They have already done it, but we have no sometimes that urge to do. So management has already performed some processes, but you are doing an independent execution once again of the same process. Management prepared the BRS and gave it to you. You told I also learned from the class 12, class 11 how to prepare BRS. I will prepare the BRS and you compare it with the management prepared BRS. So this is what we call it as recalculation. Then we have this thing called analytical procedures. So I told you analytical procedures can be performed in various ways. So here we study the relationship between two financial items, or we can study the relationship between one financial and one non-financial item. And by analyzing that relationships, by doing the comparison, by finding out the differences, we will try to analyze whether financial information is correct or not. And then you have one more thing called inquiry. So what is inquiry? Seeking of information from knowledgeable persons. So simply either inside the entity or outside the entity, if you go out, if you go to the people, ask the questions, get the information, that is what we are going to call it as inquiry. And inquiry could be a formal written inquiry, or even it could be an informal oral inquiry also. And by doing inquiry, three kinds of information you get, not just in audit, anywhere. If you do inquiry, three kinds of information you will get. Altogether new information which you are not previously aware of, or information which supports the information which you already know, or information which contradicts with the information that you are already having. So by doing any inquiry, only these three kinds of information you will get, either altogether new information, or some information which supports the information, corroborates, they use the term corroborates it, the information which corroborates the information which you already have, or the information which contradicts with the information which you have. See, inquiry will give you evidence, but the problem is you should not use inquiry alone. Inquiry should always be used in combination with other procedures. Inquiry should always be used in combination with other procedures. Clear, everyone? So like this, we have some total 7 methods. What are they? Inspection, observation, external confirmation, recalculation, reperformance, analytical procedures, and inquiry. Now a few questions to ask you here. Out of all these methods, which one is most efficient? Which one is most effective? Are you able to understand difference between efficient and effective? Efficient activity. I call an activity as efficient when it is less time consuming. If I could do the activity within a very short span of time, within a very less time, if I'm able to complete a task, I will be considered as efficient. What do you mean by effective? If you are doing the task in a perfect manner without any deviations, without any wrong things, that we call it as effective. So best method. So you tell me, out of all these methods, which method you feel it as more efficient? Which one is less time consuming? Inquiry will be most efficient method. We can complete in a very short span of time. But the problem with inquiry is it will not be effective. It will not be effective. Why? Because you can't expect a person, when you're doing an inquiry, you can't expect a person to voluntarily come and disclose us what mistakes they have committed. So that's why inquiry can get completed within less time, but it might not be the best way of getting evidence. Which one is most effective? Reperformance is going to be the most effective, best method. Why? Because you are independently executing it. You yourself are doing and getting the evidence. So reperformance is going to be the most effective method, but the problem is it is not efficient. It will be more time consuming because you have to do the process once again and you have to get the work done. So that's why it's going to be very much time consuming. Sir, now which one auditor has to use, sir? Which one auditor has to use? Auditor's professional judgment once again. See, this is the beauty of this entire subject of the audit. Nowhere they will tell you what exactly needs to be done. Everywhere they will tell you so many options, and your choice. You do whatever you want. They will say, and that's how the audit subject exists also. If the standard exactly says what needs to be done, everybody who reads the standard will get to know what auditor will do. So this leaving everything to the auditor's professional judgment, this maintains that surprise element in the audit. Okay, so these are the 7 methods. And few more things I wanted to tell you here. See, we have the 7 methods now. We have the 7 methods, right? Which methods will be suitable for performing risk assessment procedures? Which methods will be suitable for performing compliance procedures? Which methods will be suitable for performing substantive audit procedures? We have three categories of audit procedures. Risk assessment procedures we can do, compliance we can do, substantive we can do. In the risk assessment procedures, we are going to understand the entity environment and its internal control to identify and assess the risk of material misstatement. In compliance procedures, we are going to test the operating effectiveness of internal controls. In the substantive audit procedures, we are going to check the financial information. So which method will be suitable for where? Let us try to understand it. First one, starting with inspection. Can inspection as a technique be used for performing risk assessment procedures? Risk assessment procedures, what we do here, we understand the entity and its environment. Can we read some documents and get to know about the understanding of the entity? Yes. Can we do some inspection and test the operating effectiveness of controls? Yes. Control manuals and all will be there. If you go through that inspection, you can get to know. Can we perform it as a substantive audit procedures? Yes, that also we can do it. Why? Because we check the supporting documents. Test of details is nothing but inspection. Then observation. Can you do observation for performing risk assessment procedures? To understand the entity and its environment, can you do the observation? Yes. Can you use it as compliance procedures? Yes. Yes, we can do observation. Like client's internal controls are getting performed. We are sitting and observing. Can we obtain evidence regarding substantive audit procedures? Yes. Observation we can do. So checking the accounts data and financial information correct or not, there also observation we can do. So observation will be useful for even performing substantive audit procedures. Then external confirmation. External confirmation. External confirmation, can you use it as risk assessment procedure? No, we can't use it. You can't get confirmation from a third party to understand about your entity's business. That we can't do. Can we get external confirmation regarding compliance procedures? No. Internal controls are something which are internal to the organization. So here also we can't do external confirmation. Can we do it as a substantive audit procedure? Yes, we can do it as a substantive audit procedures. Then next one, what we have? Recalculation. So can you do some recalculation and understand about the entity and its environment? No. Like some people will be there, no? So who will do numbers and all and tell you your background history, accounting and all. So that we can't do. We are not astrologer. So we are not experts in that. So that's why recalculation you can't do. So can you do that recalculation in the compliance procedures? Yes, to some extent. What is to some extent is, see, in case of internal controls, no, recalculation, reperformance conveys the same meaning. So how recalculation can be useful in performing internal controls testing is like if you take the bank case, bank is having an internal control system where automatically interest will be calculated and created to the customer's account. The interest which is getting created in your accounts is not a human calculated, it is a system calculated. I want to know whether that control is working effectively or not. So can I do recalculation check? Yes, you can do the recalculation. So recalculation to some extent for monetary internal controls, for arithmetic controls, you can do the recalculation. So can I do recalculation for substantive audit procedures? Yes, you can do it. Then reperformance. Can you do reperformance as a risk assessment procedure? Do the entire business once again and understand about the entity. Not possible, right? So reperformance, we can't do it in risk assessment procedures. Can we do it in compliance procedures? Yes, reperformance, we can do it. Can you do it in the substantive audit procedures? Yes, you can reconstruct the trial, you can from the trial balance, you can reconstruct the financial statements and you can match it all. So reperformance, you can do it. Then next one we have analytical procedures. Sir, can we perform risk assessment procedures as by analytical procedure? Yes, yes, we can do it. So by studying the relationship between financial and non-financial item, we can find out the risk of material misstatement. Gross profit last year, this year, we will compare. If there is a huge spike in the gross profit, there might be a risk of material misstatement, of overstatement of revenue, understatement of expenses. So I can perform analytical procedures here. Can I do analytical procedures in compliance procedures? Not possible. Not possible. We can't test the operating effectiveness. Controls are working effectively or not. Their analytical procedures might not be that suitable. Can I use it as a substantive audit procedure? Yes, you can use it as a substantive audit procedure. Then last one, what we are left with? Inquiry. So when it comes to inquiry, can I use it as a risk assessment procedure? Yes, you can inquire the people to get to know about understanding of entity environment and its internal control. Can I use it as a compliance procedure? Yes, to test the operating effectiveness of internal controls, you can do inquiry. Can I use it as a substantive audit procedure? Yes, you can do it. Understood? So at various places, these questions will be there. These are all not in one single chapter. In risk assessment, one portion will be there. What will be included in the risk assessment procedures that I have covered it here? 4 things: inspection, observation, analytical procedures, inquiry. And internal controls, what procedures you can perform? Inspection, observation, recalculation, reperformance. Both are same, but in the answer they will mention only reperformance. But their reperformance includes recalculation also. Whereas for substantive audit procedures, every method will become suitable. Understood? Comfortable, everybody? So these are all the various methods for obtaining audit evidence. Now we will try to proceed further with the next concept, assertions. We'll try to do something called assertion. So very frequently used term throughout this auditing concepts. The most important term is assertion. Sir, what do you mean by assertion? So if you look at it here, assertions means representations which are made by management. So representations means what? Representation means what? Conveying the information, simply if I have to put it. So whatever information which is conveyed by the management, either explicitly or otherwise. Otherwise means what? Implicitly, impliedly, either explicitly or impliedly. That are embodied, that are incorporated in the financial statements and which are used by the auditor to consider the different types of potential misstatements that may occur. So we'll come back to this part later, auditor's part later. First, we'll try to understand till here. So assertions refers to representations by the management that are embodied, that are incorporated in the financial statements. So what is it, sir? See, management, by preparing the financial statements, they show various line items. Like let us say, for example, they have shown fixed assets as some amount. Let us say fixed assets as 100 crore rupees they have shown. By showing this fixed assets as 100 crores, the management is making so many implied assertions. So much of information they are trying to convey. They're trying to convey that fixed assets worth 100 crores are in existence. Fixed assets worth 100 crores are in existence with the company as on the balance sheet date. That they will not explicitly say it. That is implied. Just by showing the fixed assets as 100 crores, they're impliedly trying to convey that those fixed assets were in existence with the company as on the balance sheet date. And they are also trying to make an assertion regarding completeness. So they are trying to convey that they have completely recorded for all the fixed assets, they did not miss out anything, then the value came to 100 crores. And they are also trying to make valuation assertion. They are impliedly trying to convey that we have valued the assets properly, we have done the proper valuation, then the correct value has come to 100 crores. Even they are trying to make a assertion regarding rights. They are trying to convey that we have the rights, we are the owners of these assets, that's why we are recording. All this will not be explicitly stated. These are implied and which are embodied in the financial statements, which are built into the financial statements. Similarly, if you take one liability, long-term borrowing 50 crores is there. Regarding that also, management is trying to impliedly make so many representations. They are trying to say that these liabilities are in existence as on the balance sheet date and they have completely recorded all the liabilities. They have valued these liabilities properly and even they have obligations towards this liabilities. For P&L items, we have various assertions. If you take revenue or any expense, we have various assertions here. Like here, they will say occurrence. So if they are saying revenue is 500 crores, they are trying to imply that 500 crores worth of revenue has occurred during the financial year. And also they are trying to make an implied assertion regarding completeness. They have completely recorded all the revenue transactions. And even for revenue, they are saying measurement. They are even trying to impliedly convey that they have measured that revenue properly. And thereafter, classifications. Many I can say here. They have properly classified this revenue and cut off. So then we have cut off that this whatever revenue, whatever they have recorded here, that belongs to current year only. So like that, depending on the items of the financial statements, management is trying to make various representations. All that representations, whether explicit or implied, we are going to call it as assertion. So like if you see it here, assertions about class of transactions. Means for P&L items, what will be the assertions? We have occurrence, completeness, accuracy, cutoff, classification. For balance sheet items, existence, rights and obligations, completeness, valuation and delegation. And even by showing the notes to accounts also, management will try to convey so much of information. So in the notes to accounts also, we will have, that is in the presentation and disclosure also, we have various assertions, occurrence and rights and obligations. If the disclosure is related to P&L item, they are making an occurrence assertion. If the disclosure is related to balance sheet item, they are making a rights and obligation assertion. Completeness anyhow is going to remain common. Classification and understandability. They should have classified all the disclosures. Presentation. Classification is mainly from the presentation point of view. Current, non-current classification of assets, liabilities and all. So by showing the balance sheet, they are impliedly conveying that we have classified correctly only. Impliedly they are trying to convey. And accuracy and valuation. If it is related to P&L item accuracy, if it is related to balance sheet item valuation. Understood? And coming to the other part of the definition of assertion, sir, assertion means representations made by the management. Actually, auditor uses these assertions only to identify the potential misstatements. Auditor will take the help of these assertions only to identify the material misstatement. If you are verifying fixed assets, what you will verify here? Whether fixed assets are really in existence or not, whether they have completely recorded all the fixed assets or not, they did the valuation properly or not, and your company is the owner of the assets or not. So simply whatever assertions management is trying to make regarding that only auditor is trying to obtain evidence. Clear? So this is what regarding assertion. Now, so thereafter we have this concept called audit trail. Sir, what is this audit trail? So why this concept of audit trail has come into picture is, as we have told, even one reporting requirement we have seen. 143 subsection 3 clause J, in that last point we have. The company should have used an accounting software which is having a feature of recording audit trail facility, and it should be operated throughout the year. It should not be tampered with, and even it should be preserved. Right. So now what exactly is this audit trail? Simply, if I have to put it, audit trail is nothing but a documented flow of transactions. What is it? Documented flow of transactions. Simply, how a source document, how a particular invoice or any source document has been converted into an accounting entry, and from there how it has flown to the balance sheet. So this entire data will be data backup will be there. That's what we are going to call it as audit trail facility. If I have to put it in very simple terms to make you understand, uh, put it this way. Have you ever placed an Amazon order? You would have done it definitely, right? So if you place the Amazon order, the moment you placed an order, the payment, whatever you have done, when it was shipped, and how many stages it has crossed, when it has reached the final delivery station, when it is out for delivery, and when it was delivered, and if you have put any return, when it was picked up, or if it is an exchange, when it was picked up and new order was done. That entire documented flow of transaction will be there, right? This is one example of audit trail. Nothing but from this audit trail, we can rebuild the entire transaction. Even though the entry was missing here, that Amazon did not record that entry. Even though Amazon did not record the entry, from the trace, we can build the entry once again. Yes or no? Why? Because everything is backed. Similarly, if you link this concept in the accounting way, so what is the audit trail in the area of accounting is, let us say today, if I'm passing it, if I purchased an entry, if I purchased an invoice, I got an invoice. That invoice has to go into my books of accounts. So now an accountant will pass an entry. So accountant will open accounting software and he will record an entry. Now that entry will get recorded. But in the back end, it should also record at which time that entry was passed, what is the employee ID who passed that entry, who approved that entry, at what time that entry has been passed, date and time. Let us say after a certain period of time, there was a mistake in that entry was amended. Now in the books, amended entry will be there. But in the audit trail, to that original entry, one more line item will get added. This was the original entry, and this amendment was happened on so and so date. In the books, you will find only amended entry, but if you go back to audit trail, you will find original entry, what changes are made. Let us say that entry was deleted at a later point of time. Now that entry will not be there in the books of account, but that audit trail will be there. So and so entry was recorded, so and so date it was amended, and so date it was deleted. Entry will not be there in the books of accounts, but this flow of data will be there. So this is what the whole concept of audit trail. Understood? So it is a documented flow of transaction. It is used to investigate how a source document was translated into an account entry, and it can be used as audit evidence to establish the authenticity, to know whether a transaction is genuine or not. We can track back to its audit trail. And audit trail helps in maintaining record of system and user activity also. Which user is accessing which system, which user has passed which entry. That user activity also will be monitored by way of audit trail facility. And all the things are repeated here. It is a step-by-step record by which accounting, trade details, or everything has been recorded. And audit trails acts as a record keepers that document the evidence, how the event has taken place, who has recorded that event, when that event has happened. So it will act as a record keeper, and it will also improve your internal control and data security. If you have a audit trail in place, it will improve your internal controls and it will have your data security also. By analyzing audit trail, you can specify the reason of the problem. Particularly, you can go to the root of the problem. And yes, this audit trail will have so many advantages, but it is not a easy task. It is a costly affair. So this audit trail will cost you in terms of money. You have to invest in software and all. But not just it will cost you in terms of money, it will cost you even in terms of time also. It will cost you even in terms of time also. Today, companies are buying the audit trail softwares. Today, by default, if you buy even Tally software also, it is coming with the audit trail facility. So, audit trail facility is there, but no one is spending the time to analyze that audit trail facility. Just having audit trail will not have any use. No, if you are able to analyze that audit trail, if you are able to spend some time and analyze the audit trail facility, then only it will give you fruitful results. So that's what they say here. Implementation of audit trail is a costly affair. The cost is not only in terms of financial terms, it is even in terms of monetary terms also. Next. Thereafter, sometimes we use the help of this one last part we will cover management expert, then we will go to the SA 230. This one last portion will complete from SA 500. Thereafter, some miscellaneous discussion is there that we'll skip and we'll go to SA 230. So sometimes you might be required to take the help of expert. While conducting audit, you might be required to take the help of expert. First of all, who is an expert? From the auditing perspective, who is an expert? No, from the auditing perspective, in the sense, my intention is when I say auditor is going and consulting an expert, who is an expert? Who is a person not who is having expertise in areas other than accounts and audit. As an auditor, the need might arise you to go and consult an expert in matters only which are other than accounts and audit. In area of accounts and audit also, you can't say I will go and consult an expert. People will laugh at you. You are only expert there. You are only the expert. So when I say auditor has to go and consult an expert, I'm referring to that expert who is having an expertise in areas other than accounts and audit, not in the areas of accounts and audit. In the area of accounts and audit, you are the expert. You should not say I will go and consult an expert. So, and these experts will be of two categories: management expert, auditors expert. Experts will be of two categories: management expert, auditors expert. Management expert refers to that expert whose services are used by the management in the process of preparation and presentation of the financial statements. This much you remember. Management expert refers to that expert whose services are used by management in the process of preparation and presentation of financial statements. Let us say, let me put you in a simple way, the management is required to prepare financial statements. They have to create a gratuity provision for the employees. They have to create a gratuity provision, but they don't know how to calculate gratuity provision. Why? Because so many assumptions are involved. So how many number of employees are there? How many will stay within 5 years? How many will leave? So all that assumptions will take into picture. So what management has done is they went to one actuary. Whom they have gone to? They have gone to an actuary. Actuary is a professional like us only. We are into accounts and audit. Actuary is basically a professional in statistics. So management went to an expert who is an actuary and they asked him, sir, please calculate the amount of gratuity provision. So that provision we will record it in the books of accounts. So now who has appointed that expert? Management. For what purpose they have got the services of the expert? For the preparation and presentation of the financial statements. That person we call it as management expert. Now there is someone called auditor's expert. Sir, who is auditor's expert? See, I'm an auditor. I'm conducting audit of the company. And in the client's books of accounts, there is one pending case which was shown as a contingent liability. I want to know whether it will really result into contingent liability or a provision has to be created. Now, what I have done is I know a lawyer as an auditor. I know a lawyer. I have gone to that lawyer, got his advice. Now he will become auditor's expert because the services of expert are used by auditor for obtaining sufficient and appropriate audit evidence. Clear? So expert means first of all a person who is having an expertise in areas other than accounts and audit. Management expert means if the services of the expert are used by the management for the preparation of financial statements. Auditor's expert if the services of the expert are used by the auditor in obtaining sufficient and appropriate audit evidence, that we call it as auditor's expert. Now, sometimes what will happen is, as an auditor, you might be required to you might be using the work of management expert. Sir, how come? You are conducting that, take that gratuity case only. You are conducting audit of that company. And while verifying the financial statements, I got to know a provision for gratuity. I asked the management, sir, how did you calculate this gratuity provision? Management gave me a report. Sir, we went to so and so actuary. That actuary gave us this report. In this report, he calculated the provision. That provision we have recorded. So management handed over that copy of that actuary report to me. Some 5-10 pages of the report is there that has handed over to me. Now I'm going through that report. So basically, by going through that report, but I'm checking that report, what management expert has told. So basically, what I'm doing here, I'm using the work of management expert. Understood? So sometimes as an auditor, as a part of your audit, you might be required to take you might be using the work of management expert. So now there is one small part here. When information is to be used as audit evidence has been prepared using the work of management expert. I'm referring to that gratuity report. Just imagine, I'm referring to that gratuity report. So I want to get the evidence, but for that evidence, I'm using the work of management expert. The nature, timing, and extent of audit procedures may be affected by. So when you are using the work of management expert, what nature, timing, and extent of audit procedures you have to perform, that will be influenced by what factors? It depends on nature and complexity of the matter. So the matter for which you are using the management expert's work, what is the nature of that matter? What is the complexity involved in it? The risk of material misstatement. If the risk is very high, you will perform more audit procedures. If the risk is less, you will perform less audit procedures. It also depends on availability of alternative sources of audit evidence. Is there any alternative source apart from this management expert? Is there any other way to get the evidence? Next, the nature, scope, and objectives of the management expert's work. What is the nature of the expert's work? What is the scope of the expert's work? What are the objectives of that management expert? And whether management expert is employed by the entity or is a party providing the services. Is that management expert? Is that actuary is also an employee of a company or is an outside consultant? Next, the extent to which the management can control or influence that actuary or management expert. And whether management expert is subject to technical performance standards, like the way we are doing audit as per auditing standards. Is the expert also subjected to some technical standards? That you will have to consider. Nature and extent of any controls. What kind of controls organization is having with regard to that management expert's work? Auditor's knowledge and experience of the management expert's field or expertise. As an auditor, do you have any experience in that field? And also the auditor's previous experience of the work of that expert. In the past, have you already worked with this expert? If yes, use your past experience as well. So in case if you are using the work of the management expert's work, what nature, timing, and extent of audit procedures you have to perform, that is going to depend on all these factors. Understood? Right. So with this, we'll wind up with say 500. So we'll go to the next standard, audit documentation, where we are going to cover SA 230. So SA 230 is the standard which is going to talk about audit documentation. Sir, what exactly is the meaning of the term audit documentation? Let us try to understand it. So what exactly is the meaning of audit documentation? Very simple here. In audit, whatever you have done, what audit procedures you have performed, what evidences you have gathered, what judgments you have made, what conclusions you have reached, everything should be recorded. Everything should be kept in a documented form. So that record of audit documentation is nothing but a record of audit procedures performed, audit evidence gathered, and audit conclusions which are reached. So that comprehensive record only we are going to call it as audit documentation. Sir, why audit documentation? Why do we need to have audit documentation? Very simple. It is your responsibility to do the audit as per standards on audit. Now you have done your audit, tomorrow your opinion has gone wrong. I told you that risk will always be there. So whenever you have done the audit, there is always a chance that the opinion of the auditor could go wrong. So you have done the audit and your opinion has gone wrong. Now I told you, you cannot blame auditor every time your opinion has gone wrong. Why? Because opinion can go wrong even because of auditor's negligence also, or even opinion can go wrong because of inherent limitations also. Possible or not? But whatever it is, if it was known that auditor's opinion has gone wrong, definitely regulatory authorities are going to call you, sir, you have done the audit, but you are unable to find out this so and so fraud and all. So why you are unable to find it out? So now the court will decide whether you should be punished or not. And whether you will be punished or not, that depends on whether your opinion has gone wrong because of inherent limitations or because of your negligence. That who has to prove? Auditor himself has to. How he will prove? Go and swear. Sir, I swear on your mummy, I have done the audit correctly only. No, he will not believe, right? So we have to show some proof. That is where the audit documentation will come into picture. So audit documentation is the source. One of the main objective of maintaining audit documentation is it will provide a sufficient and appropriate record of the basis for the auditor's report. On what basis you have given the auditor's report? If tomorrow someone is coming and asking me, this audit documentation will serve as a record for me. And also it will act as a evidence that audit was planned and performed in accordance with standards on audit. If tomorrow someone is coming and asking you, what is the guarantee you have done the audit as per standards on audit? Why I have to believe that you have done the audit as per laws and regulations? Then throw that audit documentation on their face and ask them, see, I have done everything. So like that, it will act as a evidence. The main objective is it will act as a sufficient and appropriate record for the basis of the auditor's report, and also it will act as a evidence that audit was planned and performed in accordance with the standards on audit. And then we have purpose, nature of audit documentation. Once again, this is the same things only. So purpose of audit documentation. Sir, main purpose is it will act as a evidence. Apart from that, what other purposes it will serve? So apart from the main purpose, it will also serve various other purposes. So apart from the so crazy things happen. So purpose of audit documentation. The following are the purposes of audit documentation. So apart from the main purpose, what other purposes it will service? It will assist the engagement team to plan and perform the audit. It will help the engagement team members. If you have a documentation, it will help your engagement team members to plan and perform the audit. And also it will assist the members of the engagement team to direct and supervise the audit work. So it will act as instructions for them. It will act as a supervision for them. And it will be accountable. It will make them accountable for their work. Why? Because in the audit documentation, we are recording who did the work, which work was allocated to which person. Tomorrow, if something has gone wrong in one area, you can pinpoint the person. You can't say, no, sir, I did not do it, sir. You did not do it. In the documentation, it is clearly visible that the work was assigned to you only. So it makes them accountable for their work. Retaining a record of matters of continuing significance for future audits. If you maintain audit documentation, that will help you for your future audits also. And it will also enable quality control reviews and inspection. Soon we are going to discuss SQC1. There we will talk about quality controls. So whether you have maintained the quality in your audits or not, you have to review. If documentation is there, you will review. If documentation is not there, how you will review? You have to buy a time machine and go back in the past. Not possible. So that's why if you have documentation, then only you can do the reviews, either quality control reviews, inspections, internal reviews, external reviews, whatever it is. Whether you have done the audit properly or not, if someone has to do a review, if documentation is there, review is possible. If the documentation is not there, review is not at all possible. So that is what the next point. So fifth point talks about internal inspections. Sixth point will talk about external inspection. Sometimes we might be subjected to external inspection like peer review. ICA will ask us to undergo peer review, where another firm of chartered accountants will come to a firm of chartered accountant and check whether they have done the audit properly or not. So those kind of peer review inspection also, if at all, they have to happen. If documentation is there, review will happen. If there is no documentation, there is no purpose of review only. Next. Sir, what will be included in the audit documentation? Everything here. Simply, if I have to put it, everything. Your audit plans, audit programs, analysis, issue memorandum, summaries of significant matters, letters of communication, checklist, whatever communication you had, everything will form part of your audit documentation. Then, form and content of the audit documentation. So, sir, what should be the format of audit documentation, or what should be the manner of audit documentation? Is there any specific format for maintaining audit documentation? Do you think SA 230 has given you any specific format for maintaining audit documentation? The answer is absolutely no. But instead, what they have told is you maintain the documentation in such a manner that some other experienced auditor, even though he's not having any previous connection with this audit, some other auditor, even though he's not having any previous connection with this audit, But by going through your audit documentation, he should be able to understand what procedures you have performed, what evidences you have gathered, what judgments you have made, and what conclusions you have reached. You maintain documentation in such a manner that some other experienced auditor, even though he's not having a previous connection with this audit, but still if he goes through your documentation, he should be able to understand what nature, timing, and extent of audit procedures you have performed, and what are the results of that audit procedures you have performed, and what evidence you have obtained, what significant matters you have come across, and what conclusions you have reached. Just by going through your audit documentation, some other experienced auditor should be able to understand it. So simply, if I have to put it, they're saying you use your professional judgment. That's what ultimately they are trying to say. So we are not telling you any specific format. Use your professional judgment and maintain the documentation properly. And why you are documenting? See, I told you that when you should document nature, timing, and extent of audit procedures, right? When you are documenting what and all nature, timing, and extent of audit procedures you have performed, you should specifically include these things in the documentation. What things with regard to nature, timing, and extent of audit procedures? You will document all your procedures, what audit procedures you have performed. So when you are documenting nature, timing, and extent of audit procedures, you should particularly record the identifying characteristics of specific items or matters tested. What are the characteristics? Like for example, you are recording what audit procedures you have performed in the area of purchases. Explain the characteristics of purchases in that client. So what kind of purchases they will make? Is there any specific risk for this kind of purchases? So you have to document the identifying characteristics of that specific item. And who performed the audit work? Not just recording procedures will be enough. Who performed that audit procedure? In your engagement team, who is that concerned person who performed that audit procedures and when that work was completed? And this work will be reviewed by someone. Should work be reviewed? Yes. Never ever trust your article assistants. So it might sound rude to you, but tomorrow when you become a chartered accountant, you will also accept it. Okay. So never ever we should trust. Why? Because if tomorrow something goes wrong, no one in your engagement team will be blamed. I told you, when it comes to accountability before regulatory authorities, engagement partner will be held responsible. Don't ever believe blind, even if it is your own staff. So someone has to review the work of the engagement team. So you should also document who reviewed the audit work and date and extent of such review. You have to document nature, timing, and extent of audit procedures. No doubt about it. But when you are documenting nature, timing, and extent of audit procedures, particularly you have to record the identifying characteristics of that specific item, who performed the work and what is the date when such work was completed, who reviewed the work and the date and extent of such review. These things are compulsorily required to be documented regarding nature, timing, and extent of audit procedures. Important point, please do mark it. Next. The form, content, and extent of documentation depends on the following factors. Mainly, it talks about extent of documentation. Whether your documentation will be bigger or you will have a small documentation, that is going to depend on multiple factors. Sir, what are that factors? Number one, size and complexity of the client. If the size of the entity is large, extent of documentation also will be large. If the entity's operations are very complex, definitely documentation is also going to be bulky there. Nature of audit procedures. It depends on different audit procedures. If you do inspection, you will have more documentation. If you do observation, you might not have that much documentation. If you only do inquiries, you might not have that much documentation. If you perform reperformance, there will be much of documentation. So it depends on the nature of audit procedures you are performing. It also depends on risk of material misstatement. If you find risk of material misstatement to be very high, you would have performed more audit procedures. When you perform more audit procedures, the documentation also will automatically get increased. It also depends on significance of the audit evidence, materiality of the audit evidences. If the evidences are more material, more documentation. Not that material, less documentation. It depends on nature and extent of exceptions identified. Exceptions means unusual items. If you are identifying more unusual items, more documentation. Less unusual items, less documentation. The need to document a conclusion or the basis for conclusion, which is not readily determinable from the documentation of work performed. Sometimes it will not be enough if you document the conclusion. How you have arrived at that conclusion, that base is also required to be documented in a few standards. We'll see in a few standards where I will tell you one simple case. In SA 315, they say one point. In every organization, you should go with the presumption that revenue always carries a higher risk. In every organization, as per SA 315, revenue should carry a higher amount of risk of material. You should go with the presumption that revenue area carries high risk of material misstatement. But in case, because of some reason, you are conducting audit of some client, you are rebutting that assumption. That means you are not going with that assumption. You are feeling that risk of material misstatement is low for revenue in this particular client. You have to document the reason why you have taken that decision. That's what this point. Sometimes it is documenting the conclusion alone will not be enough. There might be a need to document even basis for that conclusion also. So in that cases, documentation will get increased. And also audit methodology depends on what kind of audit methodology you are using. So all these factors will determine form, nature, form, content, and extent of the audit documentation. And this audit documentation should be prepared in a timely manner. So I will tell you two options. If you are an auditor, auditor one, what he's doing is first he's doing all the work, thereafter he's collecting documentation. Second auditor, as and when he is doing the work, simultaneously he is maintaining documentation. Which documentation will be effective? Exactly. Second one will be effective. The documentation which is gathered along with the work which has been performed, that is going to be more effective than the documentation which is gathered after the work has been performed. Simple. Next. Audit file. Now, sir, what is this audit file? Audit file or work papers, working papers also we call it. Audit file, audit documentation, both are one and the same. If you ask, audit file is just another name for audit documentation, but there is a slight difference. What is the difference? See, audit documentation is something which is in its very raw form. Like for example, we 10 people have gone for audit. Everyone will do a portion of the work. So I will have documentation relating to my work. You will have documentation related to your work. Some other person of the engagement team, he might have handled some other area. He will have the documentation regarding the portion which was allocated to him. So this is raw format. Now what we should do is, once the audit has been completed, once we have signed our audit report, we all should sit together. It is in a very clumsy form. Till now, documentation is in a very raw form. So you have some part of documentation, some other person is having some part of documentation. Somehow using all that documentation, we completed the audit. We gave the report. Now, if it has to be useful in the future, in this raw form, it will not be useful. You will not be able to trace it in the future. Now, after we have completed, we all engagement team members should sit together. We should collate all our documentation, arrange in a proper order, delete the duplicate documents, give the page numbers, keep it in the respective folders. This process we should do it or not? This process we call it as assembly of the final audit file. What do we call it? Assembly of the final audit file. Where after the completion of the engagement, all the engagement team members will sit together, collect the entire raw documentation, sort it, arrange it, and delete the duplicate documents, give the page numbers, signing if it is necessary, that initials and all they will keep, and they will make that final audit file which is ready so that it becomes accessible in the future. This process we call it as what? Assembly of the final audit file. And that finally sorted file you will get now, which is arranged in proper folders and all, that we call it as audit file. And when this assembly will happen? During the audit or after completion of audit? After completion of audit, after the date of auditor's report, you will do that assembly process. Sir, but just now you told documentation gathered after completing audit is not effective. Where I told we are gathering, no. All this documentation has already been gathered. But after what we are doing, we are only assembling. We are not gathering new evidences. We are only assembling. And this assembly process, should there be a time limit or not? If there is no time limit, what will happen? Nothing will happen. This year audit will over, next year audit also will get over, but last year's file itself will not be ready. So there should be time limit. And what is the time limit? 60 days from the date of the auditor's report. In how many days? Within 60 days from the date of auditor's report, you have to prepare that audit file. You have to prepare it. And while preparing this audit file, will we perform any new audit procedures? No. Will we obtain any new evidences? No. Will we reach any new conclusions? No. We will only do administrative work. What work we will do? We will only do administrative work. So what kind of administrative work we will do? Deleting or discarding superseded documents, and sorting, collating, and cross-referencing the working papers, signing off on completion checklist relating to file assembly process, that signing of the checklist and all, documenting audit evidence that the auditor has obtained, discussed, and agreed with the relevant members of the engagement team. That means whatever discussion you had, that also you will put it on the paper. That alone we will do. So in that assembly process, we will not perform new audit procedures, we will not gather new evidences, we will not reach any new conclusions, only administrative changes we will do. So once audit file is ready, what you should do? Throw it in the dustbin. Is it so? No, you should not do it. But today no one is maintaining physical files. They are maintaining everything in the servers, they are keeping it. So what you should do, once a final audit file is ready, we have to retain it. How long? 7 years. 7 years from which date? From the date of client's audit report or your client group's audit report, whichever is later. either from the date of your audit report, your client's audit report, or if your client is forming part of a bigger group, that group's audit report will be there. Whichever is later from that date up to 7 years, you have to retain that audit documentation. That audit file has to be retained. But today, because of the digital things and all, this that is going on for life. So that will stay in that folder forever. For every year, everybody is keeping the folder. That will remain there in that folder for 10 years, 15 years, 20 years, whatever it is. And one advice to you, tomorrow by any chance if you are coming into practice and all, please don't show your misery when it comes to documentation. Place that documentation in the cloud. Get some subscription, get the cloud, and store your data, store your documentation on some cloud platform. Don't rely on your hard disk and all. I will store all the data in my computer, sir. I will keep one pen drive also, sir. In that, I will keep a backup. All that will not work. Technology has improved a lot. Don't show your misery. So buy some cloud, and in the cloud, you keep that audit documentation always. Okay, right. Yeah. Sir, this audit documentation is whose property? This audit file is whose property? Auditor's property. Sir, client's data, no, sir. Yes, it is client's data only. But who gathered it? Auditor. Who sorted it? Auditor. Who put all the efforts? Auditor. So audit documentation is auditor's property. If the client is coming to the auditor and asking them to share the copies of the documentation or give an extract of documentation, are you under an obligation to share that documentation with your client? Not under an obligation. The standard says it is at your discretion. It is at your discretion. It is at your own choice. If you want to share the copies of the documentation, share it. If you don't want to share, don't share it. Client cannot force you. So that is purely your property. If the law or regulation is asking, you have to share. If the law or regulation is asking, then you have to share it. But in all other circumstances, audit documentation is your property. And one more question for you. See, sometimes there will be principal auditor, branch auditor, right? Head office for the entire company auditor will be there, branch auditor will be there. Branch auditor for branch audit, whatever he has done, he will have branch audit documentation. For that particular branch, whatever audit he has done, there will be branch audit related documentation will be there. Can the principal auditor demand the working papers of the branch auditor? In case if he is asking, do you think branch auditor is under an obligation to share the copies of audit documentation with the principal auditor? No, no. Here also it is up to branch auditor's discretion. The branch auditor's property it is. It is exclusive his property. That's all. They are telling it is your property, your property. Your property means it's up to your choice. If you want, you will share. If you don't want, you will not share. Even the branch auditor is also not under any obligation to share the copies of the documentation with principal auditor, not even with the client. Unless there is a regulatory requirement, then there will be mandatory, or else it will not be mandatory for you. Then significant matters. In your audit documentation, you should include significant matters. So you are telling significant matter, significant matter. What is a matter? When we can call a matter as a significant matter? Professional judgment. What is it? Professional judgment. So your audit documentation should include significant matters. Sir, but how to decide which matter is significant, which matter is not significant? Don't decide. You yourself, no one will decide for you. You yourself have to decide. You use your professional judgment and you have to decide it. Or at least can we give you some examples, sir? Yes, we have a few examples. So what are the examples of that significant matters? If you see it here, number one, matters that give rise to significant risk. If you find certain matter in the organization which is giving to a very bigger risk, significant risk, that matter will be a significant matter, including your documentation. Or you performed audit procedures. By performing the audit procedures, the results indicate that the financial statements could be materially misstated. You performed audit procedures, but those audit procedures are indicating that there could be a material misstatement. Will that be a significant matter or not? Yes. Or there is a need to revise the auditor's previous assessment of risk of material misstatement. Or your audit procedures indicating that whatever risk you have identified, that you need to reassess it. You might thought risk as low, but by performing audit procedures, you realize that the risk is high. Is that also a significant matter or not? Yes. And circumstances that cause auditors significant difficulty. If some circumstances are creating a difficulty in conducting the audit, that is also an example of significant matter. Or findings that could result in a modification. You performed audit procedures, you have some finding, because of that you are required to give a modified opinion. Or you are required to highlight it in a emphasis of matter paragraph. Those also can be considered as significant matter. These are only illustrative examples, not an exhaustive list. Just a few examples of significant matters that must be included in the documentation. Next. Then, what is it? So this is regarding, there are some circumstances. So this is also one more example. So this also I will try to explain it. So examples of circumstances in which it is appropriate to prepare audit documentation relating to use of professional judgment. See, as I have told, throughout the audit, we are going to make use of professional judgment. So there are some circumstances where you are required to document your use of professional judgment also. In which manner you have used a professional judgment, in which area you have used a professional judgment, how you have arrived at that professional judgment, those also you are required to document. So some examples they have told it here, some of the examples of the circumstances in which it will be appropriate for the auditor to document even the use of professional judgment. So what are they? Number one, the rationale for the auditor's conclusion. When a requirement provides that auditor shall consider certain information or factors and the consideration significant in the context of the particular engagement. Nothing but sometimes you might be required to take a basis, rationale. On what basis you have taken a conclusion. Because that is considered significant. You are making a significant conclusion here. You are arriving at a conclusion that this misstatement is pervasive. Depending on that, you are giving opinion. Now, you might be required to document on what basis, on what rationale you have decided it as a pervasive misstatement. Maybe it is not restricted to single item. It is spread across multiple items. That's why you are arriving at a conclusion. So, like that, if you are making some conclusion which is very significant in the financial statements, the rationale, the logic for that conclusion, you might have to document. Then, the basis for auditor's conclusion for reasonableness of areas of subjective judgments. So, like for example, as I've already told you this point, the management while preparing financial statements, they make various subjective judgments, like creating a provision for doubtful debts, estimated useful life. So those areas also, in that areas, how you have determined that whatever judgments made by the management is reasonable. On what basis you have decided it? That basis of the professional judgment also you might document. These are all once again examples only. Next, the basis for auditor's conclusion about authenticity of the document. When further investigation is undertaken in response to conditions identified during the audit that cause the auditor to believe that document may not be authentic. Initially, you felt that document is not genuine, but during the course of the audit, somehow you are convinced that that document is genuine. What caused you to change that opinion? Initially, you felt document is not authentic, but now during the course of the audit, you felt it as authentic. So, what made you believe? How you have used your professional judgment to determine that it is authentic? Clear? So three examples where it might be appropriate for the auditor to document his professional judgment. These are only examples. Number one, the rationale for the conclusion where the conclusion is significant for the audit. And the auditor's judgments regarding reasonableness of the subjective judgments. Third one, the basis for auditor's conclusion regarding authenticity of the document, where the initial investigation found that it is not authentic. That's it. Then we have something called audit completion memorandum or audit documentation summary. Sir, what is it? This is one more extract of your audit documentation only. See, if you look at some big clients and all, especially listed companies and all, and when big four entities are doing the audit now, see, everybody says big four, big four, big four and all. And often I get, after the students are qualified, many students will text me or call me asking me for, sir, if you have any known contacts in the big four and all, you want to get into articleship. I'm telling you, literally, I'm telling you, I have used all the sources till now. I've been into teaching from a very long period of time, right? So every year, I have used all my contacts here by now. Every person working in the big four entity, I have touched them. I have send them the referrals for articles and all. Now once again, if I'm sending now I have reached at that a point. Now if I start sending this resumes and all, they are scolding me. So how many people you will suggest me and all? So but whatever, sir, why that much craze is for big four and all? So what is this is? There is nothing different here. Audit is a universal subject. Audit is universal. Country to country accounting will change. Country to country accounting will change depending upon its views, depending upon its risk pervasiveness and all. So they will accounting will change, but country to country audit will remain same across the world. The auditing is going to remain constant. Wherever you are doing the audit, everywhere we are doing independent examination of financial information only. Nothing is going to change there. So audit is a universal subject. Now, what differentiates this big four entity is whatever in mid-sized audit firm or a small-sized audit firm, everybody if you do the audit, 7 methods only we have. Nothing new method you can't create. Everywhere the person doing the audit, we have the same 7 methods only. But what differentiates this big four firms from the other firms is documentation. Documentation. For everything, they have a documentation. I have looked at a few files where I have seen a documentation of one listed company has gone for 3,000 pages. 3,000 pages of documentation. For everything, they will have a documentation. And they have built softwares for documentation. What they have done? They have built softwares. Big Fours, they have their own in-house softwares only for the purpose of documentation. So that's what differentiates the Big Four entities from other entities. So when these big four entities are doing this large audits and all, as I've told, 2000, 3000, 1000 plus of pages of the documentation will be there. But not everything from that documentation is significant. Not everything will have relevance in the future. See, one of the purpose of the audit documentation is to use it even for our future engagements also. But I have that documentation where 2000 pages of documentation is there for one client. Tomorrow in the future, if I want to come and refer back to some important point, I will get lost in the details. So what I will do for big audits and all, from the large documentation, I will take the significant matters and prepare one summary. There will be large documentation. In addition to that, from that large documentation, I will take significant matters and prepare one summary for that. So that only we call it as completion memorandum or audit documentation summary, which will do it in the large audits. In small audits, it is not a requirement, because in small audits, documentation itself is limited. From that limited documentation, you need not once again prepare a summary. But for large audits, this need will arise. Understood? So that's what I try to say it here. The auditor may consider it helpful to prepare and retain as a part of audit documentation a summary that describes significant matters identified during the audit and how they were addressed. So from your entire audit, not the entire documentation, from out of this entire audit, some significant matters you will take and how you have addressed them, that you have to document it. Such a summary will facilitate an efficient and effective review and inspection. If tomorrow any review or inspection also should happen, instead of giving them the full copy of documentation, you can share them a summary also. Then, further, the preparation of such a summary, it will assist the auditor's consideration of significant matters and whether there is any, it will also help the auditor to consider whether there is any relevant essay objective that the auditor cannot achieve by preparing the summary. Once you are done with your entire documentation, when you are preparing summary, you will reassess once whether I have met each and every objective of the standard or not. While preparing summary, if you felt that no certain objective standard has not been met, now you will try to compensate for that, either by performing alternative procedures or taking reasonable steps for non-compliance, whatever it is, that will help you to fulfill the objective of each and every standard also. That's it. So this is what regarding audit documentation. So now what we will try to do is, we'll try to go through audit strategy, planning and program. One small chapter we have, even though it is small, but these days they are asking a lot of questions. That chapter is not actually suitable for revision, because that chapter is full of point-wise questions only. What are the advantages of audit planning? What are the advantages of audit strategy? So like that, usual very point-wise questions will be there. But I am telling you, don't leave that chapter. They are asking 8 marks from such a small chapter. Minimum 8 marks they are testing. MCQs at least 1 or 2 I am getting, and 2 descriptive questions also I am able to see. 2 descriptive questions from that small chapter or strategy, planning and program. But no much concept will be there. Still, we'll try to quickly go through. Just at least we'll have a glance once. So let us have a look into this audit strategy, audit planning, and audit program. See, as I have told you yesterday itself, for even small activities at our personal level itself, we are doing a lot of planning. When we are doing the audit and when we are taking up this much responsibility by way of expressing the opinion and forming the basis for people's decisions, definitely we need to spend the time in our planning also. In audit also, we have to do the planning. And this audit planning involves 3 stages. When it comes to audit planning, we do it in 3 phases. Planning all will do it in at one time only, but that planning involves 3 phases. Planning is a process. The process of developing that planning plan and all, we call it as planning, audit planning we call it. And this will happen in 3 phases. First one is establishment of overall audit strategy. What is it? Establishment of overall audit strategy. Sir, what you will decide in the overall audit strategy? Simply, if I have to put it, overall overall structure in the sense, if we have to be very specific from the practical point of view, how many resources you want for doing the audit, within what time you want to complete the audit. This is what mainly this thing will be decided. So your objective and all you will write down, like your objective is to obtain reasonable assurance and all, and you have to concentrate only on material statements. All these objectives and all you will write, but ultimately one thing which we will decide in the audit strategy is within what time you have to complete the audit, with how many resources you have to complete the audit. What should be your engagement team? What should be your tentative date for completion of audit? Then, so in the audit strategy, we have decided the timing and resources. Now we will develop on the basis of this overall audit strategy. We will build a document called audit plan. So now what we will do in the audit plan? whatever resources, whatever timing that we have decided in the strategy, that has to be diverted among so many actions. Audit involves so many activities. We have to perform risk assessment, we have to perform compliance, we have to perform substantive, and in the financial statements, different items will be there: assets, liabilities, incomes, expenses. In very bigger entities, even within that also you have to go and check the breakup, like PPE, intangible assets, and all. So multiple areas we have to cover. And you have this one. Let us say you have 10 resources, you have 15 days of time. Now, which resource should take up which area and how much time he has to spend in each area? That work allocation document I have to prepare. Simply, if I have to put it, work allocation, work and time allocation. That document which divides the work among audit engagement team and that divides the time among audit engagement team. That document I'm going to call it as audit plan. Planning is a process. As I've told, planning is this entire process of developing this strategy plan and program. Whereas audit plan is a document which will allocate the time and resources among the different tasks which are at hand. Okay, audit plan also we have developed. Then what's the next one? Audit program. So what will be there in the audit program? Audit program is nothing but a breakdown of audit plan. Nothing but a. Where is the other mic? What is audit program? Audit program is nothing but a breakdown of the audit plan once again. Let us say in the audit plan, you have allocated the area of purchases for performing substantive audit procedures to a person called Mr. A from your engagement team. And you have given him 2 days of time. Now, within that 2 days of the time, what that person is required to do? So how much sample he has to take, what technique he has to follow, what method he has to follow, what should be appropriate sample size, whether he should rely on the controls or not, what specific areas you have to verify. The detailed instructions I will prepare in one document called audit program, which contains instructions, audit methodologies and techniques which you have to use for the purpose of achieving that objective in that specific area. So that document we are going to call it as audit program, which will be the most detailed version. So like that, planning process involves the 3 phases: audit strategy, audit plan, and audit program. Now, see, first step is establishment of audit strategy, where we are mainly going to decide on what is the time within which we are required to complete the audit, with how many resources we have to complete the audit. When we will do it, after performing risk assessment procedures or before performing risk assessment procedures. Okay, let me put it this way. Will overall audit strategy will come first or risk assessment procedures will come first? First risk assessment procedures. Why? Because just like that we will not decide, like we'll not take the chits and all and say we'll do the audit within 10 days with this many people, like some random decision we will not take. So first fix it here someone. So we have to disturbance also, you know. Yeah, so we'll continue now. So, as I was asking, between risk assessment procedures and establishment of overall audit strategy, which one is going to be the first? Risk assessment procedures. So, we'll not just randomly decide we will need these many resources or we'll need this much time. First, we will understand about the entity, we'll understand about its environment, we'll understand about its internal control. Then, we will take a decision whether to, in what time we have to, in what time we are supposed to complete the engagement with how many resources you want. So, first, risk assessment procedures, then only establishment of overall audit strategy. So having said that, let us have a quick look at the questions now. Right. So first, this point, what are the elements of planning? So when you are doing the planning and all things will get included. So planning activities. So when I say planning, I'm referring to the entire process. So planning includes performing something called preliminary engagement activities. I took this name even earlier. So first we will perform the preliminary engagement activities. Then we will establish the overall audit strategy. Thereafter, we will develop an audit plan. Sir, you are saying even before we establish the audit strategy, we'll perform something called preliminary engagement activities. So, what exactly are the preliminary engagement activities? We'll try to understand that in a detailed manner. So, what exactly are the preliminary engagement activities? activities. Why? Because after preliminary engagement activities, then audit strategy will come into picture. So what are preliminary engagement activities? There are a few steps involved here. Number one, we need to perform procedures regarding acceptance or continuation of a client relationship. We need to perform procedures regarding acceptance and continuation of client relationship. That is the first preliminary engagement activity. Then we have to evaluate compliance with ethical requirements, including independence. Then third one comes establishing an understanding of the terms of the engagement. Very simple points here. Three preliminary engagement activities. Number one, performing procedures regarding acceptance and continuation of the client relationship. Number two, we need to check whether we will be able to comply with the independence requirements or not, including ethical requirements. Number three, establishing an understanding of terms of engagement, nothing but drafting of engagement letter. Okay. So third point we know. So before even we start doing the audit only, we draft that letter of engagement, we get it signed. So that anyhow is self-explanatory. Third preliminary engagement activity. Let us try to understand the first and second. So what is the first one? Whenever a client approaches you, before you accept or continue the client relationship, before you say yes to that client relationship, what are the factors you are required to evaluate? What are the factors you are required to evaluate? See, before that, in some cases you are required to take a decision regarding accepting a client relationship. In some cases you are required to take a decision regarding continuing the client relationship. So when we have to take a decision regarding accepting a client relationship, they say that when a new client, altogether some new client, you did not work with him in the past. When a new client is coming to you and asking you to do an engagement, we are required to take a decision regarding accepting that engagement. Existing client, sometimes existing clients, the clients with whom we regularly work with, that existing client is asking you to do some engagement. But that existing client also might come up with a new engagement. That existing client might come up with a new engagement. So let us say last year, 24-25, I did the audit, company audit for the client X Limited. Now for the year 25-26, the same client X Limited is approaching me, but not for doing company audit, but he's asking me to do the tax audit. Existing client only, but he's coming to me with a new engagement. Here also I have to take a decision whether to accept that. On the other hand, existing client is coming up with an existing engagement only. Last year I did a company audit for the client. For the current year, the same client is coming to me and he's asking me to do once again company audit. So now I have to take a decision. In case of existing client asking me to do existing engagement, I will take a decision regarding continuing the client relationship. So whatever it is, whether you are taking a decision regarding accepting the client relationship or whether you are taking a decision regarding continuing the client relationship, what factors you have to consider? What things you have to consider before you say yes to a client relationship? So three factors they will say, not three, four they will try to say indirectly. Number one, you have to check integrity of the principal owners and key management. Whatever client who is approaching you, asking you to do the engagement for them, what is the integrity? Whether the top level management of the client or the directors of the client are the persons of integrity? Are they honest people? Are they dishonest people? So definitely that we have to check. If the client who is approaching us are honest people, we will be ready to accept. If the client is like a Kingfisher company where the owner is like Vijay Mallya, we will try to stay away. So like we have to check the integrity first factor. Then competence of the engagement team. Whether you are competent enough. If a client is coming to you and asking you to do some engagement for them, are you competent enough? Do you have enough of skill? Do you have enough of experience? Do you have enough of time? Can you afford that much time? Can you afford that many resources for completing the audit? Check it well in advance. Out of excitement, don't say yes. Check whether are you capable enough to complete that engagement or not. Then implications of the matters that have arisen during the current and previous audit engagement. This will happen in the case of existing clients. When the existing client is coming to you and asking you to do the engagement for them, you are required to consider any significant matters that have arisen during the previous engagements. Last year you did the company audit. Last year he harassed me a lot. He did not give me complete information. Whenever I asked him for information, he came to beat me. Somehow I completed the last year audit. After the year gets over, the same client is coming to me with an innocent face and is asking me, sir, please accept the audit for the next year also. Will you accept it? No, I will not accept it. So like that, significant matters that might have arisen during the previous engagements, that also you are required to do. And one more important thing which you are required to do is before accepting or continuing client relationship, you have to communicate with the previous auditor. You have to communicate with previous auditor. It is one of the requirements of the professional ethics. Under Chartered Accountants Act, they have put this responsibility. In case if you are accepting a position as an auditor, where the previous position was held by another chartered accountant, first you must communicate with him in writing and get something called a no objection certificate. Does he have any objections on me for accepting the engagement? Like that, you have to get one communication from the previous auditor. That is also forming part of one of the acceptance procedures. So whatever it is, this is the first. So before accepting the audit, you will perform these procedures. This is one of the preliminary engagement activity. Then evaluating the compliance with ethical requirements. Even you have to evaluate if I accept or continue the client relationship, will I be able to comply with the ethical requirements? We have 5 fundamental principles: integrity, objectivity, confidentiality, professional competence, due care, professional behavior. If I say yes to the client relationship, if I accept or continue the client relationship, am I in a position to comply with all that 5 fundamental principles, or are they in danger, or there is any threat? That you have to evaluate. And not just that, even will you be in a position to comply with your independence requirements, independence of mind, independence of appearance? Are there, or are you able to comply with that independence requirements or not? That also you are required to check it. So that is also one more preliminary engagement activity. So auditor should continuously evaluate compliance with ethical requirements. And also independence. What is the meaning of independence and all we have already covered. And throughout the audit engagement partner shall remain alert through observation and making inquiries as necessary for evidence of any non-compliance with ethical requirements. Not just at the beginning, throughout the audit, the engagement partner should remain alert. Is there any risk of non-compliance with the ethical requirements? And if matters comes to engagement partner's attention that indicate that members of the engagement team have not complied with ethical requirements, the engagement partner, in consultation with other firms, shall determine appropriate action. What will be appropriate action? Remove that engagement team member. That's what mostly they will do. If anybody is not complying with ethical requirements, they will take appropriate action. What appropriate action? Remove them from the engagement team. First warning, remove from the engagement team. Second warning, once again, give one more chance. Third time, no warning, remove him from the firm. Remove him from the firm. So that is what the appropriate action which will be taken. Next, the engagement partner should form a conclusion on compliance with independence requirements, especially whether will you be able to comply with independence or not. You have to form a conclusion. In doing so, the engagement partner shall. This point is also, this paragraph is also important. So, as an auditor, as an engagement partner, it is your responsibility to make sure that your engagement team is complying with independence. How you will get to know? For doing this, how you will form that conclusion? So, in doing so, what engagement partner shall do? Number one, obtain relevant information from the firm to identify and evaluate circumstances and relationships that create to independence. Definitely have to speak with the different people in the firm, identify whether there are any instances which create a threat to independence. Like we have seen 5 threats: self-interest, self-review, advocacy, familiarity. We have seen hell of examples. So whether any of that examples are present, get the information, identify whether there is any threat to independence, and evaluate information on identified breaches, if any, of firm's independence policies and procedures, or to determine whether they create any threat to independence for audit engagement. So similarly, if any breach of independence has happened, evaluate that critically. Then take appropriate action, either to eliminate that threats or reduce them to an acceptably low level. If you are unable to even reduce it to an acceptably low level, don't accept the engagement only. If you have already accepted the engagement, withdraw from the engagement. Long ago we have covered it. Understood? So this paragraph specifically, they have asked a question in one of the previous attempts. As an engagement partner, you should evaluate that the firm complies with independence requirements. How he shall do it? 3 simple steps. Obtain all the information, find out any threats to independence. Obtain information regarding identified breaches. And finally, try to reduce the threat to an, try to eliminate it or reduce it to an acceptably low level. If you are unable to do it, withdraw from the engagement or don't take up that engagement. Then this 3 point, as I have told, it is anyhow going to be self-explanatory. As an auditor, you should establish an understanding of the terms of the engagement. And that understanding, we are going to get it in the form of an engagement letter. You sign it, you prepare it, you sign it, give it to the client, get it also signed from the. So these are the 3 preliminary engagement activities. Something which will happen even before we start doing the audit. So what are the 3? Performing the procedures regarding acceptance and continuation of client relationship, and evaluating the compliance with the ethical requirements, including independence, establishing the terms of the engagement. Now, from these procedures, from these preliminary engagement activities, also I will get some information or not. In the process of performing preliminary engagement activities, I will get to know about the client or not. Can I use that information also for establishing overall audit strategy? Yes. Yes. So by doing this preliminary engagement activities, also like one simple example, if I have to tell you, you are checking the integrity. So by before accepting the audit, you are checking for integrity. So if you got to know that management are very honest people, they are best in the industry, definitely this is one of the factors which you will consider in establishing audit strategy or not. Yes. So by performing preliminary engagement activities, you are going to get some information. Even you can use that information for establishing overall audit strategy. Understood? Then, so this makes us to the next point. What are the factors which are required to be taken into account for establishing audit strategy? So as an auditor, first thing you have to establish is audit strategy. While establishing audit strategy, what and all things you will consider? As I've told you, in audit strategy, mainly we are going to decide on time and resources. But just randomly, we will not arrive at anything. That timing and resources also we will decide it after considering n number of factors. Sir, what are that n number of factors? Number one, identify the characteristics of the engagement. So you have to know the characteristics of the engagement. For what engagement you are getting appointed, what is your client, what industry it belongs to, what is their applicable financial reporting framework, and what kind of industry it operates. So like that, it depends on the characteristics of the engagement. So if the client is big enough, very complex business, there we need more time, more resources. On the other hand, the client is not that big enough, business is very simple business model, there we might not need that much amount of time and resources. So first factor which you have to consider in establishing overall audit strategies, identify the characteristics of the engagement that defines the scope. Then you have to understand about reporting objectives. Also pay attention to reporting objectives, like client what and all reports you are required to give. Is the client is having any timetable for reporting? Some clients will follow a calendar. Within this date, we have to give our audit report. Within this date, board meeting should happen. So you have to understand the timetable for reporting. What and all extra reporting requirements you have to give. That also you have to consider. Why? Because if you take the case of the banks, you are required to give a number of reports. So well in advance, you have to consider all that reporting requirements. Accordingly, you have to decide your timing. So that is the second point which you have to consider. Consider the reporting objectives. Thereafter, consider the factors that in the auditor's professional judgment are significant in directing team's efforts. Not just the above, any other matter which you feel it as significant in directing your team's efforts, consider every such factor. So that means use your professional judgment. First, they are telling identify the characteristics. Second, they are telling consider reporting objectives. Third point, they are saying not just this, any other matter which you feel it as significant for determining the audit strategy, consider everything. Like examples they have given here, the auditor needs to direct efforts, engagement towards matter that are very significant. Preliminary identification of material class of transactions, account balances helps the auditor in establishing overall audit strategy. Getting a prima facie understanding of what are the class of transactions, what are the balances, that will also assist you in establishing audit strategy. More energies will be needed for significant matters. And few examples like what things you have to consider. Few examples of the factors which will be considered as significant. Volume of the transactions. What will be the volume of the transactions? Do they have huge number of transactions or less number of transactions? If it is a real estate company, turnover will be very high, but number of transactions will be less because ticket value will be higher. If you take FMCG company, if the turnover is big, volume of transactions also will be big because ticket size will be small there. So volume of transactions is one such factor which you can consider. And it also you have to also consider significant industry developments like industry regulations and new reporting requirements if they are coming. If there are new reporting requirements, you might need more time. Significant changes in financial reporting. Are there any changes happen in the financial reporting? Like any Schedule 3 or a new accounting standards have come? There you need to take more time. And other significant recent developments like changes in the regulatory environment. So these are some other factors which will be significant in establishing your overall audit strategy. And even just now, as I have told, you would have already performed preliminary engagement activities. From that preliminary engagement activities, you would have got the information. Use that information also in establishing that overall audit strategy. So consider results of preliminary engagement activities wherever applicable, whether knowledge gained on other engagements performed by the engagement partner. In case if you have performed any other engagement for the same client in the past, use that information also in establishing your overall audit strategy. Like examples are consider results of previous audits that involved evaluating operating effectiveness of internal control. If you have worked in the past for the same client, last as a part of that other engagement, you would have understood about internal controls. Use that understanding now for deciding your overall audit strategy. Manner in which auditor emphasizes to engagement team members need to maintain a questioning mind and exercise a professional skepticism. Also, you need to always maintain a professional skepticism. Even you decide how many nature, timing, and extent of resources which are necessary. While deciding audit strategy, always consider the nature, timing, and extent of resources. Let us say you have 50 people in your office, but 45 of them are occupied in all important works. That means you have only 5 people. You are running short on resources. If you are running short on resources, the only way to compensate for that is increasing the time. Increasing the time. No, if the time is not at all there, this engagement also is very urgent. then that you have to compensate it by increasing the resources. So when establishing the audit strategy, one of the most important factor also which you have to consider is nature, timing, and extent of resources, and also whether you have experienced resources or non-experienced resources. If I have experienced team members, less time. If I have newly qualified, newly passed out CA inter students, new article assistants are there, then I may need more time. So like this, even you have to consider nature, timing, and extent of resources, whatever you have. So these are the 5 factors which you have to consider. Identify the characteristics of the engagement, consider the reporting objectives, and then other matters which you feel it as significant, and consider the information from preliminary engagement activities and other information, other engagements performed for the client, and even ascertain the nature, timing, and extent of the resources. Clear? Now, if you establish the overall audit strategy, how it will assist the auditor in development of audit plan. See, mainly work allocation is going to happen in the audit plan. Why can't we skip audit strategy and do the audit plan? Why can't we skip the audit strategy and do the audit plan? We can't skip it because unless and until you draft audit strategy, then only you can develop audit plan. Because in the audit strategy itself, you are deciding the timing and resources. So that's why if you establish audit strategy first and then you develop audit plan, you will have so many advantages. Instead of directly jumping into audit plan, first if you develop audit strategy, it will assist you better in the development of audit plan. Sir, how it will assist me? How the establishment of audit strategy will assist the auditor in development of audit plan. Number one, you can take better decision regarding resources to deploy. Which kind of resources? So this first point, first advantage is you can take better decisions regarding which resources to deploy. See, while establishing audit strategy, we are considering the resources, whether you have experienced staff or not experienced staff. Since you know that well in advance, you can do work allocation better. If the experienced staff is there, that staff I will allocate it in complex area. If less experienced staff is there, then I will allocate it in less complex area. So, like that, if you have audit strategy in place, you can take better decisions regarding which resources to be deployed for which area. And how many number of resources you can deploy for each area. That also you can take better decision. If you have strategy well in advance, you can decide how many number of resources, like how many number of resources are required for physical verification, how many number of resources are required for internal control verification. You can take better decision regarding how many number of resources also. And when these resources are to be deployed, timing. When see there is no need that all the resources are to be deployed from day one itself. If you have a strategy in place, initially you can slowly increase the staff in a phased manner. So when the resources are to be deployed, that also you can take better choice. And finally, how to manage that resources, how to direct the resources, how to supervise that resources, and when the review meetings should happen, should on-site review meetings should happen or off-site review meetings should happen, those coordination also can happen in a much better manner. So 4 advantages, 4 ways the audit strategy can assist the auditor in development of audit plan. Number one, which resources are to be allocated for which area, how many number of resources are to be deployed for each area, when the resources are to be deployed, and to do the better management, supervision, and direction of the engagement team members. Clear? Next. Coming to the next part. Thereafter, we have planning. Why it is necessary for planning? This is a general question here. They are not specifically talking to strategy plan or program. Overall planning process. Why you have to spend your time on planning? Why you can't directly jump into doing audit? Why planning is necessary? What are its benefits? If you have the planning, if you do the planning, how it will get benefited? Number one, if you do the adequate planning, benefits the auditor in several ways. What are they? Number one, helps the auditor to devote proper attention to important areas. So if you do the planning, since you do the risk assessment, you understand about the entity, you will get to know in which area you have to allocate more time, in which area you have to allocate less amount of time. And it will help the auditor to identify and resolve the potential problems. If you well in advance spend some time on planning, if any potential problem comes, you can handle it in a better way. And helping auditor properly organize and manage the audit engagement so that it is performed in an efficient and effective manner. If you spend the time on planning, everyone will have a common target. Within this time, we have to complete the audit. So when everybody is having the common target, better coordination will happen. When everybody has to collectively meet one common timeline, they all will better coordinate with each other. And assisting in selection of engagement team members with appropriate level of capabilities. It is a repeated point. Just now I have to. You can take better decisions regarding allotment of resources. Where experienced resources should go, where less experienced resources should go. And it will facilitate direction and supervision of engagement team members. One more point. Just now we have seen benefits of overall audit strategy. And assisting where applicable in coordination of work done by others. And even you can betterly plan if you want to take the help of experts to do the planning. You will get to know which areas are there. so that you can plan well in advance whether you are required to go to any expert or everything you can do it by yourself. So you can take better decisions regarding consultation with others. So these are all the overall benefits of planning. Next, they say that planning is a continuous process. Planning is a continuous and iterative process. So they say that it is not just a one-time activity; it is going to be a continuing activity. So what do you mean by that? Throughout the audit, will you be doing only planning? If throughout the audit, you are doing only planning, when you will do execution. So it's not that. At the beginning, we will do planning, but throughout the audit, we will remain alert. If any circumstances, if any new information we got, if there is any need arises, we must be able to update our plan. So that's what the meaning of planning is, a continuous and iterative process. It is not something like at the beginning you have spent the time and thereafter you are not coming back and re-referring it. No. So it is a continuous process. It is a repetitive process throughout the audit. Wherever necessary, we might be required to make changes to our planning decisions. We might be required to make updates to our strategy, plan, and program. So that's what they say. Planning is not a discrete phase of an audit. It is not a separate phase of an audit, but rather it is a continuous and iterative process. Iterative means repetitive. And it often starts shortly after completion of the previous engagement and it will continue till the completion of the current year's audit engagement. So, thereafter, this point. For example, planning needs to consider prior to auditor's identification and assessment of risk of material misstatement such matters as. So definitely while doing planning, before that only risk assessment procedures will perform. In addition to even before considering risk of material misstatement, various other factors also you will consider while doing the planning decision. So many items we will consider when doing planning. One thing is risk of material misstatement. Even beyond risk of material misstatement, some other factors also will consider when doing the planning. What are the analytical procedures to be performed as risk assessment procedures? You have to perform risk assessment procedures first. Even before that, you need to decide which risk assessment procedures you have to perform. I told you just now, out of 7 methods, 4 will be suitable for risk assessment procedures: inquiry, inspection, observation, analytical procedure. So first you have to decide which kind of analytical procedure I have to perform for risk assessment. Then you can complete risk assessment. Then you can do planning. Next, obtaining a general understanding of the legal and regulatory framework. Overall legal and regulatory framework you have to understand. Determination of materiality. Even you have to fix your materiality. What is material? What is not material? Well in advance you have to determine. And involvement of experts. Is there any need for experts and all? That also you have to consider. And performance of other risk assessment procedures. Apart from analytical procedures, whether will you do inquiry, inspection, observation, what you will do, all these things well in advance you have to consider. Even before performing risk assessment procedures, consider all these factors, then perform risk assessment procedures, then only use it for planning. Clear? Next. Next part, involvement of different persons in planning. Sir, development of audit strategy, audit plan, it is whose responsibility? Auditor's responsibility. Auditor is responsible for development of audit strategy and audit plan. Now, who is auditor here? Auditor means engagement partner. Why? Because it is a matter related to responsibility. So there is no doubt engagement partner is responsible for development of audit strategy and audit plan. Will he do it single-handedly or will he involve other persons also? Other persons also will be involved. Who will be involved? Engagement team, no doubt. The key members of the engagement team must be involved because if you involve them, you will get to know about their capabilities. They will all have a common understanding. They will all get a clarity, and work gets allocated in a better manner. So there is no doubt key engagement team members of the auditors will be allowed. Is there any requirement to involve the client's staff and management also? There is no doubt in the planning process we will involve engagement team. Is there any requirement to involve the client's staff also? Yes, client's staff and management involvement is also necessary. Why? Because we have to do the audit with their help only. If you have to do the inquiry, whenever we thought of doing inquiry, at that point of time, that person should be available. You have to let him know very in advance. Sir, on so and so day, we will come and do the inquiry. Please be available. So that's why you have to involve even clients management and staff because without their help, we will not be able to do the audit. So please involve them also in the plan. But care has to be taken to make sure that you are not discussing the detailed audit plan. Never ever it should happen. Involve them only to the extent necessary. Don't discuss a detailed audit plan with them because if you discuss a detailed audit plan with them, what you are going to do becomes predictable and overall effectiveness of the audit will be lost. So that's why involve them only to the extent necessary. Don't unnecessarily let them know the detailed audit plan so that your audit will become ineffective. So like that, we will involve the client staff, we will involve the management also and engagement team also. Thereafter, Relationship between audit strategy and audit plan. So is there any relationship between audit strategy and audit plan? Yes. Don't say any direct or inverse. That is not what I'm asking for. So both are interrelated with each other. Why? Because first we will establish audit strategy that will set the overall scope, timing, and direction of the audit. Thereafter, this audit strategy, with the help of this audit strategy, we are going to develop the audit plan. So both are not two different steps. They are closely interlinked with each other. And a change in one will automatically bring the change in other. If you are required to make a changes to the audit plan without changing audit strategy, you can't change your audit plan. If you want to change your audit strategy, then also you have to go and change your audit plan. So a change in the one automatically will result in a change in the other. So that's how the both are related with each other. They are not two different processes. They are linked with each other. Next, changes to planning decisions during the course of audit. Just now, as I told, during the course of audit, whatever plan you have decided at the beginning, whatever strategy you have decided at the beginning, whatever work allocation you have done at the beginning, those things might be required to be changed. The planning decisions might undergo changes during the course of audit, and it is necessary also. Sometimes to make your audit necessary, it is necessary. It is to make your audit effective. Sometimes it might be necessary to make the changes to your planning decisions. But first of all, why the need might arise to make changes to the planning decisions? Why the need arises because of why the need arises for changing the planning decisions. So there could be various reasons. Those reasons they are giving it here, a result of unexpected events. You initially planned for 10 people. Out of them, 2 have become extremely sick. They are bedridden. They are not coming for audit. I cannot say, no, I have decided my plan. I have already allocated the work. You die, I don't bother. You come to the work and die. I can't say it like that. So I have to compensate with the remaining 8 people. So now you might be required to increase your time. So because of unexpected events, or change in conditions, circumstances might change. Whatever conditions that are present at the time when I have done the planning, the same conditions might not persist when I am doing it. Or the audit evidence obtained from other audit procedures. Sometimes by performing other audit procedures, you will get extra information. Initially, you thought risk is low, but by performing compliance procedures, you got to know that controls are completely a bullshit. They are not at all working effectively. So if they are not at all working effectively, earlier you thought risk is low, but now you might require to change your risk assessment. Now you thought that risk is high. Initially, you thought risk as low and performed and planned for less procedures. But now you got to know about extra information. You have to update your audit strategy, update your audit plan, and increase your audit procedures. So these are the 3 most common reasons: result of unexpected events, change in conditions, or audit evidence obtained from other audit procedures. Because of these reasons, you might be required to make the changes to the planning decision. Next, factors which affect planning, supervision, and review of the engagement team members. As I have told you, never ever believe your engagement team members. You have to direct them, you have to supervise them, and even you have to review the work, whatever your team has done. So whether you will do more direction, more supervision, more review, or you will do less direction, less supervision, less review, that depends on what factors. It depends on various factors. Those factors I are trying to say it here. Number one, size and complexity of the entity. If the size of the entity is big, matters are very complex, you are required to do more supervision, more direction, more review. Then it depends on area of the audit. Some areas require more direction, more supervision, more review. Some areas might require less direction, less supervision, less review. It also depends on risk of material misstatement. If the risk is higher, more direction, more supervision, more review. If the risk is lower, less direction, less supervision, less review. It also depends on competence and capabilities of individual team members. If your engagement team members are all experienced persons, less direction, less supervision, less review. On the other hand, if your engagement team members are more or less experienced, more direction, more supervision, more review can happen. And whatever audit strategy you have developed, whatever audit plan you have developed, is it required to be documented? Yes. What and all has to be documented? Your initial overall audit strategy, your audit plan. If you have made any changes to your audit strategy and audit plan, that changes along with the reasons for changes. Sir, why documenting this audit strategy and planning is very important? Because at the planning stage, we take very key decisions. Most of the important decisions will be taken at the planning stage. So if you do the documentation, it will act as a record of the key decisions which have been taken. And it will also act as a record of planned nature, timing, and extent of risk assessment procedures. And It also serves as a record of proper planning. If tomorrow someone comes and says, see, this planning and all is covered under SA 300. Whatever content we are discussing, that is all SA 300 related content. So if tomorrow someone is coming and asking, have you done the planning properly or not? I should show the documentation. See, sir, this is my strategy, this is my plan. I complied with SA 300. I have to let them know. And it may use, the auditor may use either standard audit programs and or audit completion checklist tailored to meet the specific engagement circumstances. If possible, try to develop one single standardized audit plan for everyone, but that will not be possible because business changes, entities changes, internal control changes. It is highly impossible. So that's why what we do is we do customization. We will tailor it according to the requirements of each client. Next, a record of significant changes to overall audit strategy and audit plan and resulting changes to nature, timing, and extent of audit procedures also will explain why this plan has been changed, why the changes have happened to the audit strategy and audit plan. So that also you have to document it. Next. So this is what regarding audit strategy, audit plan. Now the next discussion is regarding audit. So we'll now talk about audit program. So as we have seen, audit program is nothing but a detailed version of audit plan, which is going to contain a series of verification procedures along with the methods and techniques which are required to be followed in each area. So that's what is ATO, meaning if you see audit program, it consists of what? Series of verification procedures to be applied to the financial statements and also for purpose of obtaining sufficient evidence so that you can form an expressed informed opinion. So to form an opinion, you have to get the evidence. For getting that evidence, what verification procedures you have to perform, that will be included in the audit program. So it is nothing but a detailed plan of applying audit procedures. So it is nothing but a detailed plan only. It will contain instructions along with appropriate techniques which are required to be followed. It is desirable in each audit, more particularly for bigger audit, an audit program should be drawn up. Compared to the small entities, in bigger entities, the requirement for audit program is much higher. Next, evolving one audit program for all businesses. Do you think will it be possible? Definitely not. We cannot evolve one single audit program which will be applicable for each and every kind because there is businesses vary in nature, size, and composition. So and also industry to industry, so many things changes, business to business, so many things changes. So that's why we cannot develop. So evolving one audit program applicable to all businesses under all circumstances is not practical. So that's why you have to you have to customize. You have to customize the audit program according to the needs of each and every client. And the assistants to keep an open mind. Whom they are referring to you only. See, one of the main disadvantages of the audit program is we will see even in the subsequent part also in the disadvantages. One main disadvantages of having the audit program is people feel that their work is becoming very redundant. Their work will look like very mechanical. Why? Because you will have an audit program. List of instructions will be given, list of techniques will be given. There is no scope for application of your mind. What they will do, simply whatever instruction has been given that they have to follow and give a checklist and fill the checklist. So work will become mechanical. And so what even they will try to do is some people will try to escape their liability saying this. Sometimes a mistake is apparent on record. Clearly it is visible, but you intentionally will not find out. And you will blame when it was asked why you did not find out that misstatement. That fellow will say, in this instruction you did not give it to me. That's why I'm not able to find a misstatement. So like that, it is a some disadvantages are also there for audit program. But still, as assistant, if the work has been assigned to you, if the work has been allocated to you, what is the one most important thing which you are required to do is you have to keep an open mind. So don't follow like a blind bull where instructions are given and you are blindly going through it. If you find anything which is not in the audit program, you have to bring it to the notice of the engagement partner and the seniors to include that in the audit program. If you find something is redundant in the audit program, if it is no longer relevant in the audit program, so you have to bring that also to the attention of the engagement partner and other senior members to eliminate that steps from the audit program. So in this manner, you have to keep an open mind. So that's what I try to say it here. Next, periodical review of the audit program. So, like the way audit strategy, audit plan, as and when necessary, we are making changes or not, same thing will become applicable for the audit program. So it is not something like once you have drawn the audit program, you have to follow it blindly. During the course of the audit, you might be required to make changes to your audit program, and sometimes it will be most important to make your audit effective. So, if necessary, like the way we are updating our audit plan, audit strategy, in the same manner, you are also required to update your audit program. So you are required to periodically review the audit program to assess whether same continues to be adequate. And also, unless this is done, any change in the business policy may not be adequately known. Audit work may be carried on the basis of obsolete programs. If you are not reviewing the audit programs, especially in the case of recurring audit, in many cases, what auditors will do is, in case of recurring audit, last year audit plan, audit program only current year they will use. If you are not reviewing it, so what will happen is when compared with the last year in the current year, so many changes could have happened. If you don't care to study about this audit program, you might be following one waste audit program, obsolete audit program, outdated audit program you might be following. So, and keeping program also to clients operations and internal control under periodic review so that in cases of redundancies of the program may be removed. So once again, depending on the client's changes in the internal controls, depending upon the client's operations, when they have undergone change, your audit program also should undergo some changes. And an audit program not only lists the task to be carried out, but also contain few relevant instructions like extent of checking and sampling plan. Even those instructions also will be there. What should be your sample size? What plan you have to follow? What sampling plan? That means which method of sampling you have to use. These instructions also will be there. Next, so long as a program is not officially changed by the principal, every assistant deputed on the job should unfailingly carry out the detailed work according to the instructions. Many persons believe that that brings an element of rigidity. That's what I told, mechanical in nature. So since it is updated unless and until that audit program has been updated by your engagement partner, every assistant is required to strictly follow. So the work will become more rigid. There is no scope for improvement. The users might feel like. So this is not true provided periodical review is undertaken and encouraging assistants on the job to observe all salient features. So how you can overcome that? By encouraging your article assistants, keep an open mind. If you find something, bring it to our attention. Even go beyond audit program, also check. So like that, if you encourage your article assistants, you can reduce this disadvantages. Next, points to be kept in mind while constructing an audit program. Whenever you are drafting an audit program, what points you will keep in mind before drafting an audit program? Always try to stay within the scope limitation of the engagement. So always stay within the scope. As an auditor, your responsibility is to obtain reasonable assurance. So you should also design instructions in such a manner that you will achieve reasonable assurance only. But some people, what they will do is they will go to next level and they will include 100% verification, like investigation, where they will get absolute assurance. Not necessary. Draft your audit program, staying within the scope and limitation. Prepare a written audit program. Never ever keep the audit program in a oral format. Always try to keep the written audit program, setting for the procedures that are needed. Determine the evidence reasonably available and identify the best evidence. For one single item, you can get the evidence from n number of sources. That doesn't mean every step you will include it. Out of all the evidences, what is the best evidence you identify and include the procedure to get that best evidence. And apply only those steps and procedures which are useful in accomplishing the objective. Unnecessary steps you don't include it. Next, include audit objectives for each area in sufficient detail, which serves as a set of instructions for the audit assistants. So, for each area for which you are developing audit program, what should be your objective that you have to list it down. And when you are drafting instructions, consider all possibilities of error. Think from things in such a manner that in all, what and all ways errors can happen, and accordingly draft your instructions and coordinate the procedures to be applied to related item. Even include the coordination procedures, like you are saying you are drafting an audit program for purchases. In that, you might add an instruction when you whoever is doing this audit program for purchases, he needs to collaborate with, he needs to coordinate with person verifying accounts payable. So, like that coordination procedures also you are required to include it in your audit. So, all these points you have to consider while developing an audit program. Then we have advantages of an audit program and disadvantages of an audit program. So starting with advantages. Sir, what are the advantages of audit program? Number one, so the entire it provides the assistance carrying out audit with a total and clear set of instructions. So they don't forget anything. You are giving them all the instructions which they are required to follow. So that they can't say we have forgot, sir, we don't know, sir, we did not remember, sir. Like that, they can't play the games. Next, it is essential, particularly for major audit, to provide a total perspective of the work, especially in case of bigger audits and all. What is the total perspective of the work you will get to know? What is expected from you, you will get to know by having an audit. Selection of assistants for job on the basis of capability becomes easier when the work is properly planned and segregated. So depending on the instructions, you can select your proper engagement team members also, whether experienced are needed or less experienced are needed. Without a written and predetermined audit program, work is necessarily to be carried out on a basis of some mental plan. If you don't have a written audit program, randomly whatever comes to your mind that you have to do. In such situation, there is always a danger of ignoring or overlooking certain entries. Under a properly framed program, such danger can be very less. The assistant, by putting their signature on the program, accepts responsibility for the work carried out. So even one more feature of that audit program is we'll draft all the instructions. No, at the end we will leave place for signature. Whoever has done that audit program, he has to sign it. By signing, what he's telling is accepting that I have carried out all the instructions. That means they will carefully do the work because you are explicitly taking the responsibility by signing that audit program. Next one. The principal can control the progress of the various audits. So if multiple audits are happening, I'm head of the firm. I want to know what is the status of the work of each audit. What I will do, I will get the audit program. In that, I will check to what extent audit programs have been completed. So from that, I can determine how many more days will be required for audits, so that I can get the status of the work. It serves as a guide of audit to be carried out in succeeding years. If you have a proper audit program for the current year, that will help you for planning audits of the subsequent years. And a properly drawn up audit program serves as even evidence in the event of any charge of negligence brought against the auditor. If someone is charging you with a negligence, even you can use that audit program as an evidence in the court of law that you are not negligent, you have performed all. Next. So this audit program is not just having advantages, it is also bringing some disadvantages. So what are the disadvantages? The first disadvantage I have told you, the work will become mechanical. Since these are nothing but a list of instructions which are required to be followed, the article assistants might feel their work is becoming very mechanical. There is no scope for any creativity at all. The program often tends to become rigid and inflexible, following set rules. Businesses may change in operation to conduct, but old program may still be carried on. Recurring audits, as I know. In recurring audits, year after year, without any review, the same audit program could be followed, which can make the audit ineffective. Inefficient assistants may take shelter. This point also, sometimes misstatements will be very apparent, but you will be very negligent. And tomorrow, when someone asks you why you are not able to find out that misstatement, you will say, "Where is the instruction?" In the audit program, there is no instruction. That's why I did not perform. So, like that, ineffective staff might take a shelter. And a hard and fast audit program may kill the initiative of efficient and enterprising assistants. So, nothing but some people will be very excited. So after their qualification, when they go and join the articleship and all, they have a lot of excitement. They want to do everything. So, but their excitement will be killed if the engagement partner says, "Don't do overaction. I'm giving you 10 instructions. Do that only." So that will kill their initiative. At the initial stage only, their initiative will be killed. So these are all the disadvantages. Next. So this is one general question. So now we will come to the materiality part. Most important part, materiality part will come. Long ago, we have already covered materiality, right? So now here I gave you relativity examples also I have given. Right. So we'll now talk about this materiality in a detailed manner. As I have told, materiality is one of the most important consideration. From the beginning, from introduction onwards, we are coming across this materiality at various instances. We have come across this already. So materiality is one of the important consideration in audit. Materiality means something which is significant, which is major, etc., etc. Then, when a misstatement can be considered as material, when a misstatement can be considered as material, if it is expected to influence the decision of users of the financial statements, then we will call it as material misstatement. And materiality, mostly it will be expressed in quantitative terms. Materiality will be mostly expressed in quantitative terms. Quantitative terms means what? In numbers and figures, like this much amount will be considered as material, this much percentages will be considered as material. So like that, materiality will be mostly quantitative in nature. But sometimes qualitative aspects also could be material. Materiality need not always be from quantitative perspective. Materiality could be related to qualitative aspects also. Like for example, going concern related disclosure. Going concern related disclosure, it is a very material disclosure or not? So you can't express that going concern materiality in numbers. Just I will say that going concern related disclosures are material. So here I expressed that materiality in qualitative terms. Now, so we all know this basic introduction, what is material, what is not material and all. But the main question comes, how to fix the materiality? How to fix materiality? If you are doing audit of one particular entity, how you will decide what is the limit, or this much amount is material, this much amount is not material, how you are going to decide it. So this will be governed by SA 320. SA 320 will help us in fixing the materiality. And ultimately, they will say it is professional judgment. One thing is going to be common here. What is material, what is not material? There is no hard and fast rule anywhere. Everywhere it is going to be professional judgment. But they give us one approach. One approach to follow they will give. They will not tell you exactly this is material, but they will tell you what approach you could follow to fix that materiality level. So SA 320 says that to fix the materiality level, you have to determine one percentage. You have to determine one percentage. Sir, how much percentage, sir? Professional judgment, 5, 10, 15, 20, 2, 3, whatever you want. So using your professional judgment, you have to determine one percentage. Now that chosen percentage should be multiplied with benchmark. That percentage should be multiplied with benchmark. So let us say using my professional judgment, I have determined 5%. Now that 5% has to be multiplied with the benchmark. So what could be a benchmark? Benchmark could be anything from the financial statements. It could be total assets, or it could be revenue, it could be profit, it could be total assets, it could be net assets, it could be gross profit. So like that, any item from the financial statements can be taken as benchmark. Sir, you are telling any item, but n number of options will be there. Which one I have to choose, sir? Once again, professional judgment. Once again, professional judgment. But the two most commonly and most widely used benchmarks are revenue and profit. Revenue and profit are the most commonly and widely used benchmarks. So I will decide one percentage using professional judgment, and that percentage I have to multiply with the benchmark. Let us say I have taken the profits as the benchmark. So 5%, and that profit figure I have to take and I have to multiply. Sir, okay, using my professional judgment, I have chosen profit as a benchmark. Now, from where I have to take the profit figure? You are telling profit is my benchmark, 5% you have decided, and you want to take the benchmark as profit. Now, what is the source from where you will take the profit from? The profit figure from where you will take? From the current year financial statements if they are ready. By the time you are starting to do the audit, if the financial statements are already prepared, you can take the current period profit figure out. So, what if the current period financial statements are not ready? In big companies and all, you need not wait till the completion of the year to go and do the audit. During the course of the year also, you can go and do the audit, right? So in case if the current year financial statements are not ready, you have chosen the benchmark, but from where you will take the benchmark? It could be last year's audited financial statements, or it could be budgets. They would have prepared the budgets. From the budgets also you can take, or even you could take it from this other thing, interim financial statements. If the interim financial statements are ready, even from the interim financial statements also you can take it. So whatever it is, if the current year financial statements are ready, so you will take it from the current year financial statements. If the current year financial statements are not ready, you start looking from other sources. So first you will identify a typical source. That source you will multiply with the percentage. So let us say current year financial statements are ready. I have taken the profit as a benchmark. So current year financial statements 100 crores is a profit. 5% into 100, 5 crores I will get it. This I will fix it as materiality level. Here, this I will fix it as materiality level. Now I will try to cover then I will try to do the audit, perform the audit procedures, find out the misstatements, and those misstatements I will try to compare it with this materiality level, whether they are material. If they are exceeding the 5 crore rupees of limit, I will consider financial statements are materially misstated. I will give a modified opinion. On the other hand, there are misstated, but on the other hand, there are misstatements, but they are within the limit of that 5 crore rupees. I will not consider them as material. Understood? Next, few more points here. The standard policy SA 320 also says one more thing. You need to fix materiality at two levels. How many levels? At two levels, you are required to fix the materiality. One is overall materiality, and the other one is performance materiality. What are they? Overall materiality, performance materiality. Sir, what is overall materiality? The materiality level which is decided for the financial statements as a whole. What is it? The materiality level decided for the financial statements as a whole. That we call it as overall materiality. So let us say, for example, I'm looking at the balance sheet. In the balance sheet, I'm able to find assets. So fixed assets, I have 100, and under current assets, I have inventory, trade receivable, cash and cash equivalents. Let us say 50, 40, 10. I have total 200 crores of balance sheet I have. So now what I'm saying is I'm fixing the materiality for the financial statements as a whole. I'm saying that if in the entire financial statements, 20 crores worth of misstatement is there, I will consider the entire financial statements to be materially misstated. So this is the materiality level kept for the financial statements as a whole, which we call it as overall materiality. But there is a problem here. When I fix this materiality individually, let us say for example, if the fixed assets 10 crores worth of misstatement happened, I will ignore it. Why? Because that is below my materiality level. And in the inventory, I found some 3 crores worth of misstatement. I ignored it because it is below my materiality level. And in the trade receivable, another 4 crores worth of misstatement is there. That also I will ignore because it is not less my materiality level. And in the cash equivalents, 4 crores worth of misstatement is there. That also I will ignore. Individually, they might not be material, but collectively, they are material. So there is a chance of missing these kind of misstatements, which are individually not material, but collectively they could be material. So the solution for this is the standard told determine one more level of materiality called performance materiality, which will be lower than the overall materiality. Which will be lower than the overall materiality. Nothing but materiality, I will decide it for each class of item or each assertion they will say. So that I call it as assertion level materiality. Performance materiality, I call it. Understood? So now what I am doing is I am telling that in the fixed assets, if 10 crores worth of misstatements are there, fixed assets are considered to be materially misstated. If an inventory some 2 crores worth of misstatement is there, it will be considered to be material. So like that, this materiality level, I will fix it for each item of the financial statements, which will be generally lower than my overall materiality. So that we call it as performance materiality. Understood? Clear? Next. Apart from that, so what else we have? So one important point is that, which is we have covered this one. Factors which help in selection of an appropriate benchmark. Very, very important, very frequently tested question. So what are the factors that will affect identification of an appropriate benchmark? So I told you benchmark could be any item. There could be n number of options available for choosing benchmark. So out of all the options, I have to choose one benchmark. How I will decide, sir? As I have told, professional judgment. But what factors I will consider in choosing that appropriate benchmark? So they try to say something here. This all 4 points are going to be very important. Number one, the elements of financial statements like assets, liabilities, equity, revenue, expenses, anything can be taken as a benchmark. First point is not a factor, it is a statement. Any item of the financial statements can be taken as a benchmark. Where there is an item, whether there are items on which attention of the users of the particular entity's financial statements tend to be focused. One of the factors which you will consider in selecting the benchmark is there any such item of the financial statement where the users of that particular industry will focus? Like if you take IT company, people are more interested to know about profits. If you take FMCG company, the focus of the company will go on revenue. So, in case if I am conducting audit of FMCG company, I will take the revenue as a benchmark. In case if I am conducting audit of a software company, profit I will take it as a benchmark. So, like that, one factor which I will consider is where the users tend to focus more. Next, it also depends on nature of the entity, whether entity where in its life cycle it is, and industry and economic environment in which entity operates, entity's ownership structure, and way it is financed. It also depends on where the company is at its life cycle. If it is in the initial stages, there will be no profits. Revenues could be there, but there will be no profit. Why? Because all this customer acquisition cost will come. So they are taking profit is not an appropriate benchmark. When the company slowly starts growing, when a trend of profit gets established, then I will take profit as a benchmark. So it depends on life cycle, how the entity is financed, what is its capital structure, all these factors also will decide. And not just that, it depends on the volatility of the benchmark. How volatile that benchmark is. Let's say, for example, there is one company whose profits are something like this, whose the trend of profits is 1 year is it's 100 crore, in another year it was 20 crore rupees of loss, in another year it was 200 crores, once again next year 50 crore rupees. Is this more volatile or less volatile? More volatile. When it is more volatile, it is not a suitable benchmark. When it is less volatile, that means it is following one trend. Let us say, for example, the profits are like 10, 15, 18, 22. So they are in a trend, they are less volatile. So then I can take it as a benchmark. So these are the three factors, guys. First point is not factor, first point is a general statement, but there are three factors. It depends on the attention, where the attention will be focused. It depends on the entity's life cycle, how it is financed, what is its capital structure and all. And finally, it depends on the volatility of the benchmark. Clear till here? Now, apart from that, one more important area regarding this materiality. See, materiality level we will decide it at the beginning. I told you in the previous session only. So we will decide materiality something at the beginning. Whatever materiality level that we have decided at the beginning of the audit, are we required to strictly follow it as it is throughout the audit, or can we make any changes? Can we revise the materiality level? Yes, we can revise the materiality level. 100% we can revise the materiality level. So it was not statutorily stated anywhere that the materiality has to be constant. Whatever you have decided at the beginning that you have to follow strictly, nothing like that. So whatever materiality level that you have decided at the beginning of the audit, it can be revised. So there might be change in circumstances, there might be some extra information available, there might be sometimes we start with budgets. As I've told, when the current year financial statements are not ready, we can take budgets. So after a certain period of time, actual results are out. If the actual results are within a close range of budget, no need to revise materiality. But my budget of revenue was 1,000 crore rupees, actual revenue was 500 crore rupees. So now what will happen? This is also one reason for revising materiality when there is a huge gap between budget and actuals. So like that, there could be various instances where you could be revising your materiality level. And not just that, documentation is also required. Documentation is also required. How you have fixed the materiality, how you have calculated the materiality, what is the overall materiality, what is the performance materiality, did you revise the materiality level? If yes, what are the revised materiality levels? For what reasons you have revised the materiality? Everything should form part of your audit documentation. Clear? Understood? So this is what the major discussion regarding materiality. So with this, we will try to even set aside SA 320 also. So completely we are done with audit strategy, planning and so till now what and all are the chapters we have done? Introduction, nature, objective and scope, ethics and the terms of engagement, audit reporting, audit documentation and evidence, and now audit strategy, plan and program. So now next thing what we will try to do is we'll try to do the standards. Try to do standards on audit. First we will be starting with 500 series. Okay, right. And before that, to understand different types of standards, some basic introduction we need to have. There are different types of standards which are applicable, which are given by AASB of ICI. So, what are the different kinds of standards, and for which engagements they will become applicable? We need to understand that structure first. So, we have 5 series of the standards actually. So, number one, we have SA series. We have SA series. SA series will become applicable whenever we are conducting audit of the historical financial information. If we are doing engagements relating to historical financial information, then SA series will become applicable. Then we have something called SRE, Standard on Review Engagements. Whenever you are doing the review engagements, if you are appointed by any entity to do the review engagements, then SRE will become applicable. And what is the difference between SA and SRE? Audit is a reasonable assurance, review is a limited assurance. But one common thing between SA and SRE, the common thing between audit and review engagements is both will deal with historical financial information only. Both will deal with historical financial information. But the differentiating factor is assurance, the level of assurance you are giving. So audit you give reasonable assurance, whereas review you give a limited assurance. Now we have something called SAE series. Standards on assurance engagement. So when you are engaged to work on other than historical financial information, other than historical financial information. So when I say other than historical financial information, what do I mean by that? As I have told, it could be either future financial information or even it could be a non-financial information. So when the subject matter of your engagement is either prospective financial information or non-financial information, then SAE will become applicable. And here, what kind of assurance we give? Moderate assurance. We give an assurance called moderate assurance. In all these three, we'll give assurance. In audit also we give assurance, review also we give assurance, and assurance engagements also we give assurance. But always we might not be doing only assurance engagements. Not every work should carry assurance. Sometimes we do some engagements where we are not giving any assurance. No assurance, nothing will be given. Just we agree with some procedures with the client. We will agree to perform some procedures with the client. We perform that procedures and our work is done. So that kind of engagements we are going to call them as related services or agreed upon procedures you can call them. Like client is asking you to compile the financial statements or client is asking you to do receivables reconciliation, trade receivable reconciliation, or the client is asking you to do inventory aging. So like that, we agree some procedures to be performed with the client. We don't give any kind of assurance. We perform that procedures and tell our findings. That's all. Those engagements we call them as related services. It is not assurance. You will not give any assurance there. And whenever you are doing that kind of related services, yes, RS will become applicable. Standards on related services will become applicable. Now, all these 4 standards put together, we call them as engagement standards. All these 4 are different kinds of engagements now. Some are assurance, some are non-assurance. Whatever it is, SA, SRE, SAE plus SRS. All of these 4 put together, we call them as what? Engagement standards. And whenever you are doing any engagement, there is a necessity for maintaining the quality in the engagements, whatever you are doing, be it audit, be it review, be it assurance, be it related service, whatever may be the engagement you are doing, in every engagement you are required to maintain quality. Quality has to be controlled, quality has to be maintained in each and every engagement you are doing. And how to maintain that quality control, that guidance has been given under SQC, Standards on Quality Control, and under this we have only one standard, SQC1. And this SQC will become applicable whether you are doing audit, whether you are doing review, whether you are doing related service, whether you are doing assurance. In all engagements, SQC1 will become applicable. Understood? So, four engagement standards along with the type of engagement you are doing, that specific category of the standard along with SQC1 will become applicable for you. So, these are all the different kinds of standards which are given by the ICA. So now we will try to understand each and every standard. We'll try to pick each and every standard and we'll try to understand it. We'll try to start with 500 series. We'll try to start in that also. I say 501. 500 we have already covered. 500 is a general standard talking about audit evidence. Now specific standards also we have one by one. We'll try to cover it. So just give me a minute. We'll have to take the help of some charts and all. Just 1 minute. So we'll start with the SA 501. So what does SA 501 talk about? So SA 501 title as you could see here. So what is the title saying? Audit evidence specific concentrations for selected items. So SA 501 is also a standard which is going to talk about audit evidence only, but the difference between 500 and 501 is 500 is a general standard talking about audit evidence in general. Whereas SA 501, it has picked up three areas. Three areas the standard has selected. So in that three areas, what special things you have to keep in mind and how to obtain evidence regarding the three selected areas, that's what this standard is going to talk about. And what are the three areas which have been selected? Number one, existence and condition of inventory, completeness of litigations and claims, and presentation of segment information. Sir, why only these three? I don't have answer. So why only this? I don't have an answer. I say felt or see actually this is also not created by I say on their own. We have an international standard on auditing I say 501. In that they have given the guidance. Same thing we have adopted. So we have adopted it. So why these three are only selected? Maybe there could be any number of reasons that the person who has drafted he might have a number of reasons. So they have selected these three areas, and for these three areas, what special things you have to keep in mind in order to obtain audit evidence? That's what this standard is going to talk about. So we'll pick area one by one and we'll try to discuss it. First one, what special considerations you have to keep in mind while obtaining audit evidence regarding existence and condition of inventory? So they are asking you to obtain evidence regarding two things. What are they? Obtain evidence regarding existence also and condition also. So what is this existence and what is this condition is? See, existence is something. So, or let me put it this way: if you have to value inventory, how the inventory valuation will be done? Closing stock quantity. So you have to determine as on 31st of March what is the quantity of the stock. Per unit, what is the cost or NRV? You have to determine whichever is lower that you have to multiply. That's how we value the stock. So we determine what is the quantity of the stock as on the balance sheet date, and we multiply per unit what is the cost or NRV. So whichever is lower will determine that number of quantity with whichever is lower cost or NRV. If you multiply it, you will get the total closing stock value. So when I say you have to obtain evidence regarding existence, existence means they are asking you to check the existence of the stock, existence of the quantity. So whatever quantity that has been used in the valuation of the closing stock, whether that much quantity is existing with the company as on balance sheet date. And condition, obtaining evidence regarding condition. Why they are asking you to obtain evidence regarding condition is because condition is something which will determine the NRV of the stock. Cost you can find it from the books of accounts, not a trouble. But NRV is something which will depend on the condition of the stock. Very simple. Very layman example I will tell you. Just take the fruits and vegetables. The day they are brought to the market, they are very fresh and they are brought to the market. The price will be high. So 1 day passes, the sale price will get reduced. 2 days passes, the sale price will get even reduced. So here that sale price is nothing but NRV. That NRV, the influential factor of the NRV is condition. Right. So by asking you to obtain evidence regarding existence, they're asking you to get the evidence regarding the existence of the quantity of the stock which has been used for valuation. By obtaining evidence regarding condition, they're asking you to obtain evidence regarding the NRV. If you are able to master that too, if you are able to get comfortable with that too, automatically stock value will also be correct. So you have to obtain evidence regarding existence and condition of the stock. How are you going to do it? How are you going to do it? What you can do? Physical verification. And this standard also says that management will compulsorily do physical verification. Step by step, we are getting into the standard now. Management will do compulsorily inventory verification. Many managements will do it on the balance sheet date. Many will not do it on. Many will do close to the balance sheet date. Whatever it is, management is required to compulsorily do their stock verification, physical stock verification. Even regarding that, we are required to report on the CARO also. So management will do physical verification of the stock. SA 501 says if you want to obtain evidence regarding existence and condition of the stock, the auditor shall attend the management's inventory counting process. Whenever management is conducting the inventory counting, they will invite you. You have to go and attend that inventory counting process. So what I have to do there by going and attending the inventory counting process? Number one, evaluate the management process. First, try to understand what process management is following for doing the inventory verification. Number two, observe the inventory counting. Take a chair, sit there, and management and the staff will be counting, and you sit and observe. When I say management is counting, management is counting, don't assume that board of directors will be wearing the suit and boot and doing the stock counting. No, the staff will do it. So first you evaluate the management's process for doing the inventory verification. Then sit and observe the management counting. Then you inspect. If you are feeling bored sitting there for a long period of the time, go and inspect. Randomly check the quality of the stock, and even perform test accounts. Even you are feeling more bored, so go to pick some random items. You do the counting. These four steps you are required to do. So management will do physical verification, go and attend that inventory verification, and perform these four steps. What are the four steps? Evaluate the management's counting process, observe the inventory management counting, inspect the inventory, perform the test. One pathetic scenario I will tell you. In one of the examination, the question was tested. MCQ was tested. So as an auditor, you should attend the management inventory counting process and do what? Four options are there. In every option, 4 points are there. Order was changed. Option A, observe inventory counting, evaluate management process, inspect the inventory counting, perform test count. Option B, perform test count, inspect the inventory, observe the management counting, evaluate the management process. Option C, evaluate the management process, observe the counting, inspect the inventory, perform the test count. D, some other combination. Order you have to remember. Very pathetic situation. I don't even expect that they have to do in this order here. Why you have to do in this order? First thing, okay, evaluate the management process, observe the inventory counting, okay. Last two, why you have to do it in order? First I will do the test count, then I will do the inspect the inventory. Have I committed any crime? No, right? But unfortunately, I happen to see that question. Not in the exam, in the MTP question I have seen it. Okay, I have seen this in the MTP question. So pathetic situation, sometimes these kind of things happens. Anyhow, that's how this course is making us even stronger mentally. Okay. Right. So whatever it is, so that's how it was tested in one item. So whatever it is, auditor management will do inventory verification. They will invite you. You have to go and attend that inventory verification and do that 4 steps. And if they are doing the inventory counting as on the balance sheet date, on that date, if the stock is matching, well and good. But in case management is doing inventory verification on other than balance sheet date, possible. So everybody will not be doing the inventory counting on the balance sheet date only. So let us say, for example, management is doing the inventory counting on 10th of April, not on 31st of March, 10th of April they are doing. So then also you will go and attend. Then also you will do the same 4 things. But there you need to do one more step. So on the day of doing physical verification, you are doing the physical verification on 10th of April. On the day the stock is matching. On the day the stock is matching. But that is not the stock which will come in the balance sheet. No. So what you should do? You should do backward calculation. So you should take the stock as on 10th of March, add back all the consumption or the sales happened from 1st of April to 10th of April, reduce all the purchases or additions which have been happened from 1st of April to 10th of April, then you will get the reverse stock available on 31st of March, and this you will calculate. But whatever additions and deletions you are doing, the transactions, intervening transactions between the date of counting and the date of balance sheet, whether they are genuine or not, that also you have to verify. In case if the physical verification is happening on other than the balance sheet date. So whatever it is, management will do physical verification either on the balance sheet date or other than the balance sheet date. As an auditor, you are required to go and attend that inventory verification and perform the 4 steps. Sometimes what will happen is management will do physical verification. They will invite you, but because of some reason you are unable to attend that inventory counting process. Possible? Yes, quite possible. So if you are unable to attend that inventory counting process, then what you should do? The standard has told, since you are unable to attend the management counting process, you should go and do the inventory verification on your own on some alternative data. Not on 100% basis, at least on a test check basis. You go on a random day. Management did the verification, they invited you, you are unable to attend. So you plan your physical verification on some alternative day on your own. You take your staff, go for physical verification, and at least try to count a few things on sampling basis. And there also intervening transactions you have to verify, because you are verifying on other date, the date, the stock, the transactions between the date of the balance sheet and the date of counting, that reconciliation properly you have to do it. Sir, management did the inventory counting. They invited, I did not go. I thought I will go later. But that has become highly impracticable, sir. That has become what? Highly impracticable. Physical verification, I am unable to attend, sir. It has become highly impracticable, sir. What I will do? First of all, what is the meaning of impracticability? What is the meaning of impracticability? The warehouse where the stock is kept is 50 kilometers away. I have to travel for 3 hours to reach that location. Can it be a reason for impracticability? No. Difficulty of time and cost cannot be considered as a reason for impracticability. When I say impracticability, that should have happened because of circumstances beyond the control of the auditor. Like, for example, the place where the stock has been kept, there severe floods are there. The place where the stock has been kept, the social riots are happening. The place where the place where that things are kept, let us say, for example, you are conducting audit of a pharmaceutical company. That stock is chemical. That chemicals are kept at such a place where human exposure is not possible. You can't go there. So these are the reasons for impracticability. So if you are unable to attend the management inventory counting process and you thought of doing the physical counting on your own, but that verification has become highly impracticable, then what you should do? Then what you should do? Try to perform alternative audit procedures. What the standard says, perform alternative audit procedures. Sir, what could be alternative audit procedure? Your headache. We don't bother. Your headache. Try to think of any alternative audit procedure which you can perform, which will give you audit evidence regarding existence and condition of stock. Sir, I will fly a drone and see, sir. Do it. Acceptable. If you feel from that you are going to get the evidence, yes, you can do it. Where I got this idea, you can fly a drone and see the stock. This is given in CA final material. In the CA final, there is one concept called, there will be one chapter called digital audit. There they will tell you how to use the emerging technologies. What could be the possibility of using the emerging technologies in audit? So there from there I have borrowed the idea. So in case if you are one of the alternative audit procedure could be fly a drone. Sir, fly a drone, I will fly a drone, but I want to know which item it is. Ask the management to attach a barcode or QR code. My drone will fly, scan the QR code or barcode. I will get to know what item it is. Good thing, no? Yes, this is the exact example. How to use a drone technology for audit. This example, they have given it in the CA final digital audit chapter. So yes, this also could be alternative audit procedure. Or even you can do document, you can do subsequent sales verification. Then what happened here once again? Subsequent sales verification in the sense, as on 31st of March, what quantity of stock is there? To know that you can verify subsequent sales. Let us say management is saying 1000 quantity of stock is there as on the balance sheet date. Now, I am unable to perform physical verification, but I am able to find that on 5th of April, they have made the sale of 900 quantity. From 1st April to 5th of April, no single purchase is there, but still they are able to sell 900 quantity means this is providing evidence that stock was already existing as on 31st of March. So whatever alternative audit procedure you can think of, try to perform all that alternative audit procedures, sir. Sir, I'm unable to find any alternative audit procedure. If I tried alternative audit procedure also, but that is not giving me the audit evidence, sir. Either I'm unable to think of any alternative audit procedure, but I tried to perform some alternative audit procedure, but that is also not working, sir. Then what I should do? Modify the opinion. Last resort, modify the opinion. Which kind of modification? Which kind of modification? Either a qualified or disclaim. Either a qualified or disclaim. Anyone, depending on whether the possible effect being material or material and pervasive. If the inventory is only material but not pervasive, qualified. If it is material and also pervasive, disclaim. Good. So this is what. And one more point they will say regarding existence and condition of inventory. Sometimes your client might be the owner of the stock. That stock is recorded in the books also, but your client might not be having the possession of the stock. Your client might not be having the custody of the stock. Stock might be lying in the custody of a third party. Stock might be lying in the possession of a third party. Possible? When it is possible? Goods is sent on consignment. Goods is sent on job work basis. In those circumstances, even though the stock is recorded in your client's book, but the stock might be lying in the custody of a third party. If that is material, are you required to obtain evidence regarding that also? Yes, you are required to obtain evidence regarding that also. How, sir? First option, external confirmation. Try to get the external confirmation. If it is reliable, well and good. But sometimes external confirmation alone will not be reliable. When, sir? When external confirmation also will not be reliable. When that third party in whose possession the stock is there, if he is not an independent person, if he is a related party of your client, then external confirmation also will not be reliable. Perform additional procedures. What additional procedures? If possible, go to that premises and you verify the stock there. If you are unable to attend, arrange for another auditor. Check the correspondence, check the communication which has happened between them. Periodical report sending and all will happen, no? So that also you can do it. So try to perform this additional procedures when external confirmations are not reliable. If the external confirmations are reliable, well and good. If they are not reliable, try to do this additional procedures also. Clear? Understood? So this is what procedures you need to perform regarding to obtain evidence regarding existence and condition of inventory. Second item, how to obtain evidence regarding completeness of litigations and claims. See, completeness, that means all litigations and claims must have been disclosed in the financial statements. As I've already told you, when there is a litigation and claim, either it will be shown as a contingent liability or it will be shown as a provision. Somehow this litigations and claims compulsorily should come in the balance sheet or financial statements. Now, how you will try to obtain audit evidence whether completeness of litigations and claims are there or not. That means whether the management has included in the financial statements all the litigations and claims or have they hidden something. You want to obtain audit evidence. How, sir? Say 501 says one procedure. First, identify whether there is any risk of material misstatement regarding completeness of litigations and claims. They are not asking you to directly go and attack. They are not asking you directly go and find out the misstatement. No. They're asking you to find out whether there is any risk of material misstatement. Is there any chance of hiding some litigations and claims in the financial statements? Identify the risk of material misstatement regarding the litigations and claims. How, sir? By doing 3 simple steps. Even they're telling you procedures also. How to identify the risk of material misstatement also. They are saying how Three things. Number one, inquire with the management and the in-house legal counsel. Go and inquire with the management. So did you completely include all the litigations? If there is an in-house legal counsel, in-house legal department is there, go and ask them, inquire, go and make the inquiries with them. Number two, reading the minutes of those charged with garnets. Check the minutes of those charged with garnets, especially whether any communication has happened with external legal counsel. Externally, have they appointed any lawyers in the meetings? So read the minutes of those charged with garnets. Third one, review legal expenses. Check the legal expenses account. What is the legal expense of the current year? What is the legal expense of the previous year? So do these three simple steps. What are the three simple steps? Inquire with the management and in-house legal counsel, reading the minutes of those charged with garnets and checking the correspondence with external legal counsel, reviewing the legal expenses account. By doing the three steps, you identify whether there is any risk of material misstatement. Is there any chance of some litigations and claims being hidden? Two outcomes could be possible. What are they? There is a risk of material misstatement or there is no risk of material misstatement. There is no risk of material misstatement. Let us say no suspicion, nothing, everything is perfectly fine. Stop. Stop. Just to perform that three steps of risk of identifying risk of material misstatement, stop it there if there is no risk of material misstatement. What if there is a risk of material misstatement? What if there is a risk of material misstatement? You find a suspicion, yes, something is wrong. There could be a chance, some litigations and claims could be hidden. Then what you will do? So if there is any risk, if you find a risk of material misstatement, then what you should do? Then you have to perform further procedures. What further procedures? You have to obtain the evidence by communicating with entities, external legal counsel. What you should do? You should communicate with entities, external legal counsel. Company would have appointed external legal counsel to fight the case. So you have to communicate with entities, external legal counsel. Sir, how you will communicate? Will you take a phone and make a call? No. That communication, you have to do it through a letter of inquiry. You have to ask whatever information you have to want, that has to be put in a letter of inquiry. But there is a problem. You don't know whom to communicate. How to communicate, in which manner if I communicate I will get the response. You don't know. Why? Because external legal counsel was not appointed by auditor, it was appointed by management. You will not know to whom to address, how to send, where to send. But who will know this? Management. So you ask the letter of inquiry to be prepared by management, sent by auditor. Ask the management to prepare the letter of inquiry. As an auditor, you should send it, and after sending that letter of inquiry, you should ask the entity's external legal counsel to respond back directly to whom? Not to the management, but respond back directly to me. So if you find risk of material misstatement in the area of litigations and claims, you have to communicate with entity's external legal counsel through a letter of inquiry prepared by management, sent by auditor, asking the entity's external legal counsel to respond back directly to auditor. If everything goes smooth, well and good. But problems come. What problems will come? Number one, management is not permitting you to send a letter of inquiry. Problem number two, management permitted you to send the letter of inquiry, but the entity's external legal counsel is not responding. Problem number three, management permitted you to send the letter of inquiry, but the entity's external legal counsel is prohibited from responding. Like the way we have confidentiality requirements, they will also have confidentiality requirements. It's prohibited from responding. Three things here. Three things can happen. Come on, tell me. Either management did not allow you to send the entity's letter of inquiry, or management allowed, external legal counsel did not respond, or he is prohibited from responding. Any of these things could happen? Yes. Then what you should do? Alternative audit procedures. So what could be alternative audit procedures? You look into it. If alternative audit procedures are also not possible, modify the opinion. Which kind of modification? Either a qualified or disclaimer, depending on materiality and pervasiveness. Perfect till here? Next. Coming to the next point. Sometimes, as an auditor, you might feel that just communicating with letter of inquiry alone will not be enough. Sometimes, as an auditor, you might feel that the communication with letter of inquiry alone will not be enough. You might find the urge to go and meet directly with the entity's external legal counsel. Possible. So generally, the standard has told you to inquire with the letter of inquiry. But sometimes you might feel that just communicating through the letter of inquiry alone will not be enough. You might feel the need to go and speak with the entity's external legal counsel directly. Possible or not? Yes. In which circumstances that need might arise? In which circumstances that need might arise? So they say 3 points: when you feel that the matter is a significant risk, or when you feel that matter is very complex, or there is a disagreement between engaged management and the entity's external legal counsel. That means you got a response. But what management was saying, what entity sectional legal counsel was saying, they are in disagreement. Then also you might go and personally meet with the entity sectional legal counsel. So in three circumstances, you might feel it necessary to go and meet the entity sectional legal counsel. So what are they? Number one, when the matter is a significant risk, when it is very complex, and also when there is a disagreement between the management and entity sectional legal counsel. Clear? Understood? And one more point here. In addition to that, see, entity sectional legal counsel will not be free. Will not be free. He will be busy, no? So he will not be free like us. So when I say corporate client, corporate lawyers will be very popular lawyers. They will have a huge client base and all. Do you think if you ask them general letter of inquiry, will they respond? So if you say them, hey, I'm an auditor of such a company, I got to know that you are the external legal counsel. I want this information. I want about this case. I want to know. Please respond. Do you think will they respond? They will not even care. So when you feel that general inquiry letter will not give you any response. If you want to increase the chances of response, you have to send a letter of specific inquiry. You have to send a letter of specific inquiry. Be specific in your inquiry. Then you will get the response. Sir, in that letter of specific inquiry, what information I have to ask? How I have to draft that letter of specific inquiry? You told that general inquiry will not get response. You told me to send the letter of specific inquiry. Tell me how to draft that specific inquiry letter also. The standard has to. What the standard has told you is number one, make a list of all, you write a letter of inquiry. In that, first include list of all the litigations and claims which you got to know. Then, where available, management's assessment of the outcome of each of the identified litigations and claims and its estimate of financial implications. Against each litigation, what assessment management has done and what is the financial implication? Have they created provision? Have they created contingent liability? What amount they are showing against each litigation? And also a request that entity's external legal counsel confirm the reasonableness of management's assessment. I gave the external legal counsel litigation, and in that litigation, what is the management's assessment? Now I am asking the entity's external legal counsel to comment whatever assessment management has made. Management has created a provision for 50 crores against one case law. Is it reasonable? Has the management created correct provision or under provisioning they have done, or they have done over provisioning? Three simple things. That's all. If you draft the letter of inquiry like this, the chances of responses will be higher. So what you will include in the letter of specific inquiry? Number one, list of all the litigations. Against each litigation, what is the assessment management has done and its financial implications, and a request that entity sectional legal counsel should comment on reasonableness of the management's assessment. So if you draft that letter of specific inquiry, the chances of responses are much higher. Understood? In addition to all that, even you should request the written representations from the management. A written confirmation from the management also you have to ask, so that they have disclosed all the litigations to you, and also they have disclosed all the litigations and claims as per the accounting standards, as per the applicable financial reporting framework. They have done it. So ask the management to give a written confirmation. Understood? So two areas we have covered. Third item, which SF 501 will talk about. What is it? Segment reporting. So as we all are aware, some companies, especially while preparing the consolidated financial statements, they are required to do the segment reporting in a separate note. So you have already read it in your accounting standards, how to identify the segments, primary segments, secondary segments, like that. You have to identify the segments. Now you need to perform some procedures regarding segment reporting. Whether segment reporting has been done properly or not, you need to obtain sufficient and appropriate audit evidence. How to do it? Very simple. Here the things are very easy, not at all complicated. So what simply they try to say here is the auditor shall obtain sufficient and appropriate audit evidence regarding how we can obtain that evidences. First you have to understand the methods. First you have to understand the methods which are used by the management in doing segment reporting. What methods they are following. So when I say methods, what exactly you have to understand? Like how the sales transfer and charges between the segments are getting eliminated. Inter-segment transactions, what treatment they are doing for inter-segment transactions. And segment-wise, you can compare with the budgets. For each segment, they will have budget also. This year, this much budgeted revenue from this particular segment. Compare it with the budgets. Allocation of assets among segments. They will have a bunch of assets. How they have allocated that assets among different segments. On what basis they have allocated. And also consistency with the prior period. So whatever segment information they are presenting in the current year, is it consistently applied in the previous year also or not? So consistency in accounting policy with regard to segment reporting. These things you have to understand. So first you understand the methods which are used by the management regarding segment information, particularly the below methods. Thereafter, evaluate whether the methods whatever are used by the management, whether they comply with applicable financial reporting framework. So first you understand the methods used by the management, then you check whether those methods are as per applicable financial reporting framework. It should not be something that accounting standards are saying something else, your management is doing something else. It should not be like that. So check whether they are matching, whether such methods comply with the applicable financial reporting framework. Simply, if I have to put it, that's what you are required to do with regard to the presentation of segment reporting. Understood? Clear? So with this, we have completed SA 501. So now what we will try to do is SA 505 we will try to do, which is going to talk about external confirmation. So let us try to understand what is this external confirmation. So as we have already seen, external confirmation is one of the method for obtaining audit evidence. And how I have defined the external confirmation as, it is the direct written response obtained by the auditor from a third party, confirming party from outside of the entity. If you are getting a confirmation, it should be a direct written response. Oral response will not have any validity as a external confirmation. So a direct written response obtained by the auditor from a third party is going to be called as external confirmation. See, in the external confirmation, two parts will be there. One is auditor sending the confirmation request. First, you are sending the confirmation request. The second thing is getting the response from the other party. See, uh, just the other person voluntarily will not come and disclose the information. First, you have to ask no. So that we call it as confirmation request. You send the request. The other person will respond. Now, this confirmation request, whatever auditor is sending, that could be of two types. For getting the external confirmation, first you send the confirmation request no, as an auditor. So whatever confirmation request which auditor is sending, that could be of two types. So what are they? Positive confirmation request, negative confirmation request. Sir, what is a positive confirmation request? What is a negative confirmation request? See, positive confirmation request refers to such a confirmation request where the auditor expects the third party to respond. Either he agrees or disagrees with the information in the request. You are drafting your confirmation request in such a manner that whereby you are expecting the third party to respond. Either he agrees with the information. That means even if the client agrees with the third party agrees with the information also, oh, I need a response. If he disagrees with the information also, oh, I need a response. So a confirmation request when the auditor expects the third party to respond, either he agrees or disagrees with the information in the request, that we call it as positive confirmation request. On the other hand, if you are sending a confirmation request and you are expecting the third party to respond only when they disagree, you are sending a confirmation request to a third party where you are expecting the third party to respond only when they disagree. So that request we are going to call it as a negative confirmation request. Now, some auditors, what they will do, they will send the confirmation request where they will not ask the other party to confirm. They will ask the information directly from the third party. Like let us say I'm an auditor, I got to know my client is having a data. What I'm doing is I'm sending a confirmation request to him in which I say that, sir, I'm an auditor of so company. I got to know that you are a debtor to my client. Please tell me what is the amount you owe. Please tell me what is the amount you owe. I'm not saying the amount and asking him to confirm. I'm directly asking the information from the third party. This is a what kind of confirmation request? This is also positive. This is also positive. Why? Because in all cases, I'm expecting a response. No. So that's why positive confirmation could mean two things. Either you are asking the third party to respond, either he agrees or disagrees with the information, or even if you are asking information directly from the third party, that is also positive confirmation request only. Next. Which one is more reliable between positive versus negative? Positive confirmation request will be more reliable. Why not negative? Exactly. Sometimes you send a confirmation request, negative, let us say. The third party did not look into it. The third party did not see it. When he did not see it, he will not respond. When he did not respond, what he will consider? The other party would have agreed the information. But that misconception, we will not have it in the case of positive confirmation request. So when we do a comparison between positive confirmation request and negative confirmation request, which one is going to be more reliable? Positive. Does that mean you should not use negative confirmation? No. No. You can use negative confirmation request also, but you have to be a bit careful. Only in a few areas you can use it. Only in a few areas you can use it. Like wherever you find that risk of material misstatement is very, very low, the chance of happening misstatement is very low, and you found evidence that internal controls are working very effectively. amounts are very small and homogeneous, like that in exceptional circumstances only you can make use of negative confirmation request. Mostly we would use the positive confirmation request. Then next definition, exception. So we have a term called exception. Sir, what is the meaning of the term exception, sir? Information which is there in the confirmation request or which is there in the books of accounts. Generally both will be same. Whatever is the books of accounts, that only will confirm. So information which is there in the confirmation request or books of accounts does not match with the response provided by the third party. Whatever information that is contained in the confirmation request and whatever response you have got from the third party, both are not matching. Like you are sending a confirmation to the debtor saying that, sir, I got to know that you are a debtor to my client. The amount outstanding is 10 lakh rupees. Please confirm. But the third party has responded, no, I'm not required to pay 10 lakh rupees. I'm required to pay 8 lakh rupees. So there's a difference between the amount in the confirmation request and the response given by third party. This we call it as what? Exception. Now, does an exception always mean a misstatement? There is a difference between the information in the confirmation request and the response provided by third party. Will you automatically conclude that it is a misstatement? No, it should not be. Why? Because that difference might have come either because of client's mistake or either because of third party's mistake also. The difference could come not just because of your client's mistake. Sometimes a mistake could have happened in the third party from whom you got the response. Then also difference will come. So that's why don't automatically conclude that exception means always a misstatement. No, exception may be because of a misstatement, may not be because of a misstatement. That is something which you have to find it out. So just I wanted you to be aware that when you find an exception, don't immediately jump into the conclusion that it is a misstatement. It need not be the case. Then we have one more thing called non-response. Sir, what is the meaning of the term non-response? Non-response could include two things. Number one, you sent a confirmation request, but it was not delivered. You sent a confirmation request, either positive or negative. You have sent it, but it was not delivered. You got it back. That is a non-response. Or you sent a positive confirmation request. It was delivered also, but it was not responded properly. That is also a non-response. What if you send a negative confirmation request? If it was delivered, but no response was received, is it also a case of non-response? No. It is an implied response. Why? Because if it was delivered and it was not responded, we want response only when it is agreed. So if we didn't get the response, we will assume that he has accepted that information in the communication request. So non-response could mean two cases. You are sending a confirmation request, either positive or negative, but it is undelivered. Or you are sending a positive confirmation request, it was delivered, but you did not get the response. So both will be considered as non-response. Understood? So definitions only we have understood. What is the external confirmation request? What is a positive confirmation request? Negative confirmation request, exception, non-response. Now we will go into the concept. So if you want to get the best possible evidence, if you want to get the best possible evidence from confirmation request, from external confirmation, there should be some control or there are some steps which are involved. So if you want to get the best evidence from the confirmation request, there are 4 steps involved. How many? 4 steps. What are they? Step number 1, determine the information to be confirmed. Nothing but determine for which information you want to use external confirmation procedure. Number 2, select the appropriate confirming party. Select the appropriate confirming party. Number 3, design the confirmation request. You have to design your confirmation request. Finally, send the confirmation request and do the follow-up wherever applicable. Where we will do follow-up, positive or negative. If response is not received within time, we will do a follow-up. For which request we will do follow-up? For positive confirmation request, we will do a follow-up. Negative, we will not do a follow-up. Okay, so 4 steps are involved. So what are the 4 steps? Determine the information to be confirmed, select the appropriate confirming party, design the confirmation request, and then follow up on the request if you don't get the response within time. So first step, selecting the information to be confirmed. So mainly we use external confirmation for what purposes here? Account balances. Amounts we will get to confirm whether asset balance, whether receivable balance is correct or not, whether creditors balance is correct or not, whether bank balance is correct or not. We mainly use it for amounts and balances. But do you think the usage of external confirmation is restricted only to accounts and balances? Can we use it for others also? Yes, we can also use it for qualitative aspects. Yes, mainly it is used for amounts and balances, but the usage of external confirmation need not be restricted only to amounts and balances. We can also use it for other purposes, for qualitative things like existence of terms of the contract. you want to get confirmation regarding the terms of the contract. What is the credit period? What is the interest rate if not paid in time? What is the discount policy? So for that also you can get external confirmation. Whether your client has entered into side agreements for discounts and all, that also you can get external confirmation. Your client is saying your client is having a immobile property. I asked him to show the original documents. My client told that original documents are there with the banker. I want to know whether really banker is holding the original title documents or not. Can I send a confirmation request? Yes. So even though external confirmations are mainly used for amounts and balances, but its use need not be restricted only for amounts and balances. Even you can start using it for other qualitative aspects. So whatever it is, determine the matter regarding which you want to get an external confirmation. Then once you have selected the information for which you want external confirmation, what is the second step? Select the appropriate confirming party, because when you address it to the confirming party properly, then only you will get the response. Even if you get a response also, that response will be reliable only when you get the appropriate confirming party. So deciding confirming party is not that easy. Why? Because see, you got to know that you are conducting audit of one big company. One of the data for your client company is Reliance. Now you have to send a confirmation request to the Reliance. Now, to which email you will send? Will you go to the official website and write the official email address? Response you will not get. So if it is receivable for you, it will be payable for Reliance. You need to know the payable, accounts payable department of the Reliance. They will have a deal. They will have a direct link will be the direct email which will address to the accounts payable team. So to that DL, if you send an email, then only you will get the response. But here I become helpless. I have to take the help of the management. Why? Because I don't know no, what is the email address of their accounts payable department and all. I don't know. That communication will be happening between the client and the Reliance. So for selecting the appropriate confirming party, you have to take the help of the management. You can't do it on your own. So whatever it is, I will select the appropriate confirming party. Third, what is it? Design the confirmation request. Now finally, you have to design your confirmation request. And while designing the confirmation request, various factors you have to consider. Like various factors I have given you here. Risk of material misstatement. If the risk is high, I will go for positive. If the risk is very, very low, then I might think of negative. And one more factor, presentation. So how you are required to present it, whether you will send it in electronic format or you want to send it in a written format. Past experience, use your past experience also. In the past, when you worked with the same client, you might have sent external confirmation. From that, you would have got experience, which a third party will give response, which a third party will not give response. So use your past experience as well. And it depends on the assertion which you are regarding which you are sending the confirmation request. And also method of communication. Once again, oral communication, sorry, not oral, written communication or email communication, WhatsApp communication, what it is. And also management authorization. Now some third parties will be there. What they will say is, if you send the confirmation request, they will read it and they will say why I should believe you as an auditor, and I will give you confirmation. I will give you confirmation. They will take the time, read the mail, and they will respond back to you why I should believe you are an auditor and why I should give you a response. Get the management authorization, then only I will respond. Now I have to go to the management, get their authorization, attach it to the email, then only I will respond it to, then only the third party will respond it back. So in that case, as when you are designing, you need to attach the management authorization also. So consider all these factors. Finally, design your confirmation request. After designing confirmation request, what you will do? Keep it safely in a locker. So what you should do? Send the confirmation request. Now, after you have sent the confirmation request, if it is a positive confirmation request, and if you are not getting the response within time, then what you should do? Do a follow-up request. Do a follow-up request. So if you have a control like this on the external confirmation procedure, you are going to get the best possible evidence from that. Understood? Next. Coming to a few more aspects here. Usage of negative confirmation request. As I have told, negative confirmation request is less reliable. You cannot use it as a sole substantive audit procedure terminology. You cannot use negative confirmation request as sole substantive audit procedure, which means what? You cannot use negative confirmation request as the only substantive audit procedure, especially in those areas where the risk is higher. So you cannot rely on this negative assertion, negative confirmation in as a sole substantive audit procedure. Either use it in combination with other procedures or use positive confirmation request. Don't use negative confirmation request as a sole substantive audit procedure, because it will give you less persuasive evidence, not pervasive. Two different terms. Persuasive, pervasive. Pervasive is a term used in context with misstatement, whereas pervasive is a term used in connection with evidence. Pervasive evidence means convincing evidence. The level of convincingness of the evidence, we call it as pervasive. So the evidence which you get from negative confirmation is less persuasive, is less convincing. So you cannot use negative confirmation request as a sole substantive audit procedure if the risk of material misstatement is high. So then where I can use negative confirmation request as a sole substantive audit procedure, sir? Where I can use negative confirmation request as a sole substantive audit procedure if they are telling you certain instances when all that things are present in those areas, you can use negative confirmation request as a sole substantive audit procedure. Sir, what are that? What are that? Risk of material misstatement is low. Controls are effective, and this I will come to this point later. Small and homogeneous population it is, or no exception. In that area, you generally don't expect the differences. And finally, recipient doesn't disregard the request. You know the third party so well that he will not ignore the request. So you have past experience with that third party. You believe that if you send a confirmation request to the third party, he will definitely see it. If you find something wrong, definitely he will respond it. That means you did not come across any instances where you believe that third party will disregard. You did not come across such circumstances. That means you know the third party so well that if you send the confirmation request, he will definitely look into it, and if he looks into it, definitely he will respond back. So if you have such conviction regarding the third party also, then also you can use negative confirmation request as a sole substantive audit procedures. So these are the areas where you can get the confirmation request, negative confirmation request as a sole substantive audit procedure. Now, going forward, management's refusal to allow the auditor to send a confirmation request. So as an auditor, you want to send a confirmation request. So you are willing to send a confirmation request to the third party. But management says no. Management says, no, sir, don't communicate with don't get the external confirmation. First of all, why we need management's permission? Why we need management's permission? We can directly send it, no. But in 2D, we become helpless. In the second step, we have to select the appropriate confirming party. We have to select the appropriate confirming party. We have to take the help of management. I went to the management and told, sir, I want to communicate with the external confirmation through external confirmation with one of your debtor or creditor. Management told, no, no, sir, don't communicate with the third party. Then what you should do? First, sit with the management, understand the reasons why they are asking you not to communicate. If there is a reasonable justification, so like what could be reasonable justification? Let us say there is a trade payable. Your client is required to pay some amount, okay, but that trade payable, that vendor did not supply you proper stock. So you are challenging. Court case is still going on. So you are challenging, but still you are showing it as a payable in your books of accounts. Now, for this payable, the auditor like this, I can create a scenario here. Whatever example I'm telling you, these are all scenarios which can be created as a case scenario based questions. So now, what auditor is saying is, sir, I want to get a confirmation regarding this payable. But the client comes to you and says, sir, please don't do it. Why? Because anyhow, we are fighting the case. We don't want to pay him. It is under litigation. Now, if you send a confirmation, my client is required to pay this much amount. Please confirm whether it is correct or not. Sir, he will use it as evidence against me, sir. He will use it as evidence against me. See, their auditor itself has told that they are required to pay me this much amount of money. So he will use it as evidence. That's why don't communicate with the intersectional legal counsel. They gave me this reason. Don't blindly believe. Don't blindly believe. Whether whatever reasons they are giving, whether they are genuine or not, try to get the supporting documents. Whether really the case is going on, is it the case, whatever reasons they have told, whether they are genuine or not. So after evaluating the reasons, if you felt that yes, there is a reasonable justification, the management is asking you not to get the external confirmation, but there is a reasonable justification, what you should do? Perform alternative audit procedures. Try to think of any alternative audit procedure and try to obtain evidence. Sir, what if it is also not possible? Alternative audit procedures are also not possible. The standard says communicate with those charged with governance and modify them. Once again, modification, either it could be qualified or disclaimer, because this is a case of non-availability of audit evidence. Coming to the other case. Sir, there is no reasonable justification only. There is no reasonable justification. I want to communicate with the third party, but management is saying no. When I ask them reasons, they don't have any valid reason, sir. No reason they are trying to give it to me, sir. Then what I should do? No reason they are giving me, or they are giving me reason also that is a bullshit reason. What I should do? So in that case, if there is no reasonable justification, the standard says you have to reassess your risk of material misstatement, including the risk of fraud. So why they are saying it is, earlier you thought that management are honest people. You felt that risk as low, but now they have shown their true nature when you want to send the confirmation. So they have shown their true colors now. They are not honest people. So reassess your risk of material misstatement. Reassess the risk of fraud. And accordingly make changes to your audit strategy, audit plan, and make changes to your nature, timing, and extent of audit procedures if necessary. So reassess your risk of material misstatement. And anyhow, we'll do the reassessment of risk of material misstatement. But in addition to that, we will also communicate with those charged with clients, and we even will consider modifying our opinion in this case also. Understood? Clear? So one more last case will be there. What if the okay, this one is over. So one more thing is there that I will explain from the material. This one. Responses to confirmation request are not reliable. Sir, what is this? Responses to confirmation request are not reliable. Which means what? In the previous case, management did not allow you to send the confirmation request. In this case, management allowed you to send the confirmation request. You got the responses also, but responses are not reliable. When you will get that out? When the third party is not independent. So when the third party is not independent, your client can influence a third party and make him give the wrong confirmation. So in case if you felt it is not reliable, and if you got to know that management tried to collaborate with the third party and give you wrong confirmation, here also what you should do, reassess your risk of material misstatement. Here also what you should do, reassess your risk of material misstatement, including the risk of fraud and even considering modifying the opinions also. And one more case, last point they say here, you have to evaluate. You will send the Excel confirmation. You will get the responses. Those responses are nothing but your evidences. Whatever responses you have got, all that responses are required to be analyzed. From that only you will form the conclusion. No. So whatever responses, whatever evidences you have got, those are required to be analyzed. How you will analyze them? They say that when evaluating results of individual external confirmation request, you have to categorize the responses. You send 100 confirmation requests here. For all that you have responses or some are unresponded. Now you have to analyze all that responses. No. So what you do is for all the confirmation requests, you segregate. How you will segregate? Those responses by the appropriate confirming party indicating agreement. Out of 100 confirmation requests, some 60 confirmation requests are there where the information, the confirmation request, response given by the third party, everything is matching. Keep it in one box. Next, a response is deemed unreliable. Some 5 responses are there where you got the responses, but they are not reliable. Why not reliable? Just now, as I have told, the third parties are not independent. Keep it in a separate box. Then, a non-response. You send either confirmation request are undelivered, or it is a positive confirmation request for which you didn't get the response. Just at the beginning only I told what is the meaning of non-response. So 5 non-response cases are there. So whatever that 5 non-responses are there, that you segregated. And finally, a response indicating an exception. That means difference. So 60, 5, 5, 1, 30 are there. In the remaining 30, there are exceptions. Differences are there. Now you analyze that exceptions in a detailed manner and find out whether there is a misstatement or not. Understood? So like this, you have to evaluate the evidence obtained from external confirmation by way of categorizing the responses into different terms. Clear? Understood? Right. So this is what regarding SA 500 and we are getting close to lunchtime. We'll do one thing. We'll discuss some small standard. So we'll do 510 only. So we'll take a little more time if necessary. So we'll complete SA 510. So SA 510 initial audit engagements and opening balance. So this particular standard is talking about two things: initial audit engagements, and then we have something called opening balances. First, let us get familiar with these terms. So, what is the initial audit engagement? Other than recurring audit, something other than recurring audit. Recurring audit we have already defined now. So, what is the recurring audit? If the last year auditor is getting appointed as a current year auditor, it becomes a recurring. Now, opposite of that is initial audit engagement, which says that the audit of the last year, the predecessor auditor, we see it here, initial audit engagement, the engagement in which prior years were unaudited. And last year was not audited. Current year, you are getting appointed as an auditor. Our last year was audited by a predecessor auditor. What do you mean by predecessor auditor? different audit firm, not just a change in the engagement partner. Altogether, different audit firm has done the audit of the preceding year. So initial audit engagements are those engagements where the prior years were either unaudited or they are audited but by a predecessor auditor. That engagements we call them as initial audit engagements. Then we have opening balances. So what are opening balances? Those balances which are there at the beginning of the financial year. These are nothing but last year's closing balances. And they represent two kinds of information. They represent two kinds of information. They represent the effect of the transactions which have taken place in the preceding year. They also reflect accounting policies which are followed in the previous year. So, opening balances convey two kinds of information. They reflect the effect of the transactions which have been followed in the reflect the effect of the transactions which have been happened in the previous year, and also they reflect the effect of accounting policies. What accounting policies are followed in the previous year? And when I say opening balances, don't just look from the balance sheet point of view. Opening balances could be there even in the notes to accounts. Opening balances could be even there in notes to accounts also. How come the last year in the financial statements they have shown in the notes to accounts a contingent liability? That is also a opening balance. Opening balance just doesn't mean only balance sheet item. It includes even the things in the notes to accounts. In the disclosures also opening balances could be there. So whatever it is, we got familiar with the terms used in the coming to the next part. Sir, what this standard is expecting you? What is the objective of the standard? Two objectives are there. Second objective, I will keep it aside. I will come to the first objective. So what is the first objective? As an auditor, we should obtain sufficient and appropriate audit evidence whether opening balances contain a misstatement that could materially affect my current period's financial statements. What is the first objective? You should obtain sufficient and appropriate evidence whether opening balances contain a material misstatement that could affect my current period financial statements. You need to obtain sufficient and appropriate evidence. Quite logical. If you have verified all the current year transactions, in the current year transactions, no material misstatement is there. But if there is a material misstatement in the opening balances, that will automatically affect my current year's balance also. No matter how correctly you account for the current year transactions. So that's why you need to obtain sufficient and appropriate audit evidence regarding the opening balances, whether they contain any material misstatement that could affect my current period financial statements. That is the first objective. And as we all are aware, how we can obtain that audit evidence? How we can obtain that audit evidence? By performing audit procedures. So what audit procedures are required to perform regarding the opening balances? So simply, if I have to summarize it here, you have to read the most recent financial statements. Whatever are the most recent audited financial statements are there, read the copies of the most recent audited financial statements. Check that prior period balances are correctly brought forward. Whether the last year closing balances are correctly brought forward or not. And even any adjustments relating to prior years have been shown as a prior period item. In the current year, if they find anything related to previous year, they should not go and adjust the opening balances. Instead, what they have to do, they have to show it as a prior period item in the current year. So check for any prior period items. And even perform some specific audit procedures. Like what? You can compare the opening trial balance with the last year's audited financial statements. You can read the most recent financial statements. You can get the supporting documents regarding the most recent financial statements. So whatever it is, you perform audit procedures to obtain. You perform these kind of audit procedures to obtain sufficient and appropriate audit evidence regarding the opening balances. There's a few more procedures here. There's a few more procedures here. So this brief I have explained. Apart from that, they say that nature and extent of audit procedures. Will you perform more audit procedures regarding opening balances, or will you perform less procedures regarding opening balances? That depends on various factors. Sir, what are the factors? The accounting policies. It depends on what accounting policies they have followed. It depends on nature of account balances, class of transactions, and the risk of material misstatement. If the risk is high, more procedures you have to perform regarding opening balances. Significance of opening balances. How important that opening balances are. If opening balances are very big figures, then you have to perform more audit procedures. And whether prior period financial statements were audited, and if so, whether previous auditor gave a modified opinion. Last year audit has happened, but the last year auditor gave a modified opinion. Then you have to be very careful when you are verifying the opening balances. More procedures you have to perform because the last year audit report contained a modified opinion. Then, so what procedures you have to perform regarding current assets and current liabilities? So when you are checking the opening balances of current assets and current liabilities, what audit procedures you have to perform? So they say that when it comes to current assets and current liabilities, some audit evidence regarding opening balances may be obtained from the current period financial statements. When it comes to current assets and liabilities, some evidence regarding opening balances, you can get it from the current year audit. Inventory, best example. So they have shown inventory as some quantity as on the balance sheet. But when you are verifying the sales of this year, that sale is automatically giving evidence regarding opening balance or not. So like that, when it comes to current assets and liabilities, some evidence you can get it by verifying the current period transactions. Especially in the case of inventories, current audit procedures on the closing inventory balance provide little evidence regarding inventory on hand at the beginning of the period. If you are doing inventory verification of the closing stock, that will not give you evidence regarding opening balance. You will do closing stock physical verification, no? Physical verification of closing stock will not give opening balance regarding, will not give audit evidence regarding opening stock. So that's why what you should do. Therefore, additional audit procedures may be necessary, and one or more of the following may provide evidence regarding opening balances. What are they? Observing a current physical inventory count and reconciling it to the opening quantities. So what one thing you can do, you do the current year closing stock verification. From that you do the reconciliation. Add back all the sales, reduce all the purchases, then you will get the stock. That you match it with the opening stock. That is one way for getting evidence regarding opening balance of inventory. Or perform audit procedures on the valuation of opening inventory items. So you get the opening stock valuation only, try to perform audit procedures on that directly. Or even perform audit procedures on gross profit ratios and cut off nothing but some analytical procedures also you can perform. Gross profit ratios and all you can compare. So like that, these kind of audit procedures you can perform, especially the current assets and liabilities to obtain audit evidence regarding their opening balances. For non-current assets and liabilities, we will not get much from the current year data. But what they say is for property, plant and equipment, investments and long term, what is the only thing which we can do is we can examine the supporting documents. For non-current assets and liabilities, like let us say for example, PPA opening balance is there. How will get to know whether that opening balance is correct or not? So you have to get the original title documents, or you have to go and see that invoices regarding plant and machinery. From that, you can get the evidence. In certain cases, auditor may be able to obtain some evidence regarding opening balances through confirmation. Even you can use external confirmations also for non-current assets and liabilities. So whatever it is, all these audit procedures you will perform here. By performing all these audit procedures, you will have your findings. You will have your findings. What could be the possible findings? Number one, opening balances do not contain any material misstatement. Will it have any impact on my current year opinion? You will give a modified opinion. Second case, you found out that you obtained sufficient and appropriate audit evidence, and you concluded that opening balances contain a material misstatement. You obtained evidence. Then what you should do? Modified opinion. Which modification? Either qualified or adverse, because it is a case of availability of audit evidence. If the effect is only material, qualified, material and pervasive, adverse. Third scenario which could be possible. You are unable to obtain sufficient and appropriate audit evidence regarding opening balances. Could be possible? Yes. What kind of opinion? Either qualified or disclaimer, depending on whether the possible effect being material or material and pervasive. Understood? Right. Only one objective we are done. The second objective, I have kept it on hold. Second objective, I did not explain. I told you in the beginning, second objective will come back to that later. So what is that second objective? So this second objective is once again related to opening balances only. I told opening balances will reflect two kinds of information. It will reflect the effect of transactions happened in the previous year. Second one, accounting policies. When it comes to accounting policies, we have the associated fundamental accounting assumption. What is that? Consistency. So automatically, along with the opening balances verification, you need to obtain sufficient and appropriate audit evidence whether whether accounting policies are consistently applied. Without any valid reason, accounting policy should not be changed. Sometimes, because of genuine reasons, you can change the accounting policy, but in that case, you are required to give a proper disclosure. Two things I'm saying. So, number one, whether the accounting policies are consistently applied. That means, without any valid reason, there should not be a change in accounting policy, just like that. If at all there is a valid reason for change in the accounting policy, that should have been properly disclosed. There are no many disclosures which are required if there is a change in accounting policy. So you need to obtain sufficient and appropriate evidence regarding this too. Whether there is a consistent application of accounting policy, or if there is a valid reason for change in the accounting policy, whether that proper disclosures have been given or not. Okay, so that is the second objective. So to obtain sufficient and appropriate audit evidence, whether accounting policies reflected in the opening balances have been consistently applied, or if there are any changes, they have been properly disclosed. When there is a valid reason, if there's a valid reason, genuine reason, that's why they have changed the accounting policy, proper disclosure has been given or not. Okay, you will perform audit procedures regarding accounting policies and what impact it could have on the opinion. So after you have performed audit procedures, you might come across two instances. Number one, accounting policies are consistently applied. There is no change in the accounting policy. If at all there is a change, also proper disclosure has been given. Unmodified opinion. Other scenario which could be possible is you have obtained sufficient and appropriate audit evidence and you concluded that either opening policy or accounting policies are not consistently applied. That means without any valid reason they are changing the accounting policy. Or there is a valid reason for changing the accounting policy but that was not disclosed properly. This could be possible. You have obtained sufficient and appropriate audit evidence. You concluded that consistency is not there. That means accounting policies are not consistently applied. Or you obtain sufficient and appropriate audit evidence that there is a valid reason, there is a change in the accounting policy, but it was not disclosed properly. Then what you will do? Modify. Which kind of modification? Either a qualified or adverse opinion you will give because you have evidence. Third situation not possible here. For opening balances, we told three situations. You found everything is correct, you are able to obtain evidence, you are unable to obtain evidence. But for accounting policies, only two. You are able to obtain evidence, you are able to obtain evidence, everything is correct, you are able to obtain evidence that something is wrong. There is no situation of non-availability of audit evidence. There should not be a scenario regarding accounting policies where you will say that I am unable to obtain audit evidence regarding opening balances. You cannot say because you are an expert. You are an expert in the area of accounts and audit. You cannot say I am unable to perform audit procedures to determine the consistency of accounting policies. You cannot say that. You don't deserve to say that because it is a fundamental accounting assumption. You are an auditor's expert. You have to arrive at some conclusion. So that's why the typical third scenario is not. Only one case, if it is everything is okay, well and good, or if you obtained evidence that accounting policy is not consistently applied, or there is a valid reason but change is not properly disclosed, then you have to give either qualified or adverse opinion. Finally, one more last paragraph. Sir, if the predecessor auditor, last year auditor, if he has given a modified opinion in the previous year's audit report, is the current year auditor also under an obligation to compulsorily give a modified opinion? If that is the case, no. Once the company gets a modified opinion, never ever in its life cycle it will get a modified opinion, unmodified opinion. But if the last year, if the predecessor auditor's report contained modified opinion, the current year auditor also will give modified when the reason because of which last year auditor has given the modified opinion, it remains relevant, uncorrected, material in the current year, then only he will give the modified. If the reason because of which last year auditor gave the modified opinion, if it's no longer relevant, no longer material for the current year, then he will not give the modified opinion. Okay, so just because last year auditor contains a modified opinion, there is no requirement on the current year's auditor also to compulsorily give a modified opinion. That's all. 510 also we have completed. So three standards we have done: 501, 505, 510. So remaining we'll do it post lunch. Okay. So since we have completed before the break, these are standards from the 500 series: 501, 505, and 510. So now what we'll try to do is 520 is talking about audit sampling. Anyhow, we have a dedicated chapter talking about it. 520 analytical procedures, 530 audit sampling. We have a dedicated chapters for that. So that we'll discuss it at that point of time. So now what we will try to do is I say 550 we will try to do, which is talking about related party transactions. See, whenever we have a related party transaction, regarding related party transactions, we have so many accounting requirements, so many dedicated disclosure requirements we have, a dedicated accounting standards we have. And even in the companies act also, they are very specific about related party transactions. So many restrictions, so many reporting requirements. Why all that attention for related party transactions? Because as I have told, in case of transactions with the related parties, the entity will be in a position to influence. So when you are in that position to influence, you can collude and commit some big frauds where identification also is going to become little difficult. So that's why when it comes to related party transactions, there are so many accounting standards which are getting so many disclosure requirements, and even in the company side, we have so many reporting requirements. So similarly, even from the auditing perspective, also related party transactions carry a little bit of higher risk than when compared with the normal transactions. Related party transactions carry higher risk. So that's why even by conducting the audit also, in order to assist the auditor in obtaining sufficient and appropriate audit evidence regarding the related party transactions, we have a dedicated standard for our assistance, which is none other than SA 550. So let us try to understand what is this SA 550 say. First of all, what is the meaning of the term related party? So first, the standard has defined who is a related party. So here standard has played it very safe. In case if there is applicable in case in the applicable financial reporting framework, if the term related party has been defined, take that definition. In the applicable financial reporting framework, which is applicable for your client, in that applicable financial reporting framework, if the term related party has already been defined, follow that definition only. In case if the applicable financial reporting framework does not provide for a definition or it provides a very minimal definition, then we will give you one definition of related party, follow it. So if applicable financial reporting framework is clear about it, follow that definition only. In case if the applicable financial reporting framework does not define the term related party or it provides a very minimal definition, then follow the definition whatever we are giving in the standard. Sir, what is the definition? As you could see here, the person can be considered, the entities can be considered to be related. A person or other entity that has control or significant influence, directly or indirectly through one or more intermediaries over the reporting entity. Reporting entity means client. If someone is having a control or significant influence over your client, then your client and that party, whichever is having influence, both will be considered as related party. Or another entity over which the reporting entity has control or significant influence, or your client is having control or significant influence in another entity, then also they will be considered as related. Either someone is having control over your client, or your client is having control or influence over other, will be considered as related. Or one more thing they say, another entity which is under common control, your client entity and some other entity, you both are under common control. And that common control can come in the form of common controlling ownership. Some common person is controlling the ownership in both of you. Or the common control can come in the form of owners who are close family members. The owners of the two entities are close family members. Or common key management, same board of directors, same decision making authorities. So, like that, in case if the applicable financial reporting framework does not provide the definition of the related party, then this will become applicable. Understood? Then, however, they say one specific point here. In case of entities which are under common control of the state means government here. So generally entities under common control will be considered to be related, no? But in case if the entities are under the common control of state, they will not be considered as related unless they engage in some significant transactions or they share some resources. So in case of entities under common control, they will not be considered as related unless they engage in certain transactions or they share significant resources. Then only they will be considered as related. Then apart from that, sir, what is the meaning of the term control? What is the meaning of the term significant influence? I will tell you in a simple manner. Control means you are able to influence the decision. You are able to influence the decision making. So generally greater than or equal to 51%, where you can take the decisions. Then you will be considered to have a control. So if you see it here, your control means you are having a power to govern, not just to have a say. You will govern whatever you think that you can make it happen in the company. That is called as control. Generally, that control we are going to get it by greater than or equal to 51%. Whereas what is significant influence means you will not be able to govern, but you will be able to participate. You will be able to participate. You will not be able to govern. That means whatever you think that will not happen. But you will have a say. You will have an opportunity to participate in the decision making. Then you will be considered to have a significant influence. So generally here greater than 20%. Significant influence can be exercised if it is greater than 20% equity shareholding. So significant influence is the power to participate. I hope you are able to identify the difference here. In control, there is a power, whereas in the significant influence, there is only participation. You cannot govern that. And the existence of the following relationships may indicate the presence of related parties, presence of control or significant influence. So how you will get to know whether there is a control or significant influence? There are some indications. All this we already know it. Direct or indirect equity holdings, share holdings you are having, or entities holding of direct and indirect equity or other financial interest in other entities. Someone is holding the shares in your entity, or you are holding shares in some other entities, or being part of those charged with governance or key management, so common management, something like that, or being a close family member. By that way, also you can exercise control or significant influence, or having a significant business relationship. And in some cases, some related parties will have a dominant influence. Dominant influence. That means wholly owned subsidiaries and all. So in case of wholly owned subsidiaries and all, holding company will have a very much dominant influence. And sometimes they will create some special purpose entities just for names if you learn it and remember it. Sometimes they will create special purpose entities where they will not directly hold the shares. Even though they don't have direct holding, some companies will be serving some purposes. So like that, by way of special vehicles also related parties can be created. So all these are definitions. Now let us come to the main part, nature and nature of related party transactions. See, generally, if the related party transactions are also happening under normal market terms and conditions. If related party transactions are also happening in the usual course of business at the normal market terms and conditions at the arm's length price like a genuine transaction, then they might not carry a higher risk of material misstatement. When related party transactions are also happening in a usual course of business under normal terms and conditions, the prices are also at arm's length price, then they might not carry a higher risk of material misstatement. But especially in some cases, related party transactions will carry a higher risk of material misstatement. So, what are that circumstances in which they will give rise to high risk of material misstatement? Few instances they say here. Number one, when they are operating. So when they give rise to high risk of material misstatement is when they are operating through an extensive and complex range of relationship. When the relationship is existing between related parties, it's not in a simple manner. It's a very complex relationship. Like you have created in between some 10 chain of companies for creating in related parties. Like their company will be there, it's a shareholder will have another partnership firm. That partnership firm will have that partnership will become a wholly owned thing of something else. So like that, if a complex chain of relationship is there, then they might carry high risk of material misstatement. Or information systems may be ineffective. Whatever information systems the client is using, especially whatever accounting softwares the clients are using for reporting the related party information, if those accounting softwares are not that effective, then also they carry a high risk of material misstatement. And then finally, when they are conducted and when they are not conducted under normal market terms and conditions, especially without consideration when the transactions are considered or performed, then they carry a higher risk of material misstatement. So usually they give rise to, they will not have high risk of material misstatement when everything is happening normally. But in some instances, they carry high risk of material misstatement. Three cases they have told when when they operate through a very extensive and complex relationship, and also when the information systems are ineffective, and also when they are not conducted under normal market terms and conditions. Then, understanding the entities related parties. Sir, how we will get to know whether the related parties are there? So if you see it here, the auditor shall inquire. By doing inquiry, you should understand the following things. So what things you have to inquire? Number one, identity of the related entities, related parties. Ask the management to give a list of all the related parties. And also what changes have taken from the prior years. Also ask the last year's related party list, compare it with the current year's related party list, check whether any additions or deletions in that list have happened. And inquire the nature of relationship. Okay, sir, you have given me list of related parties. Tell me the nature of relationship also. Are they subsidiary, associate, joint venture? So, or there is a common control. So, tell me the relationship also. And whether the entity entered into any transactions with these related parties. Sir, you gave me a list. You gave me nature of relationship. Also, tell me with any of these related parties have you entered into transactions? If yes, what type of transaction you have entered and what is the purpose of the transaction? So these are the things which are required to specifically inquire. Next. In addition to that, the auditor shall also inquire of the management and others within the entity and perform other risk assessment procedures to obtain an understanding of the controls. First, you got the list of related parties and what kind of transactions. Then you should also inquire them what kind of internal controls management has implemented regarding related parties. Like what kind of internal controls the management has implemented, trying to obtain understanding of the controls that management has established to identify, account for, and disclose the related party relationships and transactions. To identify the related parties, to account for the related parties, to disclose the related parties, what kind of internal controls management has implemented. Authorize and approve the significant transactions and arrangements with related parties. So just like that, related party transaction should not happen. If the company has to enter into related party transaction, there should be approval. What kind of controls they have to make sure that each and every transaction with the related party is getting authorized. And also authorize and approve business transactions arrangements which are outside the normal course of business, which are beyond the normal course of business. If any transactions have happened, to authorize them, to approve them, what kind of controls you should have. Simple paragraph. As an auditor, you are required to inquire the management regarding the related party relationships and transactions, and also what kind of controls management has implemented in the area of related party transactions. Thereafter, considerations specific to smaller entity. This point is this paragraph repeatedly you see it at various places, especially in internal controls also. See, in small organizations, there will be no proper structure of internal control system. There will be no segregation of duties also. Duties will not be segregated because you will not find large number of people where duties will be segregated. So in small organizations, the owner manager himself will operate the business, and also there is no proper segregation of duties. See, when the owner manager himself is managing the business, there is a positive side also, there is a negative side. So what is a positive side is, since owner manager is having control over entire business, he will not let anything wrong happen. But other side is, since owner manager himself is managing the business, there is no one to control him. He can do the transactions in whatever manner he wants. He can engage in related party transactions also. He can override the controls also. No one is there to stop him. So that's why whenever you are conducting audit of a small entity, please do consider that the risk arising from related party transactions will be much higher because the owner manager himself is controlling it and there is no proper segregation of duties. That's what the whole summary of this paragraph they will try to say it here. Then coming to the part, how the auditor can verify existence of related party. How as an auditor you will get to know whether related party transactions are there or not, whether related parties are there or not, how you can verify. You have to inspect certain documents. What you should do, you have to inspect some documents. See, inquiries we have seen, what things you have to inquire. Now they are telling that if you want to verify the existence of the related party, you have to inspect certain documents. So what things you are required to inspect? Let us see. The auditor may inspect the following records and documents that may provide information about related party transactions. What are they? Income tax returns. Try to verify their income tax returns. They are the auditor. Tax auditors will report the related party relationships. Information supplied by the entity to regulatory authorities like SEBI, MCA portals. They will submit the information. Try to check that information. Shareholders register to identify the entity's principal shareholders. Check the shareholder register. Who is having significant shareholding in your client company? You will get to know. Statements of conflict of interest from management and those charged with governance. In case if the directors are not to participate in a decision where they have an interest, so they will submit something called statement of conflict of interest. So get that statements of conflict of interest. From that you can get to know who and all are the related parties. Records of entities investment. Check their investment register where they are investing the money. By that way you can get to know their subsidiary, associate, joint ventures. Contracts and agreements with the key management or those charged with governance. What kind of contracts they have entered into. Significant contracts and agreements in the entities or not in the ordinary course of business. Especially check the contracts or agreements which are not in the course of business. Specific invoices and correspondence from entities, professional advisors. Have they got any professional legal advice regarding related party transactions? Check that. Life insurance policies, on whose name the companies are taking the life insurance policies. And significant contracts renegotiated. Generally, once a contract is finalized, it will not be renegotiated. If they are renegotiating it, mostly it will be with the related party transaction. So check the transactions contracts renegotiated, and even go through internal audit reports to see whether they have commented anything regarding related party transactions, and even documents associated with entities filings with the securities regulator like SEBI and all. Check those filings also. So if you inspect all these documents, you will be able to verify the existence of a related party relationship and also a related party transaction. Clear? That's all. So this is what regarding SA 550.